Welcome to CPA Ready, comprehensive review materials for the computer-based CPA exam that lets you customize your own review program to meet your individual learning style and ensure your success. Thank you for selecting this hotspot video, which contains a targeted, intensive review of the specified topic area. We hope you find this video to be an effective tool in your CPA exam preparation. Bisk Education.
Hello, and welcome to the Bisk CPA Review's coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette, and I'll be your instructor for this class. And in this class, we're going to be discussing a very important topic, a very heavily tested topic, and that is how a corporation accounts for income taxes. Before we begin the class, I want to say just a couple of words on the way to get the most from this class. The big thing to remember is that you have to avoid just sitting back passively and watching the video. The key to getting the most from this class is to treat this video like a normal class. Be active. Take good notes. When we get to problems, shut the video down, do the problem, get your answer before you come back and go through the problem with me. I think you'll find if you do those things, you'll get much more out of this class, and of course that's what we both want. So with that in mind, let's get into our topic, which again is how a corporation accounts for income taxes. And the basic challenge is this. When a corporation gets to year end and they go to put down their journal entry to record income taxes, the basic problem is that there are differences. There are differences between the income that the company's reported on their income statement and the income the company has reported on their tax return. And as you probably know, these differences between what the corporation reports on their income statement and what the corporation reports on their tax return falls into two categories. There are temporary differences and there are permanent differences. That's all there are. It's either going to be a temporary difference or it's going to be a permanent difference. We're going to begin with temporary differences. And the first thing I want to establish is this. What causes temporary differences? Let's be clear on this. Just remember, what causes all temporary differences, all of them, is this situation. The corporation is using one method of accounting on their books and another method of accounting on their tax return. That's what causes all temporary differences. Anytime a corporation is using one method of accounting on their books and another method of accounting on their tax return. As I say, that's what causes all temporary differences. Now stay with me. When a corporation is using one method of accounting on their books and another method of accounting on their tax return, that results in two types of temporary differences. I want you to know there are only two types of temporary differences. Let's go over them. Type 1. A type 1 temporary difference would be this. There are revenue or expense items that belong on the income statement now. GAAP says you must report these items now, but they won't be on your tax return until later. That's type 1, revenue or expense items that belong on the income statement now, but won't be on the tax return until later. Type 2. The second type of temporary difference, and I know you're ahead of me, would be the exact opposite. There are revenue and expense items that belong on the tax return now, but won't be on the income statement until later. And I want you to know that's all there is. It's either revenue or expense items that belong on the income statement now, won't be on the tax return till later, or the opposite, type 2. Revenue or expense items that belong on the tax return now, won't be on the income statement until later. Now, what I want to do next is go through some examples of each type. And I'll tell you that the good thing about the CPA exam is that the same temporary differences are in the exam again and again and again. There are some ones they really like. And one thing we want to accomplish in this class is make sure you're comfortable with the common temporary differences you see most often in the exam. So let's go back to type 1. I said that the first type of temporary difference would be revenue or expense items that belong on the income statement now. GAAP says you must report these items now, but they won't be on your tax return until later. So let's start with, we'll put down a column for books now and a column for tax later. Let's start with revenue or profit. How is it possible to have revenue or profit on the income statement now? In other words, GAAP says you have to report this item now, but it's not going to be on your tax return until later. Well, a great example of that would be a company that's involved with installment sales. Let's say we have a corporation that makes lots of installment sales. On their books, they're just using normal accrual accounting, nothing fancy. So notice under books now, we put accrual. Just on their books, they're using normal accrual accounting. But notice on their tax return, they're using the installment sales method of accounting. Now just think what's going to happen to this company. This company goes out and makes a sale. When would all the profit from that sale be on their income statement? Right away. Remember, they're not doing anything fancy on their income statement, just normal accrual accounting. So if they go out and they make a sale, all the profit from that sale will be on their income statement on their books right away. But because on their tax return, they're using the installment sales method of accounting, on their tax return, they're going to defer the recognition of profit until the installments come in, until the payments are received. So I hope you see that the way I do. Isn't that an example of how a corporation could have profit on their income statement now, but it's not going to be on their tax return until later when the installments come in, when the payments are received? Now listen very carefully. The exam would refer to this as an FTA. This is a future taxable amount. That's how the exam would refer to this example. This is an FTA. This is a future taxable amount. Doesn't that phrase make sense? Because won't the corporation be taxed in the future when the installments come in? That's a future taxable amount. Let's stay on profit. What would be another way that a corporation could have revenue or profit on the income statement now, but it's not going to be on the tax return till later? Well, let's say a corporation is involved with long-term construction contracts. On their books, they're using the percentage of completion method. But on their tax return, they're using the completed contract method. Now let's think what's going to happen here. Let's say this corporation starts a 5-year project. They get to the end of year 1, they estimate the project is 18% complete. You know what's going to happen. If at the end of year 1, they estimate the project is 18% complete, won't they recognize 18% of the estimated profit from that project on their income statement at the end of year 1? But you know this, there'd be no profit from this project on their tax return until year 5 when they complete the project, because that's how completed contract works. In completed contract, we recognize no profit from a project until it's completed, until it's finished. So you see the basic problem. Don't I have income on my income statement now, but it's not going to be on my tax return until year 5 when I finish the project? The exam would call this an example of an FTA. This is a future taxable amount, because won't the corporation be taxed out in year 5 when they complete the project? It's definitely an FTA, definitely a future taxable amount. How about an expense? Let's go to that. How about an expense, a deduction that's on the income statement now, but won't be on the tax return till later? Well, what you're looking for here is any sort of estimated expenses. And one of the ones the exam really likes, we'll put in our schedule. And that is warranty expenses. Let's say a company guarantees their products against defects. They have a warranty. On their income statement, they use normal accrual accounting. And remember, under GAAP, you have to estimate your warranty expense. In other words, if based on past experience, you expect 1% of your customers are going to want a refund. In GAAP, you have to take 1% of your sales and set up an accrued or an estimated warranty liability. You have to accrue, you have to estimate your warranty expense. If 1% of your customers tend to want a refund, then you take 1% of your sales and set up an accrued or an estimated warranty expense, an accrued or an estimated warranty liability. Well, the point is, IRS would disallow that. IRS would disallow accrued or estimated warranty expenses. IRS will not let the corporation take that warranty expense as a deduction on their tax return till they actually pay out the claims. So you see our basic problem. We have an expense on our books now. GAAP makes us estimate it, makes us accrue it, but it won't be on our tax return till later when we actually pay out the claims. Now be careful. The exam would refer to this as a future deductible amount. Isn't this a deduction the corporation can take on their tax return in the future when they pay out the claims? This is not a future taxable amount. This is a future deductible amount. I want to make a point, and I'm sure you already have gathered that I feel this way. When you go in the exam, if you know that you're dealing with either a future taxable amount or a future deductible amount, once you really get good at that, once you get good at knowing whether something is a future taxable amount or a future deductible amount, you're really going to be strong in this area. The area is not bad at all once you get that down, because the whole area of accounting for taxes really comes down to dealing with these areas. So as long as you know whether you're dealing with a future taxable amount or a future deductible amount, you're going to be strong on this. Let's go to type 2. What's a type 2 temporary difference? Well, we said there are revenue and expense items that belong on the tax return now, but won't be on the income statement till later. Let's start with revenue or profit. How is it possible to have revenue or profit on the tax return now, but it's not going to be on the income statement until later? Well, what you're looking for here is anything collected in advance. And the one we'll put in our schedule is, I think, the one the exam likes the most, and that's rental income. Let's say that I'm a landlord, you're my tenant. That's our relationship. You rent out my warehouse, and let's say you give me, a certified check that's meant to cover 5 years' rent in advance. All right, so you give me a certified check, and I appreciate it. You give me a certified check that's meant to cover 5 years' rent in advance. Think what's going to happen. If I collect 5 years' rent in advance, when I do my tax return, I have to put all 5 years' rental income on my tax return now. Why? Because all IRS cares about is I collected the money. IRS does not care about the matching concept. IRS does not care about accrual accounting. All IRS cares about is I've collected the money. So when I do my tax return, all 5 years' rental income will be on my tax return because I collected it in advance. But you know this. That rental income wouldn't be on my income statement until later, as I earn it evenly over the next 5 years. So you see my basic problem. We end up with income on the tax return now, but it won't be on my income statement until later, until I earn it evenly over the next 5 years. All right, it's time for a little pop quiz. You have to get involved here. What do you think that the exam would call this item? How do you think the exam would refer to this? Is this a future taxable amount or a future deductible amount? What is this? Is this a future taxable amount? Is this an FTA? Or a future deductible amount? An FDA. What is it? Very good. It's a future deductible amount. Why? Because we already paid the tax. We're not paying the tax in the future. We paid the tax now. We can deduct this from our taxable income later. It's definitely an FDA, definitely a future deductible amount. I hope you got that. All right, one more. How is it possible to have an expense, a deduction, on our tax return now, but it's not going to be on our income statement till later? Well, you knew we'd have to get into this one. Let's talk about depreciation. Let's say on the tax return, we're using makers. We're using the modified accelerated cost recovery system. We use whatever accelerated depreciation method Congress dreams up. So let's say on our tax return, we're using makers. whatever accelerated method Congress is allowing. But let's say on our books, we're using straight line. You see the effect that has. Don't we take a big deduction on our tax return now that we won't take on our books until later, more slowly, under straight line? It's time for pop quiz again. What do you think the exam would call this item? How do you think the exam would refer to this one? Is it a future taxable amount or a future deductible amount? How about this one? Think about it. What is it? Very good. It's a future taxable amount. I already took a big deduction. This is not a big deduction I can take in the future. I already got a big deduction on my tax return. I have to pay the taxes later. I have to pay the piper later. That's definitely a future taxable amount. Now, there's something I want you to notice from all the examples that we just went through, and it's critical that you notice this. Notice that what is unique about temporary differences, what is singular about temporary differences, is that temporary differences reverse themselves. They turn around. And you can see that in the items we just went through. In other words, the rental income that's on my tax return now that I collected in advance will eventually get on my income statement later as I earn it. The depreciation I took on my tax return now will eventually gets on my income statement later as I take it more slowly under straight line. The nature of a temporary difference is that it reverses itself. It turns around. In other words, in my first examples, if I wait long enough, the tax returns eventually catch up to the income statements. Or in my second examples, the type 2, if I wait long enough, the income statements eventually catch up to the tax returns. These just represent temporary differences in reporting. So you have to remember that. The temporary differences reverse themselves. They turn around. Now, before we get into how you account for temporary differences, let's talk about the permanent differences. Let's get into these. There are differences between what a corporation reports on their income statement and what a corporation reports on their tax return, but these differences are permanent. What does permanent mean? What it always means. Forever. In other words, I know you're with me, permanent differences do not reverse themselves. They do not turn around. They're permanent. They're forever. They never reverse themselves. Why don't we start this the same way we started temporary differences? What causes permanent differences? We already know what causes temporary differences, right? We know that. What causes temporary differences is a corporation using one method of accounting on their books and another method of accounting on their tax return. We know that's what causes temporary differences. Well, what causes permanent differences? Let's be clear on it. What causes all permanent differences is this situation. The corporation has some item on their income statement, either revenue or expense. There's some item on the company's income statement, either revenue or expense, that will never be on the tax return. It'll never be on the tax return. That's why it never reverses itself, because it never gets on the tax return. Now, let's go over some examples of permanent differences, and I will say that, once again, the good thing about the exam is that the same permanent differences are in the exam time and again, and there aren't that many they like, but you've got to know them when you see them. So let's go over the ones they like. Let's say, for example, that a corporation takes out a life insurance policy on the president of the corporation, and the corporation is the beneficiary of the policy. That's important. It's what they call a key person policy. A corporation takes out a life insurance policy on the president of the corporation. And again, it's important to remember that the corporation is the beneficiary of the policy. It's what they call a key person policy. Now you know what's going to happen. The corporation is going to pay premiums on that policy. So let's go through it. Will those premium expenses be on the company's income statement? Definitely. Why? Because the company incurred them. That's all GAAP cares about. Those premium expenses are expenses the corporation incurred in the pursuit of profit. So they're definitely on the income statement. Will IRS allow those premium expenses as an allowable deduction on the corporate tax return, on the 1120? No, IRS would disallow that, because if the corporation is the beneficiary of the policy, IRS will disallow those premium expenses. They're not an allowable deduction on the corporate tax return. So you see our basic problem. Don't we have an expense on the income statement? We have to report it because we incurred it, but it'll never be on the tax return. It's disallowed. That's never going to reverse itself. That's a permanent difference. You're just stuck with it. You know, really what causes permanent differences is that GAAP and tax law just don't agree. It's another way to look at it. That's why you have permanent differences, because there are instances where GAAP and tax law just don't agree on something. All right, let's stay on this. Let's say the president of the corporation dies, and the corporation collects $1 million in life insurance. Remember, the corporation is the beneficiary of the policy. It's a key person policy. So now the corporation collects $1 million of life insurance. You know what I'm going to ask you? Will the $1 million of life insurance proceeds be on the company's income statement? Yes, it's other income. No doubt about it. When a corporation collects $1 million of life insurance, that $1 million is on the company's income statement. It's other income. Is it on the tax return? No. Life insurance proceeds are just not taxed. So you see our basic problem. We have income on the income statement. We have to report it. We're required to under GAAP. But that's never going to be on the tax return. Life insurance proceeds are simply not taxed. That's never going to reverse itself. It's a permanent difference. We're just stuck with it. It's never going to reverse itself. Never going to turn around. Let's talk about another one. Interest income from municipal bonds. Let's say a corporation invests in municipal bonds. You know what's going to happen. The corporation is going to earn interest income on those municipal bonds. You know what I'm going to ask you? If a corporation earns interest income on those municipal bonds, will that interest income be on the corporation's income statement? Of course it will, because they earned it. It's all GAAP cares about. That's income that was earned. Is that interest income on the corporate tax return? No, it's not. Interest income from municipal obligations is simply not taxed. So you see our basic problem. We have income that's on the income statement. We have to report it because we earned it. But it's not on the tax return because it's not taxed. That's a permanent difference that's never going to reverse itself. Now, one more, and we're going to have to get into this because it's a permanent difference you have to be aware of in some of the problems in the exam. Don't forget this difference. When one domestic corporation pays another domestic corporation a dividend, 80% is non-taxable. Don't forget, there's an 80%, what they call DRD, dividend received deduction. Again, it comes up when one domestic corporation pays another domestic corporation a dividend. 80% is non-taxable. There's an 80% DRD, an 80% dividend received deduction. Now, I'm well aware that there's a 70% DRD and there's also 100% DRD, but for our purposes in this class, we'll stick to the 80% DRD. Now, you may not see why I brought this up. Let's say that you're a domestic corporation. I'm a domestic corporation, and you send me a $1,000 dividend. Think about how that's going to play out. If you're a domestic corporation, and I'm a domestic corporation, and you...
Welcome to Bisk CPA Review. Comprehensive review materials for the CPA exam to let you customize your own review programs to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you are going to master the exam content? Our unique learning management system ensures that you will master the material. Features such as exam preparation tips, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of a computer-based exam, including multiple choice, simulation, and written communication questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you will have the confidence and knowledge to pass it. Guaranteed.
Hello, and welcome to the Bisk CPA Review course and our coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette. I'll be your instructor for this class, and in this class, we're going to be talking about bonds and other liability issues as well. But let me say that in this class, we're going to spend most of our time talking about bonds, because bonds are one of the most heavily tested parts of liabilities. And as you'll see as we get into this topic, there are so many ways the exam can approach bonds in a problem that bonds are a trouble spot for a lot of students. So we are going to spend a lot of time on bonds. Now, as you know, a bond is a debt security. When a corporation issues bonds, they are borrowing money from the investors, and the bond is evidence of that debt. When investors invest in bonds, they're investing in a debt security. So it's always evidence of debt for the corporation issuing the bond. And I have some advice for you right off the bat. The secret to bonds, if there is one, is to master all the basic entries that you make with bonds. Because you'll find that once you master the basic entries that you make with bonds, now no matter what the exam comes up with, no matter what they ask in bonds, no matter how complicated the problem, one way or another, all bond problems come back to these basic entries. So that's where we're going to begin. We're going to go over all the basic entries on bonds, and I want to go right to a problem. In your viewer's guide, I want you to go to problem number 1, and let's take a look at it. It says on January 2nd of the current year, West issued. Notice that word issued. Notice in this problem, we are on the issue side. And you have to be careful because sometimes in the exam with bonds, you're on the issue side. Sometimes in the exam with bonds, you're on the investment side. So you pay attention to that. West issued 9%. Let's stop there. That 9%. That's called the stated rate of interest. That is a rate of interest that's printed right on the face of the bond certificate. It's called the stated rate of interest, printed right on the face of the bond certificate. They issued 9% bonds in the amount of $500,000. Let's stop right there. If it's $500,000 worth of bonds, it must be 500 bonds, because remember, in the CPA exam, bonds are always in denominations of 1,000. In the CPA exam, one bond equals one $1,000 debt. So if it's $500,000 worth of bonds, there must be 500 $1,000 bonds. Notice they mature in 10 years. Now they say the bonds were issued for less than $500,000. The bonds were issued for $469,500. Why? Because they want the bonds to yield more than the stated rate printed on the bonds. They want the bonds to yield 10%. And we've hit a concept that you want to know cold. Always remember that when bonds sell at a discount, there's effectively more interest. Anytime you see a discount in the exam, you know there's more interest for both sides. Now, you see why I say both sides? Because if you're the issuing company, a discount means there's effectively more interest expense. If you're the investor company, a discount means there's effectively more interest income. But a discount always means more interest. And it's the kind of thing where if you know that cold, you'll work a lot faster in these problems. You'll start eliminating answers. A discount always means more interest for both sides. They go on to say, interest is payable annually on December 31. West uses the effective interest method to amortize the bond discount. Then they say in the June 30th, notice 6 months have gone by. The bonds were issued on January 2nd, and now in the June 30th balance sheet, what amount would West report as bonds payable? And I want you to focus on that word report. We'll say more about it later. But they want to know what West would report for bonds payable. Now, as I said, the secret to bonds, if there is one, is to master all the basic entries that you make with bonds. So let's go back to January 2nd. Let's go back in time. Let's go back to January 2nd in this problem. What entry would West have made when West issued the bonds? Well, I think you know. When West goes out and issues $500,000 worth of bonds for $469,500, West is going to debit cash for what they collect, $469,500. But they're going to credit bonds payable for $500,000. You always credit bonds payable for the face amount of the debt. There's an absolute. The account bonds payable will always be credited for the face amount of the debt. So they're going to credit bonds payable for the $500,000. And of course, what they do is debit discount on bonds, $30,500. That's the entry that West would have made when West issued the bonds. Now, while we're focusing on this entry, I want to talk about some terminology. You know that the face amount of the bonds is $500,000. But the critical question in the exam is this. As of January 2nd, what is the carrying value of the bonds? Let's talk about the definition of carrying value. Never forget, the carrying value of bonds is defined as the face amount plus any unamortized premium or minus any unamortized discount. Let me say that again. The carrying value of bonds is defined as the face amount plus any unamortized premium or minus any unamortized discount. So I think we can agree that as of January 2nd, the carrying value of these bonds would be the face amount, $500,000, minus the unamortized discount, $30,500. Right now, the bonds have a carrying value of $469,500. And let me say that partly what carrying value is all about is they want to be sure that you as a student understand how this debt is carried in the financial statements. That's really the point. This debt is not carried in the balance sheet as a $500,000 liability. No, it's carried in the balance sheet as a liability of $469,500. Because remember, discount or premium in terms of presentation is presented on the balance sheet as part of the debt. So right now this is on the balance sheet as a liability of $469,500. That's its carrying value. Now, when we go to the bottom of the question, and it says in the June 30th balance sheet, what amount would West report for bonds payable? I'll tell you, a lot of students go for answer D because they think, well, we know the account bonds payable is always credited for the face amount of the debt. Wouldn't bonds payable be, answer D, $500,000? No. Now, let me say this, it might make you feel better about it. If the exam had asked, what's the balance in the account bonds payable? The answer would be D. That makes you feel a little better about that. If the exam had asked, what's the balance in the account bonds payable? No question, it's answer D. It's not what they asked. They asked how we report the debt. That word report's important. They said, what amount would West report for bonds payable? How is debt reported in a balance sheet? At its face amount, plus any unamortized premium, or minus any unamortized discount. That is how debt is reported in the balance sheet. So we're back to carrying value again. Now there's another mistake a lot of students make. Notice these bonds pay interest annually on December 31, annual interest. Now they issued the bonds on January 2nd. We're doing a balance sheet on June 30th, just after 6 months. So some students sit in the exam and say, well, since only 6 months have passed and the bonds pay interest annually, there wouldn't have been any interest adjustments at this point, not by June 30th. So why wouldn't we still be at answer A? Why wouldn't we still report the debt at 469.5? Well, I think you know why A is wrong, because it doesn't matter how you pay the interest. On June 30th, you'd make your accruals. So don't forget that. So let's think about the interest adjustment we would make on June 30th. So let's assume it's June 30th, and let's start with straight line amortization of that discount. I know that West uses the effective interest method, but let's say it's June 30th, and West uses the straight line method to amortize the bond discount. Well, I have some more advice for you. Anytime you go to make an interest adjustment with a bond, I think that you should always start with an absolute. Start with something the exam can't play around with. You know what that is? The actual interest check they send out. Always remember that the actual interest check they send out is always based on the stated rate of interest times face value. Remember that formula. Stated rate of interest times face value will always get you the check they send out. That's never, the exam can't play around with that. Stated times face. Stated times face. That'll get you the interest check that goes out. So let's get the interest check. We know the stated rate printed on the bond is 9%. But for 6 months, remember it's June 30th, would be 4.5% times the face amount, $500,000. We know the interest check is going to be $22,500. So in this entry, we're going to credit interest payable, $22,500. Notice we don't credit cash. It's not paid until December 31. We're June 30th making our accruals. So they would credit interest payable, $22,500. Now follow me through this. If they're going to use straight line amortization of that discount, well, we know they are 10-year bonds. If they're 10-year bonds, isn't that 26-month periods? So in straight line, you would take that $30,500 discount, divide by 26-month periods, and you would credit discount $1,525. You would take $1,525 of discount amortization, and you would debit interest expense $24,025. That is the adjustment you would make in straight line. Now, we've hit another major point, something you have to remember, and really just memorize it, because you'll work so much faster if you know this cold. Never forget that amortization of a discount always increases carrying value on both sides. We'll get to the investor side later. But the fact is, amortization of a discount always increases carrying value. And as I say, if you know that, you just work a lot faster. So what's just happened is carrying value has gone up $1,525 because of that discount amortization. So didn't the carrying value go from the old carrying value, $469.5, up $1,525 to answer C? You might just, for your own notes, right next to answer C, straight line. If this had been straight line, the answer would be C. Another point I want to make. What you have to love about straight line is that you're going to make the same interest adjustment every 6 months for 10 years. Now, we're not going to do all those entries, but I want you to recognize that's what everybody loves about straight line. We're going to make the same interest adjustment like clockwork every 6 months for the next 10 years. So what's going to happen? Carrying value is going to go up $1,525, up $1,525, up $1,525. So 10 years from now, when the bonds mature, what'll be the carrying value of the bonds? $500,000. What's the last entry the issuing company makes? They debit bonds payable $500,000. Credit cash $500,000. It's a debt. At maturity, the company has to pay back the face amount of the debt. I don't care whether they sell bonds at a discount or a premium. At maturity, you always have to pay back the face amount of the debt. So that's what's going to happen here. We're going to take $1,525 of discount amortization every 6 months. $1,525, $1,525. Carrying value keeps going up and up and up. So at maturity, the carrying value of the debt is $500,000. And as I say, the last entry the issuing company would make is debit bonds payable $500,000 and credit cash $500,000. At maturity, they have to pay back the face amount of the debt. And that's really the whole cycle. Now, we know in this problem, West does not use straight line. West uses the effective interest method of amortization. So let's get into that. First of all, under the effective interest method, would that change the initial entry that West made back on January 2nd? No. The entry on January 2nd, when they issued the bonds, would be the same. All that's affected by the effective interest method are the interest calculations. So now let's assume it's June 30th, first year, June 30th. What would be the entry under the effective interest method? Now, before we get into this entry, I want to make a point. I want you to be aware that the CPA exam asks more questions about the effective interest method of amortization than any other single thing about bonds. Let me say that again. Never forget that the CPA exam asks more questions about the effective interest method of amortization than any other single thing about bonds. It's not all they ask, but you've got to really be comfortable with the effective interest method. So we've hit another major point. Here is a huge thing you have to remember. Under the effective interest method, the way you calculate your interest is you multiply the effective yield of the bond, not the stated rate. You're going to multiply the effective yield of the bond times carrying value. And this is why carrying value is so critical, because to get your interest in the effective interest method, you have to multiply the effective yield of the bond, not the stated rate, the effective yield of the bond times carrying value. So let's work it out. In this problem, the effective yield is 10%, but for 6 months would be 5% times carrying value, $469,500. Aren't they going to debit interest expense? $23,475. Now, how about the check that goes out? That's not going to be any different. Interest check is always stated times face. We know to get the interest check, take the stated rate printed on the bonds, 9%, but for 6 months would be 4.5% times face value, $500,000. They're still going to credit interest payable, $22,500. So let's just pause on the entry right there. You see why the exam loves the effective interest method, because that's what you have to keep straight in your mind, that the interest expense is the effective yield of the bond, not the stated rate, times carrying value, not face value. But that has no effect on the check that goes out. The interest check is always stated times face. That's what you have to sort out in your mind. Now, obviously, the entry doesn't balance. We need a credit of $975 to balance the entry out. You know what that is? That's the discount amortization for that 6 months. So credit discount, $975. And that $975 is a plug. There's no other way to get it. It's the difference between the expense and the interest check. That's why entries help you a lot. Because a lot of times in the exam, they want the amortization for the year. Well, the best thing to do is go to your scrap paper and put down an entry, because the amortization is a plug. It's the difference between the expense and the interest check in the effective interest method. All right, so we know that amortization of a discount always increases carrying value. So didn't carrying value just go up $975? It went from $469,500 up $975 to answer B, $470,475. Let's go to December 31. At December 31, in the effective interest method, would you put down the same entry? No. Why? Well, because when you get to December 31, the effective yield is still 10%, but for 6 months it would still be 5%. That's not going to change. As you go from payment to payment to payment, the effective yield is not going to change. Still 5% for 6 months. But of course, what has changed is carrying value. Because of the adjustment back on June 30th, carrying value went up $975 to answer B, $470,475. So on December 31, we'll take the effective yield of the bond, 5%, times the new carrying value, $470,475, and we're going to debit interest expense, $23,524. But as you know, that has no bearing on the check that goes out. We're still going to credit interest payable for the stated rate of interest, 9%, but for 6 months would be 4.5% times face value, $500,000. We're still going to credit interest payable, $22,500. Entry doesn't balance. We need a credit of $1,024 to balance the entry out. That's the amortization of the discount for the last 6 months, and it's a plug. It's the difference between the interest expense and the check. And there's really no other way to get that. Another point. I know you're with me. If the CPA exam had asked, what is the amortization for the year, you would have no choice but to add up $975 plus $1,024, and there's not another way in the universe to get that answer. I hope you're with me. You've got to be comfortable with the effective interest method. What's the balance in interest payable now? Well, it was $22.5 June 30th. We've added another $22.5. Isn't the balance in interest payable $45,000? And now annually they make the payment. They would debit interest payable $45,000, credit cash $45,000. They'd make the payment. Let's do a premium. Let's go to problem number 2. In problem number 2, they say on May 1st, Bolt issued, notice we're on the issue side, not the investor side. Bolt issued 11% bonds. We know what that 11% is. That's the stated rate, printed right on the bonds. 11% bonds in the face amount of $1 million. Well, that means there must be 1,000 bonds, because bonds are always in denominations of 1,000. So if it's $1 million worth of debt, it must be $1,000 bonds. They mature in 10 years. The bonds were issued to yield, notice, a little less than the stated rate. The bonds are going to yield a little less than the stated rate, 10%. Why is that? Because they sold the bonds at a $62,000 premium. All right, so we've hit another major point. What you want to absolutely know cold is that when bonds sell at a premium, there's effectively less interest for both sides. That's what a premium always means. Effectively less interest for both sides. And you know why I say both sides? Because if you're the issuing company, a premium means there's effectively less interest expense. If you're the investor company, a premium means there's effectively less interest income. But a premium always means less interest for both sides, effectively. Bolt uses the effective interest method to amortize that bond premium. Interest is paid semi-annually on November 1 and May 1. In the October 31 balance sheet, so we're doing a balance sheet on October 31, what would Bolt report as unamortized bond premium? Well, let's get a little practice on this. Let's go back to May 1st. On May 1st, what entry did Bolt make when Bolt issued the bonds? I know you're getting used to it. Wouldn't Bolt have debited cash for what they collected, $1,062,000? They'd credit bonds payable, always for the face amount of the debt, $1 million, and they would credit premium on bonds, $62,000. That's the initial entry Bolt would have made as the issuing company. Now, as of May 1st, what's the face amount of the debt? $1 million. What's the carrying value of the debt? Well, that would be the face amount, $1 million, plus any unamortized premium, $62,000. Carrying value of the debt initially is $1,062,000. And as I said, partly what carrying value is all about is to be sure that a student understands how debt is carried in the financial statements. And this debt would be carried in the balance sheet not as a liability of $1 million. It would be carried in the balance sheet as a liability of $1,062,000. Because remember, discount or premium is always presented in the balance sheet as part of the debt. Let's do some interest adjustments. Let's say 6 months go by. We're doing a balance sheet here on October 31. So let's say it's October 31. 6 months go by, and let's start with straight line amortization of the premium. Let's get some practice on straight line. Well, let's start with the interest check. We know that they can't play games with that. The actual check that goes out is always based on the stated rate of interest, printed on the bonds, 11%. But for 6 months would be 5.5% times face $1 million. We know they're going to credit interest payable, $55,000. And you know why I credit interest payable, not cash, because it's not paid till tomorrow morning, November 1. We're on October 31 making our accruals. So we're going to credit interest payable, $55,000. Now, if it's straight line, how do we look at this? If it's straight line amortization of the premium, we're going to say, well, these are 10-year bonds. That means it's 26-month periods. So in straight line, we'll take that $62,000 premium, divide by 26-month periods, and we will debit premium $3,100. We'll take $3,100 of premium amortization and debit interest expense just $51,900. So when they ask at the bottom of the question, in the October 31 balance sheet, what would Bolt report as unamortized bond premium? Well, we know the unamortized bond premium started out at $62,000. We just amortized $3,100 of it, so it's down to answer C, 58.9. So again, you might want to just write next to answer C, straight line. If this had been straight line, the answer would be C. And we also know what we love about straight line. What we love about straight line is we're going to make the same interest adjustment every 6 months for the next 10 years. And carrying value is going to keep going down 3,100. We've hit another major point. Remember, amortization of a premium always decreases carrying value on both sides. Again, it's the kind of thing, if you know that code, you'll work a lot faster. You know amortization of a premium always decreases carrying value on both sides. So carrying value has gone down 3,100. And every 6 months, we'll make the same entry, like clockwork in straight line. So carrying value is going to go down 3,100, down 3,100, down 3,100, 20 times. So 10 years from now, when the bonds mature, what will be the carrying value of the bonds? $1 million. What's the last entry Bolt makes? Debit bonds payable $1 million. Credit cash $1 million. It's a debt. At maturity, they have to pay back the face amount of the debt, whether they sell bonds at a discount or a premium. At maturity, they've got to pay back the face amount of the debt. As you know, Bolt does not use the straight line method. Bolt amortizes the premium using the effective interest method. So let's get some practice on the effective interest method. We know that when we do a balance sheet on October 31 and we have to accrue our interest, it's not going to be paid until November 1. The way Bolt is going to work out their interest expense for this 6 months, they're going to take the effective yield of the bond, not the stated rate, the effective yield, which is 10%, but for 6 months would be 5%, times carrying value, $1,062,000. We know Bolt is going to debit interest expense, $53,100. But as you know, that has no bearing on the check that goes out. The interest check is always stated times face. So pick up the stated rate, printed on the bonds, 11%, but for 6 months would be 5.5% times face $1 million. We know they're going to credit interest payable, $55,000. Entry doesn't balance. We need a debit of $1,900 to balance the entry out. That's the amortization of the premium for that 6-month period, and it's a plug. There's no other way to get it. So when they ask at the bottom of the question, in the October 31 balance sheet, what amount would Bolt report as unamortized bond premium? Didn't the bond premium just go from $62,000 down $1,900? We amortized $1,900 of it down to answer B. Now the unamortized premium is $60,100. Let's look at a problem from the investment side. Because as I've been saying in this class, in the exam with bonds, sometimes you're on the issue side, sometimes you're on the investor side. Let's go to problem number 3. Problem number 3 says, on July 1st, 2009, Fox Company purchased, notice that word purchased, we're on the investment side here. Fox purchased 400 of the $1,000 face amount of 8% bonds of Day Corporation. All right, so Fox is purchasing $400,000 worth of bonds. The stated rate on the bonds, printed on the bonds, is 8%. But notice Fox purchased the bonds for $369.2, a little less than face amount. Fox bought the bonds at a discount. Why? Because they want the effective yield to be 10%. You know, a discount always means there's effectively more interest than the stated rate. And that's the case here. They say the bonds mature July 1st, 2014. So notice they have 5-year bonds. They go from July 1st, 2009 till July 1st, 2014. And they say that Fox uses the effective interest method to amortize the discount. The bonds are appropriately recorded as a held-to-maturity investment. They want to know the bonds, how would bonds be reported in Fox's December 31, 2009 balance sheet. All right, so let's do a couple of entries from the investment side. Let's go back to July 1st, 2009. Back on July 1st, 2009, when Fox purchases $400,000 worth of Day Corporation bonds for $369.2, what Fox will do is just simply debit investment in bonds for what it cost them, $369,200, and credit cash, $369,200. Notice that the investor normally would not set up a separate discount account. You can do it that way, but I think it's simpler just to treat it as if the investor would record all their investments at cost. They would just simply debit investment in bonds for what it cost them, $369,200, and credit cash, $369,200. All right, now that was on July 1. We're doing a balance sheet 6 months later. So let's say now it's December 31, 2009. And what if Fox used the straight line method of amortization? Let's look at straight line from the investor side. Well, first of all, we know the interest check that Fox is going to collect, right? The interest check that Fox is going to collect would be based on the stated rate of interest printed on the bonds times face amount. So let's pick up the stated rate printed on the bonds, 8%, but for 6 months would be 4% times the face amount of the bonds, $400,000. We know that Fox is going to debit interest receivable, $16,000. Notice not cash. It's not paid, not collected until tomorrow morning, January 1. Bonds pay interest semi-annually, July 1, January 1. So if you're Fox, you're not going to collect the money till tomorrow morning, January 1. Again, we're at December 31, making the accrual. So Fox is going to debit interest receivable for $16,000. Now, as I said a moment ago, the investor does not usually set up a separate discount account, but the discount is there. There's a $30,800 discount here. And in straight line, how are we going to look at it? Well, these are 5-year bonds. They go from July 1st, 2009 till July 1st, 2014. That's 10 6-month periods. So in straight line, Fox would take that $30,800 discount, divide by 10 6-month periods, and take $3,080 of discount amortization. Now, they don't have a separate discount account, so they would just debit investment in bonds, $3,080, and credit interest income, $19,080. And once again, straight line, the beautiful thing about it, we make the same adjustment like clockwork every 6 months for the next 5 years. And we know that amortization of a discount always increases carrying value on both sides. So notice carrying value of investment in bonds is going to go up $3,080, up $3,080. You're going to make that entry 10 times. So 5 years from now when the bonds mature, what's the carrying value of the investment? $400,000. What's the last entry Fox makes? They debit cash $400,000. They get their money back. Remember, they invest it in a debt security. And at maturity, they get paid back the face amount of the debt. So at maturity, Fox would debit investment in bonds, $400,000. They would debit cash, $400,000. They get their money back. They would debit cash, $400,000, and credit investment in bonds, $400,000. And that's the whole cycle. But of course, we know that Fox does not use straight line. Fox uses the effective interest method of amortization. So let's apply the effective interest method of amortization to the investor. Well, again, we know that the effective interest method, when you see it, has no bearing on the first entry. The entry that was made back on July 1, when Fox purchased the bonds, wouldn't be any different. All that's affected ever by the effective interest method are interest calculations. So let's do it. If it's December 31 and Fox uses the effective interest method, well, here again, we know that the interest check Fox is going to collect, right? The interest check that Fox is going to collect will be based on stated times face. So we pick up the stated rate of interest printed on the bonds, 8%, but for 6 months would be 4%, times the face amount of the bonds, $400,000. Fox is still going to debit interest receivable, $16,000. Interest check is not going to change, but here's what is going to change. To work out the interest income that Fox earned for that 6 months, you would take the effective yield of the bond, which is 10%, but for 6 months would be 5%, times the carrying value of the investment, $369,200, and credit interest income, $18,460. That's the income they earned for that 6 month period, and the entry doesn't balance. This next number is a plug, as it always is. We simply need a debit of $2,460 to balance the entry out. That's the amortization of the discount for that 6 month period. That's always true in the effective interest method, that the amortization for the period is a plug. It's the difference in this case between the cash and the income. And there's no other way to get that. You plug it in. So we're going to debit what for 2,460? They don't have a discount account. So debit investment in bonds, 2,460. Carrying value goes up, 2,460. So when they ask at the bottom, how would the bonds be reported in the December 31, 2009 balance sheet? Well, they were at 369.2, but amortization of a discount always increases carrying value, so carrying value has gone up 2,460 up to answer C, 371,660. I think you know what I'm saying. When you go in that exam, make sure you are comfortable with the effective interest method on both sides, whether you're on the issue side or the investor side. Now, you also may remember this, that in another class, if you had this with us, when we talked about investments, we said there are trading securities. Trading securities are accounted for at fair market value. There are available for sale securities. Available for sale securities are accounted for at fair market value. But remember, there's the third category. The third category of investments is held to maturity investments. And what we said in that class was that held to maturity investments are accounted for under amortized cost, not fair value. Held to maturity investments are not accounted for at fair value. Held to maturity investments are accounted for under amortized cost. So just so that this is in your mind and you're thinking this way, what we just went over is amortized cost for the investor. What we just applied to this held to maturity security is amortized cost. Notice there's the straight line approach to amortized cost. There's the effective interest approach to amortized cost. But held to maturity investments must be accounted for under amortized cost. So just be aware, there's the straight, if you're the investor, there's the straight line approach to amortized cost. There's the effective interest approach to amortized cost. Another point I want to make, and I'm sure you probably know this, but it has to be said, that if interest is a material item on the income statement for the issuer or the investor, all right, for the issuer or the investor, if interest is a material item on the income statement, the effective interest method is required. The effective interest method of amortization is theoretically preferred. Companies can use straight line, but only if interest is immaterial. If interest is a material item on the income statement for the issuer or the investor, the effective interest method is required. It is theoretically preferred. As I say, companies can still use straight line if interest is immaterial. But you have to be aware that sometimes in the exam, maybe for simplicity, in some problems, they'll have you use straight line. Now, what I'd like you to do next is try some problems and get some practice on this. And I think that it's so critical when we get to an area where I want you to do problems that you shut the class down, do the problems, get your answers first before you come back to the class and we go through them together. You'll find you get much more out of the class if you do that. So what I'd like you to do is shut the class down, do questions 4 through 8. 4 through 8, and then come back and we'll talk about them together. Welcome back. Let's look at these questions together. In number 4, we're talking about Web Company. I'm sure you noticed that Web Company is the issuing company. We're on the issue side. Now, as you started the question, I hope you noticed that as we start, the face value of the bonds is $100,000. Carrying value is $105,000. The stated rate of interest printed on the bonds is 7%, but the effective yield is 6%. What I'm saying is that partly what they're testing in a bond question is whether or not a student has all these concepts sorted out. And you may not be there yet, but once you get comfortable with bonds, that's how you look at a question like this. You take one look at it and you say, oh, I see. The face amount of the bonds is $100,000. Carrying value is $105,000. Stated rate of interest is 7%, but the effective yield is 6%. And of course, the effective yield is below the stated rate because they sold the bonds at a premium. And as of June 30th, year 2, the premium, the unamortized premium, must have been $5,000. If the face value of that on June 30th, year 2 is $100,000, carrying value is $105,000, that would mean that the unamortized premium on June 30th, year 2 was $5,000. Well, they want to know what would be unamortized premium a year later. June 30th, year 3. To solve this, you had to think about the adjusting entry that would be made for interest on June 30th, year 3. So let's just put it down. We know when Webb does their entry to record interest on June 30th, year 3, they use the effective interest method of amortization. That's what the problem says. So we know under the effective interest method, the way Webb would get their interest expense for that year would be by taking the effective yield of the bonds, which is 6%, times carrying value, $105,000. We know Webb is going to debit interest expense $6,300. But as you know, that has no bearing on the check that actually goes out. The check that goes out is always based on the stated rate of interest printed on the bonds, 7%, times the face amount, $100,000. We know they're going to credit cash, $7,000. And here you could credit cash because it's paid on December 31. So credit cash, $7,000. Well, you notice the entry doesn't balance. I simply need a debit of $700 to balance the entry out. Debit premium, $700. That's the amortization of that premium for that yearly period. So when they ask us at the bottom of the question, what would be unamortized premium on June 30th, year 3? Well, we know a year ago, unamortized bond premium was $5,000. Now they've amortized $700 of it. So on June 30th, year 3, unamortized premium would be answer C, $4,300. Now, another thing I want to mention, notice that every problem we've done so far has been what is called term bonds, meaning they mature after term of time. I just want you to notice that these are 10-year bonds. They mature after 10 years, after a term of time. These are called term bonds. And these are the most common type of bonds you see in the exam. In number 5, Foley Company is preparing the electronic spreadsheet below to amortize the discount on its 10-year, 6%, $100,000 bonds payable. Now, the bonds were issued on December 31, so they yield a little bit more. They wanted them to yield 8%. Well, if they wanted them to yield more than the stated rate, of course, they sold the bond at a discount, and they say that Foley uses the effective interest method to amortize the discount. Now, they give us this little table, and if you look at the table, we know the carrying value of the bonds at the end of the first year is $86,580. That's in box E2. They say, what formula would Foley use in cell E3 to calculate the carrying amount, the carrying value of the bonds at the end of year 2? Well, we know it's a discount, and we know amortization of a discount always increases carrying value, so the answer is A. If I take what is in E2, the carrying value at the end of year 1, add the discount amortization for the year, what would be in box D3, that would give me the new carrying value in box E3. Just, it's a matter of knowing that amortization of a discount always increases carrying value. So if I know the carrying value at the end of year 2 and I want to know the carrying value at the end of year 3, it's what's in that box, E2, add the discount amortization for year 3, which is box D3. Answer A. In number 6, they say on July 1st, Cody paid $1,198,000 for 10% 20-year bonds with a face amount of $1 million. So I'm sure you noticed in this problem, we're on the investor side. Sometimes in the exam with bonds, you're on the issue side. Sometimes in the exam with bonds, you're on the investor side. You want to be sensitive to that. Now, in this case, Cody paid a premium. Cody bought $1 million worth of 10% bonds and paid a premium of $198,000. Why? Because they want the bonds to yield a little less than the stated rate, 8%. Cody, the investor, uses the effective interest method. And they want to know what would be reported as the carrying value of the investment in Cody's December 31 balance sheet. In other words, 6 months later. The investment was purchased on July 1. we've got to work out the carrying value of the investment 6 months later, December 31. So think about the adjusting entry that Cody would make for interest on December 31. Well, we know under the effective interest method the way the interest adjustment is going to look. First of all, the interest check that Cody's going to collect, right? The interest check that Cody's going to collect would always be based on the stated rate of interest printed on the bonds times face amount. So if you take the stated rate, which is printed on the bonds, 10%, but for 6 months would be 5%, times the face amount of the bonds, $1 million, we know Cody's going to debit cash $50,000, and it is paid on December 31. So Cody would debit cash $50,000. The stated rate of interest printed on the bonds, 10%, but for 6 months would be 5%, times the face amount of the debt, $1 million. We know Cody's going to debit cash $50,000. But we also know, under the effective interest method, the way Cody calculates the income they've earned for that 6 months is by taking the effective yield of the bond, which is 8%. But for 6 months would be 4%, times carrying value, $1,198,000. Cody's going to credit interest income, $47,920. That's the income that Cody earned for that 6 months. Entry doesn't balance. Cody simply needs a credit of $2,080 to balance the entry out. Cody would credit investment in bonds. That's the amortization of the premium for that 6 month period. And it's a plug. It's the difference between the cash and the income. That's why entries help you a lot. And remember, Cody wouldn't have a separate premium account, so Cody would just credit investment in bonds, $2,080. So when they ask what would be reported as the carrying amount of the investment in Cody's December 31 balance sheet, well, we know amortization of a premium always decreases carrying value. So the investment in bonds went from $1,198,000 down $2,080 to answer C. That's the carrying value of investment in bonds. And notice again, we're dealing with the most common type of bonds you see in the exam, term bonds. These bonds mature after a term of time in 20 years. Now in number 7, there's no numbers. It's a theoretical type of question. They say, how would the amortization of a discount on bonds affect two things? How would the amortization of a discount affect the carrying value of the bonds and also net income? And I want you to think about something before we actually put an answer down. I want you to think about this first. In that question, are you on the issue side, the investor side, or you can't tell? I hope you thought about that, because it matters. In number 7, are we on the issue side, the investor side? No way to know. Definitely the issue side, because it's amortization of a discount on bonds payable, the liability. If it's the liability, bonds payable, we're on the issue side. Now, this question refers to a couple of concepts we've gone over in this class, and I hope you thought about them. First of all, what does amortization of a discount always do to carrying value? Always increase. So if you just knew that, that narrows it down to A or B, because we know amortization of a discount always increases carrying value. Here's another concept. When a bond sells at a discount, is there effectively more interest or less? What's a discount always mean? There's effectively more interest for both sides. And if I'm the issuing side, and I know I am because it's bonds payable, there's effectively more interest expense. And if the expenses are more, the income is decreased, and the answer is A. Got to think it through. Remember, when a bond sells at a discount, there's effectively more interest for both sides. And if I'm the issuing company, I know I am because it's bonds payable, that a discount would mean there's effectively more interest expense. If the expenses are more, the income is decreased. So you end up with answer A. Let me ask you this. What if it was the investor side in number 7? Is it the same answer? Let's think it through. If you're the investor, what does amortization of a discount do to carrying value? Still increase. But if I'm the investor, a discount means there's effectively more interest income, and the answer would be B. You might want to, just for your own studying, right next to answer B, investor. See, that's what it comes down to. It's A if it's the issuer, B if it's the investor. Notice it can matter in the exam what side you're on. It can determine your answer. the most important thing to notice in that question, if you had this question in the exam, the most important thing to notice is what side you were on. Oh, bonds payable. It's the liability. I'm on the issue side. Because if you don't stop and think about that, you could get that question wrong. Same thing with number 8. They say, how would amortization of a premium on bonds payable, it's the liability, we're on the issue side, affect the carrying value of the bonds and also net income? Well, we know amortization of a premium always decreases carrying value on both sides. So if you just knew that, it's C or D. What else do we know? We know that when a bond sells at a premium, there's effectively less interest for both sides. And if I'm the issuing company, I know I am because it's bonds payable, a premium means there's effectively less interest expense. And if the expenses are less, the income is increased, and the answer is D. I hope you got that. And of course, if you were the investor, it's C, right? If you're the investor, what does amortization of a premium do to carrying value? Decrease. But if I'm the investor, a premium means there's effectively less interest income. Income. And the answer would be C. It's C if it's the investor, D if it's the issuer. Just be careful to always know what side you're on in a question. Now, I would say to this point in this class, all we've talked about are what I would call the basics on bonds. We've really talked about now the basics, which you have to master. And what I want to show you next is the kind of problems they have in the exam where they just assume you know all the basics. They assume you know those. And then they put a few little wrinkles into the problem as well. And the first wrinkle we're going to look at is serial bonds. Let me just give you a quick definition. A serial bond is a bond where the principal gets paid back in a series. That's really all it means. The principal will be paid back in a series. So, for example, you could have $10 million of serial bonds outstanding and pay back the principal $1 million every year for 10 consecutive years. That's a serial bond. You pay back the principal $1 million of every single year for 10 consecutive years. In other words, the way they structure it, they have $1 million worth of the bonds mature in 1 year. Another $1 million worth of the bonds mature in 2 years. Another $1 million worth of the bonds mature in 3 years. That's how they do it. They have the bonds mature in a series. And that way the principal gets paid back in a series. That's what they mean by a serial bond, as opposed to the kind of bonds we've looked at so far in this class, term bonds, right? Term bonds mature after a term of time, 10 years. Now we're into serial bonds, where the bonds mature in a series. Now, what I want you to be confident on is this. If you get a serial bond question in the exam, just remember none of your basic principles change. All the basic principles are the same. All that's different is you're paying back the principal in a series. And I want you to be confident that you can break down a problem like this if you just apply the basics that you do know. Let's go to a problem. Look at number 9. If you go to number 9, it says, on December 31, 2012, Arnold issued $200,000 of 8% serial bonds. And you know what that 8% is? None of your basic principles change. That 8%, that's the stated rate printed on the bonds, to be repaid in the amount of $40,000 each year. Stop right there. See, that's what makes it a serial bond. That's really all that's different. They're going to pay back the principal $40,000 every year for 5 consecutive years. Interest is paid annually on December 31. Then it says the bonds were issued to yield 10%. So they want the bonds to actually yield more than the stated rate, 10%. And therefore they sold them at a discount, of course. It says the bond proceeds were $192.80. They sold the bonds, so they sold $200,000 worth of bonds for $192.80. So the bonds would yield a little bit more than the stated rate, which is 8%. They wanted to yield 10%. Based on the present values at December 31, 2012 of the 5 annual payments as follows. And they give us this table. And let's be honest, the most intimidating thing about this question is the table. I mean, a lot of people just don't like bonds anyway as an area, and then they get in the exam, they see a problem like this, they see that table, and they just they get discouraged. No need to get discouraged here. If you know your basics, you can break the problem down. Now, first of all, if you look at the table, weren't we already told that the bond proceeds were $192.80? We know they sold the bonds for $192.80, and if you look at the table just shows you all the calculations they went through to arrive at that number, $192.80. We don't have to have that. We don't need that table for anything. Again, it just shows you all the calculations they went through to come up with what the bond should sell for, $192.80, and we already knew that. So we don't really need that table. It's really just a big bluff, and very effective. It's going to get people get discouraged. What do we do with that table? Don't even need it. Then it says Arnold amortizes the discount by the effective interest method. We know that. We know the effective interest method. No reason to back down from this question. In the December 31, 2013 balance sheet, so a year has gone by. In the December 31, 2013 balance sheet, at what amount would Arnold report as the carrying value of the bonds? Well, let me just show you a couple of entries here. Because when you see entries, I think you'll see my point that it just comes back to your basic principles. Let's go back a year. Let's go back in time to December 31st, 2012. If I'm Arnold, what entry would I have made back on December 31, 2012 when I issued the bonds? Well, when Arnold issued the bonds, Arnold would have debited cash for $192.80. We were told the bond proceeds were $190,280. So we know that Arnold would have debited cash for the proceeds, $190,280. Arnold would credit bonds payable always for the face amount of the debt, $200,000. You know that. Now, at this point, the entry doesn't balance. We need a debit of $9,720 to balance the entry out. You know what that is? Debit discount, $9,720. Now, if you look at that entry, what does that entry look like? The entry you make for any bond. It's the same entry you'd make for a term bond. The fact that it's a serial bond doesn't change that initial entry. Now, let's go ahead a year. A year goes by. It's now December 31st, 2013. Let's apply the effective interest method because we know the effective interest method. Don't we know? Under the effective interest method, the way Arnold would calculate their interest expense for the year, they would take the effective yield of the bonds. Not the stated rate, the effective yield, which is 10%, times carrying value. What's carrying value of the bonds? Wouldn't it be the face amount, $200,000, minus the discount, $9,720? Carrying value of the bonds, $190,280. So if you take the effective yield of the bond, 10%, times the carrying value, $190,280, wouldn't Arnold have debited interest expense, $19,028? But as you know, that has no bearing on the interest check that goes out. Interest check that goes out is always stated times face. So to work out the interest check, take the stated rate printed on the bonds, 8%, times the face amount, $200,000. Arnold's going to credit cash, $16,000. The entry doesn't balance, does it? We simply need a credit of $3,028 to balance the entry out. We're going to credit discount, $3,028, because you know what that is. That's the amortization for the year. Look at that entry. What does that entry look like? Isn't that the entry you make for any bond? Isn't that the entry you make for a term bond? You see what a bluff this question is? Because people would be very intimidated by this question. But if you know your basics on bonds, you can break it down. Now, there is finally something different, and you know what it is. What makes this a serial bond? What makes this a serial bond is we're going to pay back the principal in a series. We're going to pay off $40,000 of principal every year for 5 consecutive years. So I'll grant you this is different. With a serial bond, you've got to remember to make one more entry where you debit bonds payable $40,000, credit cash $40,000, because you are going to pay off $40,000 of principal every year for 5 consecutive years, paying back the principal in a series. So I'll grant you that's different. With the serial bond, you have to remember to make one more entry where you debit bonds payable for the $40,000 and credit cash $40,000. Those are the entries that would have been made. All right, so now what do they want? They said, what would Arnold report as the carrying value of the bonds December 31st, 2013? Well, let's work it out. What was carrying value when we started? When we started, carrying value was the face amount, $200,000, minus the discount, $9,720. Carrying value when we started, $190,280. All right, now what's going to affect carrying value? Didn't we take $3,028 of discount amortization for the year? And don't we know amortization of a discount always increases carrying value on both sides? So you're going to add $3,028. Because you know that. You know that, I hope, at this point, without even thinking. Amortization of a discount always increases carrying value on both sides. So carrying value would go up $3,028. Anything else? Sure, we paid off $40,000 in principal. So carrying value would go down $40,000. To answer D, $153,308. If you know your basics, you can break that problem down. Now, we won't have to do the entry per se, but let's just talk it through. How would you do interest for the next year? Well, if you want to do the following year, well, to work out the interest expense, it would be the effective yield, 10%, times the new carrying value, $153,308, right? The new carrying value, answer D. What would be the credit to cash? 8% of $160,000. Remember, we paid off $40,000 in principal. So to work out the interest check, it would be stated times face. So the stated rate, 8%, times the face amount of the bonds remaining would be $160,000. And the difference would be your amortization. You're still applying your basic principles. What I'm going to mention next is really just definitional, but I want to make sure that you're aware of it. I want to make sure you know the difference between a debenture bond and a collateral bond. Just very quickly, a debenture bond is a bond that is not secured with any collateral. It's not secured with any assets. Just remember, debentures represent unsecured debt. That's what it is. You know, we know them better as junk bonds. That's what they're referred to as, junk bonds. All right, that's what a debenture is. A bond that is not secured with any collateral, not secured with any assets, unsecured debt. Now, a collateral bond, of course, is not junk at all. It's the opposite. A collateral bond is a bond that is secured with specific collateral. Collateral bonds always represent secured debt. Now, to show you one way they could hit this, let's go to problem number 10. Hancock Company. And we're given the December 31 year one balance sheet. And they have 4 bond issues here. They have some that are secured, some that are unsecured. And they say, what are the total amounts of serial bonds and debenture bonds? So we got to work out 2 things. What's the total amount of serial bonds? What's the total amount of debenture bonds? Well, let's look at each bond issue here. In fact, why don't we put next to each bond issue, next to each number here, the 275, the 125, the 250, the 200, next to each one of those numbers, let's put S for serial, T for term. Let's just label each one. Is that $275,000? Is that a serial bond or a term bond? Well, you put an S there because notice it matures annually. You might want to underline, it matures annually. Some of the principal is going to mature every year. So that's a serial bond. Now the $125,000, put a T there, that's a term bond because it matures after a term of time in 2021. Next to the 250, that's a term bond because notice it matures after a term of time out in 2020. And then the last one, the $200,000, put an S there, that's a serial bond because notice it matures annually. $50,000 matures every year. Some of the principal matures every single year in a series. That's a serial bond. So if you did that, you know your serial bonds are the $275,000 plus the $200,000, $475,000. So that right away narrows it down to A or B. If you just know what a serial bond is, your serial bonds are the 275 plus the 200, $475,000. So if you just knew the definition of serial bonds, it narrowed it down to A or B. But how about debentures? What's debenture mean? Unsecured. So just add up the unsecured portion. Add up 275 plus 125, and the answer is A. Debenture just means unsecured. And notice, you can have unsecured term bonds, you can have unsecured serial bonds. Debenture means unsecured. And you can have unsecured serial bonds, you can have unsecured term bonds. Either one. Now, what we're going to get into next is something the exam loves as a little wrinkle in a bond question, and that is, what do we do when bonds are sold between interest dates? Well, here's the bottom line. Anytime bonds are sold between interest dates, you always assume in that exam that the seller of the bonds will charge the buyers for accrued interest up to the date of sale. That's always the assumption in the exam. When bonds are sold between interest dates, you have to assume that the seller of the bonds will charge the buyers for accrued interest up to the date of sale. Let me show you a problem. If you look in your viewer's guide, you'll see a little problem. Let's say that a company issues $10,000 of 6% bonds on September 1. All right, so we know that a company has issued $10,000 of 6% bonds on September 1. But notice the bonds pay interest semi-annually on June 30th and December 31. So obviously, if the bonds pay interest semi-annually, June 30th and December 31, and they sold the bonds on September 1, they did sell the bonds between interest dates. All right, now my first point is don't mess up the months. Here's what automatically happens. Because the bonds were sold between interest dates, you, the buyers, will be charged accrued interest from when to when. Just remember, the way this calculation always goes for interest, for accrued interest, it always goes from the last time interest was paid, in this case June 30th, up to the date of sale, September 1. You, the buyers, will be charged accrued interest for July and August. Let me just do that again, because a lot of students mess up the months. The way the calculation for accrued interest goes, always, is from the last time interest was paid, in this case June 30th, up to the date of sale, September 1. You, the buyers, would be charged accrued interest for July, August. So I hope you see it's those 2 months. All right, now the math is very easy here. If you take 6% of $10,000, that's $600 of interest for the year. Divide by 12 months, it's $50 a month. Again, I took 6% of $10,000, that's $600 of interest for a full year. Divide by 12 months, the interest is $50 a month. Let's do a couple of entries. If you're the issuing company on September 1, you're going to debit cash $10,100. Notice the issuing company is collecting an extra $100 cash. Why? Because they charge for accrued interest for July and August, $50 a month. So if you're the issuing company, you're going to debit cash $10,100. You're going to credit bonds payable, always for the face amount of the debt, $10,000, and what they do is credit interest payable, $100. That's how they handle it. Why interest payable? Because they owe it back to the investors. That's how this system works. Yes, when bonds are sold between interest dates, the investors have to pay interest up to the date of sale, but they get it right back. The company owes it back to you. How are they going to give it back to you? Because they're going to send you a 6-month interest check like everybody else. Just how the system works. All right, now let's say you're the investor on September 1. What are you going to do? If you're the investor, you're going to debit investment in bonds, $10,000, credit cash, $10,100. Notice if you're the investor, you're charged an extra $100 cash because you bought the bonds between interest dates. That's for the accrued interest for July and August. So credit cash, $10,100. And what the investor will do is debit interest receivable, $100. Because they're going to get it back. They're going to get a 6-month interest check like everybody else. So I just want to show you that the way this is handled, it's all handled through interest payable, interest receivable. Let's go to December 31. On December 31, if you're the issuing company, just think about this now. On December 31, if you're the issuing company, you've actually incurred an interest expense for how many months? 4. September, October, November, December. Remember, they borrowed your money on September 1. So if you're the issuing company, you've actually incurred an interest expense for 4 months. September, October, November, and December times $50. Issuing company is going to debit interest expense, $200. But of course, they're going to credit cash, $300. They send everybody a 6-month interest check. And now they debit that interest payable for $100. They set it back on September 1. So hope you see how that works. Because they've actually incurred an interest expense for 4 months. They borrowed your money on September 1. So they've incurred an interest expense for September, October, November, December. 4 months times $50. Debit interest expense, $200, but credit cash, $300. They send everybody a 6-month interest check, and then they debit the interest payable for $100. They set it back on September 1. If you're the investor on December 31, you're going to debit cash, $300. You get a 6-month interest check like everybody else. So you'll debit cash, $300. But you'll credit interest income for just $200. You've only earned income for 4 months, right? You made the investment on September 1. So you've only earned income for September, October, November, December. 4 months times $50. So you'll credit interest income for 200 and credit interest receivable. The interest receivable you set up back on September 1. Now you credit that interest receivable 100. That's how the system works. It's all handled through interest payable, interest receivable. And of course, one of my messages to you is, it's obvious, but when you get bond questions in that exam, be very careful of dates. Now, you know that's true all over the financial exam, but always watch out for dates because they love bonds between interest dates. I'd like you to try a couple of these. Try problems 11 and 12. 11 and 12, and then come back. Welcome back. In number 11, they're asking at the bottom, what amount did Howe receive from bond issuance? Well, let's start with basics. We know if you're Howe, you literally went out and sold $300,000 worth of bonds at 99%. So if you multiply 300,000 times 99%, if you're Howe, you literally collected $297,000 cash just for the bonds. $297,000. And notice that's answer C. But you can't stop there, and you know why. I'm sure you noticed the bonds pay interest semi-annually on April 1st and October 1st, but they sold the bonds July 1st. So what automatically happens is Howe would have charged the investors for accrued interest from the last time interest was paid. Don't mess up the months now. It always goes from the last time interest was paid, April 1st, up to the date of sale, July 1st. The buyers would have been charged accrued interest for April, May, June. From the last time interest was paid, April 1, up to the date of sale, July 1. The buyers would have been charged accrued interest for April, May, June. So let's work it out. I'm going to take the face amount of the bonds, $300,000, times the stated rate 10%. That's $30,000 of interest for a full year, but we don't want a full year. We just want April, May, June. 3/12, 1/4 of $30,000. So to summarize, if you're Howe, you're collecting $297,000 cash for the bonds, $7,500 for accrued interest. The total amount you collected was $304,500, which is answer A. But let's put the entry down. What's the entry Howe would make? Howe would debit cash for $304,500. That's why it's answer A, because they say what amount did Howe receive from bond issuance? $304,500. We know Howe would credit bonds payable, always for the face amount of the debt, $300,000. Now what? Wouldn't Howe credit interest payable, $7,500, because they owe the interest back. Just how the system works. Yes, they charge for accrued interest up to the date of sale, but they owe it back. So Howe would credit interest payable, $7,500. The entry doesn't balance. We need a $3,000 debit to balance the entry out. You know what that is. Debit discount on bonds, $3,000. By the way, can I prove out that discount? Do I know it's right? I do, don't I? Don't I know that Howe sold the bonds for $99? So isn't there a 1% discount times $300,000? Makes sense, doesn't it? And I kind of do that myself. Does my entry make sense? It does. Because I know the bonds were sold for $99. So there has to be a 1% discount times $300,000. Discount should be $3,000. And it does come out. Now, number 12. They ask, Kane would realize net cash receipts from bond issuance of how much? Well, again, let's start with basics. We know that if you're Kane, you are selling $200,000 worth of bonds at 103%. If you multiply 200,000 times 103%, Kane literally got $206,000 just for the bonds. And I'm sure you noticed that's answer C. But you can't stop there because, once again, the bonds pay interest semi-annually, January 1st and July 1, but they sold the bonds March 1 between interest dates. So what automatically happens is the buyers would be charged accrued interest from the last time interest was paid, January 1, up to the date of sale, March 1. You, the buyers, would be charged accrued interest for January, February. So I hope you work that out. Take the $200,000 worth of bonds times the stated rate, which is 9%. That's $18,000 of interest for a full year. We don't want a full year. Now multiply by 2/12. January, February, over 12. 2/12. 1/6 of 18,000. So to summarize, if you're Kane, you're getting $206,000 cash for the bonds, $3,000 for accrued interest. Wouldn't Kane debit cash $209,000? Now that's answer B. That's not the answer either, but let's just finish the entry. We know Kane is going to debit cash, $209,000. We know Kane is going to credit bonds payable, always for the face amount of the debt, $200,000. Now what? Credit interest payable, $3,000, because that's how the system works. They charge for accrued interest up to the date of sale, but they have to pay it back. So credit interest payable, $3,000, the entry doesn't balance. We need a $6,000 credit to balance the entry out. You know what that is. Credit premium on bonds, $6,000. Can I prove that premium out? Sure we can. We know the bond sold for $103, so there should be a 3% premium times $200,000. Just tells you that your entry is right on the right track. Premium should be $6,000. Now the reason why it's not answer B is because they threw in some bond issue costs. And I just want to mention that this is something the exam does a lot. The exam loves bond issue costs. So let's talk about these for a second. It's expensive to issue bonds. There are costs involved called bond issue costs. What are bond issue costs? Costs for printing the bonds, engraving the bonds, legal fees related to the bond issue, accounting fees related to the bond issue, and underwriter's fees. That's pretty much it. Those are your bond issue costs, but it's expensive. It's printing, engraving the bonds, legal fees related to the bond issue, accounting fees related to the bond issue, and underwriter's fees. Now, I want to make a point. In the CPA exam, always assume that bond issue costs will be paid in cash up front. That's always the assumption in the exam, that bond issue costs will be paid in cash up front. So now let's make the entry for bond issue costs. Now that we've made the entry for the bonds, we're going to make another entry where we debit bond issue costs $10,000, credit cash $10,000. Because in the exam, you always assume that bond issue costs will be paid in cash up front. So now that we have the entry for the bonds, issuing the bonds, a separate entry for the bond issue costs. We would debit bond issue costs, $10,000, credit cash, $10,000. So when they ask at the bottom, Kane would realize net. The word net kind of tips it off, doesn't it? What would be the net cash receipts from bond issuance? Well, what Kane netted out of that bond issuance is the $209,000 from the bonds minus the $10,000 of bond issue costs that have to be paid in cash up front. What Kane netted out of that bond issuance is $199,000. 209 minus 10, answer D, $199,000. Now, one other point. Notice in my entries, I've actually set up an account called bond issue costs. What happens to that? Well, quick point. That account, bond issue costs, that is a balance sheet account. It belongs on the balance sheet under other assets. And don't forget, the bond issue costs will be deferred and amortized to expense over the life of the bonds. So that's what happens to that account. That account, bond issue costs, it's a balance sheet account, goes on the balance sheet under other assets. It's a deferred charge. And just remember that the bond issue costs will be deferred and amortized to expense over the term of the bonds. Now, here's what I want to get into next. Let's say that I go through the printing, the engraving, the legal fees, the accounting fees, the underwriter's fees, and I finally have some Manette Company 10% bonds. They just delivered from the printer. Oh, I've gone through the printing and the engraving and the legal fees and the accounting fees and the underwriter's fees. Expensive. And I finally have some Manette Company 10% bonds. That's the stated rate, printed on the bonds. But when I get out in the marketplace, I find the companies just like mine are paying 5% interest on their debt. Well, think about it. If my stated rate of interest printed on the bonds, remember I'm stuck with that, but the prevailing rate of interest is 5, what am I going to do? Am I going to rip the bonds up and now print up some 5% bonds? I mean, you'd go broke. You know, you've just gone through all these costs. So if the prevailing market rate of interest is 5%, my stated rate is 10%. Of course, everybody wants my bonds. There's a lot of demand, so the price rises. That's why the bonds sell at a premium, because the price starts to rise. And the price of my bonds will rise exactly to the point, not a fraction more, not a fraction less, where the effective yield of my bonds will be 5%, the prevailing market rate of interest. What if I had some Manette Company 10% bonds? You know, hot off the printer. Manette Company 10% bonds. But when I get out in the marketplace, I find the companies just like mine are paying 15% interest for their debt. Well, now nobody wants my bonds. The price starts to drop. And the price of my bond would drop exactly to the point, not a penny more, not a penny less, where the effective yield of my bond would be 15%. See, this is how discounts and premiums are used. Discounts and premiums are used to adjust the stated rate of interest, printed on the bonds, you're stuck with that, to the prevailing market rate of interest. People will not buy your bonds if they don't yield the prevailing market rate of interest. All right, so here's my point. How would you know what the premium should be on 10% bonds so they yield exactly 5%, no more, no less? How would you know what the discount would be on 10% bonds so they yield exactly 15%, not a fraction more, not a fraction less? You know, how is the market price of bonds determined? Well, the answer is that it's done with present value tables. This is how it's done. And this is the rule we work with. You got to know this rule. If the exam wants you to work out the market price of bonds, remember the rule. The rule is use present value of a dollar table for the principal, present value of an annuity table for the interest at whatever you want the bonds to yield. Let me say that again. That's the rule you work with. If the exam wants you to work out the market price of a bond, just remember the rule. Use present value of a dollar table on the principal, present value of an annuity table on the interest at whatever you want the bonds to yield. Let's go to a problem. Let's go to problem number 13. It says on January 1st, 2007, Dean Company issued 10-year bonds with a face amount of $1 million and a stated interest rate of 8%. So that you're stuck with that. That's the stated rate. It's printed on the bonds. Notice interest is payable semi-annually. Might want to circle that word. That's a key word here. Interest is paid semi-annually on July 1 and January 1. But then it says the bonds were sold, so they yield 10%. They want the bonds to yield more than the stated rate. They want the bonds to yield 10%. They give us present value factors. And at the bottom it says, what is the total issue price for these bonds? Well, you're in the exam, you get this problem, you think, all right, here's the rule I'm working with. I use present value of a dollar table on the principal at whatever I want the bonds to yield, right? It's present value of a dollar table on the principal. Now, we know the principal amount here is $1 million. But you see how they tried to mess you up? They tried to mess you up because they gave you two present value of a dollar tables. They gave you present value of a dollar at 10 periods at 10%. They also gave you present value of a dollar 20 periods at 5%. Am I going to use 0.386 or 0.377? 0.377. Hope you got that. Why? Why 0.377? Because they said they want a semi-annual yield. That's important. In other words, when I see that word semi-annual, that tells me that whatever I charge my investors for these bonds, they have to yield 5% every 6 months for 20 periods of 6 months each, not yield 10% for 10 annual periods. Let me say that again. I see that word semi-annual, it tells me, hey, whatever I charge my investors for these bonds, they have to yield 5% every 6 months for 20 periods of 6 months each, not yield 10% for 10 annual periods. So we are going to use 0.386. If they'd said the word annual, I would have used 386. Hope that makes sense to you. If they said it was annual interest, I would have used 386. But because they want a semi-annual yield, I'll use 0.377. So let's work it out. I'm going to take the $1 million of principal times 0.377. That discounts to $377,000. $377,000. All right, that's the first part. Now the next part is the part that bothers some students. The next part of the rule says what? Use present value of an annuity table for the interest at whatever you want the bonds to yield. I want present value of an annuity table on the interest. What you've got to get used to is that the actual interest checks that are sent out do represent an annuity, because aren't they a series of equal periodic payments over a specified number of periods? Let me say that again. The interest checks that are actually going to be sent out, they do represent an annuity, because after all, they do represent a series of equal periodic payments over a specified number of periods. So let's work out the interest check. How do I work out the interest check every time? It's the stated rate printed on the bonds times face value. So to get the interest check that's going to be sent out, take the stated rate printed on the bonds, 8%, but for 6 months would be 4% times the face amount, $1 million. I think we can agree. If all goes according to plan, they're going to send out $40,000 of interest every 6 months for the next 10 years. Isn't that a series of equal periodic payments over a specified number of periods? Interest checks are an annuity. What factor would I use here? 6.145 or 12.462? 12.462, because I want a semi-annual yield. Hey, whatever I charge my investors for these bonds, I want them to yield 5% every 6 months for 20 periods of 6 months each, not yield 10% for 10 annual periods. Not what I want. If they'd said the word annual, I would have used 6.145. They want a semi-annual yield. So let's do the second calculation. I'm going to take that $40,000 annuity. The interest checks are an annuity times 12.462. That discounts to $498,480. If you add up the discounted present value of the principal, $377,000, plus the discounted present value of the annuity, interest checks, $498,480. These bonds would sell for answer A, $875,480. That's how it's done. It's present value of a dollar table on the principal plus present value of an annuity table on the interest at whatever you want the bonds to yield. Try number 14. See how you do, and then come back. Welcome back. Let's look at number 14 together. I'm sure you noticed that number 14 is a little different in the sense that what they want you to work out is the market price of each individual bond. But I think we can agree. It doesn't matter whether they want the market price of a whole bond issue or the market price of one single bond. It comes back to the same thing. It's present value of a dollar table on the principal, present value of an annuity table on the interest at whatever you want the bonds to yield. Now, these bonds have a stated rate printed on the bonds. You're stuck with that, 6%. They want them to yield 8%. So let's apply our rule. I want present value of a dollar table on the principal. The principal amount is $800,000. At whatever I want the bonds to yield, I want them to yield 9% annually. It is annual interest here. So let's get our first factor. Present value of a dollar, 10 periods at a 9% yield. The factor was 0.422. If you take that factor, 0.422, times the principal, $800,000, that discounts to $337,600, $337,600. Now, the next part does bother some people. We have to use present value of an annuity table on the interest because the interest checks really are an annuity. They represent a series of equal periodic payments over a specified number of periods. So let's get the interest check. Interest check is always the stated rate of interest, printed on the bond, 6%, times face, $800,000. I think we can agree. The annual interest check is $48,000. If all goes according to plan, they're going to send out $48,000 of interest every year for the next 10 years. Isn't that a series of equal periodic payments over a specified number of periods? It's an annuity. But I want it to yield 9%. So let's get our second factor. Present value of an ordinary annuity. 10 periods at 9%. The factor is 6.418. You take that factor, 6.418, times the annuity, which is $48,000. That discounts to $308,064. $308,064. Add it up. Discounted present value of the principal, $337,600, plus discounted present value of the interest, $308,064. These bonds should sell, if you add it up, these bonds should sell for $645,664. $645,664. But they want the market price of each individual bond. Well, all I have to do is take what the bond issue should sell for, $645,664, and divide by how many bonds? There must be 800 bonds. Bonds are in denominations of 1,000. It's $800,000 worth of bonds. Must be 800 bonds. If I divide by 800 bonds, each bond would sell for $807.08. The answer is C. It's present value of a dollar table on the principal, present value of an annuity table on the interest, whatever you want the bonds to yield. Now, what I want to get into next is something the exam loves, and that is, how would you determine a gain or a loss on early retirement of bonds? Let's go to a problem. Let's go to the next problem, which is number 15. 15 says on January 1st, year one, Fox issued 1,000 of its 10% $1,000 bonds for $1,040,000. Stop right there. Right away, you notice that originally there was a $40,000 premium. You might want to write that, just jot that down. Because originally they sold $1 million worth of bonds for $1,040,000. So originally there was a $40,000 premium. The bonds were to mature on January 1st, year 11, so they're 10-year bonds, but were callable at 101 anytime after December 31, year 4. You might want to underline callable at 101. We'll talk about that in a minute. Interest was paid semi-annually on July 1 and January 1. Then they say on July 1, year 6, that's the key date, July 1, year 6, Fox called all. Notice they called in all the bonds. You got to be careful. They could call in half the bonds. They could call in a quarter of the bonds, but they called in all the bonds and retired them. The premium was amortized on a straight line basis. Before taxes, what was Fox's gain or loss in year 6 from this early extinguishment of debt? Now, I'll tell you what I like to do with this. It's not going to surprise you, but there's a couple of ways you can do a problem like this. But what I really like is a journal entry. You get a problem like this in the exam, they're very common. I would go right to my scrap paper and just think, if I'm Fox and I retire these bonds, what entry am I forced to make? My point is, you can almost force it. If you just think, if I'm Fox, I'm the retiring company, what entry am I forced to make? Well, let's work it out. Fox is retiring $1 million worth of debt. So wouldn't Fox have to debit bonds payable $1 million? Got to get the debt off your balance sheet. All right, now what was the cash that Fox paid out to get the bonds back? Well, they said bonds are callable at 101. You know what that means? When you see bonds are callable at 101, that means anytime the company wants, the company can call the bonds back in and retire them at 101% of face value. Let me say that again. When you see bonds are callable at 101, that means anytime the company wants, they can call the bonds back in and retire them at 101% of face value. So I'm going to take 101% of $1 million. We know that Fox would have credited cash $1,010,000. That's the cash that went out to retire the bonds, $1,010,000. Now, I don't want to dwell on this, but why do you think this is happening? Why is Fox doing this? What has probably happened? Interest rates have come down. Interest rates have come way down, so what Fox is going to do is issue some new bonds at a much lower interest rate, get that cash, and retire the old bonds. That's what's going on. It's refinancing. That's probably what's going on here. Fox is going to issue some new bonds at a much lower interest rate, get that cash, and use that cash to retire the old bonds with a higher interest rate. It's a refinancing. All right, now, if you're with me on the entry to this point, now we want to pause here. The next part of the problem is the hardest part. So listen carefully. Don't we know that Fox originally sold the bonds at a $40,000 premium? Don't we also know that the premium is amortized on the straight line basis? Don't we know also that these are 10-year bonds? They go from January 1st, year 1 to January 1st, year 11. They're 10-year bonds. So what did they do in straight line? Wouldn't in straight line Fox have taken that $40,000 premium, divide by 10 straight line years, the term of the bonds? In straight line, wouldn't Fox have amortized $4,000 of that premium every year? Now, how much time has gone by? If Fox is amortizing $4,000 of that premium every year, well, all of year 1 has gone by, all of year 2, all of year 3, all of year 4, all of year 5, and half of year 6. I hope you see that 5.5 years have gone by, right? Because they retired the bonds July 1st, year 6. 5.5 years have passed. So here's what you do. Take 5.5 times 4,000. In straight line, they would have amortized $22,000 of that $40,000 premium. Hope you see that. If I take 5.5 years times 4,000 of amortization every year, in straight line, they would have amortized $22,000 of that unamortized premium. So what's the balance in unamortized premium? Well, it was $40,000. They've amortized $22,000. The balance in unamortized premium is $18,000. Now in this entry, we're going to debit unamortized premium $18,000. Hope you see where I got that. The original premium was $40,000. They've amortized $22,000 of it. So the balance in unamortized premium that's on the balance sheet is $18,000. So we're going to debit unamortized premium $18,000. Why? Because we retire that also. This is really what they're getting at. They want to make sure a student understands that if you retire debt from your balance sheet, You must also retire any unamortized discount, premium, or issue costs related to that debt. You say that again. When you retire debt from your balance sheet, you must also retire any unamortized discount, premium, or issue costs related to that debt. There are no issue costs in this problem, but if there were any unamortized issue costs, you'd retire those as well. But all these items get taken off your balance sheet when you retire debt. All right, now, if you're with me to this point, the entry doesn't balance. We simply need an $8,000 credit to balance the entry out. That's gain on retirement of bonds. And the answer is D. And just to emphasize, that is an ordinary gain up in continuing operations. Just an ordinary gain up in continuing operations. That would be gain on retirement of debt of $8,000. Now, you can see one of the reasons I like entries. I like an entry because the entry kind of settles whether it's a gain or loss. If you need a debit to balance the entry out, it's a loss in retirement. If you need a credit, it's a gain in retirement. And I point that out because some students, they can quickly get the number, but they aren't sure whether it's a gain or loss. That's very common. Students get the number very quickly, they just aren't sure whether it's a gain or loss. But you put an entry down, it's clear. If you need a debit to balance the entry out, it's a loss in retirement. If you need a credit, it's a gain. All right, I'd like you to try one. Try number 16 and try the entry. Try number 16 and put the entry down that Hart would make when Hart retires those bonds. And then come back. Welcome back. Let's look at number 16 together. I'm sure you noticed that Hart is retiring $500,000 worth of bonds. So if you think about the entry Hart has to make, Hart is going to have to debit bonds payable, $500,000. You've got to get the debt off your balance sheet. Now, what was the cash that Hart paid out to get the bonds back? Well, notice Hart had to pay 102. So you take 102% of 500,000. Hart must have credited cash 510,000. That's the cash that Hart paid out to get the bonds back. Now, the next part's the hardest part. I'm sure you noticed that originally the bonds sold for 98. So originally there was a 2% discount. If originally the bonds sold for 98, originally there was a 2% discount times 500,000. Originally there was a $10,000 discount. Originally there was $20,000 of bond issue costs. They amortized the discount and the bond issue costs by the straight line approach. Now, how many years have gone by? How much has been amortized? Well, these are 15-year bonds, and they were issued on January 1st, 2008. They're retiring them on January 1st, 2020. Haven't 12 years gone by? So here's the best way to do it. Since 12 of the 15 years have passed, the 15-year bonds, 12 years have passed. Take 12 over 15, that's 80%. Since 80% of the time has passed, in straight line, they would have amortized 80% of that $10,000 discount. So the balance in unamortized discount is 20%, or $2,000. We're going to have to retire that. So credit unamortized discount, $2,000. Let me just do that again. 12 years have passed from January 1st, 2008 to January 1st, 2020. Since 12 of the 15-year term has passed, 12 over 15 is 80%. Since 80% of the time has passed, in straight line, you would have amortized 80% of that discount, that original discount of $10,000. So the balance in unamortized discount that's still on the balance sheet is 20%, or $2,000. We have to retire that also. So credit unamortized discount, $2,000. Same thing with the issue costs. Since 12 of the 15 years have passed, since 80% of the time has passed, in straight line, you would have amortized 80% of the bond issue costs. So the balance in unamortized issue costs is 20%, or $4,000. So we're going to credit unamortized issue costs, $4,000. 20% of $20,000, or $4,000. Remember, that's an asset. That's in other assets on the balance sheet, but that gets retired. That makes the point. Anytime you retire debt from your balance sheet, you must also retire any unamortized discount, premium, or issue costs related to that debt. Now, if you got the entry down to this point, it doesn't balance. We need a $16,000 debit to balance the entry out. That's a loss in retirement of bonds, and the answer is A. And again, I want to point out just an ordinary loss up in continuing operations, a loss on retirement. Try an entry with problems like that. It really works well. Now, what I want to get into next is bonds that are issued with stock purchase warrants. Now we're going to talk about bonds that are issued with stock purchase warrants. First of all, what is a stock purchase warrant? A stock purchase warrant is just like a stock option. Just think of it as a stock option. Think of it as a stock option. It allows the holder to purchase so many shares of stock within a certain period of time at a certain fixed price, called the option price or the exercise price. Again, they're stock options. But that's what a stock warrant is. It allows the holder to purchase so many shares of stock within a certain period of time at a certain fixed price, called the option price or the exercise price. So when people are holding warrants, they can buy shares of your stock at that fixed price, called the option price or the exercise price. Now here's the point. Sometimes companies will issue bonds and they'll have warrants attached to their bonds. Now why do they do this? The reason why a company would attach warrants to their bonds is to make the bonds more attractive, more marketable, and it also holds down interest rates. Now right now interest rates are very low, so you don't see it as often. When interest rates are high, stock warrants will keep interest rates a lot lower, and you see why. Rather than, in other words, a company issues bonds, but rather than give you the market rate of interest, they give you a pitiful rate of interest, but to get you to buy the bonds, they throw in some stock warrants. They throw in some stock options. So that's how these are used. They make the bonds more marketable.
Welcome to CPA Ready, comprehensive review materials for the computer-based CPA exam that lets you customize your own review program to meet your individual learning style and ensure your success. Thank you for selecting this hotspot video, which contains a targeted, intensive review of the specified topic area. We hope you find this video to be an effective tool in your CPA exam preparation. Bisk Education.
Hello, and welcome to the Bisk CPA Review's coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette, and I'll be your instructor for this class. And in this class, we're going to be discussing a very important topic, a very heavily tested topic, and that is consolidated financial statements. Before we dive into the material, though, let me just take a moment to give you some advice about the best way to use this class. The important thing to remember about a class like this is to avoid just sitting back passively and watching the class. You want to treat this like any other class. Take good notes. Later in the class, when we go to do problems, shut the class down. Get your answers to the problems before you come back and discuss the problems with me. I think you'll find if you do those simple things, you get much more out of this class, and that's what we both want. So with that said, let's get right into this topic. As I mentioned, in this class, we're going to be discussing the accounting issues that are raised when one company, called the parent company, acquires the outstanding voting common stock of another company, called the subsidiary company. And if a parent company acquires more than 50%, now that's key criteria, if a parent company acquires more than 50% of a sub's voting shares, that represents control. Now the parent company has control over the subsidiary company. And when a parent company has control over a subsidiary company, that parent and that subsidiary are required, they are required to prepare consolidated financial statements. Now, as I say, that's key criteria. Let's just go over that one more time. If a parent company acquires more than 50% of a sub's voting shares, and I have to warn you, I always have some students that talk as if it's 50% or more. It's not 50% or more. If a parent company acquires more than 50% of a sub's voting shares, that represents a controlling interest. And when a parent company has a controlling interest in a subsidiary company, consolidated statements are required. Now, why are consolidated statements required? Very simply, consolidated statements are required because we always work under a presumption that consolidated financial statements are more meaningful to shareholders, creditors, other interested parties. Consolidated statements, the argument would be, are more meaningful than if the parent and sub were to continue to issue separate statements. So that's the bottom line. That's the basic premise of this class, that consolidated statements are more meaningful than separate statements. Now, in this class, we are going to get into how you actually prepare consolidated financial statements. But I don't want to get into that quite yet. I want to start with something else first. We're going to start off this class by looking at the types of problems that come up in the exam where the parent company owns 50% or less of a sub's voting shares. And let me have you think about something right away. If a parent company owns 50% or less of a sub's voting shares, is there any way that parent and sub can prepare consolidated financial statements? No, because what's missing is control. Remember, we can only justify a parent and subsidiary combining their statements, consolidating their statements, when a parent company has control over the subsidiary company. And we know how control is defined. It's a parent owning more than 50% of sub's voting shares. So let me get to my point. If a parent company owns 50% or less of a sub's voting shares, and we agree there's no consolidation because there's no control, well, now the sub is just another investment on the parent's balance sheet. I hope you see that connection. If there's no consolidation because there's no control, well, then the subsidiary would just be another investment on the parent's balance sheet. So that's now going to be our focus. If the sub is just another investment on the parent's balance sheet, what is the proper way for the parent to account for the investment in the subsidiary? And as you probably know, there are two acceptable methods of accounting for investments in common stock. There is the cost method and there is the equity method. So I want to really begin this class by going over these methods because you have to be comfortable with these methods. We're going to begin with the cost method. And I really think the best way to study both of these methods is to know the journal entries for each method. If you know the journal entries for each method, you really can break down any problem that's in the exam on this. So let's start with the cost method. If you look at your viewer's guide, you'll see a problem. Let's say on January 1, a parent company purchased 1,000 shares of a sub's voting common stock and paid $10 a share. And notice the parent has decided to account for that investment under the cost method. What are the entries we'd make on the cost method? Well, first of all, on January 1, on the day of acquisition, the parent is going to debit investment in sub for the cost of the shares. That's 1,000 shares at $10 a share. So they're going to debit investment in sub for $10,000 and credit cash $10,000. So notice under the cost method, we establish the carrying value of the investment at the cost of the shares. All right, now let's say a year goes by. Let's say it's December 31, year one. And the sub has reported $10,000 of income. The question is, what entry would the parent make on its books under the cost method to reflect the fact that the sub has reported income? Remember, we're looking at this from the parent standpoint. So that is the question. What entry would the parent make on its books under the cost method to reflect the fact that the sub has reported income? And I think you know this. No entry. The parent makes no entry on its books under the cost method to reflect the fact the sub has reported income. Let's go ahead another year. Now let's say it's December 31, year two. And now the sub has reported a $20,000 loss. Same question. What entry would the parent make on its books under the cost method to reflect the fact that the sub has reported a loss? And again, there's no entry. So notice this. Under the cost method, we establish the carrying value of the investment at the cost of the shares. If the sub reports income, no entry on the parent's books. If the sub reports a loss, no entry on the parent's books. One more thing. What if the sub sends the parent a dividend? Let's say the sub sends the parent a $500 dividend. What's the parent going to do? Well, you know the parent's going to debit cash for what they collect, $500, and this is very important. The parent's going to credit dividend income, $500. Notice, under the cost method, parent treats dividends from the sub as dividend income. Now, one other point. When a parent has an investment in sub being accounted for under the cost method, that investment will be carried on the parent's balance sheet as one of the parent's available for sale securities. That's what this is. When a parent company has an investment in a subsidiary being accounted for under the cost method, then that investment is just carried on the parent's balance sheet as one of their available for sale securities. That's what this is. Now, I'm sure you see already the cost method is a very simple method. We establish the carrying value of the investment at the cost of the shares. If the sub reports income, no entry in the parent's books. If the sub reports a loss, no entry in the parent's books. And if the sub pays the parent a dividend, parent treats that dividend as dividend income. It's a very simple method. But I want to make a point. If you're in the exam and you get a problem on the cost method, I'd be suspicious because it's a very simple method. So if I were you and I'm in the exam and I get a problem on the cost method, I would always check to see if there's a liquidating dividend. Always check to see if there's a liquidating dividend. I mention this because a liquidating dividend is the one way to try to complicate the cost method just a little bit. Let me show you what I mean. Let's do another problem. Let's say on January 1, a parent company purchased 5% of a sub's voting shares. And again, we're assuming the parent does account for the investment under the cost method. We're going to assume a year goes by, and on December 31, the sub reports $100,000 of income. And one more point. Now let's assume that the sub sends the parent a $7,000 dividend. Let's think about it. If the sub sends the parent a $7,000 dividend, we know the parent is going to debit cash for what they collect, $7,000. And you see what they're hoping you do. They're hoping you sit in the exam and go, oh, it's the cost method, so the parent would just credit dividend income, $7,000. And you can't. You see why? In this problem, the parent owns 5% of the sub's voting shares. If the parent owns 5% of the sub's voting shares, what is the most that the parent could possibly participate in the current income of the sub? Up to 5%, up to $5,000. That's the dividend income. I'll say it again. Because the parent owns 5% of the sub shares, the most the parent could possibly participate in the current income of the sub is up to 5%, up to $5,000. That's the credit to dividend income, $5,000. Now, if the parent is sent a check for $7,000, what is the other $2,000? Well, the argument would be the other $2,000 is a return of capital. So the other $2,000 would be a credit to investment in sub, a return of capital. And I want you to know that that $2,000 that we credit to investment in sub, that's what the exam would mean by a liquidating dividend. You have to know how the exam talks. That is a liquidating dividend. And I think you see why I showed you that. It's really the one way the exam could complicate a problem that on the surface looks like a simple little cost problem. Please go in your viewer's guide to multiple choice question number 1. It says an investor, in other words a parent, uses the cost method to account for an investment in common stock classified as an available for sale security. That makes perfect sense. Notice the wording. Then they say dividends received this year exceeded the investor's share. Dividends received this year exceeded the parent's share of investees' undistributed earnings since the date of the investment. Didn't they just describe in words the problem that we just did, where the parent got a dividend greater than their 5% share? The amount of dividend revenue, notice they're very precise here, the amount of dividend revenue that would be reported in the investor's, the parent's income statement for the year would be what? How about A? Is dividend income the portion of the dividends received this year that were in excess of the investor's share? No. Anything you receive this year that's in excess of your 5% share is a return of capital. That's not dividend revenue. That's a liquidating dividend. How about B? Would dividend revenue be the portion of dividends received this year that were not in excess of the investor's share? That's right. The answer is B. Anything you receive this year that is not in excess of your 5%, your 5% share, that would be dividend revenue. I hope you're with me on the cost method, because now we're going to move on to something that's a little bit more challenging. Now we're going to get into the equity method. And here's the bottom line. If a parent company has significant influence, notice that phrase, it's a key phrase. If a parent company has significant influence over a subsidiary company, then the equity method is required. If a parent company has significant influence, notice, not just any influence, it has to be a significant amount of influence over a subsidiary company, equity method is required. Let's cover all possibilities. If a parent company does not have significant influence over the subsidiary company, well, then the cost method is required. That is the bottom line. If a parent company has significant influence over the subsidiary company, equity method is required. If a parent company does not have significant influence over a subsidiary company, cost method is required. That is the bottom line. So you know what we're leading to. How do you determine significant influence? How do we know in practice how much influence is a lot of influence? How do we know how much influence is a significant amount of influence? Well, here's what you have to do. First, we have to look for evidence. Is there any clear evidence that the parent has a lot of influence over the subsidiary? I'll give you some examples. For example, if the parent is on the sub's board of directors. If the parent is on the sub's board of directors, that's evidence of significant influence. Another one, if a parent makes policy-making decisions for the subsidiary company, well, that would be evidence of significant influence. I'll give you another one. If the parent is the largest single shareholder in the subsidiary company, that would be evidence of significant influence. So you see how we're supposed to evaluate evidence. If a parent company is on the sub's board of directors, well, that's evidence of significant influence. If the parent makes policy for the subsidiary company, that's evidence of significant influence. If the parent is the largest single shareholder in the subsidiary company, that's evidence of significant influence. In practice, we're supposed to see if there's any clear evidence that the parent has a lot of influence over the sub. But then there's something else you have to factor into this. What if there is no evidence? What if there's no clear evidence to go by? Well, if there's no clear evidence to go by, we have a guideline. If a parent company owns 20% or more, notice I didn't say more than 20%. I said 20% or more of the sub's voting shares, well, then you just assume significant influence. Equity has to be used. So don't forget, you have that guideline. First, you look for evidence. But if there's no clear evidence, we've got that guideline. If a parent company owns 20% or more of the sub's voting shares, well, then we just assume significant influence. Equity would have to be used. Let me have you think about something. Would it be possible for a parent to own 2% of the subsidiary's voting shares and have significant influence? Is that possible? Sure. Because the parent could be on the sub's board of directors. The parent could make all the policy for the sub. Remember, if there's evidence of significant influence, equity is required. It doesn't matter what percent of the stock you own. You only use the guideline if there is no evidence. Let me ask you this. Could a parent own 42% of a sub's voting shares and not have significant influence? Yes, it's possible, because another company could own the 58% and control everything. You don't really have a say in anything. It's possible. And I'm not just trying to drive you crazy here. The exam plays games with this. The people that write this exam know that a lot of people take the exam, hopefully not my students, but a lot of people take the exam. And all they know about equity is 20% or more equity, under 20% cost. That's what a lot of people, that's really the extent of what they know. But it's more complicated than that. First, you look for evidence. Evidence comes first. And then if there is no evidence, then you have your guideline. So the exam can play around with that. In other words, you could be in the exam, they could say, Jones owns, 3% of Smith stock, but Jones is on Smith's board of directors. Jones makes all the policy for Smith. That's an equity question. Because if there's evidence of significant influence, it doesn't matter what percent of the stock you own. Equity is required. Or they could go the other way. The exam could say Jones owns 41% of Smith stock and does not have significant influence. That's a cost question. So I hope you're clear on how we're going to know in the exam we have an equity question. Why don't we do an equity problem? And here once again, the best way to study this, I believe, is to know the journal entries for the equity method. If you know the journal entries for the equity method, you're going to be strong. So if you look in your viewer's guide, you'll see an equity problem. On January 1, parent purchased 20% of the sub's voting shares and paid $280,000. Stop right there. You see how you take the exam? You're in the exam. When you read that sentence, the parent purchased 20% of the sub's voting shares for $280,000. You sit in the exam and say, I have no evidence to go by, so I've got no choice but to use my guideline. 20% or more, I assume that they do have significant influence. Equity is required. I'm not minimizing how important that guideline is. It's extremely important. You use it a lot in the exam. All I'm saying is the guideline all by itself is not determinative. First you look for evidence, and if there is no evidence, then you have your guideline. But very often in the exam, you use the guideline. So we're assuming this is an equity question. We're assuming the parent does have significant influence, so it is an equity question. Notice the next line. The fair value of the sub's net assets on that day, total $1 million. A year later, December 31, the sub reports $60,000 of net income, and during the year, the sub paid $12,000 in dividends. Let's go through the entries under the equity method. First of all, on January 1, on the day of acquisition, the parent is going to debit investment in sub for $280,000, credit cash $280,000. So notice, on the day of acquisition, we still establish the initial carrying value of the investment at the cost of the shares. So January 1, the parent on their books is going to debit investment in sub for the cost of the shares, $280,000, credit cash $280,000. So what you're noticing is, on the day of acquisition, the cost and equity method are identical on that day. Now a year goes by, it's December 31, and the sub reports $60,000 of net income. I know you know this. When the sub reports income like this, this is the first place where the equity method will be dramatically different from the cost method. Why? Because under the equity method, the parent automatically picks up their share of that income. And I know you've seen this before. The basic thinking is, because the parent owns 20% of the sub's voting shares, the parent will automatically pick up 20% of that income, or $12,000. Now, what's the entry? The parent's going to debit investment in sub for $12,000, 20% of the sub's income. Notice the carrying value of the investment rises by $12,000. What does the parent credit? It's an account name you have to get used to. Equity in the earnings of a subsidiary. That's the credit. Equity in the earnings of a subsidiary. You know what that represents. That's investment income for the parent. That's investment income for the parent. That's going to end up on the parent's income statement for year one. But don't call it investment income. The account name the exam likes would be equity in the earnings of a subsidiary, or equity in the losses of a subsidiary, because that's the bottom line with the equity method. Under the equity method, the parent automatically picks up their share of the reported net income or loss of a subsidiary. How about the dividend? During the year, the sub paid $12,000 in dividends. Well, you've got to assume if the parent owns 20% of the sub's voting shares, the parent would have gotten 20% of that dividend, or $2,400. What's the entry for the parent? Well, you know the parent's going to debit cash for what they collect, $2,400. And this is very important. What does the parent credit? Investment in sub. Notice the credit is to the investment account. Why? Because under the equity method, parent treats dividends from the sub as a return of capital. That's one of the major differences in the methods. Under the cost method, parent treats dividends from the sub as dividend income. But under the equity method, parent treats dividends from the sub as a return of capital. One other point. When a parent has an investment under the equity method, how will it be carried in the balance sheet? If a parent has an investment being accounted for under the equity method, how is it carried on the parent's balance sheet? Here's what I'd like you to do. Wherever you have these entries, we're going to set up a T account for investment in sub, and let's post these entries to that T account. We know on January 1, when the parent purchased 20% of the sub shares for $280,000, we know that would have been a debit. That would have been a debit to investment in sub for $280,000, credit cash $280,000. We know that. We know when the dividend came in, that would have been a debit to cash $2,400 and a credit to the investment account $2,400. It's a return of capital. And we know at December 31, parent would have automatically picked up their share of sub income, or $12,000, 20% of $60,000, and that would have been a debit to investment in sub, $12,000, credit equity and sub earnings, $12,000. If you post the entries to the T account and you do out the math, right now, after all that activity, investment in sub is at $289,600. In other words, this investment would be on the parent's balance sheet at $289,600. That is generally accepted accounting principles. Now, you see in your viewer's guide that we also have to do a goodwill calculation. I want to make sure you're good at this. Going into that exam, you've got to be able to do a goodwill calculation. Let's do the goodwill calculation. The key to the goodwill calculation is the second line down in the problem. They told us that the fair market value of the sub's net assets on the day of acquisition total $1 million. Now you stop and think, what percent of those net assets has the parent purchased? 20%. I'm sure you know that. If I buy 20% of your outstanding voting shares, I just bought 20% of your net assets. One follows the other like day follows night. And the point is that a 20% interest in $1 million is worth $200,000. What did the parent pay for that stock? $280,000. So there is $80,000 of goodwill here. Now let me ask you a question. Now that we've proven that there is $80,000 of goodwill, and you've got to be able to do that goodwill calculation, but now that we've proven that there's $80,000 of goodwill, does the parent set up a goodwill account on their balance sheet for $80,000? No. No, that $80,000 is in the $289,600. In other words, of the investment in sub balance, $289,600 that's on the parent's balance sheet, $80,000 represents goodwill. And they could ask you that. How much of the investment balance is represented by goodwill? $80,000. But there's no separate goodwill account. All we're doing is applying an accounting method to an investment. And $80,000 of that investment represents goodwill. Do we amortize that goodwill? You know we do not. Goodwill is not amortized. It's tested for impairment, at least annually. How do we test this goodwill for impairment? Well, there's actually a fairly simple test. If there's ever a permanent decline in market for that investment, notice how I put that. If there's ever a permanent decline in market for that investment, not a temporary decline. We know every day the stock market goes up, it goes down. That's not what we're talking about. But if there's ever a permanent decline in market for that investment in sub, then you would take a loss to the income statement and you'd write the investment down. That's how you test that goodwill for impairment. If there's ever a permanent decline in market for that investment, well, then you take a loss to the income statement and write the investment down to market. But goodwill, as you know, is not amortized. It's tested for impairment at least annually. Now, we're not done with this topic yet. I started by asking, well, how does the parent report this investment in sub on their balance sheet? Well, let me ask. Is this investment in sub, this $289,600, is that a held-to-maturity security? No, it's not. Remember, held-to-maturity securities are debt securities. This is an equity security, so it's not held-to-maturity. Is it trading? No, it's not a trading security. Is this an available-for-sale security? It is not an available-for-sale security. I want you to remember that equity investments are carried separately on the parent's balance sheet. Remember that. equity investments are carried separately on the parent's balance sheet. I'd like you to try some questions. I'd like you to shut the class down, do questions 2, 3, and 4, and then come back and we'll go through them together. Welcome back. Let's do these questions together. Number 2 says, when the equity method is used to account for investments in common stock, which of the following affects the investor, in other words, the parent's reported investment income? How about the first column? How about a change in the market value of the sub's common stock? Now, you know, we just went through the equity method, went through all the entries. Did I ever mention a change in market prices? No, a change in market prices would have nothing to do with the investor's reported investment income from the investee, from the subsidiary. Nothing to do with it at all. So no in the first column. How about the cash dividends from the investee? How about cash dividends from the subsidiary? Does that affect the parent's share of investment income, the parent's reported investment income? No. Cash dividends from the investee are a debit to cash and a credit to the investment account. It's a return of capital. Cash dividends are a return of capital. They don't affect income at all. So be careful. Don't make a sloppy mistake. Double no is the answer, D. Number 3. On January 2nd of the current year, Well purchased 10% of Ray's outstanding stock for $400,000. Let's stop right there. We know whatever method Well is using, whether it's cost or equity, you always start the same way. We know on January 2nd, Well would have debited investment in Ray for the cost of the shares, $400,000, and credit cash, $400,000. We know on the day of acquisition, the cost and equity method are identical anyway. We haven't even nailed down the method. If you go right to the bottom, it says, in the December 31 balance sheet, what amount would Well report the investment in Ray? Well, you see why answer C is there. Now, I don't think you fell for this. We just talked about it. But a lot of students would go for answer C. Because what are they thinking? They're thinking, Well owns 10% of Ray's stock. That's below 20%. They just are under the cost method. They're just trying to fool me. The investment would be kept at cost, $400,000. But we know that the 20% is just a guideline. If there's no evidence to go by, and they gave you evidence. They went on to say, Well is the largest single shareholder in Ray, and Well's officers are a majority on Ray's board of directors. When there's evidence of significant influence, it doesn't matter what percent of the stock you own, equity method is required. So let's apply the equity method. We know that Well would automatically pick up their share of Ray's income. Ray's income for the year, $500,000. Well would pick up their share, 10%. What's the entry? We know Well is going to debit investment in Ray for $50,000, credit equity and sub-earnings or investment income, $50,000. Also, there's a dividend. During the year, the sub-Ray declared and paid $150,000 in dividends. Well, you've got to assume that if Well owns 10% of Ray's shares, Well would have got 10% of that dividend, or $15,000. So what did Well do for that? They would have debited cash $15,000, and you know, credit investment in sub, $15,000. Because dividends are treated not as income, are return of capital. So if you look at those entries, what happened to investment in sub? Well, investment in sub started at $400,000. It went up $50,000 when Well picked up their share of sub income, went down $15,000 because the dividend is a return of capital. The answer is B. Investment in Ray at December 31 is now reported at $435,000. And let me just quickly say that I'm showing you the entries because I'm trying to make my thinking as clear as possible, but I'm not saying you have to do entries in the exam. You could say, well, Bob, I'm getting comfortable enough with this. I knew it was a plus 50, a minus 15. It's going to be 435. I don't have to do entries. That's fine. As I say, I'm just showing you entries to try to make my thinking as clear as possible. Number 4, Burke purchased 30% of Sled Company's outstanding stock on December 31 of the current year for $200,000. On that day, the sub-stockholders' equity was $500,000. The fair value of the identifiable net assets, $600,000. And on December 31, what amount of goodwill would Burke attribute to this acquisition? This is why I mentioned earlier that you can't really go in the exam and not know how to do a goodwill calculation because they can ask. All right, what's my starting point here? If I'm going to work out goodwill, if I have to actually calculate it, do I use as my starting point, 500,000 or 600,000? That's right, 600,000. The fair value of the sub's net assets on the day of acquisition. Remember, by definition, goodwill is defined as what someone's willing to pay over fair value for net assets, not over book value. It's what someone is willing to pay over fair value for net assets. So we know that the fair value of the sub's net assets on the day of acquisition totaled 600,000. And you think to yourself, well, what percent of those net assets did Burke purchase? 30%. And the point is that a 30% interest in 600,000 is worth 180,000. But Burke paid 200,000 for the stock. If Burke paid 200,000 for the stock, there is 20,000 of goodwill in this acquisition, and the answer is B. Make sure you know how to do a goodwill calculation. What I'd like you to do is shut the class down, do number 5, and then come back. Welcome back. I hope you tried this question, and I have a question for you. You're in the exam, you've got number 5. My question is, how do you know it's an equity question? I'm asking because the word equity is nowhere mentioned in the question. They never say anything about the equity method. So my question again is, you're in the exam, you've got this question. How do you know it's an equity question at all? They never said equity. That's right. All you know is that Denver owns 3,000 of Eagle's 10,000 outstanding shares. That's 30%. If I've got no evidence to go by, I've got my guideline. If Denver owns 20% or more, here it's 30%, of the sub's voting shares, well, then I just assume significant influence. Equity would have to be used. And notice they didn't remind you. They didn't even mention the equity method. But it is an equity question. Now, during the year, the sub Eagle paid $40,000 in dividends on the common. Well, you've got to assume if Denver owns 30% of Eagle's shares, Denver would have gotten 30% of that dividend, or $12,000. So we know Denver would have debited cash $12,000, right? We know that. What do they want here? At the bottom it says, in the current year income statement, what amount of income from this investment would Denver report? You know what I'm asking. Is it answer C? Of course it's not C, because the credit would be to what? Investment in sub. That dividend's a return of capital, has no effect on income at all, right? That's how the dividend would be handled. Debit to cash, $12,000, credit the investment account, $12,000. It's a return of capital, has no effect on income at all. You know it's not answer C. But what we do know is that under the equity method, Denver would automatically pick up their share of Eagle's income. Eagle's income for the year was $120,000. Denver would pick up 30%, or $36,000. And that's answer A, and A is wrong. But it's tempting, isn't it? You see how somebody could go for A? It's a very tempting answer, but it's wrong. Now, why is it wrong? Let me just say that if you did pick A, and I'm not accusing you, but if you did pick A, I think that once you see this, you'd never make this mistake again. Let me have you think about something. In this problem, when did Denver acquire Eagle shares? That's right, July 1. Oh, July 1. Remember, under the equity method, the parent is entitled to pick up their share of sub-income since the acquisition, not for all time. Remember that. Under the equity method, the parent's entitled to pick up their share of sub-income since the acquisition. So in this problem, Denver's entitled to pick up their share of Eagle's income for the last 6 months. Now, did you notice this? They said that Eagle's income for the year was $120,000 and it was earned evenly. Well, if it was earned evenly, it would be $60,000 for the first 6 months, $60,000 for the last 6 months. So for the last 6 months, from July 1st on, Eagle earned $60,000 of income. Denver picks up 30%, their share. So debit investment in sub for $18,000, credit equity in sub earnings or investment income, $18,000, and the answer is B. So I had to show you that because dates do matter in an equity problem. And as I say, I think once you see that, I think it's the kind of thing that will always be on your mind. Let me ask you this. What if they had not said Denver earns their income evenly? What if they had not said that? You'd have to assume it. You'd have no choice. You cannot solve this problem if you don't know the sub's income for the last 6 months. So if they were silent, I'd have to assume that the sub earns their income evenly, $60,000 for the first 6 months, $60,000 for the last 6 months, and Denver picks up their 30% share. In my opinion, this is just my opinion now, but in my opinion, in a well-written exam, a student should never have to make an assumption. That's my opinion. I think in a really well-designed, well-written exam, a student should never be in the position of having to make an assumption. And I think that the CPA exam is really very good about that, but this is one of those cases where every now and then they'll put you in a position where you have to make an assumption. You have to. Because I can't solve this problem if I don't know the sub's income for the last 6 months. So if they were silent, I'd have no choice but to assume it's $60,000 for the first 6 months, $60,000 for the last 6 months, and Denver picks up their 30% share. Let's do number 6. Moss owns 20% of Dubro's preferred stock and 80% of their common stock. Then they give us the sub Dubro's stockholders' equity section at December 31, or a portion of it. Notice the sub is showing 10% cumulative preferred with a par of 100,000, common with a par of 700,000. The sub Dubro reported net income of 60,000 for the year ended December 31. What amount would Moss, the parent, record as equity in the earnings of Dubro for the year ended December 31? Now, before we solve this together, you see what they were hoping you'd do. They were hoping you'd sit in the exam and go, oh, wait, I see it. I see it. Moss owns 80% of Dubro's common stock. Moss would pick up 80% of that income, 80% of 60,000. Hello, B. I'm looking at you, answer B. It's not B. Now, why isn't it B? Well, I'm sure you see it. What do we have in this problem that we haven't had before in any problem? That's right. The sub has common and preferred stock outstanding, and the parent has an investment in both the common and the preferred stock of the sub. So that complicates this. Let's solve it together. We know that the sub's income for the year, Dubro's net income for the year, was 60,000. We know that. But remember, common can't get anything until the preferred dividend is taken care of. And notice this preferred is cumulative. Now, you may remember that with preferred stock, the annual dividend is a fixed rate on par value. So I'm going to take that fixed dividend rate, which is 10%, times the par for preferred, 100,000. The current year preferred dividend is 10,000. If you back out that 10,000, that tells you the net income available to common stockholders is 50,000. Notice I have to make that adjustment. And again, I have to make that adjustment because the preferred is cumulative. So even if that dividend is not declared, it goes into arrears. And common can't get anything until you settle the dividends in arrears anyway. So when you see it's cumulative, you back it out. You just have to back it out. As I say, if it's not declared, it goes into arrears. And common can't get anything until the arrears are settled anyway. So we back out the 10,000, and that tells us that the income that's available to common stockholders is 50,000. Now, what percent of that income that's available to common stockholders can Moss pick up? 80%. If you take 80% of 50,000, that gives you 40,000. And notice that's not an answer choice. Why? Because Moss also owns 20% of the sub's preferred stock. So Moss also has a 20% claim on the 10,000 preferred dividend. So pick up another 2,000. So the bottom line is that Moss's total ownership interest, total equity interest in all the sub's earnings would be answer A, 42,000. 40,000 of common earnings, and they also have a claim on 20% of the preferred dividend, 2,000. So Moss's total equity interest, total ownership interest in all the sub's earnings would be 42,000. I'd like you to shut the class down and do 7 through 10. Please do 7 through 10 and then come back. Welcome back. Let's do these questions together. In number 7, we once again have the question, how do we know it's an equity question? And of course, we know it's an equity question because Green owns 30% of Axle shares, so they're in the guideline, and they do say that Green has significant influence over Axle, so we know it is an equity question. Now, during the year, Axle, the sub, paid dividends of $100,000 on the common. Well, you've got to assume if Green owns 30% of Axle shares, Green would have got 30% of that dividend, or $30,000. So we know that Green would have debited cash $30,000. We know that. Now, what do they want here? At the bottom it says, what amount of dividend revenue? They're very precise here. What amount of dividend revenue would Green report in their income statement for the current year ended December 31? Well, you know what I'm asking. Is it answer B? Well, of course it's not answer B, because yes, they would have debited cash $30,000, but they would credit investment in sub $30,000. Under the equity method, which we know they use, Green would treat any dividends from Axle as a return of capital, not dividend revenue. So you know it's not B. Now, the sub also declared a $60,000 dividend on the preferred. What percent of that would Green get? All of it. Green owns 100% of the preferred stock, so we know that Green would debit cash $60,000. So let's look at our answers here. We know that there's no way it can be answer B, and if it's not B, it can't be D, because D is the 30 plus the 60, and we already know that the $30,000 is not dividend revenue. So what you're down to is A versus C. And of course the answer is C. For that dividend on the preferred, yes, they'll debit cash $60,000, and they will credit dividend revenue $60,000. The answer is C. Why? Because investments in preferred are always accounted for under the cost method. Remember that. Investments in preferred are accounted for under the cost method. The equity method is for investments in common, and I'm sure you know this. Why would it not be possible to exercise significant influence over another company by holding their preferred? That's right, because there's no voting rights. Remember, the whole idea behind preferred stock is you gave up your voting rights. You give up your voice in management, and you get preferential treatment. You get privileges that other shareholders don't receive. So you can't really exercise significant influence over another company when you're holding their preferred, because the preferred has no voting rights. So just remember that investments in preferred are accounted for under the cost method, so that $60,000 dividend would be a debit to cash, and yes, a credit to dividend revenue of $60,000. That's what they wanted, and the answer is C. Now, in 8, 9, and 10, we have a set. And it says that Grant acquired 30% of South. They're in the guideline. They also said that Grant exercises significant influence over South. So we know this is an equity set. Now, because they're asking for the carrying value of the investment, I like to set up a T account. So if we set up a T account for investment in South, let's start filling in the information. We know on January 2nd, year 3, when Grant acquired 30% of South shares for $200,000, they would have debited investment in South, $200,000, credit cash, $200,000. Then, at December 31, the sub South earned $80,000 of income and paid dividends of $50,000 for year 3. Well, we know under the equity method, Grant would automatically pick up their share of that income. So if South's income for the year was $80,000, Grant would pick up 30% or $24,000. Let's put that in the T account. Grant would debit investment in South, $24,000, credit equity and sub-earnings or investment income, $24,000. When the sub paid a $50,000 dividend, you've got to assume that Grant owns 30% of the shares, so Grant would get 30% of that dividend, or $15,000, so they would debit cash $15,000, credit the investment account because it's a return of capital. Those are the entries that have been made. Number 8 says, before taxes, what amount would Grant include in their year 3 income statement as a result of this investment? What's on the year 3 income statement? You know what I'm asking, A or B? Well, not A. The dividend, the $15,000, is return of capital. But the $24,000, 30% of the sub's $80,000 of income would be a debit to the investment account, credit equity and sub-earnings or investment income that would go to the parent's income statement? The answer is B, $24,000. Now, in number 9, they say in Grant's December 31 year 3 balance sheet, what would be the carrying amount of this investment? Well, we have the T account. It would be $200,000 plus 24 minus 15. Answer B, $209,000 would be the carrying value of the investment at the end of year 3. Now, the main reason I wanted us to do this set is because of question number 10. On July 1st, year 4, Grant goes out and sells half their shares in South for $150,000. And in number 10, they say in the year 4 income statement, what amount would Grant report as gain from the sale of the investment, gain from the sale of the stock? Well, can we agree that the carrying value of investment in South at the end of year 3, that was the question number 9, was $209,000. So the carrying value at the end of year 3 becomes the opening carrying value for year 4, $209,000. I think we agree on that. Carrying value of the investment at the beginning of year 4, $209,000. And here's the main thing I want you to remember from this set. If you sell off an investment that's been accounted for under the equity method, if you sell off an investment that's been accounted for under the equity method, you must apply the equity method up to the date of sale. That's really what they're testing here. Anytime you sell off an investment that's been accounted for under the equity method, you must apply the equity method up to the date of sale. If you don't, you won't have the proper carrying value and you won't get the proper gain or loss. So let's apply the equity method up to the date of sale. We agree that the carrying value of investment in South at the beginning of year 4 would be $209,000. Notice they said that the income for year 4 was $200,000, $100,000 for the first 6 months. That's what we need. So if the income for the first 6 months was $100,000, Grant would pick up their 30% share, so debit investment in South $30,000, credit equity and sub-earnings or investment income $30,000. Were there any dividends before the date of sale? No, there was a dividend, but that was not until October. But there were no dividends before the date of sale. If there were, you'd have to work the dividend in as a return of capital. You must apply the equity method up to the date of sale. So if we started year 4 with a carrying value of $209,000, Grant picked up their 30% share of South income for the first 6 months of year 4, $30,000. Let's agree that the carrying value of investment in South on the date of sale, $239,000. Now we can handle the sale. If Grant goes out and sells half the shares for $150,000, we know they're going to debit cash for what they collected, $150,000. We know they're going to credit investment in South for half of the carrying value. They sold half the shares, so credit investment in South for half of $239,000 or $119,500, and credit gain on sale for the $30,500. So the answer to number 10 is also B. There's the gain on sale. So don't forget that lesson, that if you sell off an investment that's been accounted for under the equity method, you must apply the equity method up to the date of sale. If you don't, you won't have the proper carrying value, you won't get the proper gain or loss. You must apply the equity method up to the date of sale. And isn't this another example of a problem where you might have to assume that the sub earns their income evenly? Here they broke it down for you. They said the income for year 4 was $200,000, $100,000 for the first 6 months. If they had said nothing like that, I'd have no choice but to assume that the sub earns their income evenly through the year. So if their income for year 4 was $200,000, it must have been $100,000 for the first 6 months, $100,000 for the last 6 months. I can't solve this problem if I don't have the parent pick up their share of sub income for the first 6 months. I have to know the sub's first 6 months income. So if they're silent, I'd have no choice but to assume the sub earns their income evenly. Just another example of a problem where you may have to make that assumption. Let's go to question number 11. We'll do it together. 11 says that Sage bought 40% of Adam's outstanding stock January 2nd of the current year for $400,000. So you read that first sentence, you're sort of thinking of the equity method. It's not nailed down, but they did buy 40%. Sage did purchase 40% of Adam's stock It's in the guideline, so we're thinking significant influence, equity. Then it says the carrying amount of Adams' net assets on the purchase date totaled $900,000. Fair values and carrying amounts were the same for all items except for the plant and for the inventory, for which fair values exceeded carrying amounts by $90,000 and $10,000 respectively. The plant has an 18-year life. All inventory was sold during the year. Goodwill, if any, will be tested for impairment each year. During the year, Adams reported net income of $120,000 and paid $20,000 in cash dividends. At the bottom it says, what amount would Sage, the parent, report in their income statement from this investment in Adams for the year ended December 31? Well, before we solve it together, you know what they wanted you to do. They wanted you to sit in the exam and go, oh, I see it. Sage owns 40% of Adams stock, so Sage would pick up 40% of that income, 40% of $120,000. Hello, A. I'm looking at your answer A. But somehow you knew it just wasn't that simple. It's not. Let's do an excess calculation. They said that the book value, the carrying amount of Adams' net assets on the purchase date totaled $900,000. Now you stop and think, what percent of those net assets did Sage purchase? 40%. If you take a 40% interest in $900,000, that comes out to $360,000. But Sage paid $400,000 for the stock. So there is a $40,000 excess here. Let me ask you a question. Is that goodwill? No. Remember, goodwill, by definition, is what someone's willing to pay over fair value for net assets. This $40,000 is what Sage was willing to pay over book value for net assets. This is an excess of cost over book value. Now you have to stop and think. Why was Sage willing to pay a premium over book value to acquire these net assets? Because this company has undervalued assets. I'm talking about the plant and the inventory. What you're dealing with here is undervalued assets. Let's start with the plant. They said that the fair value of the plant is $90,000 higher than its carrying amount. The plant is undervalued on the books. The plant has a fair value $90,000 than its carrying amount. And if you stop and think about it, if I buy 40% of your net assets, I just bought a 40% interest in that plant. So take 40% of $90,000, $36,000 of my $40,000 excess is traceable to the plant. By the way, if you have any doubts, this is a very difficult multiple choice question. In my opinion, this is about as difficult of a multiple choice as you'd ever see on the equity method. But it's something you've got to be ready for. Let's deal with the inventory. The inventory has a fair value $10,000 higher than its book value. It's undervalued on the books. And once again, if I buy 40% of your net assets, I just bought a 40% interest in that inventory. So $4,000 of my $40,000 excess is traceable to the inventory. That's how the excess breaks down. I hope you see how we trace this excess to undervalued assets. You might want to just write this in your notes. Just remember this difference. When there's an excess of cost over fair value, we call that goodwill. Again, anytime there's an excess of cost over fair value, we call that goodwill. And as you know, it's not amortized, it's tested for impairment, at least annually. But if there's an excess of cost over book value, you've got to trace that excess to undervalued assets. I hope you see how we trace that excess to undervalued assets. So why do we do this? Why do we trace the excess to undervalued assets? Because when you can trace your excess to undervalued assets, this excess is amortized over the remaining useful life of these assets. I'll say it again. When you can trace your excess to undervalued assets, this excess is amortized over the remaining useful life of these assets. Let's start with the plant. Well, no, let's back up. We know they're asking what's on Sage's income statement for the year ended December 31. Well, we know, first of all, that Sage would automatically pick up their share of sub-income. Sage would automatically pick up 40% of Adams' income of $120,000. So we know they would debit investment in sub, $48,000, credit equity in sub-earnings or investment income, $48,000. That's how we would start. But again, we know it's not answer A. Let's make our adjustments. when you can trace your excess to undervalued assets, this excess is amortized over the remaining useful life of these assets. I'll say it again. When you can trace your excess to undervalued assets, as we did here, this excess is amortized over the remaining useful life of these assets. So I'm going to start with the $36,000 of excess that I traced to the plant, and I'm going to amortize that over the remaining useful life of the plant, which is 18 years. So I take that $36,000 over 18 straight line years. I'm going to take $2,000 of amortization on that part of my excess. What's the entry? Well, this is very important. Don't debit amortization expense. If you debit amortization expense, it's going to get you down the wrong path. In the CPA exam, they always take this amortization as a direct reduction of investment income. Again, don't debit amortization expense. It'll get you messed up. In the CPA exam, they always take this amortization as a direct reduction of equity and sub-earnings. So I'm going to debit equity and sub-earnings or investment income, $2,000, credit the investment account, $2,000. How about the $4,000 of excess that I traced to the inventory? How much of that should I amortize? All of it. Why? Because they said they sold it all. If they sold half, I'd amortize half. If they sold a quarter, I'd amortize a quarter. But they said they sold it all. So I amortize all of it. And once again, I take this amortization as a direct reduction of equity and sub-earnings. So I'm going to debit equity and sub-earnings, $4,000. Don't debit amortization expense. It's just going to get you down the wrong path. Take this amortization as a direct reduction of equity and sub-earnings or investment income. So I'm going to debit equity and sub-earnings or investment income, $4,000, credit the investment account, $4,000. So now that I've made my adjustments, when they ask me at the bottom, what amount would Sage report in their income statement from this investment in Adams? Well, we started with $48,000 equity and sub-earnings, but we lowered it by 2 and we lowered it by 4 because of my amortization, and the answer is B. It's a hard question, but as I say, you've got to be ready for it. If there's an excess of cost over fair value, we call that goodwill. But if there's an excess of cost over book value, you've got to trace that excess to undervalued assets. Because when you can trace your excess to undervalued assets, this excess is amortized over the remaining useful life of these assets. I'd like you to try number 12. Try number 12, get your answer, and then come back. Welcome back. Let's look at this question together. They say on January 2nd, Keene purchased a 30% interest in Pod for $250,000. And at the bottom they're saying in the December 31 year-end balance sheet, what amount would Keene report this investment in sub? Well, because they want to know the carrying value of the investment at year-end, I think you know I like a T account. So we're going to set up a T account for investment in Pod, and we'll work it through. We know on January 2nd, when Keene purchased a 30% interest in Pod for $250,000, they would debit investment in Pod, $250,000, credit cash, $250,000. Now we know this is an equity question because, first of all, they're in the guideline. Keene does own 30% of Pod's shares. That's 20% or more. I'd assume significant influence anyway, but here they did say it. Keene accounts for this investment under the equity method. So it is an equity question. Let's apply the equity method. We know under the equity method that Keene would automatically pick up their share of Pod's income. Pod's income for the year, $100,000. Keene would pick up 30% and put that in. Debit investment in Pod, $30,000. Credit equity and sub-earnings or investment income, $30,000. But you can't stop there. Let's do an excess calculation. They said that Pod's stockholders' equity totals $500,000. That's the book value of Pod's net assets. Book value, $500,000. Now, Keene acquired a 30% interest in that. So if you take 30% of $500,000, that comes out to $150,000. But Keene was willing to pay $250,000 for the shares. So there is $100,000 excess in this problem. It's not goodwill because, as you know, goodwill is an excess of cost over fair value for net assets. This $100,000 is an excess of cost over book value. Now, why was keen, willing to pay a premium over book value? Because there are some undervalued assets, the plant and equipment. The plant and equipment have fair values $200,000 higher than book values. And if you think about it, if I buy 30% of your net assets, I just bought a 30% interest in that plant and equipment. So take 30% of 200,000, 60,000 of my 100,000 excess is traceable to that plant and equipment. The other 40,000 must be goodwill because there are no other undervalued assets. So the other 40,000 must be what I paid over fair value for net assets. That 40,000 would be goodwill. Now, as you know, we don't amortize goodwill. We test it for impairment, at least annually. But the 60,000 of excess I trace to the plant and equipment will be amortized over the remaining useful life of the plant and equipment, and that's 10 years. So I'm going to take that 60,000 of excess that I trace to the plant and equipment, divide by 10 straight line years, and you know what my entry is. I don't debit amortization expense. I debit equity and sub-earnings, 6,000, credit the investment account, 6,000, and when I put that in the investment account as a credit for 6,000, investment and sub at December 31, year end, comes out to 274,000. Answer D. Now, there's one more thing that we have to discuss with the equity method before we leave the equity method, and that is how you handle a step-by-step acquisition. Now, what is a step-by-step acquisition? Well, what you're looking for in the exam is a problem where it takes more than one purchase of stock to acquire significant influence over the sub. Again, a step-by-step acquisition is a situation where it takes more than one purchase of stock to acquire significant influence over the subsidiary. Let me give you an example. Let's say on January 1, year 1, parent company purchased 8% of a sub shares. So what would be your assumption in the exam? Well, parent purchased 8% of the sub stock. They're below 20%. I've got no other evidence to go by. I'd have to assume they do not have significant influence. I'd have to assume they'd be on the cost method. Now we're going to assume some time goes by, and then on July 1st, year 2, the parent purchased an additional 6%, of the sub's voting shares. So as of July 1, year 2, now the parent owns 14% of the sub's voting common stock. They're still below 20%. I have to assume there's no significant influence. As far as I know, they'd still be on the cost method. Now we're going to assume some more time goes by, and then on July 1st, year 3, parent company purchases an additional 11% of the sub's voting shares. As of July 1st, year 3, what percent of the sub stock does the parent now own? 8% plus 6% plus 11%. Now the parent owns 25% of the sub shares. Now it's 20% or more. I'd have to assume there is significant influence. So they would switch over to the equity method. July 1st, year 3. So this is the type of problem that you're looking for. It's a problem where it takes more than one purchase of stock to acquire significant influence over the subsidiary company. So what do we do in a case like this? Well, I'll give you a note. In a step-by-step acquisition, once you determine that the parent does have significant influence over the sub, I'll say it again, in a step-by-step acquisition, once you determine that the parent does have significant influence over the subsidiary company, as we have here, we must retroactively apply the equity method all the way back to the first purchase of shares. So that's what you're up against here. In a step-by-step acquisition, once you determine that the parent does have significant influence over the sub, you must retroactively apply the equity method all the way back to the first purchase of shares. So that's our job here. We have to go back in time and retroactively apply equity all the way back to January 1, year 1. Now, I don't know if you see the wrinkle yet that bothers a lot of people. Look at the situation. Look at the problem. We know that if we're going to retroactively apply equity all the way back to January 1st, year 1, now the parent has to pick up their share of sub-income for those years. So what percent do you pick up? 8%, 6%, 11%, 25%, 14%, 17%, 19%. I just want you to appreciate that there's all these percentages floating around in there. And that's where a lot of students seem to freeze. So I'm going to give you my rule. I always tell my students, if you can just know this rule will take you through any step-by-step acquisition. Here's the rule. The rule is, when you retroactively apply equity, always make your adjustments based on the ownership percentage that existed at the time the income was earned. When you retroactively apply equity, you always make your adjustments based on the ownership percentage that existed at the time the income was earned. You make your adjustments based on the ownership percentage that existed at the time the income was earned. So let's apply the rule. We go back to year one. What percent of the substock did the parent own all through year one? 8%. So the parent would be entitled to pick up 8%, their share. 8% of the sub's net income for year one. You make your adjustments based on the ownership percentage that existed at the time the income was earned. Since the parent owned 8% of the sub shares while the sub was earning their year one income, parent's entitled to pick up their share, 8% of that income. How about year two? What percent of the sub stock did the parent own for the first 6 months of year two? That's right, it was still 8%. So the parent's entitled to pick up 8% of the sub's first 6 months income. What percent of the sub stock did the parent own for the last 6 months of year two? 14%. So the parent's entitled to pick up 14% of the sub's last 6 months income. You make your adjustments based on the ownership percentage that existed at the time the income was earned. And of course, this is what the exam will do to you. No doubt they'll have the ownership interest change through the year, like it did here. Parent owned 8% of the sub stock while the sub was earning their first 6 months income in year two. Parent's entitled to pick up their share, 8% of the sub's first 6 months income. Since the parent owned 14% of the sub stock while the sub was earning their last 6 months income in year two, parent's entitled to pick up 14% of the sub's last 6 months income. And isn't this another type of problem where you may have to assume that the sub earns their income evenly through the year? Half and half. It's another one of those situations where you have to break the income out. How about year three? What percent of the sub stock did the parent own for the first 6 months of year three? It was still 14%. It didn't change till halfway through the year. So because the parent owned 14% of the sub stock while the sub was earning their first 6 months income in year three, parents entitled to pick up their share, 14% of the sub's first 6 months income. What percent of the sub stock did the parent own for the last 6 months of year three? 25%. So the parent's entitled to pick up 25% of the sub's last 6 months income. You make your adjustments based on the ownership percentage that existed at the time the income was earned. It's an important rule. And as I say, if you can remember that rule, it really takes you through any step-by-step acquisition. And as I mentioned, when the exam gets into this, they'll probably have the ownership percentage change through the year. I'd like you to try questions 13 and 14 and then come back. Welcome back. Let's look at these questions together. Number 13 says, on January 1 of the current year, Point purchased 10% of Iona's common stock. So what you thinking in the exam? You read that sentence, you say, well, Point owns less than 20% of Iona's shares. I've got no evidence to go by. As far as I know, Point would not have any significant influence. Point would be under the cost method. They're below 20%. Then Point purchased additional shares, bringing its ownership up to 40% on August 1. Well, now they've brought their ownership interest up to 40%. Now it is 20% or more. I've got no evidence to go by. Now I have to assume Point does have significant influence, so they'd switch over to the equity method. As you know, this is a step-by-step acquisition. And once you determine that Point does have significant influence, we must retroactively apply equity all the way back to the first purchase of shares, all the way back to January 1. How much income from the Iona investment would Point to year-end income statement report? Well, you know the answer is A. You make your adjustments based on the ownership percentage that existed at the time the income was earned. So the parent would pick up 10% of Iona's income from January 1 to July 31. You make your adjustments based on the ownership percentage that existed at the time the income was earned. Since Point owned 10% of Iona's shares, while Iona was earning the income from January 1 to July 31, Point's entitled to pick up their share, 10% of the income, from January 1 to July 31, and 40% of the sub's income from August 1st to December 31. The answer is A. They also said that Iona declared and paid a cash dividend on all its shares. Why don't I worry about the dividend? They mentioned the dividend. Why don't I worry about that? That's right, because if it's the equity method, dividends are a return of capital. They lower the investment account. They have no effect on investment income. No impact on the question at all. Number 14, because they're asking what amount would the parent report in its December 31 balance sheet as investment in TOT, because they want the carrying value of the investment, you know I like to set up a T account. So let's set up a T account for investment in TOT. We know that the parent purchased 10% of TOT shares on January 2nd for $50,000. So let's put that in the T account. We know on January 2nd they would debit investment in TOT $50,000, credit cash $50,000. Now, of course, your thinking in the exam is that as of January 2nd, the parent only owns 10% of the sub shares, 10% of TOT. They're below 20%. I have no evidence to go by. I'd have to assume, because they're below 20%, that the parent does not have significant influence. As far as I know, the parent would be under the cost method at that point. But then, on December 31, parent purchased an additional 20,000 shares, an additional 20% of TOT for $150,000. So let's put that in the T account. So December 31, there'd be a debit to investment in TOT, $150,000, credit cash, $150,000. As of December 31, now the parent owns 30% of TOT shares. Now I'd have to assume they do have significant influence. They would switch over to the equity method. And because this is a step-by-step acquisition, because it took more than one purchase of stock to acquire significant influence over the sub, we have to retroactively apply equity all the way back to January 2nd, all the way back to the first purchase of stock. Now, the sub's income for the year was $300,000. And they're asking me what amount would the parent report in the December 31 balance sheet for investment in TOT. Here's my point. If you think that because we're retroactively applying equity, because we have to retroactively apply equity all the way back to the first purchase of shares, which is January 2nd, if you think that the parent should pick up 10% of that income, 10% of $300,000, the answer would be C. If you think that the parent should pick up 30% of that income, the answer would be D. Isn't that where we are? Can we agree that A and B are just there for decoration? Nobody's thinking about A or B. I know you're not. But if you think that the parent should pick up 10% of TOT's income, $30,000, the answer would be C. If you think that the parent should pick up 30% of the TOT's income, $90,000, the answer would be D. You're down to two plausible answers. So how do you get from 2 to 1? How do you get it down to the answer? Well, my point is I gave you a rule. And what I'm hoping is that my rule would answer anything they dream up. What's my rule say? You make your adjustments based on the ownership percentage that existed at the time the income was earned. So let me ask you, what percent of TOT did the parent own while TOT was earning the income? That's right. While TOT was earning the income, it was 10%. The ownership interest didn't change till December 31. While TOT was earning the income, parent owned 10% of TOT shares. So the parent's entitled to pick up their share, 10% of that income, or $30,000, and the answer is C, not D. You make your adjustments based on the ownership percentage that existed at the time the income was earned. Now, I want to sort of summarize a little bit about what we've learned so far in this class. Now, assuming we have no other evidence to go by, now listen carefully now, assuming that there's no other evidence to go by, here's our basic guidelines. Don't we know that if a parent owns less than 20% of a sub's voting shares, then we assume what? The parent does not have significant influence. The parent would be under the cost method. True? And if the parent owns between 20 and 50% of the sub's voting shares, we assume the parent does have significant influence over the sub. Equity method would be required. But I want you to recognize that once you cross that 50% threshold, now you're no longer talking about significant influence. You're talking about control. It's a whole new world. It's a whole new universe. Because when you cross that 50% threshold, now we are no longer talking about significant influence. Now the parent has control over the sub. And when a parent company has control over a subsidiary company, consolidated statements are required. And that's what I want to get into next. What we're going to get into is how to prepare consolidated financial statements. And I want you to know that there is only one acceptable method of preparing consolidated statements. It is the acquisition method. Now, when you prepare consolidated statements under the acquisition method, your goal, and I think it's important, never lose sight of this, your goal in the acquisition method is to present the parent and the subsidiary companies as if they were one company. In a nutshell, that's what you're trying to do. Present the parent and the subsidiary companies as if they were one company. Now, why? Well, I want you to be ready for this basic argument. The basic argument is this. Once a parent company owns more than 50% of a sub's voting shares, once a parent has control over a subsidiary company, once a parent company controls the operations of the sub, the actions of the sub, the assets of the sub, the financial policies of the sub, in legal form, there are still two companies. Legally, there are still two companies. But in substance, there is only one economic entity. In substance, there's only one company because one company makes all the decisions. One company makes all the policies. One company controls all the operations. Who are we kidding? In substance, there is only one company, only one economic entity. And I want you to know that the CPA exam refers to the principle I just went over as the single entity concept. That's what this is called. The idea that in legal form there might be two companies, but in substance there's only one. And I know that you're aware of where this is all leading. If in substance there's only one company, how do intercompany transactions make any sense at all? How can the parent sell something to the sub and make a profit? If there's only one company, then in substance you just sold something to yourself and made a profit. How can there be intercompany payables, intercompany receivables, intercompany dividends, intercompany profits, intercompany losses, intercompany bonds? It's all ridiculous if you buy the original premise that once a parent company has control over a subsidiary company, in substance, there's only one company. So the bottom line is this. Your job in a consolidation is to identify and eliminate all the intercompany activity. That's what you have to do. And to get us into the type of elimination entries that you have to make in a consolidation problem, we're going to go right to a simulation. Because let's be honest, some topics in accounting just make a good simulation. And consolidation is a classic topic that just lends itself to be tested through a simulation. So we're not going to start in the minor leagues here. We're going to start in the major leagues. Let's do a whole simulation on consolidation. So I'd like you to go to your viewer's guide and take out the simulation for Jared and Munson. Let's look at Jared and Munson together. It says, On April 1 of the current year, Jared purchased 80% of the common stock of Munson Manufacturing for $6 million. So let's agree that if Jared purchased 80% of the common stock of Munson, then the other 20% of the stock is owned by what they call the non-controlling interest, what used to be called the minority interest. So the non-controlling interest owns the other 20% of the capital stock of the subsidiary. At the date of purchase, the book and fair values of Munson's assets and liabilities were as follows. So they give us the book values and the fair values of the sub's net assets on the day of acquisition on April 1. It says by year end, December 31, the following transactions had occurred during the year. The balance of Munson's net accounts receivable April 1 had been collected. The inventory on hand April 1 had been charged to cost of sales. Munson uses a perpetual inventory system in accounting for inventory. Prior to the year, Jared had purchased at face amount $1,500,000 of Munson's 7% subordinated debentures or bonds. The debentures mature 7 years, in 7 years on October 31, with interest payable annually on October 31. As of April 1, the day of acquisition, the machinery and equipment had an estimated remaining life of 6 years. Munson uses straight line. Munson's depreciation expense calculation for the 9 months ended December 31 was based on the old depreciation rates. The other assets consist entirely of long-term investments made by Munson, do not include any investment in Jared. During the last 9 months of the year, from April 1st on, the following intercompany transactions occurred between Jared and Munson. And we can see that Jared's been selling to Munson, Munson's been selling to Jared. Some of that merchandise is included in the purchaser's inventory at December 31. There's a balance unpaid at December 31. Jared sells merchandise to Munson at cost, but Munson sells merchandise to Jared at a regular selling price, which includes a normal gross profit margin of 35%. There were no intercompany sales between the two companies prior to April 1. Accrued interest on the intercompany debt is recorded by both companies in their respective accounts receivable, not interest receivable, and accounts payable, not interest payable. Just have to keep that in mind. And then at the bottom it says this business combination is being accounted for under the acquisition method. Complete the worksheet to prepare the consolidated trial balance for Jared and Sub Munson at December 31. Jared's revenue and expense figures are for the 12-month period, while Munson's are only for the last 9 months of the year. You may assume that both companies made all of the adjusting entries required for separate statements. Unless stated to the contrary, round all computations to the nearest dollar, ignore taxes. So if you look at the trial balance, look towards the bottom of the assets, you'll see that Jared does have investment in Munson Manufacturing at $6 million. Also, Jared has investment in Munson bonds for that $1.5 million. And this is what we're presented with. There's a lot going on here, a lot going on in this simulation. Well, I want you to know that when you see a simulation like this, it's a little intimidating because there is so much going on. But just at the outset, I want you to know that there are 2 major steps to breaking this down. 2 major steps to really solving just about any simulation on consolidation, where they give you a spreadsheet like this. The 2 steps are, number 1, you have to eliminate that investment account. On the trial balance, they have investment in Munson Manufacturing at $6 million. That account has to be eliminated in consolidation. Why? Because Jared and Munson represent only one economic entity. There's only one company. There's no other company to invest in. In essence, you're investing in yourself. So there's no question in consolidation, that account has to be eliminated. So that's the first thing, that's the first big thing you have to do, is eliminate that investment account. And then the other step, which is critical, is to go through all the additional information, they gave you quite a bit here, and see if there's any intercompany activity that needs to be eliminated. So if you do those 2 things, you'll break this down. If you eliminate the investment account, and number 2, if you eliminate all the intercompany activity that's mentioned in the additional information, you go through the tabs they give you. all the tabs of information, and look for any intercompany activity that has to be eliminated. And if you do those two things, you'll break the simulation down. Jared has on their trial balance investment in Munson $6 million. And as I say, that account has to be eliminated. Now, before we eliminate that account together, I want to do a couple of preliminary calculations. Don't we know that Jared paid $6 million for 80% of Munson's shares? So what's 100% of Munson's shares worth? Well, you set up an equation. You say 80% of X, 80% of the total value of Munson shares, X, must be worth $6 million. So as you know, whatever you do to one side of an equation, you have to do to both sides. So we're going to divide both sides by 80%. So what you end up with is that X, the total value of Munson stock, must be worth that $6 million divided by 80%. So if you work it out, the total value of Munson stock, the value of 100% of Munson shares, must be worth $7,500,000. That's the $6 million divided by 80%. So the total value of all the Munson shares, the value of 100% of Munson stock, must be worth $7,500,000. Now that I've got that $7,500,000, I can work out a couple of things. And again, I want to emphasize, I'm just doing a couple of preliminary calculations before I begin. Now that I've got that $7,500,000, I can do a goodwill calculation. If the fair value of 100% of Munson stock is $7,500,000, what's the fair value of Munson's net assets? Well, go back to the first page of the problem. Notice the fair value of all the assets adds up to $10,715,000. The liabilities add up to $5,515,000. So what's the fair value of the sub's net assets on the day of purchase? $10,715,000 minus $5,515,000, $5,002,000. So now let's work it out. If the total fair value of 100% of Munson shares equals $7,500,000, and the net assets have a fair value of only $5,002,000, then the total goodwill in this problem comes out to $2,300,000. In other words, if someone were to buy all of Munson shares, they'd have to pay $7,500,000 cash for net assets that only have a value of $5,002,000. So the implied fair value of total goodwill in this problem is $2,300,000. We can also work out the total fair value of the non-controlling interest. The non-controlling interest owns 20% of the capital stock of Munson, 20% of the net assets of Munson. So if the total value of 100% of the shares of Munson adds up to $7,500,000, and the non-controlling interest owns 20% of that $7,500,000, take 20% of $7,500,000, the fair value of the non-controlling interest on the day of acquisition on April 1 comes out to $1,500,000. Hope you see where I got that number. If 100% of Munson stock is worth $7,500,000 and the non-controlling interest has a 20% interest in that $7,500,000, take 20% of $7,500,000, the fair value of the non-controlling interest on April 1, the day of acquisition, is $1,500,000. Remember that under the acquisition method, we have to value that non-controlling interest at its total fair market value. And we now know that the non-controlling interest has a fair value on the day of acquisition of $1,500,000. All right, with those preliminary calculations out of the way, that gives me a couple of numbers to play with. Now let's do the first major thing that we have to do in any consolidation problem. The main elimination entry that you make in any consolidation problem is to eliminate that investment account. On Jared's trial balance, they're showing big as life. Investment in Munson Manufacturing, $6 million. We're going to have to eliminate that investment account. Now, I'm going to give you a little checklist here because this is a little bit involved. To eliminate that investment account, it's going to take 3 steps. Let me list them down. Here's a little checklist, and I'd memorize it. Here's a little checklist that you'll need to eliminate the investment account. Number 1, you have to record the goodwill. Number 2, you have to write the sub's net assets to fair market value. And number 3, you have to eliminate the capital structure of the sub. If you do those 3 things, you'll eliminate the investment account. Again, you have to record the goodwill. You have to write the sub's net assets to fair value. And number 3, you have to eliminate the sub's capital structure. Do those 3 things, you'll eliminate the investment account. And also by doing those 3 things, you will also record the total fair value of the non-controlling interest. So let's go through the 3 steps. Step 1, we have to record the goodwill. Didn't we work out that if the total value of 100% of Munson shares is $7,500,000 for net assets that only have a fair value of $5,200,000, then total goodwill in this business combination comes out to $2,300,000. So let's record that goodwill. My first entry, I'm going to debit goodwill $2,300,000. I'm going to record that goodwill. I'm going to debit goodwill $2,300,000. And that goodwill, that's going to be on the consolidated balance sheet. That's the goodwill in the purchase. So I debit goodwill $2,300,000. Now, how do I finish the entry? I'm going to credit investment in sub. I'm going to credit investment in Munson for 80% of that $2,300,000, which is $1,840,000. I'm starting to eliminate the investment account now. So I'm going to credit investment in Munson Manufacturing for 80% of $2,300,000, $1,840,000. And I'm going to credit the non-controlling interest for 20% of the goodwill, 20% of $2,300,000 or $460,000. That's my first entry. I have to record the goodwill. I credit investment in Munson for 80% of $2,300,000, which is $1,840,000. That's the first step to getting the investment account down to 0. And I credit non-controlling interest for their share of goodwill, 20% of $2,300,000 or $460,000. All right, that's the first step. Now, the second step is to write the sub's net assets to fair value. This is an adjustment that you have to make in the acquisition method. The sub's net assets have to be written to fair value. So let's look at the first page of the problem again. There's no difference between book and fair value for, of course, the cash, the notes receivable, the accounts receivable. Let's go to the inventory. Notice the inventory has a book value of $828,000 and a fair value of $700,000. And if you remember, in the additional information, they said that the inventory on hand, April 1, had been charged to cost of sales. Munson uses a perpetual inventory system in accounting for inventory. So that beginning inventory, April 1, has now been charged to cost of sales. And it was overstated. That would have been charged to cost of goods sold at $828,000. The entity should have charged it to cost of goods sold at its fair value, $700,000. So if the beginning inventory was overstated by $128,000, cost of goods sold is overstated by $128,000 because that's been charged to cost of goods sold. So I'm going to credit cost of goods sold, $128,000. How about the land? The land has a book value of $1,560,000, a fair value of $2,001,000. So I'm going to debit land, $540,000. I write the land to its fair value. So debit land, $540,000. That'll bring land from a book value of $1,560,000 up to a fair value of $2,001,000. Machinery and equipment, I have to write from a book value of $7,850,000 to a fair value of $10,006,000. So I'm going to debit machinery and equipment $2,750,000. Accumulated depreciation, we're going to write from a book value $3,250,000 to a fair value of $4,000,000. So I'm going to credit accumulated depreciation $750,000. Now, if you really look at that, what I'm doing is writing the machinery and equipment up $2,000,000, up to fair value, but here they decided to actually work out a fair value figure for the accumulated depreciation, which is a little bit odd, but we're just going to do what we're instructed to do. So I debit machinery and equipment for $2,750,000, credit accumulated depreciation $750,000. How about other assets? Other assets have a book value of $140,000, a fair value of $50,000, so I'm going to credit other assets $90,000. I write up to fair value or down to fair value. But an adjustment you make in the acquisition method is to write the sub's net assets to fair value. All right, now, if you add it all up, what did I just do? Didn't I write the sub's assets from book value $8,393,000 to fair value, 10,715,000. I just wrote the sub's assets up 2,322,000. That's what I just did, only I did it piece by piece. But I just wrote the sub's assets up 2,322,000. So I'm going to credit investment in sub for 80% of that adjustment. 80% of 2,322,000, or 1,857,600. Again, I'm going to credit investment in Munson. It's another step in getting the investment account down to zero. I'm going to credit investment in Munson for 80% of 2,322,000. I just wrote the sub's assets from book value 8,393,000 to fair value 10,715,000. I wrote the sub's assets up 2,322,000 to fair value. So I'm going to credit investment in Munson for 80% of that adjustment, 80% of 2,322,000, or 1,857,600. And I'm going to credit non-controlling interest for 20% of that adjustment, 20% of 2,322,000, or 464,400. That's the entry where I write the sub's net assets to fair value. As I say, this is an adjustment you have to make in the acquisition method. And then finally, one more adjustment to get the investment account down to zero. I have to eliminate the capital structure of the sub. So if you go back to the first page of the simulation, you'll see that the sub is showing common stock $1 million, additional paid-in capital $872,000, retained earnings $1,006,000. If you look on the spreadsheet, they're the same numbers. For Munson Manufacturing, common stock is $1 million, APIC is $872,000, and retained earnings is $1,006,000. The numbers are the same. Why are the numbers the same? Because they're not going to change until, those are the beginning balances. April 1, in common stock, additional paid-in capital, and retained earnings. Those are the beginning balances, April 1. Still on my spreadsheet, December 31, and of course those numbers will change when I work out the net profit or net loss for the year. That'll change retained earnings, but this is just a trial balance, so we still have those beginning balances. But in my third adjustment, to get rid of the investment account, I have to eliminate the capital structure of the sub. So now I debit the sub's common stock, $1 million. I debit the sub's additional paid-in capital, $872,000. I debit the sub's retained earnings, $1,006,000. I have to eliminate 100% of the capital structure of the sub. Why? There is no sub. It doesn't exist. Remember, the whole premise of this problem is that Munson has been consumed by Jared. Munson doesn't exist anymore. Munson has been consumed by Jared. The parent has consumed the sub. That's the way to look at this. So Munson doesn't exist anymore. I'll put it this way. There's only one capital structure that you'd ever carry over to the consolidated balance sheet, and that's the capital structure of the parent. The parent is the surviving entity, along with the non-controlling interest, which again, we're in the process of building. All right, so I'm going to debit the sub's common stock, $1 million. I'm going to debit the sub's APIC, $872,000. I'm going to debit the sub's retained earnings, $1,006,000. I always, in my main entries, eliminate 100% of the capital structure of the sub. Now what do I do? Well, I'm going to credit investment in Munson Manufacturing for 80% of this adjustment. Now, what does it all add up to? Well, common stock is $1 million, APIC is $872,000, retained earnings is $1,006,000. So the total net assets of the sub add up to $2,878,000. So I'm going to credit investment in Munson Manufacturing for 80% of $2,878,000, or $2,302,400. I'm going to credit investment in Munson Manufacturing for 80% of this adjustment, 80% of $2,878,000, the total net assets of the sub. So credit investment in Munson Manufacturing, $2,302,400. And I'm going to credit the non-controlling interest for 20% of the net assets, 20% of $2,878,000, or $575,600. Those are the three entries that I need to eliminate the investment account. I have to record the goodwill, I have to write the sub's net assets to fair value, and I have to eliminate the capital structure of the sub. All right, now let's make sure that this comes out. Let's just do this as a check. What did I credit to non-controlling interest? Well, in the first entry, didn't I credit non-controlling interest when I recorded the goodwill? Didn't I credit non-controlling interest for $460,000? In the second entry, When I wrote the sub's net assets to fair value, didn't I credit non-controlling interest for $464,400? And in the third entry, when I eliminated the capital structure of the sub, didn't I credit non-controlling interest for $575,600? If you add up $460,000 plus $464,400 plus $575,600, what's it add up to? $1.5 million. Didn't we know when we started that non-controlling interest has to be recorded at its full fair value, which is 20% of $7.5 million, $1.5 million. But we recorded it in those three pieces. Record the goodwill, write the sub's net assets to fair value, eliminate the capital structure of the sub. All right, have I eliminated the investment account? Well, what have I done to the investment account? Didn't I credit investment in Munson Manufacturing for $1,840,000 when I recorded the goodwill? Didn't I credit investment in Munson Manufacturing for $1,857,600 when I wrote the sub's net assets to fair value? And didn't I credit investment in Munson Manufacturing for $2,302,400 when I eliminated the capital structure of the sub? If you add up $1,840,000 plus $1,857,600 plus $2,302,400, what's it add up to? $6 million. I have eliminated the investment account. It just took those three steps. But again, not only did I think what I've done in those entries, I've eliminated the investment account because you can't invest in yourself. I wrote the sub's net assets to fair value, and I recorded the goodwill. That goodwill will be carried over to the consolidated balance sheet. In a formal consolidated balance sheet, you'll show that goodwill, $2,300,000, under intangible assets. It's the goodwill in the purchase. The non-controlling interest is now recorded at its full fair value, $1.5 million. That will be carried over. The non-controlling interest will be carried over to the consolidated balance sheet and shown within stockholders' equity in the consolidated balance sheet. It's the non-controlling interest in the entity. And it's recorded as of April 1 at $1.5 million. It's recorded as of April 1 at $1.5 million. But of course, this year, the non-controlling interest will pick up their share of the sub-income from April 1 to December 31. If there are any dividends, the non-controlling interest, their share of dividends will lower non-controlling interest for their share of dividends as well. But as of April 1, non-controlling interest will be recorded at $1.5 million, and we've recorded that now. So there's a lot going on in those first three entries. So just remember, record the goodwill, write the sub's net assets to fair value, eliminate the capital structure of the sub. If you do those three things, you've accomplished a lot. You've recorded the goodwill, you've written the sub's net assets to fair value, you've eliminated the investment account, and you've recorded non-controlling interest at its full fair value. Now, once you've done that, once you've done these three steps, now there's only one step remaining, where you go through the additional information one item at a time and look for any intercompany activity that has to be eliminated. And if you do that, you'll have checked everywhere in the simulation where there's some grading points, and you've done everything that needs to be done.
Welcome to CPA Ready, comprehensive review materials for the computer-based CPA exam that lets you customize your own review program to meet your individual learning style and ensure your success. Thank you for selecting this hotspot video, which contains a targeted, intensive review of the specified topic area. We hope you find this video to be an effective tool in your CPA exam preparation. Bisk Education.
So if we turn our attention to the additional information, it says by year end, December 31, the following transactions had occurred. The first bullet says that the balance of Munson's net accounts receivable at April 1 had been collected, so there's nothing there. Next bullet, the inventory on hand April 1 had been charged to cost of sales. We had to know that because when we wrote the inventory to fair value, we had to go through cost of goods sold or cost of sales. The first bullet that gets us into some intercompany activity is the third bullet. It says prior to the year, Jared had purchased at face value $1,500,000 of Munson's 7% subordinated debentures or bonds. These debentures mature in 7 years on October 31 with interest payable annually on October 31. So what we have, as I say, is some intercompany bonds. And before we start dealing with them, I'll just give you the bottom line. The bottom line with intercompany bond holdings is that for consolidation purposes, intercompany bond holdings must be retired. So that's our objective here. Intercompany bond holdings have to be retired for consolidation purposes. And I have another checklist for you. Now listen carefully. It does not matter. It does not matter whether the parent buys the sub's bonds or the sub buys the parent's bonds. And I mention this because students get all hung up on that, and it doesn't matter whether the parent buys the sub's bonds or the sub buys the parent's bonds. When you see this, you've got to do three things. I have a little checklist for you. Let me give you the checklist. Three things have to be done here. Number one, you must eliminate the investment and the debt. That's step one. Eliminate the investment and the debt. Step two, you must eliminate any intercompany interest payable, interest receivable. And step three, we must eliminate any intercompany interest revenue, interest expense. Those are the three things that must be done. And I think you should memorize these checklists because it's a way of knowing that you've taken care of everything that must be done when you see intercompany bonds. So let's do the first item on the checklist. We have to eliminate the investment and the debt. So there you are on the exam. You've seen this item. And you say, well, Bob said, step one, eliminate the investment and the debt. I have to eliminate the investment and the debt. How do I do that? Well, if you go to the spreadsheet and you look down in the liabilities, notice that Munson has, as a liability, subordinated debentures, in other words, bonds payable, of $5 million. We're going to debit subordinated debentures, debit that bonds payable, $1,500,000. Notice I don't eliminate all of it, not all $5 million, just the intercompany portion. Remember, your job, your objective in all these adjustments is to eliminate the intercompany portion of something. So I'm not going to debit here subordinated debentures for $5 million. The other $3.5 million of bonds must be held by outsiders. Our job, as always, is to eliminate the intercompany portion of something. So I'm going to debit subordinated debentures, basically bonds payable, $1.5 million. Why? Why am I doing that? Because Jared and Munson are now one economic entity. Don't forget the single entity concept. Jared and Munson are now one economic entity. And this entity cannot have an outstanding debt to itself. That's the problem with intercompany bonds. Now this entity has a debt to itself. So we're going to debit subordinated debentures, $1.5 million. And again, if you look back on the spreadsheet, just below investment in Munson stock, with a balance of $6 million, they have big as life investment in Munson bonds, $1.5 million. We're going to credit investment in Munson bonds, $1.5 million. Why? because this entity cannot invest in its own securities. Jarrett and Munson are one economic entity. It cannot have a debt to itself. That's why I debit subordinated debentures $1.5 million, and cannot invest in its own securities. So we credit investment in Munson bonds for $1.5 million. So that's step one on my checklist. You have to eliminate the investment and the debt. All right, now let's go to step two. We have to eliminate any intercompany interest payable, interest receivable, and there's an odd item here you have to keep in mind. Towards the bottom of the additional information, it said accrued interest on intercompany debt is recorded by both companies in their respective accounts receivable and accounts payable accounts. So for some reason, just an odd point, they don't have interest payable and interest receivable. They have accounts payable and accounts receivable. Who knows? Just a little item they threw in the problem. So let's eliminate any intercompany interest payable, interest receivable. Now, when you go to eliminate accrued interest, the first question is, when was the last time interest was paid? Always ask yourself that question. When was the last time interest was paid? Notice in this case, interest is paid annually on October 31. So the last time interest was paid was October 31. What's the date of our consolidated statements? December 31. So as of the date of our consolidation, December 31, there must be 2 months of accrued interest, November, December. It's from the last time interest was paid, October 31, up to the day of consolidation, December 31. So as of the day of consolidation, there must be 2 months of accrued interest. So let's work it out. I'm going to take the interest rate, 7%, times $1.5 million. That's $105,000 of interest for a full year. I don't want a full year. I just want November, December, 2/12. 1/6 of a year. It comes out to $17,500. So what's my entry? Debit, accounts payable. I think you know what I'm really debiting is interest payable. I'm going to credit accounts receivable. And I think you know what I'm really crediting is interest receivable, $17,500. But the point is, Jarrett and Munson are one economic entity, and this entity cannot have payables and receivables with itself. That's the problem with this item. So I took 7% of $1.5 million. It's $105,000 of interest for a full year. We're just talking about 2/12, November, December. 1/6 of that, $17,500. Debit accounts payable, really interest payable, $17,500. Credit accounts receivable, really interest receivable, $17,500, and that'll take care of it. The third step on my checklist. Now we must eliminate any intercompany interest revenue, interest expense. Let me ask you a question. When did Jarrett acquire Munson's bonds? Notice it said prior to the year. So Jarrett bought Munson's bonds maybe years ago. But even though they bought them years ago, we can't allow these bonds to be in the consolidated statements because, again, you can't have a debt to yourself. You can't invest in your own securities. You can't have payables and receivables with yourself. Doesn't matter when you bought the bonds. But Jarrett, let's agree, bought the bonds perhaps years ago. So didn't Jarrett own Munson's bonds for all 12 months of the current year? All 12 months. But listen carefully. Any interest revenue earned by Jarrett from Munson, any interest expense that Munson had to Jarrett for January, February, and March was before the parent-sub relationship began. So you can't forget that in this simulation, the parent-sub relationship began on April 1. That's the day that Jarrett acquired Munson shares. But all the interest revenue, interest expense for January, February, and March we're not worried about because they were two independent companies back then. But all the intercompany interest revenue and expense for April, May, June, July, August, September, October, November, December, for those 9 months, that's a problem because you can't earn revenue with yourself, you can't incur expenses with yourself. So let's work it out. I'm going to take the interest rate, 7%, times $1.5 million. And again, that's $105,000 of interest for a full year, but I don't want a full year. I just want 9/12 from April 1st on. 9/12, 3/4 of a year, it comes out to $78,750. I'm going to debit interest revenue, $78,750. Why? Because you can't earn revenue with yourself. Interest revenue is overstated on Jarrett's books. I'm going to credit interest expense, $78,750. Why? Because you can't incur expenses with yourself. It's all one entity now. So interest expense is overstated on Munson's books. So that's your third adjustment. Debit interest revenue, $78,750. Credit interest expense, $78,750, and that'll take care of it. Make sure you know that checklist. You see intercompany bonds. Eliminate the investment and the debt. Eliminate any intercompany interest payable, interest receivable, and step 3, eliminate any intercompany interest revenue, interest expense. If you do those 3 things, you know you've done everything you need to do with intercompany bonds. And that's why I give you a checklist, because consolidation is that kind of area where you leave the exam going, did I do everything I was supposed to do? You follow that checklist, there's nothing they can throw at you on bonds and consolidation that won't be covered by that checklist. You do those 3 things, they're done. Now let's read on. Is there more intercompany activity? It says the other assets consist entirely of long-term investments made by Munson, do not include any investment in Jared, so there's nothing there. But the bullet above that says, as of April 1, the machinery and equipment had an estimated remaining life of 6 years. Munson uses straight line. Munson's depreciation expense calculation for the 9 months ended December 31 was based on the old depreciation rates. The reason why this information is given to us is because when we wrote the sub's net assets to fair value, didn't we write the sub's machinery and equipment to fair value? When you write fixed assets to fair value, and we did that in this problem, when we wrote Munson's net assets to fair value, we had to write Munson's machinery and equipment to fair value. Anytime you write depreciable assets to fair value, that requires a depreciation adjustment. So let's work out the depreciation that the entity should take. If you look back at the machinery and equipment, didn't we write machinery and equipment to $10.6 million? That's the fair value. And we wrote accumulated depreciation to $4 million. So take $10.6 million minus $4 million. Isn't the fair value of the machinery and equipment $6.6 million? So I'm going to take that $6.6 million, divide by 6 straight line years. The remaining life of that machinery and equipment is 6 years. Divide by 6 straight line years. That would be what? $1,100,000 depreciation for a full year. I don't want a full year, just April 1st on. For the entity, we're working out the depreciation expense that the entity should take. So take $6.6 million, divide by 6 straight line years. That's $1,100,000 of depreciation for a full year, but I don't want a full year. I just want April through December, 9/12 of that. It comes out to $825,000. The depreciation expense for the entity is $825,000. Now look back at the spreadsheet. Towards the bottom, find depreciation expense. Depreciation expense, machinery and equipment under Munson, they took $588,750 based on the old rates. We don't even know how that was calculated. But the point is, depreciation expense on the spreadsheet for machinery and equipment for Munson, what they took was $588,750. What should that number be? That number should be $825,000. The depreciation expense that the entity should take. So that's our job. We have to adjust that from $588,750 up to $825,000. In other words, we have to take an extra $236,250 of depreciation. So our adjustment, we're going to debit depreciation expense, $236,250. We're going to raise that expense from what they took, based on the old rates, $588,750. That was based on the old rates. However they worked that out, $588,750. We're going to raise that up to $825,000. The true depreciation expense for the entity based on fair value. So I'm going to debit depreciation expense, $236,250, and I'm going to credit accumulated depreciation, $236,250. And that'll take care of this. This adjustment has to be made anytime you write depreciable assets to fair value in a consolidation. And in the acquisition method, you are required to do that. You are required to write all the sub's net assets to fair value. And if it's depreciable assets, you have to make a depreciation adjustment, because now the depreciation should be based on fair value. We've already seen that the other assets consist entirely of long-term investments made by Munson, do not include any investment in Jared. And then it says, during the last 9 months, which is what we're focused on, the following intercompany transactions occurred between Jared and Munson. Notice Jared's been selling merchandise to Munson. Munson's been selling merchandise to Jared. There's still a balance unpaid for both companies, and some of that merchandise is still included in the purchaser's inventory at December 31. Then they go on to say Jared sells merchandise to Munson at cost. So there's no intercompany profit in the Jared to Munson column. But Munson sells merchandise to Jared at a regular selling price, including a normal gross profit margin of 35%. So there is some intercompany profit in the Munson to Jared column. There were no intercompany sales between the two companies prior to April 1. Hey, before April 1, we're not worried. If there were any intercompany sales before April 1, we're not worried about that because they were independent companies before April 1. But from April 1st on, it's a parent selling to a sub. It's a sub selling to a parent. In other words, as of April 1, you're selling your merchandise to yourself. That's what doesn't make any sense. I have another checklist for you. You knew I would. When you see this item, you've got to do 3 things. I'm in love with 3s in this class. You see this, you got to do 3 things. Now listen carefully. I don't care whether the parent sells merchandise to the sub or the sub sells merchandise to the parent, because some students worry about that. It doesn't matter whether the parent sells merchandise to the sub.
Welcome to Bisk CPA Review, comprehensive review materials for the CPA exam to let you customize your own review programs to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you are going to master the exam content? Our unique learning management system ensures that you will master the material. And features such as exam preparation tips, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of a computer-based exam, including multiple choice, simulation, and written communication questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you will have the confidence and knowledge to pass it. Guaranteed.
Hello, and welcome to the Bisk CPA Review course. My name is Bob Manette, and I'll be your instructor in this class. And in this class, our focus is going to be on balance sheet issues. Specifically, what we're going to be talking about is liquid assets, cash, accounts receivable, notes receivable, marketable securities. Before we begin, let me advise you that the way to get the most out of this class is to treat it like any other class. Don't just sit back and watch the class passively. Be an active participant. Take good notes. Later in the class, when we do problems, it's important to shut the class down, work on the problems. Get your answers first before you come back to the class and we discuss the problems together. I think you'll find that if you do those simple things, you'll get much more out of the class, and obviously it's what we both want. So let's dive right in, and let's start with cash. Now, there's not a lot to remember about cash, but a couple of things I think we should talk about. First, remember what we put on a balance sheet under the heading cash must be money that is free and clear and available to be spent in current operations. That's what cash represents. When you put cash on a balance sheet, it has to represent money that is, quote, free and clear and available to be spent in current operations. So with that definition in mind, what do you have to be careful about? Well, when you're in the exam, always be careful if there's some reason the company can't spend the cash. For example, if they have a security deposit on a long-term project, well, they can't spend that, so it's not cash. It's not free and clear. It's not available to be spent in current operations. So you got to back that out. It's not cash. It belongs on the balance sheet as a security deposit. Watch out for a compensating balance on a bank loan. A company has a loan outstanding at a bank. Some banks require that the company keep a certain minimum balance in their account. Well, the point is, if you have to keep a certain minimum balance in your account, you can't spend that. So it's not cash. It's not free and clear. It's not available to be spent in current operations. So you back that out. That's really a short-term investment. It's not cash. Watch out for a bond sinking fund. I'm sure you know what that is. A corporation has bonds outstanding. They agree with their bondholders that they'll turn, say, $100,000 cash every year over to the hands of a trustee, so that 15 years from now, when the bonds mature, the investors know the cash will be there to pay them back. Well, the point is, if there is a bond sinking fund, that cash is in the hands of a trustee. It's not free and clear. It's not available to be spent in current operations. It's not cash. It belongs on the balance sheet under bond sinking fund. So just be careful what you put on a balance sheet under the heading cash. Also in terms of cash, be careful of the 3-month rule. Sometimes the exam likes this. Let's go over it. The 3-month rule relates to highly liquid securities, highly liquid. Certificates of deposit, treasury bills, any commercial paper with an original maturity of 3 months or less. Certificates of deposit, treasury bills, any commercial paper with an original maturity of 3 months or less. 3 months or less. You see a security like that, you can treat it as cash. They're called cash equivalents. You can just lump that into your cash balance. It's the same as cash. Let me ask you a question. Let's say I have a 6-month CD. It's going to mature in 2 weeks. Is that a cash equivalent? No, because the original maturity is 6 months. Remember, the rule works by looking at the original maturity. No, the original maturity has to be 3 months or less. That's what makes a cash equivalent. If I have a 6-month CD, it's going to mature in 3 minutes. It's not a cash equivalent. It's not, because the original maturity was 6 months. That's how the rule works. The original maturity has to be 3 months or less. So be careful of that. Now, you'd probably guess what I'm going to say next anyway, and that is that the primary thing that the exam likes to hit with cash is bank reconciliations. Now, I know that you've done bank reconciliations at some point in school, maybe in your job, every once in a while in your personal checking account. Accountants are notoriously bad at doing it in their own account, but I know you've done this before. So I don't want to give you a lot of notes on bank reconciliations, but I think we should do some. You should see what they're like in the exam. So let's go right away in your viewer's guide. Let's look at question number 1. Let's do it together. Question number 1 says, in preparing the August 31 Year 2 bank reconciliation, APIC Corporation has the following information. We know that the balance per bank statement, August 31, $18,050. And we're told there were deposits in transit August 31, a return of a customer's check for insufficient funds. There were outstanding checks August 31, and a bank service charge. And if you go to the bottom, the simple question is, at August 31, what is APEX's correct cash balance? In other words, Their basic question is, if we're doing a balance sheet on August 31, what is the correct amount to put on that balance sheet under the heading cash? Well, let's do it together. We know the bank statement. We know the bank statement on August 31 is showing a balance of $18,050. Now let's go through the reconciling items. How about the deposit in transit? Do I have to worry about that? Sure. You know what that is. That's a deposit I put in the bank. I've recorded it in my checkbook, but it's in transit. It hasn't cleared the bank yet. It's not reflected in my bank statement, so we'll add that. $3,250, we'll add that in. How about the return of the customer's check? Do I worry about that? No, don't worry about that, because don't forget, we started with bank balance. That return check is already reflected in your bank balance. That check was returned to the bank. So don't forget, we started with bank balance here, and that return of the customer's check, that would have gone back to the bank. It's already reflected in your bank balance. How about the outstanding checks? Of course we worry about that. Those are checks that we've written, we've mailed them, but they haven't cleared the bank yet, so we'll back out that $2,750. How about the bank service charge? No, don't worry about that, because you started with bank balance. The bank service charge is on your bank statement. That's already reflected in the $18,050 bank balance. So don't worry about that. And if you add it up, it gives us what we need. The correct cash balance on our balance sheet, August 31, would be answer A, $18,550. And you'll find that when you start to do a few of these, the same things come up again and again. Outstanding checks, deposits in transit, return checks, bank service fees, interest. And once you've done a few, I think you certainly feel more and more comfortable with this. Let's do another one. Let's do number 2. Number 2 says, the following information pertains to Gray Company, December 31. We know the checkbook balance, $12,000. We know the bank statement balance, December 31, $16,000. And then we also have this information about a check. But the basic question at the bottom is, in Gray's December 31 balance sheet, what amount would be reported as cash? So that's the question again. If we're doing a balance sheet on December 31, what is the correct amount to put on that balance sheet under the heading cash? Well, I have a question for you. You're in the exam, you've got this question. If I'm trying to figure out what is the correct amount to put on my balance sheet as cash on December 31, what's my best starting point? Should I start with the checkbook balance, $12,000, or should I start with the bank statement balance, $16,000? You may have noticed that there's answers whichever way you go. If I start with the $12,000, there's answers there for me. If I start with the $16,000, there's answers there for me. So your starting point matters a lot here. So I guess what I'm asking you is, theoretically, if I'm given a choice, and I am here, what's theoretically stronger, to start with checkbook or bank statement? Checkbook, bank statement. Definitely checkbook. Definitely checkbook. You want to start with the $12,000. And why is that? Why, if you're given a choice between checkbook and bank statement, is it theoretically stronger to start with checkbook? Why is that? Well, let me ask you another way. Give me some big things. Think about some big things that could be missing from bank statement. Well, sure, with bank statement, couldn't there be a lot of outstanding checks that haven't cleared yet? There could be a lot of deposits in transit. I mean, if you just think about your personal checkbook, doesn't your personal checkbook reflect all the deposits you've made, all the checks you've drawn? I mean, you may mess up here and there, but your personal checkbook does reflect at least all the deposits you've made, all the checks you've drawn. The problem with starting with bank statement is there could be a lot of deposits in transit, a lot of outstanding checks. At least your checkbook reflects all the deposits you've made, all the checks you've drawn. Now, checkbook's not perfect either, is it? Because what could be missing from checkbook? Return checks, bank service fees, interest. Checkbook's not perfect because what's missing from checkbook would be bank service fees, interest, return checks, but those items tend to be immaterial. That's the argument. Those items tend to be immaterial. So the bottom line is, if you're given a choice between checkbook and bank statement, it's always good to start with checkbook. So we're going to start with the $12,000, but then there's another issue we have to deal with. They say that a check was drawn on Gray's accounts payable to a vendor, dated and recorded December 31, but not mailed till January 10th. So it was dated and recorded December 31, year 3, but they didn't mail it till January 10th, year 4. All right, so let's think about this. That payment of $1,800, is that already reflected in the $12,000 checkbook balance? Yes, because they said it was dated and recorded. Recorded means it was booked. It was booked. So your $12,000 checkbook balance reflects that $1,800 payment. So, of course, the question is, if we didn't mail that till January 10, year 4, should we add it back? If you think you should, it's answer B. If you don't think you should, it's answer A. That's where we are, right? If you think you should add that back, you're looking at answer B. If you don't think you should add that back, you're looking at answer A. So should you add it back? Yes, of course you should add it back. The answer is B. You do add it back. But why? Why do we add it back? What's the thinking there? Because if we didn't mail that till January 10th, then on December 31, that cash was free and clear and available to be spent in current operations. Again, if I didn't mail that till January 10th, then on December 31, the date of my balance sheet, that cash was free and clear. It was available to be spent in current operations. You have to add it back, and if this bothers you, just think about what adjusting entry I'd have my client make here. We know when they dated and recorded it, they would have debited accounts payable, credit cash, $1,800. That's what they did when they recorded it on December 31. They would have debited accounts payable, $1,800, credit cash, $1,800. That's why it's reflected in your checkbook balance. But if I'm the auditor on a job like this and I say, well, you didn't mail it till January 10th, so on December 31 you had the cash, the adjusting entry I'd have my client make is debit cash $1,800, put the cash back because they had the cash on December 31. That's why the answer is B, and credit accounts payable. The liability goes back on the books. The liability goes back on the books because the liability was outstanding on December 31. So that's the adjusting entry that you'd make. Debit cash $1,800, credit accounts payable $1,800, and put the liability back on the books as well. You know what the issue is here? Cutoff. This is an issue of cutoff. The balance sheet is dated December 31. You didn't mail that till January 10th. We had the cash. I'd like you to try some questions now. And I'd like you to try 3, 4, 5, and 6. Do 3, 4, 5, and 6. Shut the class down, do those problems, and then come back and we'll go through them together. Welcome back. Let's look at these problems together. In number 3, they say, at October 31, Dingo had cash accounts in 3 different banks. And that is the key, that it's in 3 different banks. They say one account is segregated solely for a November 15th payment into a bond sinking fund. The second account, used for branch operations, is overdrawn. The third account, used for regular operations, has a positive balance. How would these accounts be reported in the October 31 balance sheet? Well, I want you to look at answer C. C says the segregated account, the bond sinking fund, is a non-current asset, and the regular account would be a current asset net of any overdraft. I just want you to know answer C is fine if it's all one bank. If it's all one bank, C works just fine. Why? Because banks have the right of offset. If you have two accounts at a bank, one has a positive balance, the other's overdrawn, banks have the right of offset. But because this is three different banks, it's A. The segregated account, the bond sinking fund, is a non-current asset. The regular account is a current asset. And if you're overdrawn at another bank, that is a liability. That has to be paid back, has to be settled. And the answer is A. Now, in 4 and 5, we're back to a more traditional sort of reconciling problem. They give us a basic reconciliation. We know the balance per bank statement, March 31, and we can see how they added the deposits in transit at the end of March, took out the outstanding checks at the end of March, giving us the proper balance March 31. Then we also know what happened in April. The deposits during April, the disbursements during April, and 4 says, what is the cash balance per books April 30th? What's the cash balance per books on April 30th? Well, let's work it out. We know that the bank statement balance on March 31 was $46,500. Can we figure out what the bank statement balance must have been on April 30th? We know the bank statement balance on March 31 was $46,500. That's given. Can we work out what the bank statement balance was on April 30th? They didn't give it to us, but we can work it out because we know all the deposits during April. We add $58,400. We know all the disbursements in April. Back out $49,700. So the bank statement balance on April 30th must be $55,200. That's the bank statement balance, April 30th, $55,200. But they want to know the cash balance per books on April 30th. So what else do I have to worry about? How about the outstanding checks at the end of April? There's still 7,000 of outstanding checks that haven't cleared yet. In April, those are checks I've written. They're reflected in the books, just haven't cleared the bank yet. So back out the 7,000 of outstanding checks. Notice there are no deposits in transit at the end of April. So just back out the outstanding checks of 7,000. There's your balance per books, April 30th. Answer A, $48,200. How about number 5? What were the cash disbursements per books in April? Well, we know the total April disbursements were given at $49,700. That's given. There's your total disbursements for April per the bank, $49,700. Now, does that represent all April disbursements? No, because of that $49,700, $12,600 represents checks that were outstanding at the end of March that cleared in April. I hope you're with me on that point. When you look at the $49,700 of disbursements per bank in April, that's not all April disbursements because $12,600 of that would be the outstanding checks at the end of March clearing in April. So back out the $12,600. That brings you down to $37,100. Any other disbursements per books? Yeah, how about the 7,000 of outstanding checks at the end of April? There's another 7,000 of checks on the books that we've written, we've mailed them, just haven't cleared the bank yet, not reflected in the bank disbursements. So add another 7,000 of disbursements on the books, haven't cleared the bank yet. Your total disbursements on the books would be answer A again, $44,100. Let's look at number 6. June 30th, this company's cash balance was $10,012. And they're asking, what's at the bottom, what is the adjusted cash balance for this company, June 30th? So what adjustments do we have to make? Well, their books are showing a cash balance of $10,012. But there's a problem with check 101. The actual amount of the check was $95. That was the actual amount of the check, 101, $95. But somehow it was recorded in the books at $59. The numbers were transposed. So the difference between $59 and $95, we're going to have to back out another $36. So the book balance is wrong because that $95 check, that was the correct amount, was recorded on the books at 59. The numbers were transposed. So that $36 difference, we back out. How about the interest that we earned? Well, that's not reflected in our books yet, so we add the interest we earned, $35, and then the $50 of service charge on the bank statement. That's not reflected in the books yet. Back out the service charge of $50, and the correct cash balance per books, June 30th, would be answer B, $9,961. So you can see the type of problems that the exam can have with cash, the issues that come up with cash, but the most heavily tested thing having to do with cash in the CPA exam are bank reconciliations. So as I said before, once you get a little experience with bank reconciliations, the way the exam comes at bank reconciliations, and you do a few in your homework, which I know you will, I don't think you'll have any problem there at all. Let's move on to accounts receivable. And let me say right off the bat that the primary thing that the exam hits with accounts receivable is accounting for bad debts. So let's dive right into it. There are two methods of accounting for bad debts. There is the direct write-off method, and there is the allowance method. So that right away, that's what you're up against. There are two methods of accounting for bad debts. You've got the direct write-off method, and you've got the allowance method. Let's start with the direct write-off method. Just remember this basic point. Under the direct write-off method, a company makes no entry for bad debts till something happens, till a customer actually defaults. And when the customer defaults, the account is written off at that point. That's what we mean when we say the direct write-off method. The company's not making any entry for bad debts. They do nothing for bad debts until a customer defaults. And as I say, when the customer defaults, the account gets written off at that point. Let me give you a quick illustration. Let's say that a company does use the direct write-off method, and let's say that back in year one, the company made a $900 sale on account. So back in year one, if the company made a $900 sale on account, we have to assume they would have made the normal entry. They would debit accounts receivable $900, they would credit sales $900, the normal entry. Now we're going to assume that this company hasn't collected a dime on this account in year one, year two, year three, and then finally, in year four, the company decides to give up their collection effort. You know, maybe the customer has left the country. Maybe the customer's declared bankruptcy. The exam won't give you lots of detail, but the basic point is that in year four, for whatever reason, the company decides to give up their collection effort. Here's my point. If the company uses the direct write-off method, in my example, there would have been no entry for bad debts. In year one, no entry for bad debts. In year two, no entry for bad debts. In year three, but in year four, when the company gives up their collection effort, they would book an entry. They would debit bad debt expense, $900. They're going to debit bad debt expense, $900. And that expense goes to the income statement for year four. And what would they credit? Accounts receivable, $900. They would write off that account. And that's pretty much all there is to it. That, in a nutshell, is the direct write-off method, where a company makes no entry for bad debts. They do nothing for bad debts till a customer defaults. And when the customer defaults, the account is written off at that point. And as I'm sure you know, from a theoretical standpoint, the direct write-off method is extremely weak. And I know you're aware what the problem is. The matching concept. Just look at this example. When I do my year four income statement, won't I end up matching year four sales with an expense I really incurred back in year one? See, that's a problem. Because, of course, the whole objective of the matching concept on an income statement is to match current revenues with current expenses. That is our basic objective under the matching concept, where on an income statement, our attempt is to match, as best as we can, current revenues with current expenses. Well, notice the direct write-off method distorts that. If you just think of the example we just went through, When this company does their year 4 income statement, don't they end up matching year 4 sales with an expense they really incurred back in year 1? They didn't know it at the time, but the direct write-off method, from a theoretical standpoint, is extremely weak because of the matching concept. Is the direct write-off method acceptable under generally accepted accounting principles? It is, as long as a company's bad debt expenses are an immaterial item on the income statement. So I'll say that again. A company can use the direct write-off method under GAAP as long as the company's bad debt expenses are an immaterial item on the income statement, and you know exactly what I'm going to say. If a company's bad debt expenses are a material item on the income statement. If bad debt expense is a material item on the income statement, the company is required to use the allowance method to account for bad debts. Let's get into that, what you're much more likely to see in the exam. Under the allowance method, a company is going to estimate the accounts that they think will go bad and set up a provision, an allowance for bad debts, an allowance for the accounts they think will go bad on their balance sheet. It's a very different approach. That's the allowance method, where we estimate the accounts we think will go bad and set up a provision on our balance sheet, an allowance on our balance sheet for the accounts we think will go bad. Now, I'll say this right off the bat. The big thing to remember about the allowance method, and it messes a lot of people up, you have to remember about the allowance method that there are two approaches to the allowance method. There is an income statement approach and there is a balance sheet approach. You have to remember that about the allowance method, that there are two approaches to the allowance method. There is an income statement approach and there is a balance sheet approach to the allowance method. And once you get that in your mind, this really is the key to the exam on this. Once you're solid on that point, this becomes a lot easier. Let me show you what I mean. Let's go to question number 7. They say the following information pertains to Oro Corporation. We know the credit sales for the year ended December 31, $450,000. We know that the allowance account had a credit balance back on January 1 of $10,800. We also know during the year they wrote off $18,000 of bad debts. That's the information we're given. Now, you'd probably think of this anyway, but I'll just give you this advice. An excellent approach to allowance for bad debts questions, when you get them in the exam, is to go to your scrap paper right away and put down a T account for the allowance account. It really helps. So try to remember that. Anytime you get a question on the allowance method, just right away go to your scrap paper. They give you scrap paper in the exam, use it, and put down a T account for the allowance account. So let's say we do that. We'll put down our T account for the allowance account, and let's put in what we know about it. We know that back on January 1, the allowance account had a $10,800 credit balance. We also know during the year they wrote off $18,000 of bad debts. So you just kind of mentally put that in. If they wrote off $18,000 of bad debts, what entry did they make when an account goes bad? They would have debited the allowance account, $18,000. Credit the individual accounts receivable, $18,000. Remember, in this approach, when accounts go bad, we debit the allowance account. We have a provision on our balance sheet, an allowance on our balance sheet for the accounts we think will go bad. So when an account goes bad, we're going to debit the allowance account, in this case $18,000, and credit the individual accounts receivable, $18,000. Just write off those accounts. Here's my point. After that activity, there is now a $7,200 debit balance in allowance for bad debts. I hope you're with me on that. So if you look at that T account, right now there is a $7,200 debit balance in allowance for bad debts. Now let's read on. They say, according to past experience, 3% of Oro's credit sales have been uncollectible. You might want to underline 3% of credit sales and just write above that, income statement approach. Notice in this problem, They're basing their estimate on the income statement. See, when you say, 2% of gross sales tend to go bad, 1% of net sales tend to go bad, or in this example, 3% of credit sales tend to go bad, you're basing your estimate on the income statement. 1% of gross sales tend to go bad, 2% of net sales tend to go bad. In this example, 3% of credit sales tend to go bad. You are basing your estimate on the income statement. And here's the point. When you base your estimate on the income statement, it does not matter that there's a $7,200 debit balance in allowance for bad debts. That'll have no bearing on your adjusting entry. Every year, you just take 3% of credit sales. So when they get to December 31, they're going to take 3% of $450,000. They're going to debit bad debt expense, $13,500. And they're going to credit allowance for bad debts, $13,500. So we'll put that in our T account. But the basic point is, when you base your estimate on the income statement, when you use the income statement approach to the allowance method, it does not matter that there's a $7,200 debit balance in allowance for bad debts. That has no bearing on your adjusting entry, whether there's a debit or credit balance in allowance for bad debts. That'll have no bearing on your adjusting entry. Every year, you just take 3% of credit sales. So as I say, I'm going to take 3% of $450 at year end, debit bad debt expense, $13,500, credit allowance for bad debts, $13,500, and when I put that in the T account, and they ask me at the bottom, after the provision is made for bad debt expense for the year, what is the balance in the allowance account? Well, if you look at your T account, now the balance in the allowance account after that adjustment is a credit of $6,300, and the answer is A. Let's look at question number 8. Based on an aging of receivables, you should circle that word aging and write above it balance sheet approach. See, this is a completely different approach. Now we're going to base our estimate on an aging of receivables, on analysis of receivables. This is the balance sheet approach to the allowance method. Based on an aging of receivables at December 31, Terry Company determined that the net realizable value of the receivables at that date is $190,000. Additional information follows. We know the accounts receivable at December 31, $220,000. We know back on January 1, the allowance account had a $32,000 credit balance, and during the year, they wrote off $24,000 of bad debts. Well, you know me. I get a question on allowance for bad debts. Right away, I'm going to go to my scrap paper in the exam, put down a T account for allowance for bad debts. Now let's put in what we know about it. We know back on January 1, the allowance account had a $32,000 credit balance. Put that in. We also know that during the year, they wrote off $24,000 of bad debts. So you just kind of mentally put that in. What they would have done is debit, when accounts go bad, they debit the allowance account, in this case $24,000, credit the individual accounts receivable, $24,000, write off the accounts. We'll put that in. You see my point. After that activity, there's now an $8,000 credit balance in allowance for bad debts. That's where we are. But I want to go back to the point. This is the balance sheet approach. Now they're basing their estimate on the balance sheet, an aging of receivables, an analysis of receivables. So we're going to have to do a little side calculation. What do we know about the receivables? Well, don't we know that their gross accounts receivable at December 31 totals $220,000? So we put that down. A little side calculation. What do we know about the receivables? We're analyzing the balance sheet. It's the balance sheet approach. We know their gross accounts receivable at December 31 totals $220,000. But they said, based on an aging of receivables, they only expect to net $190,000. They expect the net realizable value of receivables just to be $190,000. So take that $220,000, back out $190,000. What our aging is telling us is that we need a $30,000 provision for bad debts. If our gross accounts receivable at December 31 totals $220,000, but based on an aging, we only expect to net $190,000. What our aging is telling us, what our analysis of the balance sheet is telling us, is that we need a $30,000 provision for bad debts. Now go to your T account. What do we have as a balance in the allowance account now? $8,000. I have to adjust that up to $30,000. So I'm going to debit bad debt expense, $22,000. I'm going to credit allowance for bad debts, $22,000. And that'll bring the allowance account from $8,000 up to $30,000, which my aging says I have to have. So when they ask me at the bottom, what is Terry's doubtful accounts expense, December 31? They want to know the expense on the income statement. And that's answer B. Excuse me, that's answer D, $22,000. Answer D. That's the expense on the income statement, right? Before I made my adjustment, there was an $8,000 credit balance in allowance for bad debts. My aging says I need a $30,000 allowance for bad debts. So I have to adjust for the difference. I debit bad debt expense, $22,000. That's why the answer is D. And credit allowance for bad debts, $22,000. That'll bring the allowance account from $8,000 up to $30,000, which my aging says I have to have. You see the difference? In the balance sheet approach to the allowance method, your job is to adjust the allowance account to its proper balance. So in the balance sheet approach, you have to consider whether there's a debit or credit balance in the allowance account before you make your adjusting entry, because your job in the balance sheet approach is to adjust the allowance account to its required balance. Let me show you something else that comes up with the allowance method. Let's say that a company does use the allowance method, and let's say that a $300 account has gone bad. So a company does use the allowance method, and let's say that a $300 account has gone bad. Well, if a $300 account has gone bad, we have to assume the company would make the normal entry. They would debit the allowance account, $300, credit the individual account receivable, $300. That's the normal entry in the allowance method when an account goes bad. You know what the exam likes? What happens in this method if 2 weeks go by, 2 months go by, and now the check comes in? What if you collect an account that you've written off? Well, let's say 6 months later, you go to your mailbox, the check is there. What do you do in the allowance method if you collect an account that you've written off? Well, let me just quickly say that there's more than one way you can handle this. I'll just show you what I think works the best. If you collect an account that you've written off, always start by reversing the entry that you made when you wrote it off. Just think reverse. You've got to reverse the entry that you made when you wrote it off. So now I'm going to debit account receivable, $300. Reestablish the account. Credit the allowance account, $300. And then I simply record the payment like any other payment. Debit cash, $300. Credit accounts receivable, $300. That'll always work. Just reverse the entry that you made when you wrote it off. So I'm going to debit account receivable, reestablish the account, credit the allowance account, $300, and then, as I say, record the payment like any other payment. Debit cash, $300, credit accounts receivable, $300. That'll always work. Reverse, record the payment. Reverse, record the payment. Reverse, record the payment. It's not the only way to do it, but I think it's a good, clean, easy way to handle that situation. I'd like you to try some problems on this. Please do 9, 10, and 11, and then come back. Welcome back. Let's do these questions together. In number 9, we're talking about Inge Company, and you know the way I feel about this. You're in the exam, you get a question on allowance for bad debts, right away, go to your scrap paper, put down a T account for the allowance account. Let's assume you did that, and let's put in what we know about it. We know that the allowance account started a year ago with a $30,000 credit balance. And we're also told that during the year, they wrote off $18,000 of bad debts. So you kind of put that in mentally. We know when accounts go bad, we would have debited the allowance account, $18,000, credit the individual accounts receivable, $18,000. And then you see what they threw in. Uncollectible accounts recovered during the year, that $2,000. Bothers a lot of people. But I'm hoping you always remember, anytime you see this, reverse, record the payment. Reverse, record the payment. You always start by reversing the entry that you made when you wrote it off in the first place. So now just mentally, you reverse the entry that you made when you wrote it off. You would debit accounts receivable, reestablish the account, credit the allowance account, $2,000, and then, as I say, you just simply record the payment like any other payment. Debit cash, $2,000, credit the account receivable $2,000, which we don't really have to put down because it doesn't affect the allowance account. But here's my point in terms of the allowance account. After all that activity, if you work it out, there's now a $14,000 credit balance in allowance for bad debts. And you know what I'm going to ask you, because I would ask you every time in this problem. Are they using an income statement approach or a balance sheet approach? A balance sheet approach. They base their estimate on an aging of receivables, on an analysis of receivables. Now, what do we know about this? We know at year end, December 31, their gross accounts receivable totals $350,000. Based on an aging, what do they expect to net? Just $325,000. So what your aging is telling you is that you need a $25,000 provision for bad debts. You need a $25,000 allowance for bad debts. Now look at your T account. Since you already have $14,000, you have to adjust it by 11. So you're going to debit bad debt expense, $11,000, credit allowance for bad debts, $11,000, and that'll bring the allowance account from $14,000 up to $25,000, which your aging says that you require. Because that's your job in the balance sheet approach, to adjust the allowance account to its proper balance. That's why in the balance sheet approach, you have to consider whether there's a debit or credit balance in the allowance account before you make your adjusting entry. Because your job, again, is to adjust the allowance account to its required balance. So when they say at the bottom, for 2003, what would be ING's uncollectible accounts expense? What's the expense on the income statement for bad debts? You know, it's $11,000. Answer B. Let's go to number 10. January 1st, Jamin Company had a credit balance of $260,000 in allowance for bad debts. Go to your scrap paper, put down a T account. We know a year ago, January 1, they had a $260,000 credit balance in allowance for bad debts. Notice during the year, they wrote off $325,000 of bad debts. So we'll put that in. They would have debited the allowance account, $325,000. Credit the individual accounts receivable, $325,000. So after that activity, there is now a $65,000 debit balance in allowance for bad debts. You know what I'm going to ask. Does Jamin use an income statement approach or a balance sheet approach to the allowance method? Income statement approach. They base their estimate on the income statement. They expect 2% of their credit sales to go bad. Now, their credit sales for the year were $9 million times 2%. So we know they're going to debit bad debt expense, $180,000. Credit allowance for bad debts, $180,000. Because you know in the income statement approach, it doesn't matter whether there's a debit or credit balance in the allowance account. That has no bearing on your adjusting entry. Every year, you just take 2% of credit sales. So when they get to December 31, they'll take 2% of $9 million, debit bad debt expense, $180,000, credit allowance for bad debts, $180,000. And when you make that adjustment, that brings the balance in the allowance account up to answer A, a credit balance of $115,000. And that's what they wanted. The balance in the allowance account, December 31 at the end of the year. Answer A, $115,000. Number 11, Hall Company. Right away, we'll set up a T account for the allowance account. A year ago, January 1, they had a $24,000 credit balance in allowance for bad debts during the year. They wrote off $96,000 of bad debts. We'll put that in. They would debit the allowance account, $96,000. Credit the individual accounts receivable, $96,000. We take care of that. After that activity, there's a $72,000 debit balance in allowance for bad debts. Is this the income statement approach or the balance sheet approach? It's the balance sheet approach. They base their estimate on an aging of receivables, an analysis of the balance sheet. Now, what do we know about the balance sheet? We know at year end that based on an aging, they need a $100,000 allowance for bad debts. Well, since they already have a $72,000 debit balance in allowance for bad debts, and our aging says we need a $100,000 credit balance in allowance for bad debts, we're going to have to debit bad debt expense, $172,000. And we're going to have to credit allowance for bad debts, $172,000, to bring the allowance account from a debit of $72,000 to a credit of $100,000. That's our job here. Adjust the allowance account to its required balance. To bring that allowance account from a debit balance of $72,000 to a credit balance of $100,000, which our aging says we need. Just remember, in the balance sheet approach, you have to consider whether there's a debit or credit balance in the allowance account before you make your adjusting entry, because your job in the balance sheet approach is to adjust the allowance account to its required balance. So when they ask us at the bottom, what is the uncollectible accounts expense for the year? It is answer A, $172,000. Now, before we leave accounts receivable, I want to go through a couple of terms that you might see in the exam. What does it mean to pledge receivables, factor receivables, assign receivables? Let's talk about these terms. When a company pledges their accounts receivable, what that means is that they are using their accounts receivable as security for a loan. And the big thing to remember about pledging receivables is that when you're pledging your receivables, anytime you've pledged your receivables, anytime you're using your receivables as security for a loan, you have to footnote that. Shareholders, creditors, other interested parties have to know about that if you've used your receivables as security to get a loan. So just remember, if you pledge your receivables, that is a required footnote. What does it mean if a company factors their receivables without recourse? Well, if a company factors their receivables, what that means is that they have actually sold their receivables to a factor. That's what it means to factor receivables. The company's actually sold their receivables to a factor. And if they sell them without recourse means if the customers default, the factor has no recourse to come after the company for additional funds. In other words, when you factor your receivables without recourse, the sale is final. The sale is final. If the customer defaults, that's the factor's problem. The factor has no recourse to come after the company for additional funds. So in terms of the entry, if a company factors their receivables without recourse, the sale is final. Just treat it as a sale. The company will debit cash for whatever the factor gives them, credit accounts receivable for the book value, and they'll recognize a gain or loss on sale. It's almost always a loss because the factor will give you a discounted price. So debit loss on sale. But because the sale is final, the company will recognize a gain or loss on sale. The factor has no recourse to come after the company for additional funds. All right, now one other possibility. What if a company factors their receivables with recourse or assigns their receivables with recourse? Well, I know you're ahead of me. When you see with recourse, it means the sale is not final. That's exactly what it means. The sale is not final. If the customer defaults, now the factor or the assignee has recourse to come after the company for additional funds. Just think of it this way. If you factor your receivables with recourse, who collects the receivables? The factor or the company? The company still collects the receivables. The sale's not final. See, if you factor your receivables without recourse, sale is final, you've sold your receivables. The factor will collect the receivables. That's their problem. But if you factor your receivables with recourse or assign your receivables with recourse, the sale is not final. So the factor's not going to collect the receivables. The company's going to collect the receivables. And when you really analyze it, when you factor your receivables with recourse or assign your receivables with recourse, it's really just another way of using your receivables as security for a loan. So in terms of the entries, they're pretty straightforward. When you factor your receivables with recourse or assign your receivables with recourse, since the company's still going to collect the receivables, the sale's not final, on their balance sheet, they're going to separate the receivables they factored or the receivables they've assigned from all their other receivables. So they're going to debit accounts receivable factored or accounts receivable assigned and credit accounts receivable. That way on their balance sheet, they've separated the receivables they factored or the receivables they've assigned from all their other receivables. Tends to be their large ones, some of their larger accounts. And as I say, it's really just using the receivables as security for a loan. So now they'd make another entry where they debit cash and credit notes payable. And then what basically happens is the company collects the receivables, because the sale's not final, the company still collects the receivables, and as the company collects the receivables, they pay off the note with interest. We don't have to go through all those entries, but that's now what happens. The company still collects the receivables, and as they collect the receivables, they pay off the note with interest. Whereas if you factor without recourse, the sale is final. The factor collects the receivables. The receivables are the factor's problem now. That is the difference. All right, now we're done with accounts receivable, and what we're going to get into next is notes receivable. In the area of notes, the first thing I want to get into is how you discount a note. And of course, you know, when I say discount a note, I mean we take a note to the bank and we get cash for it. So how do you discount a note? Let's go to a problem. Number 12 says Rand accepted from a customer a $40,000 90-day 12% interest-bearing note dated August 31, 2007. Then on September 30th, 2007, Rand discounts the note at Apex Bank. And notice the bank's discount rate is 15%. However, the proceeds were not received until October 1. We're doing a balance sheet on September 30th. If you're doing a balance sheet on September 30th, the amount receivable from the bank based on a 360-day year would include interest revenue of how much? Let's get into how you discount a note. And the secret to discounting a note is you always start by calculating the maturity value of the note. That's always your first step. You've got to figure out the maturity value of the note. So let's do that. I'm going to take the $40,000 note from this customer. It bears interest at 12%. So what is that? 40,000 times 12%, that's $4,800 of interest for a full year, but it's not a full year note. It's a 90-day note. So I'm going to multiply by 90 over 360. They said it's based on a 360-day year. So the point is, there's $1,200 of interest due at maturity, plus the $40,000 of principal, the face value of the note. That means that the maturity value of the note would be $41,200. That's what my customer has promised me. If I'm Rand, my customer has promised to pay me $41,200 90 days from now. And the reason you have to start by calculating that maturity value is that's the amount the bank works with. The bank is going to take that maturity value, $41,200, times the bank's discount rate, 15%. Now listen, times how long the bank holds the note. So a lot of people make a mistake. You've got to take that maturity value, $41,200, times the bank's discount rate, 15%, times how long the bank's going to hold the note. This was a 90-day note. It was dated August 31. When did Rand go to the bank? September 30th, after 30 days. So if it's a 90-day note and Rand went to the bank after 30 days, how long is the bank going to hold the note? 60 days. So I'm going to multiply by 60 over 360. The bank is going to keep $1,030. So remember that little twist there. It's the maturity value times the bank's discount rate times how long the bank's going to hold the note, times 60 over 360. So the bank is going to keep $1,030. So take that maturity value, $41,200, the maturity value, minus what the bank keeps, $1,030. What the bank's going to give Rand when they discount the note is the difference, $40,170. Now, we have this odd thing where the proceeds are not received until October 1. We're doing a balance sheet on September 30th, so we're going to debit receivable from bank, $40,170. We're going to credit the note receivable, $40,000, and credit interest revenue, $170. So the answer is A. The amount that's going to be collected from the bank is going to include interest revenue of $170. So just make sure when you win the exam, you know how to discount a note. Now, we're going to stay on notes, and what I want to get into next is how you handle a note that has no provision for interest. A big tip-off in the exam is when you see the phrase non-interest-bearing note. When you see that phrase, non-interest-bearing note, You know there's something wrong. Why? Because notes are supposed to bear interest. Remember, accounts receivable, accounts payable do not bear interest. But notes receivable, notes payable are supposed to bear interest. So that's my point. You're in that exam, you see that phrase, non-interest bearing note, you know there's something wrong, and here's the bottom line. When you see a non-interest bearing note, your job in that exam is to impute or infer the interest that must be in that note. That's your job in that exam, to impute or infer the interest that must be in that note. Let's go to a problem. Number 13. Says, on January 1st, 2005, Elliott sold. Now notice we're on the seller side here. And you have to know with non-interest bearing notes, sometimes in the exam you're on the seller side, sometimes in the exam you're on the buyer side. Here we notice we're on the seller side. Elliott sold a building which had a carrying amount of $350,000, receiving a $125,000 cash down payment, and notice, as additional consideration, a $400,000, there's the phrase, non-interest bearing note due January 1st, 2008. Now, as I say, when you see that phrase, you know there's something wrong. We're going to have to impute or infer the interest that must be in this note. They go on to say, there was no established exchange price for the building. What does that mean? When you see that sentence, that there was no established exchange price for the building, that tells you you don't know the building's cash price. You don't know what the building would sell for in cash. So what do you use? The discounted present value of the payments. Let's read on. They say the prevailing rate of interest for a note of this type is 10%. Present value of $1 at 10% for 3 periods is 0.75. And at the bottom they say, what amount of interest income would be included in Elliott's 2005 income statement? What is the interest income for Elliott's 2005 income statement? You see why answer A is there. Because they hope you sit in the exam and go, hey, they're just trying to trick me. It's a non-interest bearing note. There is no interest. Now, we know it's not that simple. Again, our job here is to impute or infer the interest that must be in this arrangement. Let's do a couple of entries because I think it helps. Let's go back in time. Let's go back to January 1st, 2005. If I'm Elliott in this problem, what entry would I make when I sell the building? Well, you know I'm going to debit cash $125,000 because I got the cash down payment. Now listen carefully. If there's a secret to non-interest bearing notes, it's this. Always remember to record the note at its discounted present value. That's the secret with non-interest bearing notes. You have to remember to record the note at its discounted present value. So they said the prevailing rate of interest for a note of this type is 10%. Present value of $1, 10% for 3 periods, 0.75. I'm going to take that factor, 0.75, times the face amount of the note, $400,000, and I'm going to debit note receivable for its discounted present value, $300,000. That's really the secret here. Record the note at its discounted present value. Now, if I'm Elliott, I'm going to credit the building. Remember, I'm selling a building. I'm going to credit building for its carrying value, $350,000, and I'm going to credit gain on sale, $75,000. That's the entry that Elliott should make back on January 1. Now, before we continue this problem, I just want you to think about something. They said in this problem that this is a non-interest bearing note. That's what they said. If you had the document, you would see the way the lawyers drew it up. It says it all over it. This is a non-interest bearing note. It says it in beautiful gold script. Non-interest bearing notes written all over it. Here's my question. In your opinion, is there any interest in this note? Of course there is. How much interest exactly is there in this note? $100,000. Why? Because a promise to pay me $400,000 3 years from now is worth $300,000 today. Why am I getting that extra $100,000? Because I'm willing to wait 3 years. We call that interest. That's the thinking here. A promise to pay me $400,000 3 years from now is worth $300,000 today. The reason I'm getting that other $100,000 is because I'm willing to wait 3 years. We call that interest. We impute, we infer the interest that must be in this arrangement. All right, now let's go ahead a year. It's now December 31, 2005. Follow what Elliott would do. Elliott is going to take the going rate of interest for a note of this type, 10%, times the carrying value of the note, $300,000. Remember to use carrying value, not face value. When you're doing these calculations, always use the carrying value of the note, not face value. So Elliott's going to take the going rate of interest for a note of this type, 10%, times the carrying value of the note, $300,000. Elliott's going to debit note receivable, $30,000, and credit interest income, $30,000. And that's why the answer is B, not A. We impute, we infer the interest that must be in this arrangement. Let's go ahead another year. Let's say it's December 31, 2006. Would Elliott make the same entry? No. Be careful. When Elliott gets to December 31, 2006, the interest rate is still 10%, but the carrying value of the note has changed. Because of our adjustment back on December 31st, 2005, now the carrying value of the note is what? $330,000, right? Because of our adjustment back on December 31, 2005, the carrying value of the note's gone up $30,000 to $330,000 times 10%. So Elliott would debit note receivable $33,000, credit interest income $33,000. Now watch out for the second year. Sometimes they'll ask for the interest for the second year. And you've got to be aware that as you go from payment to payment to payment, the interest rate's not going to change, but the carrying value of the note keeps changing. Let's stay on this problem. What if I'm the buyer here? Same problem. What if I'm the buyer? What would I do back on January 1? Well, if I'm the buyer, back on January 1, I'm going to credit notes payable for its discounted present value. Hey, face value of the note is $400,000, but prevailing rate of interest for a note of this type is 10%. Present value of a dollar at 10% for 3 periods is 0.75. If I'm the buyer, I'm going to take that factor, 0.75 times the face amount of the note, $400,000, and I'm going to credit notes payable for its discounted present value, $300,000. I'm going to credit cash for the down payment, $125,000, and I'm going to debit the building, $425,000. That's what the building does. I mean, that's what the buyer does of the building. Debit building, $425,000. I just want you to be confident that we impute interest, whether we're on the seller side or the buyer side, equally. Let's go ahead a year. What's the buyer going to do? December 31, 2005. Well, the buyer, just like the seller, has to take the going rate of interest for a note of this type, 10%, times the carrying value of the note, $300,000, debit interest expense, $30,000, credit notes payable, $30,000. Notice the buyer has to recognize interest expense. And let's just carry it through. What happens on December 31, 2006? Well, the interest rate's still 10%, but because of our adjustment back at December 31, 2005, now the carrying value of the note is $330,000 times 10%. So the buyer will debit interest expense, $33,000. Credit notes payable, $33,000. As I say, watch out for the second year. Because, as I say, as you go from payment to payment to payment, the effective interest rate's not going to change. That's a one-time determination, and it doesn't change over the life of the note. But what keeps changing, of course, from payment to payment to payment, is the carrying value of the note, because that's always what you work with. Carrying value, not face value. I'd like you to try a couple of these. I'd like you to do a set, 14 and 15. So please do 14 and 15, and then come back. Welcome back. Let's do this set together. They say that on January 2nd, 2002, M sold. So you notice right away we're on the seller side. M sold equipment with a carrying amount of $480,000 in exchange for a $600,000, there's the phrase, non-interest-bearing note due January 2nd, 2005. Then they say there was no established exchange price for the equipment. We know what that means. We don't know what the equipment would sell for in cash. We don't know its cash price, so we're going to use the discounted present value of the payments. And they go on to say, the present value, they say the prevailing rate of interest for a note of this type is 10%. Present value of a dollar at 10% for 3 periods, again, is 0.75. And they ask us 2 questions. Now, before we answer the 2 questions, You know me, I like entries. Let's go back to January 2nd. What entry would M make when M made that sale? Well, we know that the secret to non-interest-bearing notes, if there is one, is to remember to record the note at its discounted present value. So if you're M, you're going to take the going rate of interest for a note of this type, 10%. We know that the present value of a dollar at 10% for 3 periods is 0.75. So you'll take that factor, 0.75, times the face amount of the note, $600,000, and M is going to debit note receivable for its discounted present value, $450,000. M will credit the equipment for its carrying value, $480,000, and debit a loss on sale of $30,000. And if you got that entry down, now you can answer number 15. 15 says, in M's 2002 income statement, what amount would be reported as gain or loss on sale? Well, you know it's A. There is a $30,000 loss on sale. And not only that, but when a year goes by and it's December 31, 2002, which is what question number 14 is all about, what's M going to do? Well, M is going to take the difference between the face amount of the note, $600,000, and its discounted present value, $450,000. M takes that $150,000 discount and amortizes it to interest revenue over the life of the note. And you know how to do that. At December 31, 2002, M is going to take the going rate of interest for a note of this type, 10%, times the carrying value of the note, $450,000, and M is going to debit note receivable, $45,000, and credit interest income, $45,000. That's why 14 is B. I think if you do a couple of entries, the answers hopefully just shake out for you. Try number 16 and come back. Welcome back. In number 16, they say on January 1 of year 3, Mill exchanged equipment for a $200,000, there's the phrase, non-interest-bearing note due January 1st, year 6. The prevailing rate of interest for a note of this type, 10%. Present value of a dollar at 10% for 3 periods, again, 0.75. And they want to know interest income. Well, once again, let's think about what Mill would do. Back on January 1, we know that Mill would record the note at its discounted present value. So Mill would take that factor, 0.75, times the face amount of the note, $200,000. Mill would debit note receivable for its discounted present value, $150,000, and we'll just credit sales, $150,000. We don't know the carrying value of the equipment. We'll just credit sales, $150,000. The point is that we're not going to let Mill overstate their sales. The real sale for Mill is $150,000. The rest is interest. We don't care how the lawyers drew it up. We impute, we infer the interest that has to be in this note. Now a year goes by. It's December 31, year 3. What Mill is going to do is take the going rate of interest for a note of this type, 10%, times the carrying value of the note, $150,000, and debit note receivable, $15,000, and credit interest income, $15,000. They wanted interest income, so the answer is B, right? No. B would be fine if they want the interest income for year 3, but they don't. They want the interest income for year 4, the second year. That's why I warned you on this earlier in the class. Sometimes in the exam, they want the interest for the second year. You know what I'm saying. If you picked answer B, you certainly know what you're doing. But watch out for dates. They want the interest income for year 4. So let's carry it through to year 4. When Mill gets to December 31, year 4, the interest rate is still 10%, but because of the adjustment in year 3, now the carrying value of the note is $165,000 times 10%. So Mill will debit note receivable $16,500 and credit interest income $16,500, and that's why the answer is C. I'd like you to try number 17 and then come back. Welcome back. In number 17, they say on December 30th, year 4, Chang sold, we're on the seller side. Chang sold a machine to door. in exchange for a non-interest-bearing note requiring 10 equal annual payments of $10,000 each. So for the first time in a problem like this, we have an annuity, a series of equal periodic payments over a specified number of periods. They go on to say that Door made the first payment on December 30th, year 4, the first day. The market rate for similar notes, 8%. Then they give us present value factors. Together, let's think about this. What entry would Chang make, the seller, on December 30th, year 4? When Chang makes this sale, what will Chang do? Well, just think of this. When does Chang get the first $10,000? Today. They said the first payment was made right away, December 30th, year 4. So Chang, we know, is going to debit cash $10,000. And now we know that Chang should always record the note at its discounted present value. So let's get our interest factor. You know I don't want the first table. I don't want present value of a single dollar. I want present value of an ordinary annuity at 8%. But what bothers some students, I don't want the factor for 10 periods. I want the factor for 9 periods, 6.25. Why? Because our job here is to discount the other 9 payments. After all, Chang has received the first payment. This is an annuity in advance. We got the first payment immediately at the beginning of the first period. So as I say, our job here is to discount the other 9 payments. So you see why we'd want the factor for 9 periods, 6.25. Take that factor, 6.25, times the equal payments in the note, 10,000. Chang is going to debit note receivable for its discounted present value, 62,500, and credit sales, 72,500. That's the entry for Chang. So when they ask us at the bottom, in the December 31 year 4 balance sheet, what amount would Chang report for the note receivable? It's answer C, its discounted present value on that day, 62,500. What we're going to get into next are notes that do have interest. These are interest-bearing notes, but the interest is too much or it's too little. What you have to be careful about in the exam is a note that has unreasonable interest. Let's go to a problem. Number 18 says, on December 31, year 1, Jet received 2 $10,000 notes receivable from customers in exchange for services rendered. So right away in this problem, there are 2 notes we're going to have to deal with. They say on both notes, interest is calculated on the outstanding principal balance at the annual rate of 3%. So notice both notes do bear interest at 3%, and everything's payable at maturity. There are no periodic payments. The note from Hart, made under customary trade terms, is due in 9 months. The note from Max is due in 5 years. And then they say the critical point. The market rate for similar notes is 8%. See, what you have here is unreasonable interest. How do I know that? Because both notes bear interest at 3%. But a fair rate for similar notes is 8%. So there is interest, but it's not enough. Then they give us present value factors at 8%. We know present value of a dollar at 8% due in 9 months, 0.944, and present value of a dollar due in 5 years at 8%, which is 0.680. They ask at the bottom, at what amounts would these 2 notes be reported in Jet's December 31, year 1 balance sheet? Well, let's start with a note from Hart. Let me show you what Jet wants to do. If I'm Jet and I get that $10,000 note from Hart for services, I don't want to worry about the 3% and the 8%. I want to have a simple, uncomplicated life. You know what I want to do if I'm Jet? I want to debit note receivable $10,000 and credit sales $10,000. A simple, uncomplicated life. Let me just debit note receivable $10,000, credit sales $10,000. In other words, what Jet is saying is, hey, in my book, that's a $10,000 sale. Now here's the question. Considering that the note from Hart bears interest at 3%, but a fair rate of interest for this kind of note is 8%. Can Jet do that? Yes, there's no problem. Why? Because when a note is made under customary trade terms, if a note is made under customary trade terms and is due in less than a year, notice the note from Hart is due in 9 months. That's really the critical point. So if a note is made under customary trade terms and it's due in less than a year, there's no requirement to impute interest on that note. So there is no requirement to impute interest on the note from Hart. So what I'm saying is, when Jet gets the note from Hart, Jet can just debit note receivable $10,000 and credit sales $10,000. That can be treated as a $10,000 sale. So if you look at the answers, now we know it has to be C or D, because the note from Hart does get recorded by Jet as a $10,000 note. Now obviously the note from Max is more complicated, because the note from Max has unreasonable interest, but it's due in 5 years. So now what I want to show you is how to handle unreasonable interest when it's due more than a year out. Here's what you have to do. If you see a note with unreasonable interest due more than a year out, the first thing you have to calculate is the maturity value of the note. Start with maturity value. Let's do it together. We're going to take the $10,000 note from Max. It bears interest at 3%. So what is that? That's $300 of interest due every year for 5 years. So at maturity, what has Max promised me if I'm Jet? Max has promised to pay me $1,500 of interest, $10,000 of principal. So at maturity, I'm going to receive $11,500. If I'm Jet, that's what Max has promised me. $11,500 5 years from now. Now, we're going to discount that note back to today at a fair rate of interest, which is 8% for this kind of note. So we get our factor. Present value of a dollar at 8% due in 5 years, 0.680. We multiply that maturity value, 11,500 times 0.680. The discounted present value of that note is 7,820. So what Jet should do for the note from Max is debit note receivable at its discounted present value, 7,820, and credit sales, 7,820. In other words, what we're saying to Jet is, we're not going to let you overstate your sales. The real sale here is not 10,000. The real sale is 7,820. The rest is interest. We don't care how your lawyer drew it up. A fair rate of interest for this kind of note is 8%. So the rest is interest. So now we know the answer is D, because the note from Hart would just be reported as a $10,000 note. But the note from Hart should be reported at its discounted present value, and that is 7,820. Answer D. Now we're done with notes, and what we're going to get into next is a huge topic, and that is how to account for a company's investments. Now, as we get into this discussion, let me just quickly say, we're going to have a discussion now on how we account for a company's investments, except one. What we're not going to talk about in this discussion is investments that are accounted for under the equity method. We're not going to cover that because we cover the equity method as part of our class on consolidation. That really is something that should be discussed in conjunction with consolidation. So that's the one thing we're not going to get into in this class. Investments in common stock that are being accounted for under the equity method. We're not going to worry about that. But other than that exception, let's talk about how a company accounts for their investments. And generally speaking, a company should divide their investments into three categories, three portfolios. Here we go. The first category, the first portfolio, would be held to maturity securities. Now, what investments go in this category? Well, just remember that held to maturity investments are for investments in debt securities only. Debt securities only, like bonds, where management has both the intent and the ability to hold the debt until maturity. That's a held to maturity investment. Investments in debt securities only, like bonds, where management has both the intent and the ability to hold the debt until maturity. That's what goes in this category. Now, a couple of things to remember about this portfolio. Point number one, how do you classify these investments? Would a held to maturity investment be a current investment or a non-current investment? I always tell my students that maybe they don't think classification is a big deal, but the exam does. It's very important to know classification when you win the exam. So held to maturity, would it be a current investment or non-current? You have to go by the maturity date. My point is, if the debt matures more than 12 months from the balance sheet date, it's a non-current investment. If the debt matures less than 12 months from the balance sheet date, it's a current investment. It's the only way to classify these investments. You have to go by the maturity date. I think you see my point. If the debt matures more than 12 months from the balance sheet date, it's a non-current investment. If the debt matures less than 12 months from the balance sheet date, it's a current investment. That's how you classify these investments. Point number 2. Held to maturity investments will be carried on a company's balance sheet at amortized cost. Remember that. Held to maturity investments always get carried on a company's balance sheet at amortized cost. Now, what is amortized cost? You've definitely had this before. Amortized cost is the method everybody gets taught in school, where you amortize discounts and premiums on bonds as part of the interest adjustment. Let's do a simple example. The example in your viewer's guide says, Corporation A purchased bonds with a face amount of $500,000 and a stated interest rate of 9%. Remember, the stated rate, that's printed right on the bonds. That's the stated rate of interest, printed right on the bonds. But notice, A bought $500,000 worth of bonds at a discount. They only paid $469,500 for the bonds because they want the bonds to yield 10%. That's why you buy bonds at a discount, because you want them to yield a little bit more than the stated rate. Here the bonds are going to yield 10%. That's why there's a $30,500 discount here. The difference between $500,000 and what they paid, $469,500, there is a $30,500 discount here. And again, the reason there's a discount, we want the bonds to yield a little bit more than the stated rate. Now, the investment was on January 1, and let's assume that the bonds pay interest annually on December 31. What adjustment would A, the investor, make on December 31? Well, first of all, we know this, that the interest check that A will collect is always based on the stated rate of interest printed on the bonds times face value. Remember that. With a bond, the interest check is always the stated rate of interest printed on the bonds times face value, stated times face. So I'm going to take the stated rate, 9%, times the face amount of the bonds, $500,000. We know A is going to debit cash, $45,000. Now, there's two ways to do the amortization. There's the straight line approach, and there's the effective interest approach. What you see most often in the exam is the effective interest approach. Here we go. Under the effective interest method, the way you calculate the income that A earned for this period is by multiplying the effective yield of the bond. The effective yield is 10% times carrying value. What's the carrying value of the bonds? The face amount, $500,000, minus the unamortized discount, $30,500. The carrying value of the bonds is $469,500 times the effective yield, 10%. We know that A is going to credit interest income for $46,950. That's the income that was earned for that first period. Now, the entry doesn't balance. The next number is a plug. I need a debit of $1,950. To balance the entry out, you debit investment in bonds, $1,950. That $1,950 is the amortization of the discount for that period. That would be the effective interest approach to amortized cost. Held to maturity investments are always accounted for under amortized cost. Let's apply the straight line approach, just to make sure you see the difference. If A used the straight line approach, when A gets to December 31, here again, they know that the interest check they're going to collect is always based on the stated rate of interest, 9%, times the face value of the bonds, $500,000. So they're still going to debit cash, $45,000. But in straight line, it's a little different. Let's assume these are 10-year bonds. All right? Let's assume these bonds mature in 10 years. In straight line, they would do this. They would take the $30,500 discount, divide by 10 straight line years, and take $3,050 of discount amortization. So they would debit investment in bonds $3,050 and credit interest income $48,050. That's the straight line approach to amortized cost. So that's the bottom line. Held to maturity investments are always accounted for under amortized cost. And notice, there's the straight line approach to amortized cost, and there's the effective interest approach to amortized cost. All right, now the second portfolio would be trading securities. What investments go in this category? Well, trading securities are for investments in stocks or bonds, equity or debt securities, stocks or bonds that are held for the purpose of selling in the near term. That's a trading security. Investments in equity or debt securities, stocks or bonds that are held for the purpose of selling in the near term. Held for the purpose of selling in the near term. Now, three big things to remember about trading. Let's start with classification because it's easy. Trading securities are always classified as a current asset, always. Point number two, trading securities are carried on the balance sheet at fair value. Trading securities would always be carried on the balance sheet at their fair market value. It's fair value accounting here. Now, I think you see what's coming for point number three. If I'm going to write trading securities up to fair value, then I'm going to have an unrealized holding gain. If I write trading securities down to fair value, well, then I'm going to have an unrealized holding loss, and that's the third point. Any unrealized holding gain or loss, any unrealized holding gains or losses from the trading portfolio belong on the income statement. These gains and losses are included in earnings. Any unrealized holding gains and losses from the trading portfolio belong on the income statement. They're included in earnings. Let's do an example. Again, if you look in your viewer's guide, you'll notice we get to December 31st, 2005. I'm looking at my trading portfolio, and I've got investment in A, cost $8,000, but at year end has a fair value of $12,000. So what am I going to do? At year end, I'm going to debit investment in A, $4,000. I'm going to write that security up to fair value, and I'm going to credit an unrealized holding gain, $4,000, and take that to the income statement. It's trading. B, cost $10,000 with a fair market value at year end of $5,000. So I'm going to debit an unrealized holding loss of $5,000. That loss will go to the income statement, and I'll credit investment in B, $5,000. I'll write it down to fair value. Notice I write up to fair value or down to fair value. How about C? It cost $20,000, but at year end, 2005, has a fair value of $27,000. So I'm going to debit investment in C, $7,000, and credit an unrealized holding gain of $7,000. And again, we know that gain would go to the income statement because it's trading. Now let's say we get into year 6, and we actually go out and we sell investment in C for $25,000. So now we get into another year, year 6. Now we actually go out and we sell investment in C for $25,000. And remember, that's what's happening with trading. We buy and sell these securities all the time. That's the nature of trading. So if we go out and we actually sell investment in C for $25,000, you know you're going to debit cash for what you collected, $25,000. What would you credit to investment in C? $20,000 or $27,000? That's right, $27,000. At the end of last year, we wrote that security to its fair value. It's being carried in the financial statements at $27,000. So now if we sell it, we credit investment in C, $27,000, and we debit our realized loss of $2,000. And that realized loss, of course, would go to the income statement. Realized gains and losses always go to the income statement. It doesn't matter what portfolio you're in. Realized gains and losses always go to the income statement. The issue we're really discussing is, what do we do with these unrealized holding gains and losses? Well, the unrealized holding gains and losses for the trading portfolio go to the income statement also. But I want to point out again that realized gains and losses always go to the income statement, as they always have. The third portfolio is called available for sale securities. Now, what investments do we put in this category? Well, available for sale securities are for investments in stocks or bonds, equity or debt securities that are not categorized as held to maturity or trading. So you see how this works. Any investment that we don't put in the first two portfolios just automatically falls to the third, and it's on our balance sheet available for sale. And if we need cash, we'll get rid of it. So investments in equity or debt securities, stocks or bonds, that are not categorized as held to maturity or trading. That's what we consider available for sale. Now, there's three big things to remember about available for sale. Let's start with classification. You know, I've got to talk about it. Well, it's a little tricky here. Available for sale securities could be current or non-current. Why? I bet you see it. Because if I have debt securities in this portfolio, I've got to look at the maturity date. If the debt matures more than 12 months from the balance sheet date and they intend to hold on to it, it's a non-current investment. If the debt matures less than 12 months from the balance sheet date, it's a current investment. Doesn't that make sense? You could have debt securities in this portfolio, and you've got to look at the maturity date. If the debt matures more than 12 months from the balance sheet date, it's a non-current investment. If the debt matures less than 12 months from the balance sheet date, it's a current investment. Now, if I have equity securities in this portfolio, which I no doubt will, I look at management's intentions. If management intends to sell the investment off in a short period, it's a current investment. If management intends to hold on to it indefinitely, it is a non-current investment. You look at management's intent. What I'm saying is, there's nothing to prevent a company from having both a current and a non-current portfolio of available for sale. Let's do a little problem on available for sale in your viewer's guide. We get to December 31st, 2005. We're looking at our available for sale securities. We've got Q, we've got R, we've got S. And Q costs $3,000, but at year end has a market of 10. R costs $5,000, but at year end has a market of 15. S costs $7,000, but at year end just has a market of 1. Now listen carefully. The available for sale portfolio is carried on the balance sheet at its aggregate fair market value. The available for sale portfolio is carried on the balance sheet at its aggregate fair market value. So at year end, at the end of 2005, I would look at the aggregate cost of that portfolio, $15,000, compared to the aggregate market, $26,000. I'm going to adjust this portfolio by $11,000. Notice I'm going to do it in aggregate, not security by security. And if you're not sure why I'm doing available for sale in aggregate, not security by security, you'll certainly see why in a minute. But the available for sale portfolio does have to be carried on the balance sheet at its aggregate fair market value. And then that leads to the third point, which is that any unrealized holding gains or losses, from the available for sale portfolio don't go to the income statement. They go directly to stockholders' equity as an item of other comprehensive income. So any unrealized holding gains or losses, from the available for sale portfolio simply will not go to the income statement. No, these gains and losses flow directly to the balance sheet. They go directly to stockholders' equity as an item of other comprehensive income. So at year end, if we say, well, the aggregate cost is $15,000, the aggregate market is $26,000, we're going to debit an account called market adjustment, $11,000. That market adjustment, that's a balance sheet account. That's a valuation account for the balance sheet. And what do I credit? OCI. This gain wouldn't go to the income statement. It goes directly to stockholders' equity as an item of other comprehensive income. So notice I would credit OCI. Now let's say we do a balance sheet at December 31, 05. If you do a balance sheet at December 31, 05, probably in non-current assets, you don't have enough information here, but probably in non-current assets, you'd see this. Available for sale securities at cost, $15,000, plus the market adjustment account, because it's a debit, plus market adjustment, $11,000. So the available for sale portfolio is on the balance sheet at $26,000. It's aggregate fair market value. You can see that what's required for trading and available for sale is fair value accounting. Let's go ahead another year. Let's say it's now December 31, 2006. You get to December 31, 2006. Now you're looking at your available for sale portfolio. Now notice the cost is still $15,000, but the market's come down to $14,000. So what do I do? Well, look at last year. At the end of year 5, didn't we set up a balance in market adjustment of an $11,000 debit? What do I need as a balance in market adjustment at the end of year 6? A $1,000 credit, because now market's below cost. So you see the problem. At the end of year 5, we had set up a market adjustment account with an $11,000 debit balance. But now, a year later, because the market values have changed, what I need in market adjustment is a $1,000 credit. So what am I going to do? I'm going to have to credit market adjustment for $12,000. I'm going to have to credit that market adjustment account for $12,000. I've got to bring, my job here is to bring that market adjustment from an $11,000 debit balance to a $1,000 credit balance, because now market's below cost. I write up to market or down to market. It's fair value accounting. And that's my job here, to bring that market adjustment account from an $11,000 debit balance to a $1,000 credit balance. So I'm going to credit market adjustment $12,000, and I'll debit OCI $12,000. And by the way, if this is the only item of OCI they have, they could have other items. But if this is the only item of OCI they have, then down in stockholders' equity, accumulated OCI just went from an $11,000 credit to a $1,000 deficit. This is all taking place on the balance sheet, and I'm sure you see that. Because if this is the only item of OCI they have, they could have others, but if this is the only item of OCI they have, then down in stockholders' equity, accumulated OCI just went from $11,000 credit to a $1,000 deficit from that adjustment. Let's get into year 7 for a minute. Let's say when we get into year 7, now we actually go out and we sell investment in R for $8,000. So now it's year 7. We go out, we sell investment in R for $8,000. So if I sell investment in R for $8,000, I'm going to debit cash $8,000, and I'm going to credit investment in R for its original cost, $5,000. Not its market value, $3,000. Its original cost, $5,000. And I'm going to debit a realized loss. Excuse me, I have a realized gain here of $3,000. I'm going to credit a realized gain of $3,000. And that realized gain, of course, would go to the income statement, because as we've already said, realized gains and losses always go to the income statement. It doesn't matter what portfolio you're in. So I go out and we sell investment in R for $8,000. Of course, I'll debit cash $8,000. And I'll credit investment in R for its original cost. That was never adjusted, $5,000, and I'll credit a realized gain, $3,000. And naturally, that realized gain would go to the income statement, as they always do. So I hope that gives you a better idea of why we do available for sale in aggregate. Because if we ever sell a security out of that portfolio, we've got to go back to the original cost of the security to work out any gain or loss that's realized for the income statement. Another thing I want to mention, they might mention in the exam that there's been a permanent decline in market for security. What if they say there's been a permanent decline in market for a security? Well, I want you to know that we only care about permanent declines if we're dealing with held to maturity or available for sale, never trading. We don't care about the issue in trading. So again, only care if a decline is permanent if you're dealing with held to maturity securities or available for sale securities. Doesn't matter. The issue is not important in trading. Now, you know, when I say there's been a permanent decline, this is something extreme. A company going bankrupt. We know that every day the stock market goes up, it goes down. It's not what I'm talking about. Those temporary increases, temporary decreases, that's not what we're talking about. This is something unusual. A company going bankrupt like Enron. Well, here's the point. If the exam says there's been a permanent decline in market, then you're going to debit a realized loss. They're going to have to tell you. But if the exam specifies there's been a permanent decline in market, then you're going to debit a realized loss. Take that loss to the income statement and credit investment in Enron. You're going to write it off. That's how you handle a permanent decline. Debit a realized loss, take that loss to the income statement, it's considered realized, and credit investment in Enron. Just write it off. And as I say, we only care about the issue of permanent declines if we're dealing with available for sale securities or held to maturity securities. It's not an issue in trading. I'd like you to try a question. I'd like you to try number 19 and come back. Welcome back. In 19, they say at year end, RIM Company held several investments with the intent of selling them in the near term. So you know it's trading. That's what trading securities represent. Equity or debt securities that are held for the purpose of selling in the near term. And they want to know at the bottom, what amount would RIM report as trading securities in its year-end balance sheet? Well, notice they have the investment in the bonds. The investment in the bonds cost $92,000, but at year-end have a market value of $105. Would the bond be on the balance sheet at $92, its cost, or market $105? Market $105, because if it's a trading security, trading securities are accounted for under fair value. We would actually write that investment in bonds to $105,000 at year end. Why? It's trading. Now, if that were held to maturity, it would be an amortized cost. We wouldn't care about the fair value of the bonds. But it's trading. So we would write that investment to its fair value at the balance sheet date, $105,000. Same thing with the equity security. It costs $35,000. Year end has a market of $50,000. Well, that would be written to $50,000. So what's on the balance sheet for trading? $105 plus $50. Answer D, $155,000. Please try number 20 and come back. Welcome back. And number 20, they say during year 9, Scott purchased marketable equity securities, classified them as available for sale. We get to year end. We've got security D, E, and F. Remember, we don't do available for sale security by security. We do it in aggregate. So at year end, we'd look at the aggregate cost, $96,000, the aggregate market, $86,000. What would we do? We would debit OCI, $10,000. That loss wouldn't go to the income statement. It would go right to stockholders' equity as an item of OCI. So we would debit OCI $10,000 and credit market adjustment $10,000. That would be our adjustment. When they ask at the bottom, the amount of unrealized loss from these securities in Scott's year 9 income statement, you know it's zero. Answer D. Because unrealized holding gains and losses from the available for sale portfolio don't go to the income statement. They go directly to stockholders' equity as an item of OCI. Please try number 21 and come back. Number 21, they say that the following information pertains to Smoke. Smoke has 2 securities. Notice these securities are classified as available for sale. The first security has a cost of $70,000, but at year end has a market of $50,000. The second security has a cost of $50,000, but at year end has a market of $60,000. Now, I hope this didn't bother you. They said about the second security that Smoke believes that the recovery from an earlier lower fair value is permanent. I hope you recognize that's nonsense. There's no such thing as a permanent recovery. We would care if a decline is permanent. That would matter if a decline was permanent. But how could you ever say a recovery is permanent? You mean that security could never go down in market value again for the rest of time? That's really nonsense. A recovery could never be permanent because that's the rest of eternity. We don't know that. But as I say, a decline could be permanent. We'd have to care about that. But here's the point. If you add this up, the aggregate cost of the available for sale portfolio is $120,000, 70 plus 50. The aggregate market is $110,000, 50 plus 60. So what entry would you make? You would debit OCI $10,000. That loss wouldn't go to the income statement. It would go directly to stockholders' equity as an item of OCI. So they would debit OCI $10,000 and credit market adjustment $10,000. So when they ask at the bottom, what is the effect on the market adjustment account? You know it's D. It creates a $10,000 credit balance. Please try number 22 and then come back. Welcome back. Number 22 says, during year 7, Wall purchased 2,000 shares of hemp for $31,500. It's available for sale security. The market value of this investment at the end of year 7 was $29,500. But remember, we wouldn't do available for sale security by security. We would do it in aggregate. And then they sell the investment at $14 a share. So what happens? If they go out and they sell the 2,000 shares at $14 a share, aren't they getting $28,000 for that investment minus the $1,400 in brokerage commissions? What they netted out of that sale was $28,000 minus $1,400, $26,600. They're going to debit cash $26,600. They're going to credit investment in hemp for its original cost, $31,500, and then debit a realized loss of $4,900. And the answer is A, because we know realized gains and losses always go to the income statement. It doesn't matter what portfolio you're in. That never changes. But the issue that you have to remember is what you do with unrealized holding gains and losses. But once the gain or loss is realized by actually selling the security, it always goes to the income statement. Please try number 23 and then come back. Welcome back. In number 23, they say at the end of year 1, Lane Company held trading securities that originally cost $86,000, but at the end of year 1 had a market value of $92,000. So remember, at the end of year 1, those securities would have been written to their fair value, $92,000. Because we know trading securities are accounted for under fair value. We write them up to fair value, down to fair value. We would have written these trading securities to their fair value, $92,000. Then in year 2, all the securities were sold for $104,500. Well, if all the securities were sold for $104,500, they're going to debit cash $104,500, credit the securities for the amount they're being carried on the balance sheet, fair value $92,000, and credit a realized gain of $12,500. That's a realized gain because they actually sold the securities. And the realized gain, of course, goes to the income statement, as it always does. Then it says at year end, at the end of year 2, Lane had acquired additional trading securities that cost $73,000, but at year end had a market of $71,000. So what would they do? They would debit an unrealized holding loss of $2,000 and credit the securities $2,000. They'd write those securities to fair value. And that unrealized holding loss of $2,000 would go to the income statement because it's trading. So when they ask at the bottom, what is the impact of the stock activities on the income statement? Well, you've got a realized gain of $12,500. That's on the income statement. An unrealized holding loss of $2,000. That's on the income statement because it's trading. The answer is B. It's a net gain on the income statement of $10,500. Let's do 24 and 25 together. It says Sun had investments in equity securities classified as trading, and they cost $650,000. Then on June 30th, year 5, Sun decided to hold the investments indefinitely and then reclassified them from trading to available for sale on that date. The investment's fair value was $575,000 December 31, year 4, $530,000 June 30th, year 5, and $490,000 December 31, year 5. Let's do this year by year. When Sun got to the end of year 4, when Sun got to December 31, year 4, we know the cost of these securities was $650,000. The market value was $575,000. So what would they have done at the end of year 4? They would have debited an unrealized holding loss of $75,000. That loss would go to the income statement in year 4 because it's trading, and they would credit the securities, $75,000. What I'm saying is they would have literally written those securities down to $575,000 at the end of year 4. Because it's trading, trading securities are accounted for at fair value, and again, that $75,000 loss would have gone to the income statement. That's what happened in year 4. Now, these two questions are asking about year 5. So let's get into year 5. On June 30th, year 5, when the market value was $530,000, they transferred this investment from trading to available for sale. And that's why we're going to do this set together. Because you have to know how to deal with transferring investments from one portfolio to another. And I want you to know that when you see this in the exam, because they do like this, when you see in the exam that they're transferring investments from one portfolio to another, what you're dealing with is a rule. It's not a hard rule, but you have to be aware of it. Here's the rule. When you transfer investments from one portfolio to another, on the day of the transfer, write the individual security to its fair market value. On the day of the transfer, write the individual security to its fair market value. Why? Because the effect they always want a security to enter its new portfolio at fair value. That's the effect they want. So let me say it again. The simple rule is, on the day of the transfer, you always write the individual security to its fair market value. Because the effect they always want a security to enter its new portfolio at fair value. All right, so let's just follow that through. On June 30th, year 5, when they transfer this investment from trading to available for sale, the market value is now $530,000. So they're going to have to write the security from $575,000, that's the carrying value on the balance sheet right now, from $575,000 down to $530,000. So what would they do? They would debit an unrealized holding loss of $45,000. And they would credit the security, $45,000. They would literally write that security from $575,000 down to $530,000. That way the security enters its new portfolio at $530,000. It's fair value. So they would debit an unrealized holding loss of $45,000 and credit the security, $45,000. And that loss would go to the income statement because trading's involved. So now we can answer number 24. 24 says, what amount of loss from investments would Sun report in its year 5 income statement? The answer is A, $45,000. That loss would go to the income statement because trading's involved. And I want you to know that that entry we just looked at, where we debit the unrealized holding loss, $45,000, credit the investment, $45,000, that's the entry you make if trading's involved, if you're going to or from trading. If you're going to or from trading, that's the entry that you would make. What if you're going, same problem, what if you were going from available for sale to held to maturity, or held to maturity to available for sale? Well, the rule would be the same. You have to write the security to its fair value because they always want a security to go to its new portfolio at fair value. So in this problem, if we were going held to maturity to available for sale or available for sale to held to maturity, if trading's not involved, we would still credit investment in securities for $45,000. I would still have to write the securities from $575,000 down to $530,000. But the difference is if trading's not involved, I would debit OCI $45,000. Now the loss wouldn't go to the income statement. I would debit OCI $45,000. And that shows you every mathematical possibility. But in this problem, trading is involved, so that's why the answer to number 24 is A. The loss would go to the income statement because trading was involved. You're going to or from trading. The gain or loss would go to the income statement. Now, let's get into the end of 2005. When we get to the end of year 5, now I'm looking at my available for sale portfolio. And the securities in the portfolio at its fair value, $530,000. Remember, it went in at fair value. But at year end, the market value is $490,000. So what would you do? You would debit OCI $40,000. And credit market adjustment, $40,000. Remember, now it's available for sale. So at year end 5, you would debit OCI $40,000 and credit market adjustment $40,000. So in the ask at number 25, what amount would Sun report as net unrealized loss on investments in equity securities in OCI? The answer is also A. But the main reason we did that set of questions is so that you're comfortable with dealing with transferring investments from one portfolio to another. As I say, it's not complicated. You always write the security to its fair value on the day of the transfer because they always want a security to enter its new portfolio at fair value. I want to remind you that what we have not discussed are investments in common stock being accounted for under the equity method. Remember, we discussed the equity method in great detail as part of our class on consolidated financial statements. What about investments in common stock being accounted for under the cost method? Well, you may remember that the cost method is a pretty simple method. If a company purchases, say, 2,000 shares in another company's stock for $14 a share, well, if they use the cost method, they're going to debit the investment for the cost of the shares. 2,000 shares at 14, $28,000, and credit cash $28,000. They would establish the carrying value of the investment for the cost of the shares. That's why they call it the cost method. And then, if the other company sends the investor company a dividend, say of $2,000, the investor company would debit cash $2,000 and credit dividend income $2,000. Because under the cost method, the company would treat any dividends coming from the other company as income. It's a very simple approach. And as I say, in our class on consolidated financial statements, we get into much more detail about the distinction between the cost method and the equity method and the differences between the cost method and the equity method. But I'll say one more thing about this, and that is that anytime an investment is being accounted for under the cost method, that's just carried as one of the company's available for sale securities. So just keep that in mind. When an investment's being accounted for under the cost method, it's just carried as one of the company's available for sale securities. That's what it is. What we're going to get into next is something else that you have to be aware of when it comes to accounting for a company's investments, and that is derivatives and hedging activities. Let's start with some definitions, because that's really primarily what this area is about, is understanding the definitions. What's a derivative? A derivative is an investment that derives its value from something else. That's where the word comes from, derivative, because it derives its value from something else. For example, if you invest in grain futures, that's a derivative investment because the total value of that investment is derived from whether the price of wheat went up or down today. If you invest in foreign currency options, that's a derivative investment because the total value of that investment is derived from whether the euro got more expensive or cheaper today. That's what a derivative investment is. It's an investment that derives its value from another security or another commodity. It derives its value from another security or another commodity. Now, there's something that bothers people right away, so I want to say it. You've got to get used to this. Please remember that a derivative investment can be an asset or a liability. Keep that in mind. A derivative investment can be an asset or a liability. Why? Because with a derivative, if you're in a gain position, clearly you're in an asset position. But if you're in a loss position, and it's big enough, it could be a liability. So keep that in mind. Now, what's hedging? Hedging is a strategy. It's a strategy where a company invests in a derivative for the purpose of counterbalancing the potential loss in another security or another transaction. In other words, you're hoping that you make enough profit on this investment that'll counterbalance a loss that you're anticipating somewhere else. That's what hedging is. It's a strategy where a company invests in a derivative for the stated purpose of counterbalancing the potential loss in another security or another transaction. As I say, you're hoping that you make enough profit on this investment that'll counterbalance a loss that you're anticipating somewhere else. You're hedging your bets. Now, the most important part of this, how do we account for derivatives in hedging activities? Let's start with how we account for derivative that's not being used as a hedge. Not being used as a hedge. Well, it's actually pretty simple. If a company has a derivative investment that's not being used as a hedge, then it'll be on the balance sheet as either an asset or a liability. If a company has an investment that is a derivative, but it's not being used as a hedge, it's a non-hedge derivative, that investment will be on the balance sheet as either an asset or a liability, and it's accounted for at fair market value. So once again, what's required is fair value accounting. And if we're going to use fair value accounting, you know what's coming. If I write a non-hedge derivative up to fair value, well then I'm going to have an unrealized holding gain. If I write a non-hedge derivative down to fair value, well then I'm going to have an unrealized holding loss, and that's the third point. Any unrealized holding gain or loss, any unrealized holding gain or loss from a non-hedge derivative belongs on the income statement. That gain or loss would be included in earnings. Now, how we account for a derivative that is being used as a hedge depends on what kind of hedge that it is. There are two broad types of hedges. The first type is called a fair value hedge. A fair value hedge is a hedge against potential losses. That's what a hedge is. It's a hedge against potential losses from the change in the fair market value of something. You're hedging against potential losses from the change in the fair market value of an asset or a liability. That's what a fair value hedge is. Hedging against potential losses from the change in the fair market value. The change in the fair market value of an asset or a liability. Now, once you know what a fair value hedge is, it's actually pretty simple. A fair value hedge will be on the balance sheet as either an asset or a liability. And yes, it is accounted for at fair market value. So once again, it is fair value accounting. And if I'm going to use fair value accounting, I could have unrealized holding gains and losses. And let's make the point. Any unrealized holding gains or losses, any unrealized holding gains or losses from a non-hedge derivative, any unrealized holding gains or losses from a fair value hedge belong on the income statement. These gains and losses do go to the income statement. They're included in earnings. So notice the accounting for a fair value hedge is exactly the same as the accounting for a derivative that's not being used as a hedge. Because again, any unrealized holding gains or losses from a non-hedge derivative or any unrealized holding gains or losses from a fair value hedge, those gains and losses, all of them, belong on the income statement. They are included in earnings. As I say, bottom line is, we account for a fair value hedge exactly the same way we account for a derivative that's not being used as a hedge at all. The second type of hedge is called a cash flow hedge. Now, a cash flow hedge is a hedge against potential losses from the future cash flows from an asset or liability. That's a cash flow hedge, where you're hedging against potential losses from the future cash flows from an asset or a liability. Hedging against potential losses from the future cash flows from an asset or a liability. Now, once you know what it is, how do we account for a cash flow hedge? Well, if a company has a cash flow hedge, it will be on the balance sheet as either an asset or a liability. And yes, it's accounted for at fair market value. So if a company has a cash flow hedge, it's going to be on the balance sheet as a distinct asset or distinct liability. And yes, it will be accounted for at fair market value. So here again, what's required is fair value accounting. Now you know what's coming. If I'm going to use fair value accounting, then I'm going to end up with unrealized holding gains and losses. So be careful. how we account for the unrealized holding gains and losses from a cash flow hedge depends on whether the hedge is effective or not. You got to listen carefully now. This is the only little complicated part of this, because how we account for the unrealized holding gains and losses from a cash flow hedge depends on whether the hedge is effective or not. What do I mean by effective? I think you know. Effective means I am making a profit on this investment that is counterbalancing a loss somewhere else. That would be an effective cash flow hedge, right? If I'm making a profit on this investment that is counterbalancing a loss somewhere else, it's an effective cash flow hedge. And here's the point. If you have an effective cash flow hedge, that gain is not on the income statement. That gain goes directly to stockholders' equity as an item of OCI. If you have an effective cash flow hedge, the gain doesn't go to the income statement. The gain goes directly to stockholders' equity as an item of other comprehensive income. What if it's ineffective? How could it be ineffective? Well, what if I take a loss on the investment? What if I take a bath on the investment? Who said I had to make a profit? Well, if you have an ineffective cash flow hedge, that loss goes directly to the income statement. It does go to the income statement, and it's included in earnings. So you see the difference. If I have a derivative that's not being used as a hedge, or if I have a fair value hedge, the gains and losses go right to the income statement. But if I have a cash flow hedge, how I handle the gains and losses depends on whether it's effective or not. If I have an effective cash flow hedge, the gain doesn't go to the income statement. It goes directly to stockholders' equity as an item of OCI. But if it's ineffective, the loss would go right to the income statement. It would be included in earnings. Now, I don't want to go over too many entries here, but I just want to show you a couple. Let me give you an example. Let's say a company has an investment in X, and it is a cash flow hedge. So a company has an investment in X, it is a cash flow hedge, and let's say it's effective. Let me ask you something. If it's effective, is it rising in value or falling? It's rising. Let's say it's gone up in market value $10,000. So what would I do? I would debit investment in X, $10,000. I'd write that investment up $10,000, and I would credit OCI. That gain wouldn't go to the income statement. It would go right to stockholders' equity as an item of OCI. But here's what's a little tricky. Now what happens is that when the loss that I was hedging against, remember I was trying to counterbalance a loss, when the loss that I was hedging against finally gets on the income statement, that could be a year and a half from now. When the loss gets on the income statement, again, when the loss that I was trying to counterbalance, when the loss that I was hedging against does get to the income statement, that could be a year from now. Now I'll debit OCI, $10,000. I'll take that gain out of stockholders' equity, and I'll credit gain on derivatives, $10,000. That gain now will go to the income statement, because on the income statement, I want to show the loss and how I counterbalanced it. That's what happens. So again, when the loss that I was hedging against finally gets on the income statement, maybe a year from now, then I'll debit OCI. I'll take the $10,000 gain out of stockholders' equity, and I'll credit gain on derivatives, $10,000. That gain would now go to the income statement. That way, on my income statement, I can show the loss and how I counterbalanced it. Let's say this. Let's say the company also has an investment in Z. It is a cash flow hedge. So the company also has an investment in Z, a cash flow hedge. And let's say it's ineffective. Well, that means it's dropping in market value. Let's say it's declined in market $3,000. What would I do? I would debit loss on derivatives, $3,000. I would take the loss right to the income statement, and I would credit investment in Z, $3,000. If you have an ineffective cash flow hedge, that loss would go right to the income statement. Doesn't go to OCI. It goes right to the income statement. Now, derivatives and hedging activities also will come up in the area of foreign currency. There are foreign currency hedges. You got to be aware of these. If the exam were to mention a foreign currency denominated firm commitment hedge, if they were to mention a foreign currency denominated firm commitment hedge, in other words, it's denominated in a foreign currency, a foreign currency denominated firm commitment hedge, or a foreign currency denominated available for sale securities hedge, either one of those, if they're mentioned, a foreign currency denominated firm commitment hedge or a foreign currency denominated available for sale securities hedge. Those are fair value hedges. That's what they are. They're fair value hedges, and you know how to account for them. However, if they mention a foreign currency denominated forecasted transaction hedge, I think you'd get it anyway, because now you're talking about cash. If they mention a foreign currency denominated forecasted transaction hedge or a foreign currency net investment in foreign operations hedge, they mention either one of those are cash flow hedges. So either a foreign currency denominated firm commitment hedge or a foreign currency denominated available for sale securities hedge, those are fair value hedges. But a foreign currency denominated forecasted transaction hedge, now you're talking about cash, or a net investment in foreign operations hedge, now you're talking about cash, those are cash flow hedges. So you just go right back to the notes that we went over and the entries we went over for a cash flow hedge. I'd like you to try some questions. I'd like you to try 26, 27, and 28, and then come back. Welcome back. In number 26, they say, which of the following financial instruments is not a derivative? What's not a derivative? Well, you know, an interest rate swap is a derivative. Currency futures, foreign currency options, definitely a derivative investment. A stock index option, the value of that investment depends on what happens to the S&P 500, what happens to the Dow Jones average. It is derived from something else, but a bank certificate of deposit is not a derivative investment. Answer D. 27. If it is not practicable for an entity to estimate the fair value of a financial instrument, which of the following must be disclosed? How about number 1? Would you have to disclose information pertinent to the estimating of the fair value of the instrument? Yes, you'd have to disclose that. And also number 2, you'd have to disclose the reasons why it's not practicable to estimate the fair value, why you're not able to do it. What are the factors you'd consider and why you're not able to do it? Yes, they both have to be disclosed, and the answer is C. 28. Which of the following risks are inherent, unavoidable, in an interest rate swap? How about the risk of exchanging a lower interest rate for a higher interest rate? Sure, that risk is inherent in the whole idea of the swap. Maybe interest rates will continue to go lower, and here you've exchanged it for a higher interest rate because you thought they were going to go much higher. It's inherent. It's baked into the cake. Nothing you can do about that. And also the second one, the risk of non-performance by the counterparty to the agreement. That risk is there as well. It's a risk you're taking with an interest rate swap. So the answer is C again. Both those risks would be inherent and unavoidable in that sort of swap. That concludes our discussion of cash and receivables and investments. And from all of us at the Bisk CPA Review, we want to wish you the best of luck on the exam. Keep studying.
Welcome to Bisk CPA Review, comprehensive review materials for the CPA exam to let you customize your own review programs to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you are going to master the exam content? Our unique learning management system ensures that you will master the material. And features such as exam preparation tips, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of a computer-based exam, including multiple choice, simulation, and written communication questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you will have the confidence and knowledge to pass it. Guaranteed.
Hello, and welcome to the Bisk CPA Review course and our coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette. I'll be your instructor in this class, and in this class, we're going to be covering a very heavily tested area in the financial exam, and that is state and local governmental accounting, or fund accounting. Now, before we begin, I want to say a few words about the way to get the most out of this class. The most important thing is to treat this like any other class. Try to avoid just sitting back passively, watching the class. Be an active participant. Take good notes. Later in the class, when we do problems from past exams, it's important to shut the class down. You do the problems. Get your answers before you come back and we discuss the problems together. If you do those simple things, you'll find you get much more out of this class, and that's what we both want. So let's talk about state and local governmental accounting. First thing I want to say is that governments, whether we're talking state government, city government, township government, borough government, governments, no matter how big, no matter how small, governments exist to perform different services for a community. That's why governments exist, to perform different services for the community. And what a government's going to do is set up a different fund. They set up a different fund for all the different services they provide for the community. So maybe we should first ask this question. Exactly what is a fund? A fund is an accounting and fiscal entity. That's what it is. It's an accounting and fiscal entity that keeps track of the money coming in and the money going out as the government performs different services for the community. Now, let's get some language down. A governmental unit, like a town, a governmental unit, like a city, uses three types of funds. So you see how that works? A governmental unit, like a borough, a governmental unit, like a town, uses three types of funds. First, they use governmental funds. Second, they use proprietary funds. And third, they use fiduciary funds. So keep that in mind. A governmental unit, like a town, uses three types of funds. They use governmental funds, they use proprietary funds, and they use fiduciary funds. Now, you're going to find when you do your homework in this area, when you start doing questions from past exams in this area, that a lot of grading points, a lot of questions in the exam are really just testing whether or not you know the names of all the funds used by a government and what each one does. So that's actually where we're going to start. We're going to begin this class by going over the governmental funds. Let's talk about the governmental funds. The first governmental fund is called the general fund. The general fund accounts for the general day-to-day operations of the municipality. Let me say that again. The general fund accounts for the general day-to-day operations of a municipality. And I want to just give you a tip right at the beginning. As you're studying these funds, as much as you possibly can, let the name of the fund help you remember its purpose. I think you see what I have in mind. We call this the general fund because it accounts for general operations. I think you have to do that. Let the name of the fund be more than just a name. Let the name of the fund prompt you to remember its purpose. I think you'll find that helps a lot. So the general fund accounts for the general day-to-day operations of a municipality. The second governmental fund is called a special revenue fund. The government sets up a special revenue fund when the government collects revenue that's earmarked, it's restricted for some special public purpose. Notice the revenue is special. The revenue is special. It can only be spent on some special public purpose. That's why we need a special revenue fund. Let the name of the fund help you remember what it's doing. Let me give you an example, and an example helps here. Why would a government need a special revenue fund? Let's say a town gets a state grant that's dedicated to highway maintenance. Classic case. If a town gets a state grant that's dedicated for highway maintenance, that's going to be a special revenue fund because that revenue is special. That revenue can only be spent on that special public purpose and no other purpose. Now, there's another important point. It's important to remember that a special revenue fund is an expendable fund. It's an expendable fund. What does that mean? It means you can spend the interest, you can spend the dividends, you can spend every dime of the principal in this fund on that special public purpose. It's an expendable fund. Third governmental fund is called a capital projects fund. The government sets up a capital projects fund to account for the construction of. It accounts for the construction of major capital assets. So if a government's going to construct a new civic center, if a government's going to construct a library, a police station, the government's going to account for a project like that through a capital project fund because it accounts for the construction of major capital assets. Fourth governmental fund is called the permanent fund. Now, the government sets up a permanent fund when the government collects revenue that's earmarked. It's restricted for some special public purpose, but this fund is non-expendable. It's a non-expendable fund. What does that mean? You can never spend the original principal. The original principal can never be spent. It sits there permanently. That's why it's called the permanent fund. You know, let's say Bill Gates donates $1 billion to the city of Seattle for scholarships for needy students. And Bill Gates specifies, it's up to the donor, and Bill Gates specifies all Seattle can spend on scholarships are the interest and the dividends on the billion. The billion itself will sit there permanently. That would be a permanent fund. It's a non-expendable fund. You can never spend the original principal. Let me ask you this. What if Bill Gates said, no, you can spend the interest, you can spend the dividends, you could even spend the original billion on scholarships? What kind of fund would that be? You know, that's a special revenue fund. That's a special revenue fund because now you need an expendable fund. Now you can spend the interest, the dividends, and every dime of the principal on scholarships. I just want you to recognize that when you boil it down, the only difference between a special revenue fund and a permanent fund is simply that the special revenue fund is is an expendable fund. A permanent fund is a non-expendable fund. Other than that, they're really identical. Now, another point. Think about these four funds we just talked about: the general fund, the special revenue fund, the capital projects fund, the permanent fund. These four funds have something in common. None of these four funds are allowed to carry their own long-term debt. Remember this. These four funds, the general fund, the special revenue fund, the capital projects fund, the permanent fund, are forbidden to carry their own long-term debt. It's a rule. So let's think what happens here. If one of these funds actually issues some long-term debt, because it does happen. Let me give you an example. Let's say the capital projects fund issued bonds. And let's be honest, what's likely to come up in the exam is bonds. So let's say that the capital projects fund issued bonds to pay for the construction of a new civic center. Well, let's think what would happen. If capital projects fund issues bonds, you know they're going to debit cash, but do you see my point? They can't credit bonds payable. None of these four funds are allowed to carry their own long-term debt. They're forbidden to carry the long-term debt. So you can't credit bonds payable. So what do they credit? They credit an account that we're going to use a lot in this class: other financing sources. So they're not going to credit bonds payable. They're forbidden to carry long-term debt. But what they would credit is other financing sources. Now, what do you think here? Do you think the government carries the debt somewhere? Does it report the debt somewhere? Of course. The government actually reports the debt in the government-wide statement of net position, which we will talk about much later. But the government would actually report the debt in the government-wide statement of net position, and we'll get to that later. Now, another point. These four funds are not allowed to service their own long-term debt. So remember this. These four funds are forbidden to carry their own long-term debt, and these four funds are forbidden to service their own long-term debt. So my point is, you're never going to see an account like interest expense in any one of these four funds, because these four funds are not allowed to service their own long-term debt. These four funds are not allowed to carry their own long-term debt. So we need another governmental fund. The fifth and final governmental fund is called the Debt Service Fund. All the Debt Service Fund does is accumulate money to make interest payments and principal payments on long-term debt of the first four funds. That's all it does. I'll say it again. All the Debt Service Fund, all it does is accumulate money to make interest payments and principal payments on long-term debt of the first four funds. In other words, all the Debt Service Fund does is service debt. You've got to let the name of the fund help you remember its purpose. It's really important that you do that. So now we have the five governmental funds. There are only five governmental funds: general fund, special revenue fund, capital projects fund, permanent fund, and debt service fund. Those are the five governmental funds. We're going to talk about some things that all five governmental funds have in common. For example, all five governmental funds have what is called the same measurement focus. I want you to remember that the measurement focus in all five governmental funds is the flow of current financial resources. It's the flow of current financial resources. Remember we said earlier in the class that, what these funds do is keep track of the money coming in and the money going out as the governments perform different services for the community. Well, that's what we mean by their focus is the flow of current financial resources. Another way to look at this, if you want to visualize what a fund is, it's not a bad idea to think of each fund as a separate checking account. That works pretty well. It's as if the government has set up all these different separate checking accounts that keep track of the money coming in and the money going out as the government performs different services for the community. And what the exam would call that is their measurement focus, the flow of current financial resources. If I were to ask you, what is the measurement focus of your checkbook, your personal checkbook? I'm sure you've never thought about that before. But if I were to ask you, what is the measurement focus of your personal checkbook? You would agree it's the flow of current financial resources, keeping track of the money going out and the money going in as you live. Now, these five governmental funds have something else in common. All 5 governmental funds use modified accrual accounting. All 5 governmental funds use modified accrual, and that's what we're going to get into next. Modified accrual is the most important thing we're going to discuss in this class. It is the most heavily tested thing about state and local governmental accounting. You must understand modified accrual. Now, let me say that modified accrual is not the kind of thing you can cover in a couple of seconds. This is going to take us some time. And you have to start somewhere. So here's where I want to begin. When you boil it down, what's the major difference? What's the major difference in modified accrual on the revenue side? And what's the major difference in modified accrual on the expenditure side? So I want to begin to get us started. Let's start with revenue. Now, you know that if we were talking about a profit-making company under normal accrual accounting, which of course is what we're used to, recognizes revenue as it's earned, right? That's what we're all used to. That's just normal accrual accounting, recognizing profit as it's earned, recognizing revenue as it's earned. Well, when you get into these 5 governmental funds, just stop and think what kind of revenue they're going to be collecting. For the most part, tax revenue. So I think you see the problem. You can't say that a government should accrue tax revenue as it's earned, because they don't earn it. They just tax. They just take it. So here's the point. Under modified accrual, governments accrue tax revenue, not when it's earned, when it's available and measurable. That's the phrase. In modified accrual, governments accrue tax revenue, not when it's earned. They don't earn it. No, they accrue tax revenue when it's available and measurable. Now here's the point. What does available and measurable mean? That's what's tricky. What does it mean? Let's say a government levies taxes. Does that make them available and measurable? No. No, remember that. You don't look at the tax levy. No, here's what you have to do. You have to estimate what you're going to collect from a tax levy within the current fiscal year and up to 60 days into the next fiscal year. Why? Because what you estimate you're going to collect from a tax levy within the current fiscal year and up to 60 days into the next fiscal year, all that tax money is considered available to pay off current expenditures. That's what we mean by available and measurable. It's what you estimate you're going to collect from a tax levy within the current fiscal year and up to 60 days into the next fiscal year, because all of that tax money is considered available to pay off current expenditures. Now, there's more. In modified accrual, there are only 5 types of tax revenue that would ever be accrued. Again, in modified accrual, there's only 5 types of tax revenue that we would ever accrue. Number 1, property taxes. Number 2, real estate taxes. Number 3, income taxes. Number 4, sales taxes. Again, number 1, property taxes. Number 2, real estate taxes. Number 3, income taxes. Number 4, sales taxes. And number 5, tax payments due from other governmental bodies. Number 5 would be tax payments due from other governmental bodies. I'll just give you a quick example. Let's say a town was anticipating collecting some sort of state matching funds. Well, the town could accrue that because it falls in that 5th category. Tax payments due from other governmental bodies. But in modified accrual, those are the only 5 types of tax revenue that you would ever accrue. And let me make sure you're with me. When do you accrue those 5? That's right, when they're available and measurable. Now, all other tax revenue, parking meter money, hunting license fees, fishing license fees, fines, penalties, anything else you can think of is recorded on a cash basis. And you know what that means. Nothing is recorded until it's collected. So that's a big part of modified accrual. Only 5 types of tax revenue are ever accrued. All other revenue, parking meter money, hunting license fees, fishing license fees, fines, penalties, anything but the first 5 would be recorded on a cash basis. Simply meaning nothing would be recorded until it's collected. Now, that's the major difference in modified accrual on the revenue side. How about the expenditure side? Well, the major difference in modified accrual on the expenditure side is to remember this. None of the 5 governmental funds, general fund, special revenue fund, capital projects fund, permanent fund, debt service fund, none of those 5 governmental funds are allowed to carry their own fixed assets. Remember this. The 5 governmental funds are forbidden to carry their own fixed assets. So if one of the 5 governmental funds does go out and purchase a fixed asset, because it does happen, they can't debit machinery, they can't debit equipment, they can't debit building. What they do is debit expenditures control and credit vouchers payable. It's important to remember that if any of the 5 governmental funds buys a fixed asset, they treat the purchase of a fixed asset like an expenditure. It's expensed. And when you boil it down, that's the major difference in modified accrual on the expenditure side. I should ask you, do you think the government reports the fixed assets somewhere? Of course they do. The government would actually report the fixed assets in the government-wide statement of net position, which again, we'll talk about later. And you're starting to see why this does get a little bit complicated, because the government-wide statements, as you'll see, are done under normal accrual accounting, while these funds are using modified accrual. I'd like you to shut the class down and do the first 2 multiple choice questions in your viewer's guide. And you may notice that there are no answers to the questions in your viewer's guide, so don't look for them, because I don't want them in there. I want you to answer the questions. I know that if we put the answers in the viewer's guide, you'll go to look one up, notice the answer for the next 5. Don't lie to me. That's exactly what you do. And I don't think that you test yourself the same way. It's important that you get your answers, and then we go through the questions together. So please do the first 2 questions and then come back. Welcome back. Let's look at these questions together. Number 1, they say the following information pertains to property taxes levied by Oak City for the calendar year 1. Well, you're in the exam, you see it's property taxes, and the first thing you're thinking is, hey, in modified accrual, there are only 5 types of tax revenue that we would ever accrue. Property taxes, real estate taxes, income taxes, sales taxes, and tax payments due from other governmental bodies. So obviously property tax is one of the 5. It should be accrued. When do we accrue it? When it's available and measurable. Notice the levy was $700,000. And they ask at the bottom, what amount would Oak report for year 1 net property tax revenue? But the point is, it's not A. You don't look at the levy. No, you're supposed to estimate what you're going to collect from that levy within the current fiscal year. So you pick up the $500,000 and even the $100,000 of that levy that you estimate you're going to collect within the first 60 days of fiscal year 2. All of that money is considered available to pay off year 1 expenditures. That's what's available and measurable. And the answer is C. Number 2, which of the following fund types of a governmental unit has income measurement, income determination, as a measurement focus? General fund? No. Capital projects fund? No. The answer is C. Double no, because remember, the focus of all 5 governmental funds is the flow of current financial resources, not income measurement. That's the measurement focus in all 5 governmental funds. These are 2 governmental funds, general fund, capital projects fund. The measurement focus in all 5 governmental funds is not income determination. It is the flow of current financial resources. The only way to understand modified accrual is to do journal entries, because as you'll see when you do your homework in this area, modified accrual uses a whole different set of account names. You have to know what makes them increase, what makes them decrease. This is tested in the multiple choice. This is tested in simulations. So there's no way out of this. And make no mistake, right now we could do We could do a simulation on the general fund. We could do a simulation on the special revenue fund, the capital projects fund, the permanent fund, the debt service fund, because they all use modified accrual. But to get us started, I want to do a simulation on the general fund, where we have to go through the journal entries, the account names that are used in a general fund. And I should say before we start this, that the actual accounting in modified accrual is very basic. That's not going to bother you. It really isn't. It's very basic accounting. But what does get a little bit tricky is you are going to have to learn a whole new set of account names. And if you look in your viewer's guide, you'll see we've set up T accounts. The simulation that we're going to look at is Pine City. So if you go in your viewer's guide, you'll see the simulation for Pine City, the Pine City General Fund. And as I say, in your viewer's guide, you'll see that we've set up T accounts. And there are 20 of them. And it is very handy, I think, to have these T accounts, because it kind of gives you right away a list of all the account names you're going to have to be comfortable with anyway. So they're just a handy place to have them. These are all the account names that are used in modified accrual, and you have to be comfortable with them anyway. But as we go through the simulation, we're going to do the journal entries under modified accrual, but I want you to post these entries to the T accounts as we go through. I only make you do this once, but I think it's important to do this one time, where as we go through journal entries, you take the time, post the entries to the T accounts, because I think you'll learn modified accrual much better if you do it that way. So let's look at the simulation on Pine City, the Pine City's general fund. It says Pine City's first year budget. Now, so Pine City just came into existence, and that helps because that means there's a zero in all these accounts. There's a zero balance in all these accounts because Pine City just came into existence. This is its first year. Pine City's first year budget is given in point number 1. Then in items 2 through 13, we're given the activity for the first fiscal year. And notice there's 2 requirements. Requirement A, prepare the appropriate journal entries for the general fund. And there's also B, prepare the closing entries for the general fund. All right, so let's start the entries. If you go back to item number 1, we're given the budget. And you have to be aware that one of the major differences in modified accrual is that under modified accrual, not only does the government have a budget, they actually make a journal entry to record the budget. They actually make a journal entry to book the budget. I mean, you know that, profit-making companies have a budget, but there's no journal entry for the budget. But in modified accrual, not only do they have a budget, they actually make a journal entry to record the budget. So let's get the entry down. They say they're estimating that during the tax year, they're going to collect $110,000 of tax revenue. So let's start our budget. We're going to debit. It's going to be a debit to estimated, notice the word estimated, revenues control, $110,000. So notice the budgeted revenues are a debit to estimated revenues control of $110,000. And then they say they have legislative authority to spend up to $97,000 of that. And you have to be aware that legislative authority to spend money, that's the definition of an appropriation. So we're going to credit appropriations control, $97,000. So remember, legislative authority to make contracts, incur obligations, basically legislative authority to spend money. That's the definition of an appropriation. So we're going to credit appropriations control, $97,000. Now, once you've done that, now there are these estimated transfers. Notice there's an estimated permanent transfer from the capital projects fund of $7,000. There's going to be, and you might want to circle the word from, estimated permanent transfer from the capital projects fund of $7,000. There's also going to be an estimated permanent transfer to, circle that word to the debt service fund of $2,000. I want to talk about permanent transfers for a minute. What we're up against here is a rule that you have to be aware of. You have to know this rule, a permanent transfer of money from one fund to another. That word permanent is important. A permanent transfer of money, not a temporary transfer, which we'll talk about later on, but a permanent transfer of money from one fund to another for operating purposes is always called other financing sources or other financing uses. Let me say that again. A permanent transfer of money from one fund to another for operating purposes is always called other financing sources or other financing uses. And keep in mind, the fund that receives the money, it's a source. The fund that sends the money, it's a use. Remember that. The fund that receives the money, it's a source. The fund that sends the money, it's a use. And I bring this up because when you're setting up your budget, if you're estimating that during the fiscal year there are going to be permanent transfers have to be budgeted for, not temporary transfers. Let me say that again. Permanent transfers have to be budgeted for, not temporary transfers, which we'll talk about later. All right, so when you see in this budget listing that they're estimating during the fiscal year there's going to be a permanent transfer from the Capital Projects Fund of $7,000. Well, if it's going to come from the Capital Projects Fund to the general fund, that means the general fund is going to receive the money. To the general fund, it's going to be a source. So in the budget, they're going to debit estimated other financing sources, $7,000. Again, that's a debit to estimated other financing sources, $7,000. Now, they also are estimating that during the fiscal year, there's going to be a permanent transfer to the debt service fund. Well, now the general fund is sending the money. So to the general fund, that's going to be a use. So in the budget, we're going to credit appropriations dash estimated other financing uses, $2,000. Again, credit appropriations dash estimated other financing uses, $2,000. Just remember, permanent transfers have to be budgeted for, not temporary transfers. Now, if you add it all up, the entry doesn't balance. This next number is a plug. I simply need a credit of $18,000 to balance the entry out. We're going to credit budgetary fund balance. So credit budgetary fund balance, $18,000. That's the entry to record the budget. And you'll see when you do your homework, lots of questions in the exam about the entry to record the budget. You've got to know that entry like the back of your hand. And we'll certainly be looking at that entry again. It's not the only time you're going to see it in this class, but it's a very heavily tested entry in governmental accounting, and I think you know why. Because there's nothing like this in profit-making accounting. I think when you really boil it down, a lot of what the exam focuses on is what's different between what a profit-making company does and what a government does under modified accrual. As I said before, profit-making companies have a budget, of course they do, but they don't make an entry to record the budget. This is unique to modified accrual, that there's an actual journal entry to book the budget. So the exam asks a lot of questions about it. Make sure you know that entry. All right, now that we've booked the budget, now let's get into the actual activity. Number 2. Now Pine City levies real estate taxes of $108,000, and they estimate $8,000 will be uncollectible. Well, once again, we know that in modified accrual, there are only 5 types of tax revenue that you would ever accrue: property taxes, real estate taxes, income taxes, sales taxes, and tax payments due from other governmental bodies. So because this is real estate taxes, we are going to accrue it. It's one of the 5. Now, remember, we got into, well, what does available and measurable mean? We're going to accrue it when it's available and measurable. We have to estimate what you're going to collect from this levy within the current fiscal year or up to 60 days into the next fiscal year. Notice in this simulation, they didn't give us all that detail. But since they told us what they estimate is uncollectible, we have to assume the rest will be collected within the current fiscal year or up to 60 days into the next fiscal year. But here's the entry. We're going to debit taxes receivable current. The important point is we're going to accrue it. It's real estate taxes. So we're going to debit taxes receivable current for the full levy, $108,000. We're going to credit estimated uncollectible taxes, $8,000. That's like your allowance for bad debts in a profit-making company. As I said earlier, the accounting is actually pretty basic. So we're going to credit estimated uncollectible taxes, $8,000. And notice we're going to credit revenues control, $100,000. So be aware of that. Actual revenue is a credit to revenues control. In this case, $100,000. Item 3. Now people start to pay their real estate taxes. And the city collects $106,000 in real estate taxes. So I think you know what they're going to do. They're going to debit cash for the $106,000, and they're going to credit the receivable. Credit taxes receivable current for the $106,000. Now, if you stop and look at it, you see the problem. Turns out they've collected more in real estate taxes than they estimated they were going to. So we're going to have to make an adjusting entry. Just a little wrinkle here. Turns out they collected more in real estate taxes than they estimated they were going to. So it's going to require an adjusting entry. So what do we do here? Well, notice originally we thought that $8,000 of the real estate taxes would be uncollectible. Now apparently how much is uncollectible? Just $2,000. So that account is overstated. So we're going to debit. We're going to debit estimated uncollectible taxes, $6,000. And what do we credit? Revenues control, $6,000, because they didn't recognize enough actual revenue either. So credit revenues control, $6,000. That takes care of that. Item number 4, the city collects $11,000 in parking meter receipts. Well, here again, we're back to the basic rule that in modified accrual, there are only 5 types of tax revenue that would ever be accrued: property taxes, real estate taxes, income taxes, sales taxes, and tax payments due from other governmental bodies. All other tax revenue, like parking meter money, is recorded on a cash basis. Nothing is recorded until it's collected, and here it's collected. So they're going to debit cash for the $11,000. And they're going to credit, revenues control for $11,000, because actual revenue is a credit to revenues control. All right, now if you're with me on the first 4 items, they've all dealt with revenue, and now we get into item 5. Now Pine City has approved purchase orders for goods and services estimated to cost $84,000. And included in that order is an order for a Xerox machine estimated to cost $6,000. Now, this is an important point we've hit, and I want you to think about something. If a profit-making company sent out purchase orders, is there a journal entry at that point? I think you know the answer is no. No, profit-making companies, if they send out purchase orders, do not make a journal entry. Profit-making companies don't make any journal entry until when? Until the goods and services are delivered, until the company is billed, right? That's what we're all used to. Profit-making company sends out a purchase order, there's no entry. Profit-making companies make no entry until the goods are delivered, until we're billed, until we're extended credit. And my point is, that's what we're used to. That's normal accrual accounting. Now listen carefully. This is very important. In modified accrual, just the act of sending out a purchase order requires an entry, because governments use an encumbrance system. And that's what we're starting to get into here. And let me just say what I'm sure you're thinking. The exam loves the encumbrance system because it's different. It's unique to modified accrual. So in modified accrual, just the act of sending out a purchase order requires an entry because governments use an encumbrance system. So let's do it. When those purchase orders go out, in the general fund, they're going to debit encumbrances control for the $84,000. Debit encumbrances control, $84,000, and credit budgetary fund balance reserved for encumbrances, $84,000. Notice the general fund would book an entry, debit encumbrances control for the $84,000, and credit budgetary fund balance reserved for encumbrances for the $84,000. Now, a couple things to keep in mind. Always remember that an encumbrance is just an estimate of what we think goods and services are going to cost, right? An encumbrance is just an estimate of what we think goods and services are going to cost. We won't know the actual amount until we're billed. But the important thing is, governments use an encumbrance system. Maybe I should ask you this. What is an encumbrance? What is it? It's a potential obligation, right? That's really what an encumbrance is. It's a potential obligation. It's not an actual obligation until the goods and services are delivered, until we're billed, until we're extended credit. But this is a major difference in modified accrual. In modified accrual, not only do we keep track of actual obligations, we keep track of potential obligations. And that's what an encumbrance represents. And again, an encumbrance is just an estimate of what we think goods and services are going to cost. We don't know the actual amount until we're billed. Item 6. Now the goods and services start to come in, and the city is billed. Now there's a billing, $75,000 for goods and services that they estimated would cost $73,000. In other words, this is 73 of the 84. And notice the note there, this does not include the Xerox machine. That hasn't come in yet. All right, we've hit another important point. Remember this. The way the encumbrance system works, when the city is billed, they always start by reversing. You've got to reverse the original encumbrance for the original estimated amount. Again, the way the encumbrance system works, when a city is billed, they always start by reversing the original encumbrance for the original estimated amount. So they said this bill for $75,000 was for goods and services that they estimated would cost $73,000. So we're going to start here by debiting budgetary fund balance reserved for encumbrances. And we're going to credit encumbrances control. Not for $75,000, not for $75,000, $73,000. What we estimated those goods and services were going to cost. You always reverse the original encumbrance for the original estimated amount. So we're going to debit budgetary fund balance reserved for encumbrances. And we're going to credit encumbrances control for the original estimated amount, and that's $73,000. Now that we've done that, we book the expenditure and the liability vouchers payable at whatever we're billed, more or less. Here it was more. So we're going to debit expenditures control and credit vouchers payable, $75,000. Then item 7 says the invoices for $75,000 were approved for payment. So, of course, we're going to debit vouchers payable, $75,000, credit cash, $75,000. That is a very important sequence of entries. Don't go in that exam and not be comfortable with the encumbrance system. You can see from those entries, it's not difficult, but you've got to know it, because the exam loves the encumbrance system for the reason we talked about before. There's nothing like this in profit-making accounting. And a lot of questions in the exam focus in on what's different between what a profit-making company would do and what a government would do under modified accrual. And encumbrance accounting is unique to modified accrual. Item 8. Now the Xerox machine comes in with a bill for $6,500. What are you going to do? That's right, reverse, right? You always reverse the original encumbrance for the original estimated amount. So we're going to start off by debiting budgetary fund balance reserved for encumbrances. And we're going to credit encumbrances control, not for $6,500, $6,000. The original estimated amount. We always reverse the original encumbrance for the original estimated amount. Then we're going to record the Xerox machine at its actual amount. But you know what I'm going to say now. You can't debit equipment for the $6,500. The general fund is forbidden to carry fixed assets. None of the 5 governmental funds are allowed to carry fixed assets. So the general fund now is going to debit expenditures control, $6,500. Remember, they treat the purchase of a fixed asset like an expense. So they're going to debit expenditures control for what they're actually billed, $6,500, and credit vouchers payable for the $6,500. So we reverse the original encumbrance for the original estimated amount, and then we book the expenditure and the liability vouchers payable at what were actually billed. And for some reason, they don't seem to be paying that invoice. Maybe it's in dispute. We don't know. It hasn't been paid yet. But don't just assume it'll be paid. Could be in dispute. And there's nothing to indicate here that the invoice has been paid. By the way, where would the government actually report this Xerox machine? Because the general fund is forbidden to carry the fixed assets. Where would they report it? You know, in the government-wide statement of net position. Remember, the government-wide statements are done under normal accrual accounting. And we will talk about that more later in this class. But that's where you'd actually find the Xerox machine. It would be reported with all the other fixed assets in the government-wide statement of net position. Item 9. At year end, they do a physical count, and they have a supplies inventory of $1,000. And Pine City uses the purchase method to account for supplies. Now, what do they mean by the purchase method? It's actually very simple. If you're using the purchase method, that means that as you go through the fiscal year, every time you purchase supplies, you just debit expenditures control, credit vouchers payable. Debit expenditures control, credit vouchers payable. That's your routine entry. In other words, all year you expense it. That's what the purchase method means. Every time you purchase supplies, debit expenditures control, credit vouchers payable. Debit expenditures control, credit vouchers payable. Then at year end, you take a fiscal account, you've got $1,000 of supplies on hand, now you'll book an entry. You'll debit inventory of supplies for $1,000, and you'll credit the non-spendable fund balance, $1,000. That's the entry. Year end, you've got $1,000 of supplies on hand, you'll debit inventory of supplies and credit the non-spendable fund balance. And we're starting to get into the different designations of fund balance, which you're going to have to know. This is called the non-spendable fund balance because this represents the part of fund balance that's already been spent, in this case on supplies. So the non-spendable fund balance represents the part of fund balance that's already been spent, in this case on supplies. Now, I don't want to dwell on this, but the other possibility from the purchase method might be the consumption method. I think you see the consumption method with supplies in profit-making company quite often. What's the consumption method? You probably know. In the consumption method, say in profit-making accounting, if you use the consumption method for supplies, it means as you go through the fiscal year, every time you purchase supplies, you debit supplies, credit accounts payable. Debit supplies, credit accounts payable. And then at year end, you take a fiscal account and expense what you consumed. You see that most often in profit-making accounting, the consumption method. But here, in modified accrual, they're using the purchase method. Now, in 10, 11, and 12, we're getting back to transfers of money from one fund to another. In item 10, notice there's a temporary, look at that word, there's a temporary transfer of $3,000 to the special revenue fund. So the general fund is making a temporary transfer of $3,000 to the special revenue fund. And I'm sure you know this. What does temporary mean? You know, it means eventually the special revenue fund has to pay it back. So here we go. Because this is a temporary transfer of money from one fund to another, in the general fund, they're going to debit a receivable. They're going to get it back. Eventually, it's temporary. So in the general fund, they're going to debit a receivable called due from special revenue fund, $3,000. They're going to debit due from special revenue fund, $3,000, credit cash, $3,000. And then just to show you the other side, what would special revenue do? Well, special revenue fund is sending the money, so they're going to debit a receivable. They're receiving the money, so they're going to debit cash $3,000 and credit due from, and credit due to the general fund because they have to pay it back. So let me do that again. This is how you handle a temporary transfer of money from one fund to another. The fund that sends the money, in this case the general fund, is going to debit a receivable called due from special revenue fund, $3,000, credit cash $3,000. Then on the other side, the special revenue fund would debit cash, they get the money, and credit a liability called due to general fund. So it's really very simple. That's how you handle a temporary transfer of money from one fund to another. Item 11. Now the general fund receives a permanent transfer of $7,000 from the capital projects fund. So you see what's happening. The general fund is receiving a permanent transfer of $7,000 from the capital projects fund. So you know that the general fund is going to debit cash $7,000, and you know what they're going to credit, other financing sources, $7,000, because it's a rule. A permanent transfer of money from one fund to another for operating purposes is always called other financing sources or other financing uses. And as we said before, the fund that receives the money, it's a source. The fund that sends the money, it's a use. In this case, the general fund received the money. The money came from the capital projects fund. So the general fund is going to debit cash, $7,000, and credit other financing sources. What would it look like on the other side? You know, capital projects is sending the money, so it's a use. They would debit other financing uses control, $7,000, and credit cash $7,000. That's what it looks like on both sides. But we're really just concerned here with the general fund. So it would be a debit to cash and a credit to other financing sources. $7,000. Item 12. Now the general fund sends a permanent transfer of $2,000 to the debt service fund. So now the general fund is sending the money. The general fund is sending a permanent transfer of $2,000 to the debt service fund. So because the general fund is sending the money, the general fund is going to debit other financing uses. It's a use for the general fund. Debit other financing uses. And sometimes you'll see that called operating transfers out. You might see that account name, operating transfers out. Operating transfers out is the same thing as other financing uses. Eventually it would be closed into other financing uses. It would show up in the financial statements as other financing uses. But you might see that account name, operating transfers out. So the general fund is going to debit other financing uses or operating transfers out, $2,000, credit cash, $2,000. And of course, on the other side, the debt service fund would debit cash, $2,000, and credit other financing sources. They're the fund that received the money, so it's a source. So credit other financing sources, or what? Operating transfers in. Operating transfers in, same thing as other financing sources. It would show up in the financial statements as other financing sources. But you might see those account names. All right, so we have now done all the journal entries under modified accrual, and that takes care of requirement A. They said prepare the appropriate journal entries for the general fund. We've done that. But there's also B. Prepare the closing entries for the general fund. Now, we're going to go through the closing entries, and I don't want you to think it's busy work. You'll see in your homework a lot of multiple choice are about the closing entries. This is why I make us do a problem right to the bitter end, right through closing entries. Now, if you've been doing as I asked and you've been posting the entries that we've done to the T accounts, I want you to shut the class down and get the balance in all the T accounts before we do the closing entries. Shut the class down, take a few minutes, get the balance in all the T accounts, and then we'll go through the closing entries together. Welcome back. Hopefully now you have the balance in all the T accounts, and now we're going to get into the closing entries. And I want to give you just a little bit of a game plan here that I think will help you. Try to remember that in modified accrual, you're always looking to close out three things. Number one, you have to close the budget. Number two, you have to close actual activity. And number three, you have to close the encumbrances. I think it's good to remember that because it gets you organized. Hey, it's modified accrual. I've got to close out three things. I've got to close the budget. I've got to close the actual activity. I've got to close the encumbrances. I've got to close the budget. I've got to close the actual activity. I've got to close the encumbrances. That's the game plan. Let's close the budget. Now, you'll see that when you close the budget, all you have to do is reverse the entry that you made when you set it up. So now you debit the budgetary fund balance for $18,000, and that should zero that account out. Now you debit appropriations - estimated other financing uses for the $2,000, should zero that out. You debit appropriations control for the $97,000, would zero that out. Credit estimated other financing sources, $7,000 to zero that out, and credit estimated revenues control for the $110,000 to zero that out. And I promise you that's all that entry is ever going to be. It's just a matter of reversing the entry that you made when you set it up, but it's got to be done. You've got to close the budget. Now, I know that it may seem like a bit of a waste of time. You say, well, Bob, we open the budget and then we close it. Why do we do that? Well, theoretically, the reason why they book the budget is supposedly, theoretically, it's there as a control. So I'll just give you an example. You book the budget, right? And then as you go through the fiscal year, that your expenditures plus your encumbrances should never exceed your what? Can you fill in that blank? You got the budget recorded, right? And then as you go through the fiscal year, that your expenditures plus your encumbrances should never exceed your what? Appropriation, your legislative authority to spend money. So that's theoretically why it's there. So now as you go through the fiscal year, that your expenditures plus your encumbrances should never exceed your appropriation, your legislative authority to spend. But it's got to be closed. So the first thing you do is close out the budget. Now, the second thing you close out is the actual activity. Now, what do I mean by the actual activity? You've got to close out the actual revenues, the actual expenditures, the actual sources, and the actual uses. You've got to close out all the actual activity, actual revenues, actual expenditures, actual sources, and actual uses. So let's do it. We're going to debit revenues control for the $117,000. That's the balance in revenues control. Remember, actual revenue was a credit to revenues control. And now we're going to debit revenues control for the $117,000. Should zero that out. We're going to debit other financing sources control for the $7,000. To zero that out, we're going to credit other financing uses control for the $2,000. And we're going to credit expenditures control for the $81,500. Let me do that again. Debit revenues control for $117,000. Zeros it out. We're going to credit expenditures control for the $81,500. Zero it out. We're going to debit other financing sources control for the $7,000 and credit other financing uses control for the $2,000. See, that's what I mean by close out actual. You've got to close out actual revenues, actual expenditures, actual sources, and actual uses. You have to close out all the actual activity. Now, you'll notice the entry doesn't balance. This next number is a plug. Really no other way to get it. We simply need a credit of $40,500. It's a plug. Plug it in there. We need a credit of $40,500 to balance the entry out. We're going to credit the unassigned fund balance. Notice, to balance the entry out, we credit the unassigned fund balance. You have to know all these fund balance designations, and we're going to credit the unassigned fund balance for $40,500. The unassigned fund balance, that's the part of fund balance that's spendable. It's unrestricted. It's uncommitted. Again, when you see the unassigned fund balance, that's the part of fund balance that's spendable. It's spendable. It's unrestricted. It's uncommitted. It's called the unassigned fund balance. Now listen carefully. In any other fund, other than the general fund, in any other fund, that would be called the assigned fund balance, because that fund balance would be assigned to the purpose of the special revenue fund. That fund balance would be assigned to the purpose of the capital projects fund. That fund balance would be assigned to the purpose of the permanent fund. That fund balance would be assigned to the purpose of the debt service fund. In any other fund, that would be called the assigned fund balance, listen, unless it was in deficit. If it's in deficit, it's always unassigned. Let me do that again. This fund balance for the general fund is called the unassigned fund balance. It's the part of fund balance that's still spendable. It's uncommitted. It's unrestricted. It's called unassigned fund balance. But in any other fund, it would be called the assigned fund balance, because that fund balance would be assigned to the purpose of that fund. So it would be assigned to the purpose of the special revenue fund, or assigned to the purpose of the capital projects fund, or assigned to the purpose of the permanent fund, or assigned to the purpose of the debt service fund. In any other fund, it would be called the assigned fund balance, unless it's in deficit. Anytime it's in deficit, I don't care what fund it is, it's always called unassigned. But in the general fund, this would be called the unassigned fund balance. And as I say, it's a plug. Now, the third thing we close out are the encumbrances. Now, if you look at your T accounts on encumbrances, right now there's still a $5,000 debit balance in encumbrances control, and there's a $5,000 credit balance in budgetary fund balance reserve for encumbrances. Now, before we get into how we close this, why is there a balance in those accounts? I think you know why. When there's a balance in those accounts, it doesn't tell you that there's still $5,000 of purchase orders out in the world somewhere, but the goods and services haven't come in yet, right? That's what it tells you. You see a balance in those accounts, and by the way, they should always agree. Notice it's $5,000 in both. And anytime there's a balance in those accounts, it's telling you that there's like $5,000 of purchase orders floating around in the world somewhere, but the goods and services still haven't come in yet. In other words, they still have some potential obligations. In modified accrual, not only do we keep track of actual obligations, we keep track of potential obligations, don't we? So here's how you close out the encumbrances. It takes two entries. First, we debit the budgetary fund balance reserved for encumbrances, and we credit encumbrances control, $5,000. That zeroes those accounts out. That's our first entry. We debit budgetary fund balance reserved for encumbrances, and we credit encumbrances control, $5,000. Those accounts are zeroed out. But I still have a problem. There's still $5,000 of purchase orders floating around somewhere. We still have potential obligations. So here's what we do. We make a second entry. In our last entry, when we closed out the actual activity, didn't we establish that this general fund has an unassigned fund balance of $40,500? Well, it turns out not all their fund balance is unassigned. They've got purchase orders outstanding. So now we debit the unassigned fund balance for $5,000, and we credit the committed fund balance, $5,000. Again, my second entry. We're going to debit the unassigned fund balance, $5,000, and we're going to credit the committed fund balance, $5,000. The committed fund balance is the part of fund balance that's already committed. It's the fund balance that's reserved for contractual commitments. The part of fund balance that's reserved by decision making. I'll say it again. The committed fund balance represents that part of fund balance that's already committed. It's already committed because of contractual obligations or decision making. So it's the part of fund balance that's contractually committed. Think of it that way. It's called the committed fund balance. All right, now we have made all the closing entries, and if you look at the T accounts, all that's left are balance sheet accounts. And if you look in your viewer's guide, you'll see the balance sheet for the Pine City General Fund. And as I say, that's all that's left in the T accounts, or balance sheet accounts. And if we were to do the balance sheet for the general fund, it's in the viewer's guide. Take a look at it. Under assets, there's cash of $44,000. There's taxes receivable current of $2,000, but they also have estimated uncollectible taxes of $2,000, so the net receivables are zero. They have $1,000 in supplies inventory, and notice that due from special revenue fund. Remember, that was a temporary transfer. It's eventually going to come back to the general fund, so that's going to show up on the general fund balance sheet as due from special revenue fund, a receivable of $3,000. So the total assets add up to $48,000. Then there's liabilities and fund balance. There's only one liability, that vouchers payable. For some reason, that $6,500, we have not paid for that Xerox machine yet. As I said, maybe that invoice is in dispute. But notice how we present the fund balance. They have an unassigned fund balance of $35,500. They have a fund balance that's committed, that's contractual commitments, of $5,000, and a non-spendable fund balance of $1,000. Hey, that's the part of fund balance that's already been spent on supplies. If you look at the next page, notice Pine City's general fund statement of revenues, expenditures, and changes in fund balance. So if we were to do the statement of revenues, expenditures, and changes in fund balance for the general fund, under revenues, you've got real estate taxes of $106,000, miscellaneous revenues, that was the parking meter money, of $11,000. So the total revenue is $117,000. Total expenditures, $81,500. That gave you an excess of revenue over expenditures of $35,500. Then there was other financing sources of $7,000, other financing uses of $2,000. That gave us an excess of revenue and sources over expenditures and uses of $40,500. But don't forget, we've got that committed fund balance, contractual commitments of $5,000. So the increase in the unassigned fund balance, $35,500, then you would simply show the unassigned fund balance back on January 1. In this case, it was zero because the city just came into existence, and that gives you the unassigned fund balance at December 31, which is $35,500. Those are fund financial statements. Now, we do these fund financial statements, and they're supposed to help with three things. These fund financial statements are supposed to help us make political decisions. They're supposed to help us establish social policy. Again, these fund financial statements are supposed to help us make political decisions. They're supposed to help us establish social policy, and these fund financial statements are supposed to help us evaluate generational equity. These fund financial statements are supposed to help us evaluate generational equity, and you might see that term in the exam, generational equity, so I want to talk about it. What do I mean by generational equity? Now, when you see that phrase in the exam, generational equity, in this context, the word equity means equitable, means fairness. Think of it as generational fairness. And what it basically means is we're not supposed to charge future generations for the cost of services we're receiving today. Again, think of it as generational fairness, simply meaning we're not supposed to charge future generations for the cost of services we're receiving today. That would be generational inequity. That would be generational unfairness. And if you go back to the general fund balance sheet, take a look at it. Is there generational fairness? There is, because notice the unassigned fund balance is in surplus by 35.5. That's really what you're looking for, deficits. You may not have ever heard that before, but what a deficit really represents is charging future generations for the cost of services we're getting today. That's what a deficit really represents. But here, for the first time in the history of the world, we have an unassigned fund balance that's in surplus. So in this financial statement, there is generational fairness. There is generational equity, but you have to be aware of that term, and these fund financial statements are supposed to help us evaluate generational fairness, generational equity. Now, I want to go back to all these fund balance designations because they're important in the exam that you know all of them. And so far we've covered 5, right? There's the budgetary fund balance. That's, what the budgetary fund balance represents is the impact your budget's going to have on fund balance, right? That's called budgetary fund balance. The impact your budget, you're projecting your budget, will have on your fund balance. Then we looked at the non-spendable fund balance. What's that? The non-spendable fund balance is the part of fund balance that's already been spent, in our example, on supplies. It's already spent, called the non-spendable fund balance. Then we looked at the committed fund balance. The committed fund balance is the part of fund balance that's for contractual commitments. And then we looked at the unassigned fund balance, right? The part of fund balance that's spendable, part of fund balance that's uncommitted, the part of fund balance that's available. It's called the unassigned fund balance in the general fund. In any other fund, what's it called? The assigned fund balance, because that fund balance would be assigned to the purpose of the special revenue fund. That fund balance would be assigned to the purpose of the capital projects fund, and so forth. Any other fund, it's called the assigned fund balance, unless it's in deficit, and it's always called unassigned. But there is one more. I bring this up because there is one more fund balance you might see referenced in the exam. It's called the restricted fund balance. The restricted fund balance is the part of fund balance that's restricted by law. The part of fund balance that's restricted by law, by the Constitution, by enabling legislation. That's what the restricted fund balance represents. Part of fund balance that's restricted by law. Could be by the Constitution, by enabling legislation. That's called the restricted fund balance, and you may see that mentioned as well. Now you know all the fund balance designations in governmental accounting. I'd like you to try some questions. We've been through a lot. I'd like you to try questions 3 to 14. Please do number 3 to number 14. Get all your answers, and then come back. Welcome back. Let's look at these questions together. In number 3, they ask, which event is supportive of interperiod equity? They're talking about generational equity, equity between periods, fairness between periods. We don't want to charge future generations for the cost of services we're getting today. So it would be supportive of generational equity, interperiod equity. How about number 1? How about a balanced budget is adopted? Yes, that's supportive of interperiod equity because we're not running up deficits. We're not trying to charge future generations for the cost of services we're receiving today. And then number 2, residual equity transfers out equals residual equity transfers in. The whole idea that transfers between funds, that transfers out will equal transfers in, has nothing to do with generational equity, interperiod equity. Transfers out should always equal transfers in. That doesn't have any effect on it. So the answer is A. Only the first statement, a balanced budget, is supportive of interperiod equity. Number 4, Park City uses encumbrance accounting. Formally integrates the budget into the general fund accounting records. Here's the budget information. When Park's budget is adopted, they want to know what would be the budgetary fund balance. Well, let's just put the entry down together. You're going to debit estimated revenues control for the $30 million. You're going to credit appropriations control for the $27 million. And then there's a transfer. There's an estimated transfer to the debt service fund of $900,000. It has to be permanent. I'll tell you why. I know that might bother you, but they're not going to necessarily say the word permanent. You have to assume that's permanent for a couple of reasons. First of all, the money's going to the debt service fund. It's going to be used to service debt. It's never going to come back. It is permanent. The debt service fund's like a black hole. Once money goes into the debt service fund, you're never going to see it again. But not only that, if this makes you feel better, if it's temporary, they have to say it. If it's a temporary transfer, they will say the word temporary. But it's a permanent transfer. And of course, permanent transfers have to be budgeted for. Now, they said this is a estimated transfer to the debt service fund. So the general fund is going to send the money. So to the general fund, it's a use. So in the budget, we're going to credit appropriations dash estimated other financing uses for the $900,000. And now we plug our credit to budgetary fund balance of answer C, $2,000,001. You've got to know that entry to record the budget. Number 5, the estimated revenues control account of a governmental unit would be debited when? Answer C, when the budget is recorded. When we record the budget, we debit estimated revenues control. Now, in number 6, remember I mentioned that the exam loves 2 things. They love the entry to record the budget, and they love closing entries. And this multiple choice is about both. It's about the entry to book the budget, and it's also about closing entries. They're basically asking in number 6, how would recording the budget and closing entries affect one account name, the budgetary fund balance? But you had to be careful, because notice in the first sentence it says the budget of a governmental unit for which appropriations exceed estimated revenues. In other words, if you just make up some numbers, when this governmental unit adopted their budget, they debited estimated revenues control for, say, $200,000 and credit appropriations control for $250,000. Just making up numbers. But the point is, they have legislative authority to spend more than they're going to collect. Great idea, right? That's why we're in such a mess. Oh, yeah, that's politicians. Oh, we have legislative authority to spend much more than we have, so we'll just borrow the rest, right? That's how you get into trouble. But that's what they're talking about there. They would have debited estimated revenues control, say, for $200,000, but credit appropriations control for $250,000. So in other words, they would debit in their budget, debit budgetary fund balance for the $50,000. In other words, budgetary fund balance was in deficit when they recorded the budget. Then at year end, when you close out the budget, you reverse the entry. So you would credit budgetary fund balance for the $50,000, debit appropriations control $250,000, credit estimated revenues for the $200,000. You'd reverse everything. So in this question, what's the effect on the budgetary fund balance? It's answer C. It would be debited at the beginning of the year because it's in deficit and credited at the end of the year when you close it out. Kind of the opposite of what you'd normally think. But you have legislative authority to spend more than you're going to collect. Number 7, in the current year, New City issued purchase orders and contracts of $850,000 that were chargeable against current year budgeted appropriations of $1 million. So at least they haven't exceeded their legislative authority to spend. The journal entry to record the issuance of the purchase orders and contracts would include what? Well, just the act of sending out a purchase order requires an entry. So in modified accrual, you would debit encumbrances of control for the $850,000 and answer B, credit budgetary fund balance reserve for encumbrances for the $850,000. The answer is B. Number 8, the encumbrances account of a governmental unit is debited when? When do we debit encumbrances control? Answer B, when a purchase order is approved. Just the act of sending out a purchase order requires an entry because we use an encumbrance system. Number 9, which of the following amounts are included in the general fund's encumbrance account? This is really the CPA exam kind of looking you in the eye saying, what's an encumbrance? Well, before we answer, what is an encumbrance? It's a potential obligation. That's what an encumbrance is. So what am I going to find in the encumbrance account? How about number 1? Am I going to find outstanding Vouchers payable amounts? No, that's an actual obligation. An encumbrance is a potential obligation. Am I going to find number 2? Outstanding purchase orders? Of course I will. Those are potential obligations. How about number 3? How about the excess of the amount of a purchase order over the actual expenditure on the order? Well, no, if the actual expenditure has been booked, then the original encumbrance has been reversed. It's gone. All I'm going to find in the encumbrance account in that list is answer C. Just number 2, outstanding purchase orders. Number 10, the encumbrance system. Again, the exam loves the encumbrance system because there's nothing like it in profit-making accounting. Elm City issued a purchase order for supplies with an estimated cost of $5,000. So just if you're getting used to it mentally, what was the entry? Didn't they debit encumbrances control? $5,000. Credit budgetary fund balance, reserve for encumbrances, $5,000. You get good enough at this, you can just kind of do it mentally. When the supplies were received, the accompanying invoice indicated an actual price of $49.50. So what did they do? You always reverse the original encumbrance for the original estimated amount. So now you would debit budgetary fund balance, reserve for encumbrances for $5,000. The answer is D. Credit encumbrances control $5,000, and then book the expenditure and the liability vouchers payable at what they're actually billed, $49.50. But the answer there is D, because you'd have to debit budgetary fund balance, reserve for encumbrances, $5,000, and credit encumbrances control $5,000 when the bill comes in. Number 11, we're back again to closing entries. Now, remember I said that I think what helps you is to remember that in modified accrual, we're always looking to close out 3 things. We've got to close the budget. We've got to close the actual activity. And we have to close the encumbrances. In this multiple choice, are they asking us to close the budget? No. The only budget account we know is appropriations, right? It's the only budget account I have is appropriations. In other words, I don't know estimated revenues. I don't know budgetary fund balance, so I can't close the budget. Are we being asked to close encumbrances? I don't know the encumbrances. No, what they're asking you to do here is think about how you close out the actual activity. Notice the exam loves closing entries. Now, you know what this means. You know. What do I mean when I say close out actual activity? I mean close actual revenues, actual expenditures, actual sources, and actual uses. Got to close out all the actual activity, so let's do it. We're going to debit revenues control, $8 million. We're going to credit expenditures control, $5 million, because we have to close out the actual revenue, the actual expenditures. Do that. Notice there's a source here of $1.5 million. Now, if it's a source, did they send the money or receive it? They received it. During the year, didn't they debit cash, credit other financing sources? So to close it out, we're going to debit other financing sources, $1.5 million. Got to think it through. There's also a use. Now, if there's a use, that means they sent the money. That means during the fiscal year, they debited other financing uses, credit cash. So to close it out, I credit other financing uses, $2 million. That's what it means to close out actual activity. You have to close out the actual revenue, the actual expenditures, the actual sources, and the actual uses. And now the entry doesn't balance. It's always a plug. I need a credit of $2.5 million to balance the entry out, and that is the unassigned fund balance. That's what they wanted. And the answer is B. Number 12, a county's balances in the general fund include the following. They give us a list of balance, and they say at the bottom, what is the remaining amount available for use by the county? That is the question. What is the remaining amount available? Don't you know? You know as you go through the fiscal year that your expenditures plus your encumbrances can never exceed your appropriation. Your expenditures, $164,000, plus your encumbrances, $18,000. That adds up to what? $182,000. What's the legislative authority to spend? $435,000. $435,000, the appropriation, minus your expenditures plus your encumbrances, minus $182,000. The answer is C. That's what's still available, right? Your expenditures plus your encumbrances should not exceed your legislative authority to spend, your appropriation. So since the legislative authority to spend is $435,000, so far they've spent $164,000. They have contractual obligations of $18,000. $253,000 still available, but you knew that. Answer C. Number 13. 13 says, which of the following journal entries would a city use to record $250,000 in fire department salaries incurred during the day? Now, I like this question because we haven't talked about fire department salaries, and yet I hope you answered this with no problem because you know modified accrual. And if you know modified accrual, some answers just shouldn't make sense. Would you ever, A, debit an expense and credit appropriations? Of course not, ever, because you're combining there an actual account with a budget account. Those things, that's never done. In modified accrual, there are actual accounts and there are budget accounts, and they're never mingled in a journal entry. So A, I'm hoping you say, well, Bob, that makes no sense. How about B? Would you ever debit an expense and credit an encumbrance? No, never, because you're combining an actual account with a budget account. Would you ever C, debit encumbrances and credit a liability? Never. So the only answer that makes any rational sense at all to those of us who know modified accrual is D. Fire department salaries, no problem. It's got to be a debit to some kind of expense account, expenditures control for salaries, and credit a liability, a payable. That makes some sense. In number 14, financing for the renovation of Fur City's municipal park was begun and completed during the year. And here are the list of their sources. They got a grant from the state government. They got proceeds from bonds. They had a transfer from the general fund. And they say in the capital projects fund, what would be revenues? What would be other financing sources? Let's start at the bottom. How about the transfer from the general fund? Now, you know how to handle this. Remember, it's got to be permanent. It's got to be a permanent transfer from the general fund because they have to say the word temporary. If they don't say it's temporary, you've got to assume it's permanent. Now, when the capital projects fund got that transfer from the general fund, what entry did capital projects make? Didn't they debit cash for the $100,000 and credit other financing sources? It's a permanent transfer of money from one fund to another for operating purposes. So that would be in the capital projects fund, a debit to cash and a credit to other financing sources. So that's other financing sources. How about the proceeds from the bonds? We said this earlier in this class. Remember, if one of the 5 governmental funds issues bonds, they debit cash. They can't credit bonds payable. They're forbidden to carry long-term debt. The capital projects fund would be forbidden to carry long-term debt. So when they issue bonds, they debit cash and credit other financing sources. That would be other financing sources. And then the grant from the state government, that would be debit cash, credit revenues control. That would be revenue, grant revenue. And the answer is C. And since we're talking about a grant in this case, I want to get into something. Let's talk about a rule that's unique to modified accrual. And it's a rule you have to be aware of. In modified accrual, if a governmental unit receives restricted money, like a grant, that governmental unit is not allowed to recognize that grant money as revenue until they spend the money for the intended purpose, until they meet the terms of the grant. Let me say that again. In modified accrual, if a governmental unit receives restricted money, like a grant, this usually comes up with some sort of grant, a state grant. In modified accrual, that governmental unit is not allowed to recognize that grant money as revenue until they spend the money for the intended purpose, until they meet the terms of the grant. Let me just give you a quick example. Let's say a town gets a $200,000 state grant, and the money's restricted to purchase equipment. All right, so it's restricted. So a town gets a state grant of $200,000, and the money's restricted to purchase equipment. When the town gets that grant, they're going to debit cash $200,000. But they haven't spent the money yet for the intended purpose, so they would credit deferred revenue. They can't recognize the revenue until they spend the money for the intended purpose. So in this case, they would debit cash $200,000, and they would credit deferred revenue for the $200,000. Now, if we did a balance sheet at this point, that deferred revenue would be a liability, wouldn't it? Why is it a liability? Because theoretically, if they never meet the terms of the grant, they have to give the money back. Now, that's never happened in the history of the world. Believe me, they'll spend it. But theoretically, if they never spend the money for the intended purpose, eventually they have to pay it back. It's a liability. So right now, it would be a liability called deferred revenue. And I want to emphasize that this money is not being received in advance of timing requirements. Again, this is a grant that's been received not in advance of timing requirements. In other words, the money could be used immediately. So even though the money can be used immediately, it wouldn't be revenue immediately because it's not revenue until they spend the money for the intended purpose. All right, now let's say the town goes out and buys $200,000 worth of equipment. If they go out and they purchase $200,000 worth of equipment, they would, remember, they're not allowed to carry fixed assets, so they would debit expenditures control, $200,000, credit vouchers payable, $200,000. And now that they've spent the money for the intended purpose, they would debit deferred revenue, $200,000, and credit revenues control, $200,000. That's how it works. You cannot recognize the revenue until you spend the money for the intended purpose. And going back to question number 14, that grant from the state government, I had to assume they spent the money for the intended purpose because it says this renovation was begun and completed. It was completed. So I'm assuming in that multiple choice we had to assume that the money was spent for the intended purpose so the grant revenue could be recognized. But I want to emphasize again that this is grant money that you've received and it's spendable immediately. It's not money in advance of timing requirements. But I have to get into this. What if a governmental unit did receive a grant in advance of timing requirements? That's a little different. If a governmental unit receives a grant in advance of timing requirements, they would debit cash and credit deferred inflow of resources. Let me say that again. If a governmental unit receives a grant in advance of timing requirements, in other words, it can't be spent until some future time. They get a grant in advance of timing requirements. The entry would be a debit to cash and a credit to deferred inflow of resources. Now that account, you might see that in financial statements. If you see that account, deferred inflow of resources, it always has a credit balance. And it would be shown below liabilities in a general fund balance sheet. You would see that below liabilities, called deferred inflow of resources. That would be in the general fund balance sheet. And later when we talk about the government-wide statements, you would see that below liabilities in a government-wide statement of net position. And you really might see that account, deferred inflow of resources. Now, then when the timing requirements are met, then you would debit deferred inflow of resources and credit revenue. When the timing requirements are met, then you would debit deferred inflow of resources and credit revenue. But you might see that account name, deferred inflow of resources. Always has a credit balance. When else would this be used? Well, if there was a deferred gain on refinancing debt. If there was a deferred gain on refinancing debt, that would be deferred inflow of resources. A deferred gain on a sale-leaseback. A deferred gain on a sale-leaseback would be deferred inflow of resources. Proceeds from the sale of future revenue. Proceeds from the sale of future revenue would, again, be a debit to cash credit, deferred inflow of resources. An increase in the fair value of hedge securities. When a government hedges, future transactions, an increase in the fair value of hedge securities. What would the entry be? If there was an increase in the fair value of hedge securities, debit the investments, credit deferred inflow of resources. I just mentioned this because you could see that on a general fund balance sheet, again, below liabilities, or in a government-wide statement of net position, below liabilities. Now, how about a deferred outflow of resources? Let's say grant expenses are paid in advance of timing requirements. Again, let's say grant expenses are paid in advance of timing requirements. What would you do? You would debit deferred outflow of resources and credit cash. Again, if you paid grant expenses in advance of timing requirements, the entry would be debit deferred outflow of resources and credit cash. And that account, you might see that in financial statements. Deferred outflow always has a debit balance. You could see that on a general fund balance sheet below assets, or on a government-wide statement of net position below assets. And then when the timing requirements are met, what do? Debit expenditures and credit deferred outflow. When else would you debit deferred outflow? Well, if there's a deferred loss on refinancing debt. If there's a deferred loss on refinancing debt, that would be debited to deferred outflow. A deferred loss on a sale-leaseback. A deferred loss on a sale-leaseback would be a debit to deferred outflow of resources. The cost of acquiring rights for future revenue. the cost of acquiring rights for future revenue would be a debit to deferred outflow. And a decrease in the fair value of hedged securities, a decrease in the fair value of securities, of hedged securities, when the governmental unit is hedging future transactions. If there's a decrease in the fair value of hedged securities, you're going to debit deferred outflow of resources and credit the investment. You're going to write it down. And one more time, you could see these accounts, below, you could see this account, deferred outflow of resources, below assets on the general fund balance sheet, or below assets on the government-wide statement of net position. I want to go back to modified accrual. As I said earlier in this class, the best way to learn modified accrual is to do journal entries, to get used to the account names and how they're used. So what I want to get into next is another simulation that's in your viewer's guide. I want you to go to Morris City. What we're going to do now is a simulation where we have to go through the journal entries and the account names for a capital projects fund, and that's going to force us to get into the debt service fund. In Morris City, they're going to construct a new city hall. And we know that's the kind of project we account for in a capital projects fund because it accounts for the construction of major capital assets, like a city hall. They have legislative authority to spend up to $775,000 on the construction. They're going to finance the construction by issuing $700,000 worth of bonds and getting a $100,000 state grant. In items 2 through 9, we have the activity. And let's start with the journal entries in the Capital Projects Fund. As we've been saying, one of the major differences in modified accrual, and we know the Capital Projects Fund uses modified accrual. All 5 governmental funds use modified accrual. And in modified accrual, not only do we have a budget, but we actually make a journal entry to record the budget. So that's where we should start. What would be the entry to record the budget in the Capital Projects Fund? Well, there is something a little different here. Notice how they're going to finance the construction by issuing $700,000 worth of bonds. Now, you know this. Later in the problem, when they actually issue the bonds, and we'll get there, but later in the problem when they actually issue the bonds, we know they're going to debit cash. They can't credit bonds payable. They're not allowed to carry long-term debt, so they're going to credit other financing sources, aren't they? So here's my point. If you're setting up your budget and you're estimating during the fiscal year there's going to be bond proceeds, anytime you're setting up a budget and you're estimating during the fiscal year they're going to collect bond proceeds, that has to be part of your budget as a debit to estimated other financing sources for the $700,000. So that's how we'll start our budget entry. We're going to debit estimated other financing sources, $700,000. They're also expecting a $100,000 state grant. Debit estimated revenues control for the $100,000. They have legislative authority to spend up to $775,000 on the construction. You know what that is. It's the appropriation. Legislative authority to spend money. That's the definition of an appropriation. This is getting to be old hat for you now. So we're going to credit appropriations control for the $775,000. Now the entry doesn't balance, does it? We need a $25,000 credit to balance the entry out. You know what that is. That's your budgetary fund balance, $25,000. Now let's get into the actual activity. In item 2, they actually receive the $100,000 state grant. So what are you going to do? In the Capital Projects Fund, they're going to debit cash, $100,000, and credit deferred revenue, right? Remember, in modified accrual, when the governmental unit receives restricted money like a grant, they're not allowed to recognize that grant money as revenue until they spend the money for the intended purpose, until they meet the terms of the grant. And this is not ahead of any timing requirements. The money's available right away, but they haven't spent the money yet on meeting the terms of the grant, so they'll credit deferred revenue for the $100,000. Item 3. Now they actually issue the bonds. They go out and they issue $700,000 worth of bonds at a premium. They sell the bonds for $745,000. And this is something I really want to get into in this simulation because we haven't talked about this yet. How do we handle selling bonds at a discount, selling bonds at a premium. And let me start with a discount, even though that's not in this problem. But let me just change it. What if instead, and make sure this is clear in your notes, I'm going to change it. What if instead they sold $700,000 worth of bonds for $680,000 at a discount? Well, that's pretty easy. If they went out and sold $700,000 worth of bonds for $680,000, we know in the Capital Projects Fund they would debit cash for the $680,000. They can't credit bonds payable. They're not allowed to carry long-term debt. So they would credit other financing sources control for the $680,000. And with a discount, that's pretty much all you'd have to do. Because with a discount, the real issue is, did they receive enough money to do what they want to do? Because if they didn't, there's going to have to be another source of financing in the problem. Let me say that again. The real issue with a discount is, did you get enough money to do the project? Did you get enough money to do what you want to do? If you did not, there would have to be another source of financing in the problem. And that's pretty much it. What I'm saying to you is a discount's not very complicated. You sell bonds at a discount, you would just debit cash for the $680,000 and credit other financing sources, $680. And that's pretty much it. Now, in this problem, there's a premium. And premiums are more difficult. In this problem, they sold $700,000 worth of bonds for $745,000. So we're going to start the same way. In the Capital Projects Fund, they would debit cash, of course, for what they collected, $745,000. They can't credit bonds payable. They're not allowed to carry long-term debt. So they would credit other financing sources for the $745,000. Now we have to think about something. What are we going to do with that premium? Let me ask you this. If a profit-making company had this $45,000 premium, what would a profit-making company do with it? They would amortize it. I want you to listen to me. This is another major difference in modified accrual. In modified accrual, there's no amortization taken on bond discount or bond premium. Let me say that again. Another major difference in modified accrual is that in modified accrual, there's no amortization taken on bond discount or bond premium. You have to be aware of that. Just another difference in modified accrual. But I want to ask you another question. What would a profit-making company do with that extra $45,000 cash? What would they do with that little windfall? My point is, who are we kidding? A profit-making company would use that extra $45,000 cash to service the debt. That's why when you buy bonds at a premium, your effective yield is lower because they pay you back with some of your own money. That's what a profit-making company would do with that extra money. They would use it to service the debt. Governments are no different. What a government's going to do is use that extra $45,000 cash to service the debt. Where is the debt serviced? In the debt service fund. So now we're going to make another entry in the Capital Projects Fund where we literally transfer this $45,000 premium over to the debt service fund to service the debt. So let's make another entry in the debt in the Capital Projects Fund. What are we going to debit? Isn't this a permanent transfer of money? It's not coming back. It's a permanent transfer of money from one fund to another for operating purposes. And since the Capital Projects Fund is sending the money to the Capital Projects Fund, it's a use. So the Capital Projects Fund is going to debit other financing uses control, $45,000, and credit cash, $45,000. Hope you see why that entry is being made. The Capital Projects Fund is sending that $45,000 cash received for the premium over to the debt service fund to service the debt. Let's go to the debt service fund. So far, all of the entries we've made are in the Capital Projects Fund. But now let's go to the Debt Service Fund. What would the Debt Service Fund do? Remember I said all the Debt Service Fund does is accumulate money to make interest payments and principal payments on long-term debt of the other four governmental funds. That's all it does. All the Debt Service Fund does is service debt. That's why when you're in the exam, you're going to let the name of the fund help you remember its purpose. I know you will. All right, so in the Debt Service Fund, they get the money, and they're going to debit cash, $45,000. And what do they credit? Well, it's a permanent transfer for operating purposes, and debt service received the money. It's a source, so they're going to credit other financing sources control, $45,000. That's what debt service would do. It's a transfer of money from one fund to another. Now, we keep saying that all the debt service fund does is make interest payments and principal payments on long-term debt of the other governmental funds. Where does the debt service fund get the money to service the debt? Well, there are three primary sources. Number one, There could be transfers from other funds, like the one we just looked at, the $45,000. So there could be transfers from other funds. There could be special tax levies. And then don't forget number 3, the debt service fund has all this cash laying around, so they make investments and generate a lot of investment income as well. That's where the debt service fund gets the money to service the debt. All right, now let's say 6 months go by. Now you'll see in this simulation we don't have a lot of information about the bonds, so I'm just going to make I just want to make up a number here. Let's say 6 months go by, and it's time for the first semi-annual interest payment of $21,000. I'm just making up a number to illustrate. You cannot derive that number from anything I've said or anything that's written down there. But let's say it's time, 6 months go by, it's time for the first semi-annual interest payment of $21,000. What would you see in the debt service fund? In the debt service fund, if it's time for the first semi-annual interest payment, the debt service fund would debit expenditures control for the $21,000 and credit matured interest payable, $21,000. That word matured is very important. We'll talk about it in a minute. And then they'd get approval to send out the checks, so they would debit matured interest payable, $21,000, and credit cash, $21,000. Now, again, we don't have a lot of information on the bonds. Let's say these are 10-year bonds. What's going to happen 10 years from now when the bonds mature? Well, 10 years from now, when the bonds mature, won't they have to make the last interest payment and pay off the principal if they're 10-year bonds? So let's go ahead 10 years. They've got to make the last interest payment, pay off the principal, so you'd see entries like this. You'd see in the debt service fund, you'd see a debit to expenditures control for $721,000. Credit matured interest payable, $21,000. Credit matured bonds payable, $700,000. That's what happens when the bonds mature. Debit expenditures control, $721,000. Credit matured interest payable, $21,000. Credit matured bonds payable, $700,000. Again, that word matured is important. And then they get approval to send out the checks. They would debit matured interest payable, $21,000. Debit matured bonds payable, $700,000. And credit cash, $721,000. I want to say a word about this word matured. We've now run into another major difference in modified accrual. This is important. Remember, in modified accrual, in that debt service fund, they would never accrue interest like a profit-making company. Again, under modified accrual, in that debt service fund, they would never accrue interest like a profit-making company. No, under modified accrual, that debt service fund will not record interest or principal until it's matured, due, and payable, until it's a payment date. So try to remember that. They don't make accruals in modified accrual. They wouldn't accrue interest, not in modified accrual. In modified accrual, that debt service fund will not record interest or principal until it's matured, due, and payable, until it's a payment date. And that's what I'm illustrating there. So hope you see the kind of entries that are made in the debt service fund, because that's all it does, is service debt. It makes interest payments and principal payments on long-term debt of the 4 other governmental funds. Item 4. Now they sign a contract with a construction company to build the city hall for $650,000, and Morris City has agreed to furnish some labor on the project and some materials on the project. Well, you know what we've already learned in this class. Just the act of sending out a purchase order, just the act of signing a contract like this creates a potential obligation. It's not an actual obligation yet, but in modified accrual, we don't just keep track of actual obligations. We keep track of potential obligations in the encumbrance system. So you know my point. When they sign that contract with a construction company in the capital projects fund, they're going to debit encumbrances control, $650,000, and credit budgetary fund balance reserved for encumbrances, $650,000. Don't forget the encumbrance system. Just the act of signing that contract is going to require an entry. In the capital projects fund, they sign that contract, they're going to debit encumbrances control, $650,000, and credit budgetary fund balance reserved for encumbrances, $650,000. And always remember, an encumbrance is just an estimate of what we think something's going to cost. We don't know the actual amount until we're billed. Now, they said in item 4 that Morris City did agree to furnish some labor on the project, and number 5 says now they pay $15,000 of wages to people who worked on the project, probably planning. So in the capital projects fund, they'll debit expenditures control for $15,000 and credit cash. $15,000 was paid. They also said in item 4 that they're going to furnish some raw material on the project, and item 6 says they approve purchase orders for raw material, estimated to cost $38,000. You know what to do. Don't forget the encumbrance system. They send out those purchase orders, then in the capital projects fund, they're going to debit encumbrances control and credit budgetary fund balance reserved for encumbrances, $38,000. I know you, Bob, I could do the encumbrance system in my sleep now. Good. That's what I want. Got to know the encumbrance system. So they send out those purchase orders. You can do it in your sleep. Yes. Debit encumbrances control, $38,000. Credit budgetary fund balance reserve for encumbrances, $38,000. No problem, Bob. That's what I want to hear. Number 7, the raw materials are delivered and they get a bill for $36,000 and it was approved for payment. You know, without me saying it, you always reverse the original encumbrance for the original estimated amount when a bill comes in. So when that bill comes in, they're going to debit budgetary fund balance reserve for encumbrances, and they're going to credit encumbrances control. Not for $36,000, $38,000. $38,000. The original estimated amount. You always reverse the original encumbrance for the original estimated amount. And then you would book the expenditure and the liability at what you're actually billed, more or less. Here it was less. So they're going to debit expenditures control and credit vouchers payable for what they're actually billed, $36,000. And they said it was approved for payment, so they'll debit vouchers payable $36,000 and credit cash $36,000. Item 8, the construction is finished and they get an invoice from the construction company for $609,000, and that is approved for payment. Well, here again, you're billed, you always reverse the original encumbrance, in this case, for the original contract amount. So they're going to start here by debiting budgetary fund balance reserved for encumbrances, and they're going to credit encumbrances control, not $609,000, $650,000. The original contract amount. You always reverse the original encumbrance, in this case, for the original contract amount. So the first entry would be to debit budgetary fund balance reserved for encumbrances, credit encumbrances control for the $650,000, the original contract amount. Now that they've done that, they're going to record the City Hall at its actual amount, but you know the Capital Projects Fund is forbidden to carry fixed assets, so they'll debit expenditures control for the $609,000 and credit vouchers payable for the $609,000, what they're actually billed, and then they said it was approved for payment, so they'll debit vouchers payable $609,000 and credit cash $609,000. And let me add this. Now they must have spent that state grant. Now that the construction's finished, they must have spent that state grant, meeting the terms of the grant, so now they can debit deferred revenue for the $100,000 and credit revenues control for the $100,000. Now they have some actual revenue. Item 9, let's do the closing entries. As we've been saying in this class, it always helps you to step back and go, wait a minute, it's modified accrual. In modified accrual, we're always looking to close out 3 things. You know what they are. You've got to close the budget. You've got to close the actual activity, and you have to close the encumbrances. That always gets you organized. Hey, it's modified accrual. I've got to close the budget. I've got to close the actual activity, and I've got to close the encumbrances. Let's close the budget. As we've said in this class, closing the budget's never going to bother you. It's just a matter of reversing the entry that you made when you set it up. So that's not bad, as long as you remember it's got to be done. So now we're going to debit budgetary fund balance for the $25,000. If you debit budgetary fund balance $25,000, that would zero that out. We're going to debit appropriations control for the $775,000 to zero that out. We didn't keep track of T accounts here. I only make you do the T accounts once to really start getting used to it. We're just doing entries here. But you know, when I debit appropriations control $775,000, it'll zero it out. I'm going to credit estimated revenues control $100,000. That would zero that out. And credit estimated other financing sources $700,000. And that would zero that out. And I promise you, that's all that entry is ever going to amount to. It's just a matter of reversing the entry that you made to set it up in the first place. Now that we've closed the budget, we close the actual activity, and you know what that means. Close the actual revenue, the actual expenditures, the actual sources, and the actual uses. You've got to close out all the actual activity. Let's do it. We're going to debit revenues control for the $100,000. That's the state grant. We're going to credit expenditures control, $660,000. Now, we don't have a T account here. Where did that $660,000 come from? Well, that's all the expenditures on the project. That was the $609,000 we paid to the construction company, That was the $36,000 of raw material that we provided on the project and the $15,000 of wages we paid on the project. Again, that's $660. If you had a T account, it would be obvious. It's all the expenditures on the project. The $609,000 we paid to the construction company, the $36,000 of raw material that we provided on the project, and the $15,000 of wages we paid on the project. And by the way, if you were to look at the government-wide statement of net position, remember, that's where the government reports its fixed assets, in the government-wide statement of net position. And if you were to look at the government-wide statement of net position, you'd see that City Hall on there at $660. In other words, the point I'm making is we capitalize all the expenditures on the project, not just what we pay to the construction company. So keep that in mind. We would capitalize all the expenditures on the project, not just what we pay to the construction company. You'd find that City Hall on the government-wide statement of net position at $660,000. But here, that's our actual expenditures. So we're going to credit expenditures control, $660. Close out the actual expenditures. We're going to debit other financing sources control for the $745,000. Remember, that account was created when we issued the bonds. Close out our actual sources. We're going to credit other financing uses control for the $45,000. That account was created when we sent the premium to the debt service fund. So you notice what I've done here. I've closed out the actual revenues of $100,000, the actual expenditures of $660, the actual sources of $745, the actual uses of $45,000, and the entry doesn't balance. We need a credit of $140,000 to balance the entry out. What would we call that? I need a credit here of 100. Let's have a little multiple choice here, because I know you're getting good at this now. I know you want to show off. So I need a credit here of $140,000 to balance the entry out. What would I credit for $140,000? I'll give you some choices. Would I credit restricted fund balance, $140, unassigned fund balance, $140, assigned fund balance, $140, committed fund balance, $140? How do you feel about that? A little multiple choice for you. What would I credit for $140? The restricted fund balance, the unassigned fund balance, the assigned fund balance, the committed fund balance. Do you have a thought on that? Very good. Credit the assigned fund balance of $140, because this fund balance is assigned to the purpose of this fund. Remember, if this was the general fund, that would be the unassigned fund balance. But in any other fund, that's the assigned fund balance, because this fund balance is assigned to the purpose of this fund. Credit assigned fund balance for the $140,000. Now, the third thing you close out are the encumbrances. We've closed out the budget. We've closed out all the actual activity. Third thing we close out are the encumbrances, but if you had T accounts, this would be obvious. There are no outstanding encumbrances. But even though there are no outstanding encumbrances, we're not done yet. I'll tell you why. There's a little wrinkle here. Again, there's no outstanding encumbrances. Don't worry about that. But we're not done, because here's what's left. If you had T accounts, here's what you would see. Once you close out the budget, once you close out the actual activity, there are no encumbrances. All that's left is a debit in cash of $140,000 and a credit in the assigned fund balance of $140,000. That's all that's left. A debit in cash of $140,000 and a credit in the assigned fund balance of $140,000. Here's the point. In a capital projects fund, if the project is finished, if it's finished, and there's still an assigned fund balance, they would want you to assume they would use that assigned fund balance to service the debt. Again, in a capital projects fund, if the project is finished, it's got to be finished, and there's still an assigned fund balance, they would want you to assume they would use that assigned fund balance to service the debt. So now we're going to make another entry in the capital projects fund where we transfer this $140,000 to the debt service fund to service the debt. So you know what you're going to do. You're going to debit other financing uses, right? This is a permanent transfer. It's never coming back. It's a permanent transfer for operating purposes. The capital projects fund is sending the money. So it's going to be a debit to other financing uses for the $140,000 and credit cash, $140,000. And then they'd make one more entry in the capital projects fund where they would debit the assigned fund balance, $140,000, and credit other financing uses, $140,000. And now that entry closes out the capital projects fund. One more time. I'm going to debit other financing uses, $140,000, and I'm going to credit cash, $140,000. That sends the money to the debt service fund to service the debt. And then I make one more entry where I debit the assigned fund balance for $140,000, close it out, and credit other financing uses, $140,000. That entry closes out the Capital Projects Fund. And of course, then in the Debt Service Fund, they would debit cash, $140,000, and credit other financing sources, $140,000. They'd use the money to service the debt. So try to remember that. In a Capital Projects Fund, if the project is finished, it's got to be finished, and there's still an assigned fund balance, they would want you to assume they would use that assigned fund balance to service the debt. Remember we said that a governmental unit, like a town, a governmental unit, like a city, uses three types of funds. They use governmental funds, and as you know very well, there are 5 of those: general fund, special revenue fund, capital projects fund, permanent fund, debt service fund. It's 5 governmental funds. They use proprietary funds. There are 2 of those. And they also use fiduciary funds. There are 4 of those. So a governmental unit uses 11 different types of funds. 5 governmental funds, 2 proprietary funds, 4 fiduciary funds. Let's get into the proprietary and the fiduciary funds. First thing I want to say, the proprietary and the fiduciary funds carry their own fixed assets. Again, the proprietary and the fiduciary funds carry their own fixed assets. And they depreciate their own fixed assets. So you would see depreciation expense in the proprietary funds. You'd see depreciation expense in the fiduciary funds. The proprietary and the fiduciary funds carry their own long-term debt. So you'd see accounts like bonds payable, long-term notes payable in the proprietary funds, the fiduciary funds, because they carry their own long-term debt. Also, the proprietary and the fiduciary funds service their own long-term debt. So you would see an account like interest expense in the proprietary funds, in the fiduciary funds. So that's the bottom line. The proprietary and the fiduciary funds carry their own fixed assets, depreciate their own fixed assets, carry their own long-term debt, service their own long-term debt. In other words, the proprietary and the fiduciary funds use normal accrual accounting, not modified accrual. Not modified accrual. Also, the proprietary and the fiduciary funds have the same measurement focus. The measurement focus, and you know the exam likes this kind of thing, the measurement focus in the proprietary and the fiduciary funds is total economic resources. That's why they carry their own fixed assets. That's why they carry their own long-term debt, because their focus is total economic resources and income measurement. These funds want to see if they're making a profit or not. That's their focus, total economic resources and income measurement. All right, now let's talk about the proprietary funds. There are 2 proprietary funds. The first proprietary fund is called an enterprise fund. Now listen carefully. The government sets up an enterprise fund anytime the government wants to act like a private enterprise. Let the name of the fund prompt you to remember what it does. The government sets up an enterprise fund anytime the government wants to act like a private enterprise. Any kind of public utility. That's what you normally see in the exam. Municipal gas, municipal electric, municipal water department. That would be an enterprise fund, because the government's going to act just like a private enterprise. Just stop and think. How would you finance the day-to-day operations of a municipal water department? How would you do it? How would you finance the day-to-day activities of a municipal water department? You would charge consumers. You would charge the public, just like a private enterprise. This could be a municipal parking garage. How would you finance the activities, the day-to-day activities of a municipal parking garage? You charge the people who park there. You charge the public. You charge consumers, just like a private enterprise. That's when the government sets up an enterprise fund. When the government's acting, just like a private enterprise. Then the second proprietary fund is called an internal service fund. The government sets up an internal service fund when one agency of the government is servicing other agencies of the government. Again, internal service fund. It's when one agency of the government is servicing another agency of the government. So this would be something like a central printing office for all governmental agencies, a central motor pool for all governmental vehicles, a central data processing department for all governmental agencies. That's why you have an internal service fund. You know, just stop and think. How would you finance the day-to-day activities of a central printing office? By charging whom? Other governmental agencies. That's why there's 2. That's why there's 2 proprietary funds. Enterprise funds charge the public, charge consumers for services, just like a private enterprise. Internal service funds charge other governmental agencies for services. So that's why there's 2 of them. let's talk about the fiduciary funds. Now, when you get into the fiduciary funds, now what you're into are the trust funds. And why does the government need trust funds? Well, the government needs a trust fund anytime the government is holding assets in trust. Let the name help you. Government needs a trust fund anytime the government's holding assets in trust. The first fiduciary fund is called the pension trust. The pension trust is for the pension system, the retirement system for city employees. If you think about it, for the pension system, the retirement system for city employees, that has to be a trust fund because the government is holding that money in trust. The government doesn't own that money, the employees do. Government holds that money in trust. That's called the pension trust. Next trust fund is called a private purpose trust. The government sets up a private purpose trust when the government's holding money in trust that'll benefit a private individual or a private organization. It gets called a private purpose trust. Government sets up a private purpose trust when the government's holding money in trust that'll benefit a private individual or private organization. For example, let's say somebody dies and leaves, $10 million to the city, and they want all the interest and dividends to go to a certain nursing home. And if the nursing home ever goes out of business, the city keeps the $10 million. And these kind of things happen. Somebody dies, leaves $10 million to the city, and they want all the interest and dividends to go to a certain nursing home. And if the nursing home ever goes out of business, the city keeps the $10 million. That would be a private purpose trust because the governmental unit is holding money in trust that benefits a private organization, the nursing home, or a private individual. Third trust fund is called the investment trust. Let's say that the government runs a temporary surplus. It would be very temporary. But if the government runs a temporary surplus, the government has to invest that money in government-backed bonds. And those bonds would have to be held in a trust fund because the government really holds those investments in trust. The government does not own that money. The taxpayers do. Again, let's say a government runs a temporary surplus. They would invest that surplus in government-backed bonds is what they would do. And those investments have to be kept in a trust fund because the government is holding that money in trust. The government doesn't own that money. The taxpayers do. That's why you have an investment trust. And there is one more fiduciary fund. You have to be aware of it. It's called an agency fund. It's called an agency fund. And the government sets up an agency fund anytime the government is going to act as an agent. Let the name always help you to remember its purpose. Government sets up an agency fund anytime the government is acting as an agent for somebody else. And I want to give you an example, and it's an example you see a lot in the exam. Let's say a municipality, is going to collect school taxes. Let's say a municipality is going to collect school taxes for, 50 different school districts in their area. So we have a municipality, they've agreed to collect school taxes, for 50 different school districts in their area. Well, that would be an agency fund because that municipality is going to act as an agent for all those school districts. Now, I don't want to show you a lot of entries here, but I want to show you one entry. But let's stay with that example. Let's say a municipality is going to collect school taxes, for 50 different school districts. So they go out, they set up an agency fund, they collect all the school taxes. What's the entry in the agency fund? They would debit cash and credit due to District 1, due to District 2, due to District 3. There'd be 50 credits. I'm making a point. In an agency fund, you're never going to see revenues, ever, or expenditures, or any kind of fund balance or net asset position. Remember this, in an agency fund, there are never any revenues or expenditures or a fund balance or a net asset position of any kind. All you ever see in an agency fund is cash and a liability due to somebody. In other words, all an agency fund is a temporary holding account for money. It's always cash and due to somebody. There's never any revenues, expenditures, a fund balance, or a net asset position. It's impossible. The exam loves exceptions. It's impossible. Can't have revenues. An agency fund can't have revenues, can't have expenditures, can't have a fund balance, can't have a net asset position. All you ever see in an agency fund is cash and then a credit due to somebody. They could use an agency fund for federal withholding for city employees. Debit cash, credit due to federal government. Life insurance, health insurance premiums, an agency fund for all city employees. They would debit cash, credit due to insurance company. That's all you ever see in an agency fund is cash and then a credit, a liability due to somebody. I'd like you to try some more questions. I'd like you to shut the class down, do questions 15 to 23, and then come back. Welcome back. Let's do these questions together. Number 15, Sig City used the following funds for financial reporting purposes, and they want to know how many of these funds use normal accrual accounting. I hope you picked them right out. The Internal Service Fund is a proprietary fund, normal accrual accounting. The Enterprise Fund, the Airport Enterprise Fund, it's a proprietary fund, normal accrual accounting. The Pension Trust, it's a fiduciary fund, normal accrual accounting, and the answer is B. 3 funds use normal accrual accounting. The General Fund, the Capital Projects Fund, the Special Revenue Fund, Debt Service, the Governmental Funds, they all use modified accrual. 16. The modified accrual basis of accounting would be used for which of the following funds? I know you could do it blindfold. Capital Projects, Governmental Fund. Not an enterprise fund, that's a proprietary fund. Proprietary funds use normal accrual accounting. Pension Trust uses normal accrual accounting, you know that. The answer is A. 17. The Debt Service Fund, our governmental unit, is used to account for the accumulation of resources for and the payment of principal and interest in connection with what? A private purpose trust fund? No. A proprietary fund? No. No, these funds carry their own long-term debt and service their own long-term debt. No, the Debt Service Fund is for the governmental funds, right? For the governmental funds, not proprietary funds, not fiduciary funds. Double no. Answer A. 18. Cedar City issued $1 million of 6% revenue bonds at par April 1st to build a new water line for its Water Enterprise Fund. Interest is payable every 6 months. What amount of interest expense would be reported for the year ending December 31? I have a question for you. Let's forget this is governmental for a second. If this were a profit-making company, forget governmental, forget all that. If this were a profit-making company, what would be the interest expense for the year? Wouldn't you take 6% of $1 million? That's $60,000 of interest for a full year. We don't want a full year. We want April through December, which is 9/12 of a full year, which would be $45,000. If this were a profit-making company, the answer would be C, $45,000. And that's what it is for an enterprise fund, too. Answer C, because it's just like a private enterprise. It's just like a private enterprise. Let the name of the fund help you remember that. 19. The following information for the year ended June 30th pertains to a proprietary fund established by Glen Village in connection with the public parking facilities. They want to know for the year ended June 30th, this proprietary fund would report net income of what? Well, you have their receipts, $600,000. What are their expenses? They've got expenditures for parking. They've got expenditures for salaries and other cash expenses, $96. And they also have parking meters, and they have depreciation of the parking meters. Remember, it's a proprietary fund. It's an enterprise fund. It's a proprietary fund. Carries its own fixed assets, depreciates its own fixed assets. Normal accrual accounting. So you're going to pick up the salaries and other cash expenses and the depreciation expense of $94. The total expenses were $190,000. So $600,000 minus $190 in expenses, the answer is D. Just like a profit-making company. It's just like a private enterprise. It's an enterprise fund. Number 20, they say through an internal service fund, New County operates a centralized data processing center to provide services to New's other governmental units. What we have here is an internal service fund. We have one agency of the government servicing other agencies of the government. This internal service fund build, think of that word build. They build New's Parks and Recreation Fund $150,000 for data processing services. What account would New's Internal Service Fund credit to record this billing? Well, I'll tell you what's important about this question. The most important thing to notice about this question is that this is not a transfer between funds. It's a transaction between funds. And you might want to write this down so you remember it. This is called a quasi-external transaction. You just might want to write down it's a QET. Again, it's not a transfer between funds. It's a transaction between funds. We have one fund billing another fund for services. It's a transaction between funds. And I'm just going to give you a quick note here on how you handle all quasi-external transactions. They're really easy. As long as you can pick up in the exam, hey, this is not a transfer between funds, this is a transaction between funds. It's a QET. It's a quasi-external transaction. Here's how you handle all quasi-external transactions. Just remember, the fund that sells the goods or services recognizes revenues control. The fund that sells the goods or services credits revenues control. The fund that buys the goods or services debits expenditures control. It's really that simple. That's how you handle all quasi-external transactions. Just remember, the fund that sells the goods or services credits revenues control. The fund that buys the goods or services debits expenditures control. So in this case, the internal service fund sold the service, so they would credit revenues control. Answer D. Same thing with number 21. They say a city's electric utility, which is operated as an enterprise fund. That makes sense. It's just like a private enterprise. Any kind of public utility, that's going to be an enterprise fund. A city's electric utility, which is operated as an enterprise fund, rendered billings for electricity supplied to the general fund. We have one fund billing another fund for services. Again, you might just write down, it's a QET. Oh, it's a QET. It's not a transfer between funds. It's a transaction between funds. It's a quasi-external transaction. Which of the following accounts would be debited by the general fund? Well, since the general fund bought the service, the general fund would debit expenditures control. Answer B. 22 gets us into residual equity transfers. Now, as I've said in this class, the exam loves transfers of money from one fund to another. And so far in this class, we've looked at two types of transfers. First, we looked at a temporary transfer of money from one fund to another. That's not hard, right? If there's a temporary transfer of money from one fund to another, the fund that sends the money debits a receivable called due from. The fund that receives the money credits a payable called due to. Really very simple. That's how you handle a temporary transfer of money from one fund to another. The fund that sends the money debits a receivable called due from. The fund that receives the money credits a payable called due to. Then we looked at a permanent transfer from one fund to another for operating purposes. If you see a permanent transfer of money from one fund to another for operating purposes, the fund that sends the money debits other financing uses. The fund that receives the money credits other financing sources. We know that. Well, this is a different one. This is called a residual equity transfer, just in case they mention it. I'll tell you what it is. A residual equity transfer is a permanent transfer of money. It is permanent. It's a permanent transfer of money from one fund to another, but not for operating purposes. I'll say that again. A residual equity transfer is a permanent transfer of money. It is permanent from one fund to another, but not for operating purposes. Notice this is going from the general fund to an internal service fund. What it probably is, it's not for operating purposes, it's capital. You know, it's seed money. In most cases, that's what it would be. Capital to get the internal service fund started. So let me just show you the entry on both sides. What the general fund would do, if the general fund sends they say here, Gem City's internal service fund received a residual equity transfer of $50,000 from the general fund. This $50,000 transfer would be reported in the internal service fund as a credit to what? Well, this is what it looks like on both sides. When the general fund sends a $50,000 residual equity transfer to the internal service fund, the governmental fund, because it's a permanent transfer, would debit other financing uses. It's a permanent transfer for operating purposes, so the general fund would debit other financing uses dash residual equity transfer, $50,000, and credit cash, $50,000. That's how the general fund would handle it. It's permanent. It's never coming back, so the general fund would debit other financing uses dash residual equity transfer, $50,000, credit cash, $50,000. And then the proprietary fund, in this case the internal service fund, would debit cash and answer B, credit transfers in. That's how you handle a residual equity transfer. Number 23, Jape City issued $1 million of general obligation bonds at 101 to build a new city hall. So this would be a capital projects fund. It accounts for the construction of major capital assets. As part of the bond issue, the city also paid $500 in underwriters' fees and $2,000 in other debt issue costs. So that they got some bond issue costs here of $2,500. What amount would Jape City report as other financing sources? Well, we've said it several times in this class. If one of the governmental funds, like a capital projects fund, issues bonds, they go out and they issue $1 million worth of bonds at 101, the capital projects fund would debit cash for $1,010,000 and answer A, credit other financing sources. Remember, they can't credit bonds payable. They're not allowed to carry long-term debt. They're forbidden to. So capital projects would debit cash for 101% of $1,010,000, credit other financing sources. They can't credit bonds payable. So they'd credit other financing sources $1,010,000. So the answer is A, and then the bond issue costs would be handled by the debt service fund. Services the debt. And in the debt service fund, the bond issue cost would be a debit to expenditures control, $2,500 in credit cash. But it wouldn't affect other financing sources. Now, it's important to remember that when you're talking about state and local governmental accounting, what you're talking about is the GASB, the Governmental Accounting Standards Board, not the FASB. You're talking about the GASB, the Governmental Accounting Standards Board. The Governmental Accounting Standards Board, the GASB, establishes generally accepted accounting principles for state and local governmental units. And what we're going to get into next is GASB 34. It's a very important GASB. GASB 34 established the reporting model for state and local governmental units. And what I'm talking about is the comprehensive annual financial report, the CAFR. So just remember, GASB 34 established the reporting model for state and local governmental units. It's what they call the CAFR, the Comprehensive Annual Financial Report. Now, there are 6 parts to the CAFR, and I want to go through each one. This is very important and very heavily tested. You have to be aware of these 6 parts. There are 6 parts to the CAFR. Part 1 is the Management Discussion and Analysis, the MD&A. The Management Discussion and Analysis always precedes the financial statements, always. The Management Discussion and Analysis, the MD&A, always precedes the financial statements. And what it does is compare the current year to the prior year, and it explains any major changes. That's what it does. The MD&A, the Management Discussion and Analysis, it always precedes the financial statements. It compares the current year to the prior year, explains any major changes. And one small thing, the Management Discussion and Analysis, even though it always precedes the financial statements, it's part, if they ask, it's part of the RSI. It's part of the required supplementary information. Again, even though it always precedes the financial statements, if they ask, the Management Discussion and Analysis is always, it's part of your required supplementary information. It's part of the RSI, which we'll say more about in a little bit. Part 2 of CAFR is the heart and soul of the whole thing. Part 2 is the basic financial statements. This is the heart and soul of GASB 34. It's the heart and soul of the whole thing, the basic financial statements. Now remember, the basic financial statements include first the government-wide statements. Again, your basic financial statements first include the government-wide statements, the government-wide statement of net position, and the government-wide statement of activities. And then your basic financial statements also include the fund financial statements. You know there are 5 governmental funds: general fund, special revenue fund, capital projects fund, permanent fund, debt service fund. There are 5 governmental funds, and those statements are done under modified accrual. Then there are 2 proprietary funds: enterprise, internal service fund, and their statements are done under normal accrual accounting. And then there are 4 fiduciary funds: the pension trust, the private purpose trust, the investment trust, and the agency fund. There are 4 fiduciary funds, and those statements are done under normal accrual accounting. Let's focus in on the government-wide statements. Now, if you look in your viewer's guide, as I mentioned, there are 2 government-wide statements, and you have an example of both. I just want to point out some important things about them. The first government-wide statement, and there's an example in your viewer's guide. First one is a government-wide statement of net position. And it's basically a balance sheet, but it's called a government-wide statement of net position. And when you look at the government-wide statements, and you just start by looking at the government-wide statement of net position, right away the first thing you notice is in the government-wide statements, they separate governmental activities from business type. The first thing you should notice, the government-wide statements separate governmental activities from business type activities. Give me an example of a fund that's governmental activities, clearly? What comes to mind? What would be an example of a fund that's clearly governmental activities? General fund, special revenue fund, capital projects fund. What would be a fund that would be business type activities? Proprietary funds, right? Enterprise fund, the enterprise fund. That comes to mind right away, right? The proprietary fund, an enterprise fund, just like a private enterprise. All right, so that's what the government-wide statements do. It separates governmental activities from business type. And if you look at the statement, you'll notice a couple of things. You'll notice that this is where the government reports its fixed assets. Notice they have fixed assets with accumulated depreciation. So this is where the government reports all its fixed assets with accumulated depreciation. And I want to give you a note here. In the fixed assets, you would also find infrastructure. Now, what's infrastructure? Infrastructure would be roads, bridges, sewer systems. Now, here's what the exam might ask you. Should you depreciate infrastructure? Again, infrastructure would be things like roads, bridges, sewer systems. And the exam might ask you, should you depreciate infrastructure? The answer is no. You're not required to depreciate infrastructure if you do three things. Number one, you keep an up-to-date inventory of your infrastructure. That's number one. You must keep an up-to-date inventory of your infrastructure. Point number two, you have to assess its condition at least every 3 years. Number two, you have to assess its condition at least every 3 years. And number three, you have to disclose the expenditures that will be required to maintain it. As long as you do those three things, if you keep an up-to-date inventory of your infrastructure, if you assess its condition at least every 3 years, and disclose the expenditures that will be required to maintain it, as long as you do those three things, you don't have to depreciate infrastructure. And you have to know this. That's called the modified approach of depreciation for infrastructure. That's what that's called. It's called the modified approach of depreciation for infrastructure, which means depreciation doesn't have to be taken. Notice in the government-wide statement in net position, here's where the government reports its long-term debt, including bonds payable, long-term notes payable. Here's where the government reports its long-term debt. Now, as I've been saying, the whole point of the government-wide statements is to separate governmental activities, like the general fund, from business-type activities, enterprise fund. Where would I find the fiduciary funds? Well, remember, the fiduciary funds are excluded from the government-wide statements. Got to know that. Remember, the fiduciary funds are really trust funds for the most part. The government is holding assets in trust. So when you really look at it, fiduciary funds are not governmental activity. They're not business-type activities. It's just the government holding money in trust. So the fiduciary funds are excluded from the government-wide statements. Notice something else. Notice the column for component units. Now, what are component units? Why don't you just write this in? Just remember, it would be like a school district, a school board, a rescue squad, something like that, component units. Now, you have to be aware of something. With component units, again, a school district, a school board, a rescue squad. Now, listen very carefully. If a component unit is organized as a separate legal entity, if it's organized as a separate legal entity, its governing body is not substantially the same as the governing body of the primary government. I'll say it again. If a component unit is organized as a separate legal entity, its governing body, the component unit's governing body, is not substantially the same as the governing body of the primary government. Well, then it would be shown as we have it here, as a discrete presentation. No, it's a separate column. Then it's shown as a discrete presentation in a separate column. Now, on the other, let's just flip it around. If a component unit is not organized, it's not organized as a separate legal entity. Its governing body is substantially the same as the governing body of the primary government. It really services the primary government. Then the component unit would just be blended. That's the word. Just blended into governmental activities. Hope you see that. That's really the choice there with component units. If it's a separate legal entity, its governing body is not substantially the same as the governing body of the primary government, it would be a discrete presentation, a separate column, as it is in our example. But if it's not a separate legal entity, the governing body of the component unit is substantially the same as the governing body of the primary government, then you would just blend it into governmental activities. Now, another point. We've been saying that the whole point of the government-wide statements is to separate governmental activities from business type. Where would I find the Internal Service Fund? Now, this drives people crazy. you would think logically, well, the Internal Service Fund is a proprietary fund. It's got to be business type. No, they took the position that what is an Internal Service Fund? It's one agency of the government servicing other agencies of the government. So remember, in the government-wide statements, the Internal Service Fund is always governmental activities. They catch a lot of people on that. Remember that, even though it's a proprietary fund. In the government-wide statements, an Internal Service Fund is always governmental activities. Now, if you notice in the government-wide statement of net position, you see the interfund transactions. You see that interfund balance. I want to talk about this. That would be something like a due from on the general fund balance sheet and a due to on the enterprise fund balance sheet. That's what that interfund balance would be. It would be like a due from on the general fund balance sheet and a due to on the enterprise fund balance sheet. Now, here's the point I want to make, that if there's a due to, due from within governmental activities, that gets eliminated from the government-wide statements. Again, if anytime there's a due to, due from within governmental activities, that gets eliminated from the government-wide statements. They don't want you to gross up your assets. Likewise, if there's a due to, due from within business-type activities, that gets eliminated from the government-wide statements. But if there's a due to, due from between governmental and business-type activities, it stays in the statement. That's what you're seeing there. It's what they call a partial elimination of interfund transactions, not a total elimination of interfund transactions. Let me just go through that again. Anytime there's a due to, due from within governmental activities, that gets eliminated from the government-wide statements. If there's a due to, due from within business-type activities, all within business-type activities, gets eliminated from the government-wide statements. But if there's a due to, due from between governmental and business-type activities, we leave it in the statement. So that's what's required in the government-wide statements, a partial elimination of interfund transactions, not a total elimination of interfund transactions. And then one more thing I want you to notice about the government-wide statement of net position. Notice there are three categories of net. Look, if you look at the bottom, there are three categories of net position. There's the net investment in capital assets. That's the first category. The net investment in capital assets. What that represents are your capital assets, your fixed assets, less accumulated depreciation and less any corresponding debt, any mortgages. That's called net investment in capital assets. Then there's restricted and unrestricted. But you have three categories of net position. Now, also in your viewer's guide, you'll see an example of a government-wide statement of activities, basically an income statement. Now, you already know a lot about this. Notice, in a government-wide statement of activities, the whole thrust of the statement is to separate governmental activities from business-type activities. And where am I going to find the fiduciary funds? Remember, the fiduciary funds are excluded from the government-wide statements. Notice the component units. You know what that is. It's a school board. It's a school district, a rescue squad. And if it's organized as a separate legal entity, the governing body of the component unit is not substantially the same as the governing body of the primary government, it would be a discrete presentation, as we have here, in a separate column. Where would I find internal service fund? Even though it's a proprietary fund, in the government-wide statements, it's governmental activities. But the main thing you want to notice in the government-wide statement of activities is that first, the whole thrust of the statement is to separate governmental activities from business-type activities and then report net revenues or net expenses by program. That's what you can see there. Yes, we separate governmental activities from business-type activities, and our first mission on that statement is to report net revenues or net expenses by program. And once you've done that, once you've reported net revenues or net expenses by program, then notice general revenues are separated. Then general revenues come in. And then extraordinary items. Those are gains or losses that are both unusual and infrequent. The criteria that you know well. Extraordinary items. Then there are special items. Gains or losses that are unusual but not infrequent. Infrequent but not unusual. Meets one of the criteria. So once you've reported net revenues or net expenses by program, then at the bottom you bring in general revenues. They're separated. and then extraordinary items and special items. But once again, we have a government-wide statement, the government-wide statement of activities, separating governmental activities from business-type activities, reporting net revenues or net expenses by program. There are 5 governmental funds. There are 5 governmental funds, and their statements are going to be done under modified accrual. They have to do a balance sheet, and we did one earlier in this class. Remember, we did a balance sheet for Pine City. It's in your viewer's guide. We did a balance sheet for Pine City under modified accrual. But they have to do a balance sheet. The 5 governmental funds have to report a balance sheet and a statement of revenues, expenditures, and changes in fund balance. And we did one of those as well. So if you look in your viewer's guide, back in Pine City, you'll see an example of a balance sheet and a statement of revenues, expenditures, and changes in fund balance for the general fund. But in the fund financial statements, the 5 governmental funds, general fund, special revenue fund, capital projects fund, permanent fund, debt service fund, have to do a balance sheet and a statement of revenues, expenditures, and changes in fund balance under modified accrual. Now the 2 proprietary funds, enterprise, internal service, they have to show a statement of net position, basically a balance sheet, but it's called a statement of net position, and a statement of revenues, expenses, and changes in fund net position. Again, they have to show a statement of net position, basically a balance sheet. And remember, these statements are done under normal accrual accounting. These are proprietary funds, enterprise, internal service. These statements will be done under normal accrual accounting. And they have to show a statement of net position, a balance sheet basically, and a statement of revenues, expenses, and changes in fund net position. And, listen carefully, the proprietary funds are the only funds in governmental that have to do a statement of cash flows. Now, if you look in your viewer's guide, I want to show you a couple of things here. In your viewer's guide, you'll see an example of a statement of cash flows under the FASB format. And I just put this in just to refresh your memory, because it's the format you know so well. Notice in a statement of cash flows under the FASB format, we have cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. And basically, cash flows from operating activities is cash received from customers minus cash expenses. And then you have cash provided by cash flows from investing activity. What goes in there? If you buy or sell property, plant, or equipment, if you buy or sell investments. And then finally, cash flows from financing activities. If you borrow or repay principal, if you pay dividends, if you issue shares, or you buy or sell treasury stock. Just a review of what you already know. But if you go to the next page, here's how you do a statement of cash flows under the GASB format. And one more time, the proprietary funds, when they do their statement of cash flows, and they're the only funds in governmental that do a statement of cash flows. But when the proprietary funds do a statement of cash flows, it's this GASB format. Now notice, in the GASB format, you've got cash flows from operating activities. So that's, cash revenues less cash expenses. That's pretty clear. That's cash flows from operating activities, cash revenues less cash expenses. And then there's cash flows from investing activity. So if you buy or sell investments, that makes sense. And notice interest, cash received for interest and dividends. Cash received for interest and dividends. I've got a question for you. Where would I find cash received for interest and dividends in a statement of cash flows under the FASB format? It would be on the income statement. It would be operating. Notice here it's investing. Got to notice the differences here. Cash received for interest and dividends. If this were the FASB format, it would be on the income statement. It would be operating. Here it's investing. And then what the GASB format does is divide financing activity into 2. There's cash flows from non-capital financing and cash flows from capital and related financing activities. Let's look at cash flows from non-capital financing activity. What goes in here? If you borrow or repay principal for purposes other than to acquire, construct, or improve capital assets, that's cash flows from non-capital financing activities. Notice cash interest paid. Why don't you highlight that? Cash interest paid. Where would I find cash interest paid? In a statement of cash flows in the FASB format, it would be on the income statement. It would be operating. Notice here it's financing. It's different, isn't it? And then finally, there's cash flows from capital and related financing activities. Notice the first one, buy or sell property, plant, and equipment. buy or sell property, plant, and equipment. Where would I find buy or sell property, plant, and equipment? In a statement of cash flows under the FASB format. It's investing. Here it's financing. Notice these differences. If you buy or sell PP&E, that's cash flows from investing activity. In the FASB format, here it's financing. And again, notice cash interest paid. That would be on the income statement, the operating activity. In the FASB format, here it's financing. Make sure you know these differences. Could the CPA exam have a simulation where they want you to do a statement of cash flows for a proprietary fund? Absolutely. Certainly they have multiple choice on this, and they could have a simulation where they want you to do a statement of cash flows for the proprietary funds. And when a proprietary fund does a statement of cash flows, and they're the only fund in governmental that does a statement of cash flows, they follow the GASB format. So you have 4 categories: cash flows from operating activity, cash flows from investing activity, cash flows from non-capital financing activities, and cash flows from capital and related financing activities. Be careful. All right, now the fiduciary funds. The fiduciary funds remember, we're still, in case you've lost track, we're still in part 2 of CAFR, the basic financial statements. The fiduciary funds have to do a statement of fiduciary net position, basically a balance sheet, but they have to do a statement of fiduciary net position and a statement of changes in fiduciary net position. And that's part 2. Again, the fiduciary funds, and remember, their statements would be done just like the proprietary funds under normal accrual accounting. The fiduciary fund statements would be done under normal accrual accounting, and they have to show a statement of fiduciary net position and a statement of changes in fiduciary net position. And that's part 2. Part 3 of CAFR would be notes to the financial statements. Here's where you would disclose, for example, how many employees have vested rights in the pension plan, something like that. So part 3 would be notes to the financial statements. Part 4 in CAFR would be your RSI, your required supplementary information. Now, what is your RSI? This is part 4, the required supplementary information, other than MD&A. It's your required supplementary information other than MD&A. Remember, management discussion and analysis is part of your RSI, but that's always preceding the financial statements. So now we're talking about your RSI other than management discussion and analysis. Well, you'd have to compare the original to the final budget in your required supplementary information other than MD&A. You're comparing the original to the final budget. You're disclosing fixed asset accounting methods. In other words, here's where you would disclose you're using the modified approach of depreciation for infrastructure, for example. You'd have to disclose now, this is where you're disclosing that you're using the modified approach of depreciation for infrastructure. Also, you would have a 10-year schedule for pension trust funds, things like that. Part 5 of CAFR would be combining statements for non-major funds and non-major components. Again, part 5 would be combining statements for non-major funds and non-major components. The point is, if there are non-major funds and non-major components, they can be aggregated and reported in a separate column. By the way, not just in the CAFR, but also in the fund financial statements, both. But if there are non-major funds, non-major components, they can be aggregated, reported in a separate column in the fund financial statements and also as part of the CAFR. Now, a couple of points. Internal service funds and fiduciary funds are exempt from this analysis. In other words, there's no such thing as a major and a non-major internal service fund. No such thing. No such thing as a major and a non-major fiduciary fund. They're exempt from this analysis. But I got into this because you have to know this. What is a major fund? Because now we're drawing a distinction between major funds and major components and non-major funds and non-major components. So what's a major fund? Well, the general fund is always major. General fund, you should know what a major fund is. The general fund is always major. Also, any fund is major whose assets, liabilities, revenues, expenditures are equal to or greater than 10% of the total of funds in the same category, either governmental or enterprise. Again, what's a major fund? General fund is always major. Also, any fund is major whose assets, liabilities, revenues, expenses are equal to or greater than 10% of the total for funds in the same category, either governmental or enterprise, and equal to or greater than 5% of the total for all funds. That's what a major fund is. And then also, one more point, the governmental unit, the primary government can deem any fund they want to be major. In other words, even regardless of the criteria, the primary government can say, we consider this special revenue fund to be major. They can just deem any fund they want to be major. But the point is, if there are non-major funds, non-major components, they can be aggregated and reported in a separate column in the government-wide statements and also in the fund financial statements. And then finally, Part 6 in CAFR would be all the individual fund statements and schedules for all the primary government's funds. Part 6 would be the individual fund statements and schedules for all the primary government funds. In other words, here's where you find all the detail. They could have 75 capital projects funds going. Now you find all those statements. They could have 15 special revenue funds going. So Part 6 are all the individual fund statements and schedules for all the primary government's funds. They've got 150 capital projects funds going. Here's where you find all the detail to your heart's content. Please do some more questions. I'd like you to do 24 to 34 and then come back. Welcome back. Let's do these questions together. In number 24, they say Marta City School District, we're talking about a component unit, is a legally separate entity. You know that's important. And 2 of its 7 board members are also city council members. Well, if it's 2 of 7, would you say that the governing body of this component unit is substantially the same as the governing body of the primary government? No. So you know that if it's a separate legal entity and the governing body of this component unit is not substantially the same as the governing body of the primary government, well, then it should be a discrete presentation, a separate column. In the government-wide statements, in the fund financial statements, it's a discrete presentation. Answer B. 25, Chase City uses an internal service fund for a central motor pool. The assets and liabilities account balances for this fund that are not eliminated normally would be reported in the government-wide statements as what? Well, we talked about this. Please don't miss this. Even though it's a proprietary fund, and you would think logically in the government-wide statements it would be business-type activities, no, in the government-wide statements, internal service fund is always governmental activities. Answer A, because it's one agency of the government servicing other agencies of the government, always governmental activities. Number 26, Dale Town's public school system, again, we're talking about a component unit, is administered by a separately elected Board of Education. By the way, that's not the same thing as the governing body. The Board of Education decides things like curriculum. That's not the governing body. The Board of Education is not organized as a separate legal entity, does not have the power to levy taxes or issue bonds, they never would. Dale's Town Council approves the budget, and they want to know how we handle this in the government-wide statements. Well, if it's not a legally separate entity, just blend it into governmental activities, and the answer is B. 27, Berry Township's eligible infrastructure assets are exempt from depreciation if the modified approach is used. That's true. Which of the following are requirements of the modified approach? How about 1, the entity performs condition assessments. Yes, at least every 3 years. That's a requirement. 2, the entity annually estimates the amount to preserve. Yet you have to disclose the amount to preserve, to maintain. Number 3, the entity assesses asset conditions in comparison to condition levels established by the National Association of Public Works Engineers or a comparable organization. That sounds like it ought to be true, but it's not. It's not a requirement. You know the requirements. They have to keep an up-to-date inventory of infrastructure, assess its condition at least every 3 years, and disclose the expenditures needed to maintain it. So just the first 2 are required. The answer is B. 28. Dogwood City's Water Enterprise Fund received interest of $10,000 on long-term investments. How would this amount be reported in a statement of cash flows? Now, you know an enterprise fund is a proprietary fund, and you know that the proprietary funds are the only funds in governmental that do a statement of cash flows. So where would I find this $10,000 of cash received for interest? I hope you remembered it's investing activities. Answer D. If it were the FASB format, it would be on the income statement, it would be operating. But in the GASB format, it's investing activities. You've got to remember those differences. Answer D. Number 29. Which of the following is a required financial statement for an investment trust fund? Well, an investment trust fund is a fiduciary fund, and you know that it's answer D. They have to do a statement of changes in fiduciary net position. So they have to do two statements, a statement of fiduciary net position and a statement of changes in fiduciary net position. 30, it is inappropriate to record depreciation expense in the government-wide statements related to the assets of which type of fund? How about enterprise fund? Well, of course, that's business type activities. Remember the government-wide statements? It would report the fixed assets with accumulated depreciation. General fund, special revenue fund, the governmental funds. And even though they're not allowed to carry fixed assets in the government-wide statements, those fixed assets would be reported with accumulated depreciation. So it's not B, C, or D. But A, agency fund cannot have fixed assets. It's impossible because an agency fund cannot have a fund balance or any kind of net asset position. An agency fund never has any assets, any liabilities, any revenues, any expenses, any net asset position of any kind, any fund balance of any kind. It's not possible. So an agency fund can't carry fixed assets, and that's why it's A. $31. They say during the current year, Knox County levied property taxes of $2 million. They expect 1% to be uncollectible. And they give you a lot of information. And they say, what amount of property tax revenue would Knox County report for their entity-wide statement of activities? Now, this, to me, is a very important question. And I want you to listen very carefully. I think this is a big trouble spot for a lot of candidates. When you're in that exam, listen to me. When you're in that exam, and they start talking about financial statements, always take a breath and go, wait a minute. Are we talking about the government-wide statements, which are normal accrual accounting, or the fund financial statements, which are modified accrual? Remember that big distinction. Anytime they start talking about statements, take a deep breath. Wait a minute. Are we talking about the government-wide statements, which are normal accrual accounting, or the fund financial statements, which are modified accrual? All right, now here they're talking about what amount of property tax revenue would Knox County report in their entity-wide statement of activities. Well, that's a government-wide statement. Let me show you the entry. And the government-wide statements are done under normal accrual accounting so that when they levy those real estate taxes, they're going to debit taxes receivable current for the $2 million. Since they expect 1% to be uncollectible, they're going to credit estimated uncollectible taxes for 1%, $20,000, and credit revenues control, $1,980,000. And the answer is C. They'll accrue all of it. And all that information about 60 days means nothing because the government-wide statements are normal accrual accounting. Remember, the fund financial statements are modified accrual, and you have to get into that whole 60-day thing. I hope you understood that distinction. Anytime they start talking about statements, wait a minute, is it the government-wide statements? That's normal accrual accounting. Or is it the fund financial statements, which are modified accrual? Be very careful. Hey, this is normal accrual accounting, so I'll just debit taxes receivable current for the full levy. For the full levy, $2 million. Credit estimated uncollectible taxes for 1%, $20,000, and credit revenues control for the $1,980,000. All that 60-day information doesn't mean anything. 32. March 1st, WAG City issued $1 million of 10-year 6% bonds at par with no bond issue costs. The bonds pay interest September 1 and March 1. What amount of interest expense and interest payable would WAG report in its government-wide statement, normal accrual accounting, at the close of fiscal year December 31? Well, what's the total interest expense? Well, take 6% of a million. That's $60,000 of interest for a full year, or $5,000 a month. I hope you're with me on that. If you take 6% of a million, that's $60,000 for a full year's interest, or $5,000 a month. All right, so what's their interest expense for the year? Well, at $5,000 a month, it would be March, April, May, June, July, August, September, October, November, December. 10 months times 5,000, $50,000. And what's interest payable? Well, it was paid on September 1, so what's payable would be all the interest accrued for September, October, November, December, 4 months at $5,000, $20,000. And the answer is A. There's an interest expense of $50,000, 10 months at $5,000 a month, and interest payable of $20,000, September, October, November, December times 5,000. 33. On January 2nd, the city of Walton issued $500,000 of 10-year 7% bonds. Interest is paid annually beginning January 2nd of the following year. One amount of interest expense is Walton required to report in its statement of revenues, expenditures, and changes in fund balance in its governmental funds at the close of its fiscal year, September 30th. Well, once again, I hope you're in the exam, take a breath. Gee, a statement of revenues, expenditures, and changes in fund balance. That's a fund financial statement. In the fund financial statements, they use modified accrual. And in modified accrual, we don't recognize interest or principal until it's mature, due, and payable. So the answer is A. Not until there's a payment date, which is next January 2nd. I hope you see the difference. This is a fund financial statement. So it's modified accrual. And in modified accrual, we don't recognize interest or principal until it's a payment date. They don't make accruals like a profit-making company. It's another major difference in modified accrual. So there'd be nothing accrued. And the answer is A. It's a very important distinction. Number 34. The following are BOA City's long-term assets. Fixed assets used in an enterprise fund, infrastructure assets, roads, bridges, sewer systems, and then all other general fixed assets. What aggregate amount would BOA report in the governmental activities column of the government-wide statements? What's governmental activities? Well, not the enterprise fund assets. That's business type. But the infrastructure assets, $9 million, and the other general fund fixed assets, other general fixed assets, $1.8 million. Those would be governmental activities, fixed assets. Answer C, the $9 million plus the $1.8 million. Now, you know that in GASB 34, we've got the government-wide statements under normal accrual accounting, but the fund financial statements are done under modified accrual. And you know what's inevitable. They want a reconciliation. GASB 34 requires two reconciliations, where you reconcile from modified accrual to accrual accounting. And you have to know how to do these. If you look in your viewer's guide, you'll see the first example. The first one that's required, you have to reconcile all your governmental fund balances to the net position in governmental activities, in the government-wide statement of net position. So again, in the first one, you have to reconcile all your governmental fund balances under modified accrual to the net position in governmental activities, in the government-wide statement of net position. All right, so if you look at this first example, notice all their governmental funds, all their governmental fund balance sheets. We're talking about general fund, special revenue fund, capital projects fund, permanent fund, debt service fund. All the governmental fund balance sheets are showing total fund balances of $24 million. And that's all done under modified accrual. There are three reconciling items, and we have to decide what would be the net position in governmental activities, in the government-wide statement of net position under normal accrual accounting. We know it's $22 million, but how do you get there? Well, we have three differences we have to think about. It's either plus or minus. How about the first one? Long-term debt issued for the capital projects fund. All right, just think it through with me. When the capital projects fund goes out and issues long-term debt, what's the entry? Wouldn't they have debited cash for that $13 million? They can't credit bonds payable, right? In modified accrual, they're not allowed to carry long-term debt, so they would have credited other financing sources, right? In modified accrual, that's how that would have been handled by the capital projects fund. They would have debited cash $13 million, credit other financing sources, $13 million. And then at year end, when you close out your actual revenue, your actual expenditures, your actual sources, your actual uses, right? At year end, when you closed out those actual sources, that would have caused an increase to the fund balance. But in the government-wide statements, that should not increase net position. It should increase the debt. So back it out. That's a subtraction. It's weird, isn't it? You're going from modified accrual to accrual. So let me just do that again. When the Capital Projects Fund issued that debt, they would have debited cash. They can't credit bonds payable. They would have credited other financing sources. And then at year end, when you close out your actual revenues, your actual expenditures, your actual sources, your actual uses, when you close out those actual sources, that would have caused an increase to the fund balance. But in the government-wide statements, that should not increase the net position. It should increase the debt. So back it out, subtract it. It's a little different way of thinking, isn't it? You're going from modified accrual to accrual. How about number two? Fixed assets acquired by the general fund. Well, think what happens. When the general fund bought fixed assets, they can't debit machinery. They can't debit equipment. They're not allowed to. Not allowed to carry fixed assets. So they would have debited expenditures control for the $9 million and credit vouchers payable. And then what happens at year end? When you close out your actual revenues, close out your actual expenditures, when you close out your actual expenditures, that would have caused a decrease to the fund balance in modified accrual. But in the government-wide statements, that should not lower the net position. It should increase fixed assets. So add it back. I'll do that again. General fund bought fixed assets. They can't debit machinery. They can't debit equipment. They would have debited expenditures control, credit vouchers payable. Then at year end, when you close out your actual revenues, close out your actual expenditures, that would have caused a decrease to the fund balance in modified accrual. But in the government-wide statements, that should not decrease the net position. It should increase fixed assets. Add it back. And let me just say that if that starts to drive, you go, Bob, this is just going to drive me crazy. You couldn't memorize it. In other words, debt is always subtracted. Fixed assets are always added. I mean, that's not bad. If you just go, Bob, I'm just getting frustrated. And I see your lips moving, but I just don't really understand it. Debt is always subtracted. Fixed assets are always added. And then the last one, internal service fund balance. That $2 million, is it already in the $24 million? No, it's not already in the $24 million because it's not a governmental fund. Remember, all that's in the $24 million at the top are the 5 governmental funds: general fund, special revenue fund, capital project fund, permanent fund, debt service fund. That's all that's in the $24 million, the 5 governmental funds. Remember, the internal service fund is a proprietary fund. It wouldn't be there. But in the government-wide statements, it's always governmental activity. So add it in. So that's how you get to the $22 million. Now, the other one that's required, the second reconciliation, you have to reconcile the net change in governmental fund balances to the net change in the net position for governmental activities in the government-wide statement of net position. So again, now you have to, in the second one, reconcile the net change in governmental fund balances under modified accrual to the net change in the governmental net position in the government-wide statement of net position. All right, so once again, at the top, you see that during the year, there was a net increase in all the fund balances of $12,500,000. That's modified accrual. And there are 6 reconciling items here. We have to reconcile to what was the increase or decrease in the net position in governmental activities in the government-wide statement of net position under normal accrual accounting. Once again, you're going from modified accrual to normal accrual accounting. In other words, the way I look at it, you're going from insanity to sanity. That's really what you're doing. Insanity back to sanity. You know, modified accrual is nuts. Let's agree on that. I mean, it is nuts. Yeah, we have to know it because we're taking the CPA exam. Well, you are. But you see my point. You've got to know it because you're taking the CPA exam, and that's all there is to it. But it doesn't. You know, modified accrual, it should be thrown in my opinion, in the trash heap of history. But we have to know it for the exam. All right, so let's reconcile. We know that during the year there was a net increase in all the fund balances under modified accrual of $12,500,000. Let's reconcile. How about the bond proceeds? Let's go over it again. When a governmental fund collected bond proceeds, they debited cash for that $3 million. They can't credit bonds payable because they're not allowed to carry long-term debt, so they would have credited other financing sources, right? And then at year end, when you close out your actual revenues, your actual expenditures, your actual sources, your actual uses. That's what happens. When they close out those actual sources, that would have caused an increase to the fund balance in modified accrual. But in the government-wide statements, that should not increase net position. It should increase the debt, so back it out. But like I say, you can memorize it too. Debt is always subtracted. How about number 2, the current repayment of bond principal? Now, we did look at the debt service fund in this class. Now, what happens in the debt service fund when they make a principal payment? Remember, in the debt service fund, they use modified accrual. So when they make a principal payment, don't they debit expenditures control and credit matured bonds payable? So what happens at year end? When you close out your actual revenues, your actual expenditures, when they close out those actual expenditures, that would have caused a decrease to the fund balance in modified accrual. But in the government-wide statement, it wouldn't cause a decrease to net position. It would decrease the debt instead. So add it back. One more time. In the debt service fund, in modified accrual, they make a principal payment. They would debit expenditures control and credit matured bonds payable. At year end, when you close out your actual revenue, your actual expenditures, that would have caused a decrease to fund balance. But in the government-wide statements, that should not decrease net position. It should decrease the debt. Add it back. How about the excess of revenue earned over available and measurable? What's at the top? What's in the $12,000,005? Available and measurable. It's modified accrual. But in the government-wide statements, it's normal accrual accounting. So if you earned more than available and measurable, then add it in. Add in the $600,000. Because again, what's at the top? Modified accrual is available and measurable. And if it turns out you earned more than what was available and measurable, add it in. How about the current fixed asset acquisition? Add it, right? You memorize it, just add it. But you understand the logic. If one of the governmental funds buys fixed assets, they debit expenditures control. They can't debit machinery, they can't debit equipment. They debit expenditures control, credit vouchers payable. Then at year end, when you close out your actual revenues, close out your actual expenditures, would have caused a decrease to the fund balance in modified accrual. But in the government-wide statements, that would not decrease net position, it would increase fixed assets. Add it back. Like I say, you can memorize it. Number 5, depreciation expense. Is that depreciation expense reflected at the top? No. In modified accrual, they don't carry fixed assets, they don't depreciate fixed assets. But in the government-wide statements, they use normal accrual accounting, the depreciation would be taken, back out $200,000. And then finally, the internal service fund net revenues. I hope you don't miss this one. Is that $800,000 at the top? No, it's not a governmental fund. Remember, all that's at the top are the governmental funds: general fund, special revenue fund, capital projects fund, permanent fund, debt service fund. But in the government-wide statements, internal service fund is governmental activities, so add it in. And that's how you get to the $11,850,000. You've got to know how to do these reconciliations. Now, this can also, of course, be tested in multiple choice. Try the last two multiple choice, 35 and 36, and then come back. Welcome back. Look at number 35. 35 says, Knox City reported a $25,000 net increase in all their fund balances for total governmental funds. Now that's done under modified accrual, right? They just looked at their 5 governmental fund balance sheets: general fund, special revenue fund, capital projects fund, permanent fund, debt service fund. They looked at all their governmental fund balance sheets, added up the fund balances, add up to $25,000 under modified accrual. We have 3 reconciling items, and they want to know what would be the net change in the net position for governmental activities in the government-wide statement of net position under normal accrual accounting. How about the first one, the motor pool internal service fund? You're never going to miss that, right? That $9,000 is not already in the $25,000 because it's not a governmental fund. It's a proprietary fund. But in the government-wide statements, it's always governmental activities. Add it in. How about the enterprise fund? No, that's business-type activities. Be careful of that trick. Remember, we're trying to work out to the net position in governmental activities in the government-wide statement of net position, right? We're trying to work out the net position in governmental activities in the government-wide statement of net position, not business-type activities. And the enterprise fund is business-type activities. Wouldn't worry about it. How about the employee pension fund? Well, that's a fiduciary fund, and the fiduciary funds, as you know, are always excluded from the government-wide statements. Don't worry about it. The answer is B. 36. Tree City reported a $1,500 net increase in all their fund balances for governmental funds. That's modified accrual. Again, all they did was look at their fund balance sheets for their 5 governmental funds: general fund, special revenue fund, capital projects fund, permanent fund, debt service fund, last year. They looked at the fund balances this year, and there's been a net change of $1,500 increase under modified accrual. And they want to know what would they report as the net change in the net position for governmental activities in the government-wide statement of net position. Well, how about the general capital assets of $9,000? Fixed assets are always added, right? You've memorized it now anyway, right? Debt is always subtracted. Fixed assets are always added. And how about the depreciation expense? Is the depreciation expense reflected already in the $1,500? No, because in modified accrual, they're not allowed to carry fixed assets. They're not allowed to depreciate fixed assets. But in the government-wide statements, depreciation would be taken. So back it out, and the answer is $7,500. It's the $1,500 plus $9,000 minus $3,000. Answer C. Let's do one more reconciliation. In your viewer's guide, there's a third reconciliation where you have to reconcile the net change in the governmental fund balances under modified accrual to the net change in the net position for governmental activities in the government-wide statement of net position. Now, if you look at this, during the year, there was a net increase in all the fund balances under modified accrual of $2,006,000. There are 9 reconciling items. All you have to decide is add or subtract and see if you can work out what was the net change in the net position for governmental activities in the government-wide statement of net position. I'd like you to shut the class down and get the answer. Welcome back. I know you did well on this. During the year, there was a net increase in all the fund balances under modified accrual of $2,006,000. Why don't we together reconcile to the net increase in net position for governmental activities in the government-wide statement of net position? Why don't we just do that? Because we know this so well now. How about the first one? Depreciation expense on governmental fixed assets. Well, of course, that's not reflected in the $2,006,000 because in modified accrual, you're forbidden to take depreciation. You're forbidden to carry fixed assets. But in the government-wide statements, it's normal accrual accounting. Take the depreciation, back out the $200,000. You would subtract. Same thing with the next item, amortization of a discount. We know in modified accrual, at the top, there's no amortization taken, ever, on bond discount or bond premium. But in the government-wide statements, it's normal accrual accounting. The amortization on the discount would be taken. Subtract that $50,000. The current general fund fixed asset acquisition. Well, you've memorized anyway. Fixed assets are always added. Bob, I like that. I like that. Don't have to think it through. Just add it. $800,000. Number 4, the internal service fund net revenues of $1 million. Is that $1 million already reflected at the top? No, it's not a governmental fund. But in the government-wide statements, internal service fund is always governmental activities. Add it in. How about the enterprise fund net revenues? You're not going to fall for that. That's business-type activities. That's business-type activities. We're trying to work out the net change in the net position for governmental activities. Enterprise fund is business-type activities. Don't worry about it. Not considered. How about number 6? Current bond proceeds for the capital projects fund. Well, you know debt is always subtracted. Back it out. How about current debt service repayment of principal? $100,000. Now, you getting used to this? What happens when the debt service fund pays principal? Debit expenditures control, credit matured bonds payable. Then at year end, when you close out the actual revenues, actual expenditures, when you close out those actual expenditures, that would cause a decrease to the fund balance in modified accrual. But in the government-wide statements, that should not decrease the net position. It should decrease the debt. So add it back. Add that back. How about number 8? Excess of revenue earned or available and measurable. Well, what's at the top, the $2,006,000, is modified accrual, available and measurable. But the government-wide statements are done under normal accrual accounting. So if they've earned more than what's available and measurable, add it in. Add that $75,000 in. And then the last one, number 9, fiduciary fund net revenues. Add or subtract neither. Ignore that because the fiduciary funds are just excluded, always excluded from the government-wide statements anyway. And the answer is $3,825,000. And that's the last problem we're going to do together. And I want to wish you a lot of luck in the exam from all of us at the Bisk CPA Review course. We want to wish you the best of luck on the exam. Keep studying.
Welcome to Bisk CPA Review, comprehensive review materials for the CPA exam to let you customize your own review programs to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you are going to master the exam content? Our unique learning management system ensures that you will master the material. And features such as exam preparation tips, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of a computer-based exam, including multiple choice, simulation, and written communication questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you will have the confidence and knowledge to pass it. Guaranteed.
Hello, and welcome to the Bisk CPA Review course and our coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette. I'll be your instructor for this class. In this class, we're going to be talking about international financial reporting standards, or IFRS. As I'm sure you know, IFRS is now tested in the CPA exam, and IFRS is really an enormous topic. So what we're here to discuss is the best way for a student to prepare themselves for IFRS questions in the exam. And my feeling about how to handle this is to concentrate on the major differences between U.S. generally accepted accounting principles and international financial reporting standards. You want to focus on the major differences between U.S. GAAP and IFRS, because I think that, for the most part, that's what the exam will focus in on. I think it's the best way to study this. And before we dive into the topic, let me just mention that it's important that you treat this like any other class. Take good notes, be an active participant. You know, later when we do problems and I assign some, it's important to shut the class down. Do the problems, get your answers before you come back and we discuss the problems together. You do those simple things, I think that you'll get much more out of this class, and that's what we both want. So make sure you handle it that way. Now, one major difference between U.S. GAAP and IFRS, theoretically, is that U.S. GAAP is considered more of a rules-based approach. It's a rules-based approach. U.S. GAAP sets down bright line rules that we have to follow, where IFRS, it is argued, is more of a principles-based approach. IFRS lays down general principles regarding recognition, measurement, reporting, general principles, and allows more judgment in applying the principles. So that's one major difference, that U.S. GAAP is a rules-based approach, bright line rules. IFRS, more of a principles-based approach and allows more judgment in applying the principles. I want to really get started by talking about the financial statements that are required under IFRS. Let's go over the financial statements. Under IFRS, a corporation is required to do a statement of financial position, what we generally call a balance sheet. But under IFRS, it's always called a statement of financial position. And we'll be saying more about differences in the statement of financial position as we move along. Under IFRS, a corporation has to do a statement of comprehensive income. As you'll begin to see, IFRS very much emphasizes comprehensive income. And we know what comprehensive income is. Comprehensive income is defined as anything that affects stockholders' equity. It's very broad. Anything that affects stockholders' equity, as long as it doesn't come from the owners, like issuing shares, or go to the owners, like a dividend. That's comprehensive income. And as I say, IFRS very much focuses on comprehensive income. So under IFRS, a corporation has to do a statement of comprehensive income. Now, you may remember that under U.S. GAAP, when we report total comprehensive income, we can use a one-statement approach. We can use a two-statement approach. And remember that what that difference means. If we do a one-statement approach, that means we're doing a combined statement of income and comprehensive income. We do our income statement the way we've always done it, and then after we report net income, after net income, we show the items of other comprehensive income. the items of OCI for the period, and then that lets us show a bottom line, total comprehensive income. That's the one statement approach, where you do a combined statement of income and comprehensive income. Or under US GAAP, you can use a two-statement approach, where under the two-statement approach, we have an income statement, the way we've always done it, and a separate statement of comprehensive income. And when we do a separate statement of comprehensive income, we start with the net income on our income statement. Remember, for most companies, that's the biggest part of comprehensive income. So anytime you do a separate statement of comprehensive income, you're going to start with the net income right off the income statement and then add all the items of OCI for the period, and that lets you report total comprehensive income. Well, I mention this because under IFRS, a corporation is required to have a statement of comprehensive income, and under IFRS, they will allow either the one-statement approach or the two-statement approach. Under IFRS, they do allow either the one-statement approach or the two-statement approach. Now, another thing I should mention, a couple of big differences. Since we're focusing on the differences between US GAAP and IFRS, I should mention that when you are doing your statement of income, the statement of comprehensive income, and as I say, they allow the one-statement approach or the two-statement approach. When you are doing your statement of comprehensive income, please remember under IFRS, they do not have extraordinary items. Keep that in mind. There's a major difference between IFRS and US GAAP, that on the statement of income, which would be part of your statement of comprehensive income, there are no extraordinary items. Under IFRS, you have net income from continuing operations, there's discontinued operations, but there are no extraordinary items in IFRS. Another little difference, or a major difference, depending on your point of view, under IFRS, they do not allow the completed contract approach of recognizing revenue for long-term contracts. The completed contract method is not allowed. So there are some major differences there. All right, number 3. Under IFRS, a corporation has to report a statement of changes in equity. A statement of changes in equity, where you have a statement showing the change in all stockholders' equity items. You show during the accounting period what was the change in common stock, the change in additional paid-in capital, the change in retained earnings, the change in accumulated OCI, accumulated other comprehensive income items. There are gains and losses, of course, that are not on the income statement. They go directly to stockholders' equity as an item of OCI. So in stockholders' equity, we have accumulated OCI, where these gains and losses that are not on the income statement accumulate. And so we show on our statement of changes in equity the change during the accounting period to accumulated other comprehensive income items. So you do that statement, and there must be, in that statement, there must be a column for comprehensive income. So in that statement, you'll show how net income is part of comprehensive income and goes to retained earnings. The items of OCI for the period would be considered part of comprehensive income and go to accumulated OCI. But that statement is required, showing a statement of changes in all equity accounts. And in that statement, you would also have a column for comprehensive income. So we know they have to do a statement of comprehensive income. They have to do a statement of changes in equity. Number 4, they have to do a statement of cash flows. Now, under IFRS, when a corporation does their statement of cash flows, they can use either the direct method or the indirect method. IFRS allows either the direct method or the indirect method. But a couple of small things I want to mention. Here's a difference in IFRS. When you do your statement of cash flows under IFRS, what do you do with interest received? Interest income, dividend income. Well, under US GAAP, interest income, dividend income is on the income statement. It's part of cash flows from operating activities. Well, under IFRS, interest income, dividend income can either be in operating activities or investing activities, either one, as long as it's done consistently. So let me say that again. U.S. GAAP, interest income, cash received for interest, cash received for dividends, that would be on the income statement. It would be an operating item. But under IFRS, interest income, dividend income, cash received for interest, cash received for dividends, will either be in operating or investing activities. Either one, they'll allow you to use either one, but it has to be applied consistently. Same thing with interest paid, dividends paid. Now, we know dividends paid is always under U.S. GAAP or IFRS, financing activities. We know dividends paid always under U.S. GAAP, financing activities. Well, under IFRS, the cash you pay for interest, the cash you pay for dividends can either be in operating or financing, either one, as long as you do it consistently. So little picky differences in IFRS. So the cash you pay for interest, the cash you pay for dividends can either be on operating or it can be in financing as long as it is done consistently. Another difference in the statement of cash flows under IFRS. You may remember that when we do a statement of cash flows under U.S. GAAP, we have to worry about those non-cash investing and financing activities. I know you remember those. Remember those non-cash investing and financing activities? Preferred stock converted to common stock. There's no effect on cash. It's a non-cash investing and financing activity. Bonds converted to stock. It's a non-cash investing and financing activity. If there's a straight exchange of debt for property, a company issues a note for an asset. What is that? It's a non-cash investing and financing activity and also a straight exchange of stock for property. A company issues stock for an asset. That is a non-cash investing and financing activity. Well, under U.S. GAAP, these non-cash investing and financing activities are a supplemental disclosure in the statement of cash flows. I know you remember that. The non-cash investing and financing activities are a supplemental disclosure in the statement of cash flows under U.S. GAAP. Under IFRS, they're not a supplemental disclosure in the statement of cash flows. They're in notes to the financial statements. Another picky difference. Under IFRS, the non-cash investing and financing activities are not a supplemental disclosure in the statement of cash flows. They would be disclosed in notes to the financial statements instead. All right, so we have a statement of financial position, a statement of comprehensive income, a statement of changes in equity, and a statement of cash flows. And then finally, number 5 would be notes to the financial statements. Another thing that I want to talk about, because the exam seems to emphasize this, and that is, what do we consider the date of transition to IFRS? When a corporation does make a transition to IFRS, they go from U.S. GAAP to IFRS. They transition. What is the date of transition? Well, it is a technical point, and I think the best way to bring it out is to go to a question. If you go in your viewer's guide, let's look at question number 1. Question number 1 says, on August 1st, year 2, Lex Company decided to adopt IFRS. So that's August 1, year 2. Lex is going to convert to IFRS. The company's first IFRS reporting period is for the year ended December 31st, year 2. Lex will present year 1 statements for comparative purposes. What is Lex's date of transition? It's a technical question. What is technically the date of transition? Well, here is the answer. The date of transition is the beginning of the earliest period. It's the beginning of the earliest period for which a company presents comparative information under IFRS. I'll say it again. Date of transition is the beginning of the earliest period for which the company presents comparative information under IFRS. So since they're going to present year 1 statements for comparative purposes, the date of transition to IFRS would be answer A, January 1st, year 1, the beginning of the earliest period. for which the company presents comparative information under IFRS. And in this case, that would be, since they're going to show year one for comparative purposes, it would be January 1, year one. That would be the date of transition, answer A. And this is something you want to remember. Under U.S. GAAP, there's no particular requirement regarding comparative information. Under U.S. GAAP, there is no particular requirement regarding comparative information. But under IFRS, a company is required to present the prior year statements for comparative purposes. Notice that. Under U.S. GAAP, no particular requirement regarding comparative information. But under IFRS, a company is required to present the prior year's financial statements for comparative purposes. So since they decided to transition to IFRS in year two, they'd be required to present year one statements for comparative purposes under IFRS. So the date of transition is the beginning of the earliest period for which they present comparative information under IFRS, and that would be answer A, January 1st, year one. Now another point. I'll use Lex Company as an example. When Lex Company transitions to IFRS, what are the financial statements that are required? Well, we know the date of transition is January 1st, year one. Lex would be required under IFRS to report 3 statements of financial position, 3 of them. One on the date of transition, January 1, year one. Another one dated December 31st, year one, the end of the first year, and a third statement dated December 31, year two. Let me say that again. When a corporation transitions to IFRS, as Lex is doing, they'd be required to report 3 statements of financial position. One on the date of transition. We know that's January 1st, year one. Another statement of financial position at the end of the first year, December 31, year one, and then a third statement dated December 31, year two. Lex would have to show 2 statements of comprehensive income. 2 statements of comprehensive income. One for year one, one for year two. 2 statements of changes in equity. 2 statements of changes in equity. One for year one, one for year two. And 2 statements of cash flows. One for year one, one for year two. Those are the statements that are required when you transition to IFRS. Let's look at question number 2. They say, how would a first-time adopter of IFRS recognize the adjustments required to present its opening IFRS statement of financial position? So we have a first-time adopter of IFRS. How do we recognize the adjustments required to present the opening IFRS statement, that very first one? In Lex's case, January 1st, year one. Well, the answer is D. Look at answer D. It says all of the adjustments would be recognized directly in retained earnings or, if appropriate, in another category of equity. The answer is D. And just to give you a quick example why both retained earnings and stockholders' equity is implicated here, if you're going to see later when we talk about intangibles, if you adopt IFRS and you elect to use the revaluation model for intangibles, you're going to revalue under the revaluation model for intangibles. You'll revalue the intangibles to fair value, and any gain or loss would go directly to retained earnings. But if you elect the revaluation model for property, plant, and equipment, you would adjust property, plant, and equipment to fair value, but the gain or loss would go directly to stockholders' equity as an item of OCI. So that's why they're both implicated. That's why the answer is D. Number 3, which of the following is the minimum reporting requirement for a company that is preparing its first IFRS financial statements? Date of transition. Do you have to go beyond A? You have to show 3 statements of financial position, right? 3 of them. One on the date of transition. Another one dated the end of the first year, and another one dated the end of the second year. 3 statements of financial position. You don't have to go beyond. Answer A. Number 4, which of the following statements is not required under IFRS? Not required. Well, notes to the financial statements are required. A statement of cash flows is required under IFRS. Answer D, a statement of comprehensive income, you know, is required. But answer C, there's no statement of retained earnings. Answer C, that's the answer. IFRS does not require a statement of retained earnings. They require a statement of changes in equity, all stockholders' equity accounts, and include in that statement comprehensive income as well. Number 5, in the year of transition to IFRS, which of the following is not one of the required statements of financial position? So if it is the year of transition, the date of transition, which of the following would not be one of the required statements of financial position? Well, just think about Lex. Would we have to do a statement of financial position January 1, year 1? The date of transition? Yes. December 31, year 1? Yes. December 31, year 2? Yes. But not answer B. There's no statement of financial position January 1st, year 2, right? No, it's a statement of financial position on the date of transition, January 1st, year 1, the end of the first year, the end of the second year. But there's no statement of financial position January 1st, year 2. How about statement of cash flows? There would be one for year 1, one for year 2. How about statement of changes in equity? One for year 1, one for year 2. How about statement of cash flows? One for year 1, one for year 2. Number 6, under IFRS, which of the following is not an allowed method of accounting for long-term contracts? You know it's completed contract. It's one of the differences in IFRS. IFRS does not allow the completed contract method. Under IFRS, you have to use the percentage of completion method to recognize revenue from a long-term project, or they'll let you recognize revenue as, equal to the costs that have been incurred up to a certain point. They'll let you do that. But basically, it's percentage of completion under IFRS. They don't allow completed contract, and you need to be aware of that. I want to get more into now the changes or the differences that you would see under IFRS in the statement of financial position. And I want to start with inventory. Let's start with inventory. Now, we know under U.S. GAAP, the primary basis of accounting for inventory is historical cost. We know that. Under U.S. GAAP, the primary basis of accounting for inventory, historical cost. Well, that's also true under IFRS. The primary basis of accounting for inventory is also historical cost. And what is historical cost? Well, under IFRS, just like U.S. GAAP, it would be all the costs you incurred to bring that inventory into a condition and location for sale. So things like purchasing costs, handling costs, warehousing costs, freight in, transportation in as part of the cost of merchandise, warehousing costs. All these costs would be capitalized to inventory. And that's true under IFRS as well as U.S. GAAP, because under both U.S. GAAP and IFRS, the primary basis of accounting for inventory is historical cost. But never forget that ultimately, whether it's U.S. GAAP or IFRS, inventory must be carried on a balance sheet at its original cost or its market value, whatever's lower. Under U.S. GAAP and IFRS, inventory must be accounted for using lower of cost of market. And how you apply lower of cost of market to inventory is different between U.S. GAAP and IFRS. So let's go to a problem, because I want to show you this. It's very important that you know the difference between applying lower of cost of market to inventory under U.S. GAAP and applying lower of cost of market to inventory under IFRS. I feel there's no question the exam will always emphasize this. So let's go to question number 7. Ames Company determined the following values for its inventory at December 31. Notice we know the historical cost, we know the replacement cost, the sales value, the cost to complete and sell, the normal profit margin, and also the fair value. They ask under IFRS, what amount would Ames report for inventory at December 31? Well, before we do IFRS, let me refresh your memory on U.S. GAAP. How would U.S. GAAP solve this problem? I know this will certainly ring a bell, even if you haven't thought about it in a while, but if you've prepared a little bit on inventory, you know it's a little complicated. Under U.S. GAAP, if you're going to apply lower of cost of market to inventory, the first thing you have to work out is the ceiling, because there's an absolute ceiling, and market can't be above the ceiling. The ceiling is called net realizable value. So how do we define net realizable value? Let's figure that out. The net realizable value would be the selling price, $190,000, the sales value, minus the normal cost to complete and sell, minus the normal disposal cost, $10,000. So the ceiling net realizable value would be $180,000. I hope you see how I got that. That's simply defined as the selling price, $190,000, minus all the cost to complete and sell, all the disposal costs of $10,000. So net realizable value would be $180,000. Market can never be higher than that. Then you have to figure out the floor. The floor is defined as that ceiling, net realizable value, $180,000, minus a normal gross profit on sale. So we're going to back out the gross profit on sale, $8,000. That's the normal gross profit on sale. So the floor would be $172,000. And what I mean by floor is we know market can never be below that amount. It's an absolute floor. And there's no fancy name for it. It's just called the floor, the bottom. But market can't be below that. All right, so first we calculate the ceiling, net realizable value, that is $180,000. Then we get the floor, that's $172,000. Now our next step, what is market? Well, we look at three numbers. Remember, to figure out market, you've got to look at three numbers. Look at replacement cost, $160,000. The ceiling, net realizable value, $180,000. And the floor, $172,000. You look at those three numbers. Look at replacement cost, $160,000. The ceiling, net realizable value, $180,000. And the floor, $172,000. Whatever number's in the middle is your market. Under U.S. GAAP, you look at those three numbers, and whatever number's in the middle is your market. The middle number here is $172,000, the floor. That's your market. All right, then your last step is to say, all right, it's the lower of cost, $200,000, or market, which I now know is $172,000. I'll use $172,000. Notice that's answer C. If this were U.S. GAAP, the answer would be C, $172,000. The lower of cost, which is historical cost, is $200,000. Market I now know is $172. Because it's lower, I use market. In other words, I'd have to write the inventory down to $172,000. What's the entry? What's the entry? My job here is to write the inventory down from its cost, $200,000, down to market, which I now know is $172,000. So I would debit loss, inventory loss, $28,000, and take that loss to my income statement. And I would credit inventory, $28,000. I would literally write my inventory down from $200,000 down to $172 because market is lower. What if it recovers? What if it recovers? It's not recorded, right? It's important. In U.S. GAAP, a recovery would not be recorded. Now let's apply IFRS. Here we go. If you apply lower of cost of market to inventory under IFRS, NRV, the net realizable value, is defined exactly the same way. You take the selling price, $190,000, minus the normal disposal cost. Back out the normal cost to complete and sell, $10,000. Notice net realizable value is also $180,000. It's defined exactly the same way. And under IFRS, inventory is carried on the balance sheet at the lower of cost or NRV. It's actually easier. You don't have to worry about the floor and replacement cost. No, under IFRS, inventory is carried on a balance sheet at the lower of cost or net realizable value. So take the cost, $200,000. Market is $180,000, NRV. I'll use $180,000 because it's lower. So what's my entry? You know, I'm going to debit inventory loss, $20,000. That loss is going to go to my income statement, and I'm going to credit inventory, $20,000. I write my inventory down from $200,000 down to $180. So that's why the answer is B. The answer to number 7 is B, because it's IFRS. What if it recovers? I know I keep asking that. Let's say the next year they say inventory is recovered by $16,000. Listen carefully. Another major difference in IFRS. IFRS would record a recovery. U.S. GAAP would not. Under IFRS, if they said that the following year inventory is recovered in value by $16,000, I would debit inventory $16,000. Debit inventory $16,000. Write it up and credit income $16,000. I'd have $16,000 of income go to my income statement if it recovers, because IFRS records recoveries in market. U.S. GAAP does not. It's another major difference. Let's look at number 8. Number 8 says, a company determined the following values for its inventory at the end of the fiscal year. We know the historical cost. We know the replacement cost. We know the NRV. It's given to us. We know the NRV less the normal profit margin. That's the floor under U.S. GAAP. And we know the fair value. Then they say, oh, under IFRS. We're not under U.S. GAAP here. We're under IFRS. Under IFRS, what amount would the company report for inventory on the balance sheet? Well, IFRS is actually a little easier than U.S. GAAP. Under IFRS, it's the lower of cost, which is $100,000, or market, which is NRV, 90. I'll use 90. It's lower. And the answer is C. You got to love IFRS in this sense. It's the lower of cost or net realizable value. Under IFRS, net realizable value is always market. And then remember, IFRS does record a recovery in market, where U.S. GAAP would not. Number 9, which of the following is a true statement regarding the accounting and reporting requirements related to inventory for both IFRS and U.S. GAAP? So what's true of both? Accounting for inventory. What's true about accounting for inventory under both IFRS and U.S. GAAP? A says both IFRS and U.S. GAAP are based on the principle that the primary basis of accounting for inventory is fair value. No, the primary basis is historical cost under both, not fair value. B, under both IFRS and U.S. GAAP, the cost of inventory includes all the direct expenditures to ready the inventory for sale, including selling expenses? No, not selling. IFRS and U.S. GAAP wouldn't include selling expenses in the cost of inventory. C says under both IFRS and U.S. GAAP, inventory is carried at the lower of cost, market, and any write-downs of inventory to create a new cost basis that subsequently cannot be reversed. Now, it could be reversed under IFRS, but not under U.S. GAAP, so that's not true of both. But answer D is a true statement. Under IFRS, LIFO is prohibited. That, you can't argue with that. That's another thing you need to know, that under IFRS, there is no last in, first out. You know, under IFRS, you can use first in, first out, weighted average, the retail method, but you can't use LIFO, not in IFRS. As you know, when we're talking about intangible assets, we're talking about copyrights and patents, trademarks, goodwill, secret formulas, leasehold improvements, franchises. These are your basic intangibles. Now, in terms of accounting for intangibles, there are a couple of issues. First of all, let's talk about U.S. GAAP. If we're talking about U.S. GAAP, what costs would we capitalize for a copyright, a patent, a trademark? Well, remember, in U.S. GAAP, we look for three things. We capitalize purchase price. So if I purchase your trademark for $1 million, I capitalize the million. You do capitalize purchase price. Also, number 2, you would capitalize legal and other fees to register the copyright, the patent, the trademark, whatever it is. And then never forget number 3, you would also, in U.S. GAAP, capitalize legal fees in successful defense of a copyright, a patent, a trademark. Though these are the costs we capitalize to intangible accounts. Well, IFRS is no different in this regard. IFRS would capitalize purchase price, legal and other fees to register the copyright, the patent, the trademark, and legal fees in successful defense of a copyright, a patent, a trademark, or whatever it might be. So U.S. GAAP, IFRS are the same in that regard. Now, in terms of how we account for an intangible after acquisition, there is a difference, starting with U.S. GAAP. Remember, U.S. GAAP divides intangibles into 2 broad categories. First, there are intangibles with a finite useful life, like a patent, like a leasehold improvement. And under U.S. GAAP, if you have an intangible with a finite useful life, you amortize that intangible over your best estimate of its useful life. That's U.S. GAAP. You have an intangible with a finite useful life, a copyright, a patent, a leasehold improvement. You'd amortize that intangible over your best estimate of its useful life. Now, there are also intangibles that have an indefinite useful life. Goodwill is the big one. Goodwill, a trademark in most cases. There are intangibles with an indefinite useful life. And under U.S. GAAP, if a company has an intangible with an indefinite useful life, it's not amortized. It's not amortized. It's tested for impairment at least annually. And what if it recovers? Remember, if there's been an impairment loss and it recovers, U.S. GAAP would not record a recovery in market. Now let's talk about IFRS. Now under IFRS, with intangibles, you have a choice. With intangibles, you can either use what is called the cost model or the revaluation model. Under IFRS, for intangibles, there's a choice. The company can either use the cost model or the revaluation model. Now, the cost model is very similar to U.S. GAAP. Under the cost model, you would divide intangibles into two categories. If it's an intangible with a finite useful life, you'd amortize that intangible over the best estimate of its useful life. If it's an intangible with an indefinite useful life, you wouldn't amortize it. You test it for impairment at least annually. And if you write an intangible down because there's been an impairment loss and it recovers, remember, IFRS would record a recovery in market. But listen to me carefully, not goodwill. Both U.S. GAAP and IFRS, if they've written goodwill down to market because of an impairment loss and goodwill recovers, both U.S. GAAP and IFRS will not record a recovery in market for goodwill. There, U.S. GAAP and IFRS agree. But under IFRS, for intangibles, you can choose, again, what is called the cost model. Or, for intangibles, you can use what is called the revaluation model. Now, in the revaluation model, it can only be used if the intangible has an active market. You can only use the revaluation model if it is an intangible with an active market. But under the revaluation model, it doesn't matter whether the intangible has a finite or an indefinite life. Again, under the revaluation model, it does not matter whether the intangible has a finite or an indefinite life. The intangible would, first of all, be recorded at the cost of acquisition, the purchase price plus legal and other fees to register, plus legal fees and successful defense. So you'd start by recording the intangible at its cost, and then periodically you would revalue the intangible to its fair value. The gains and losses would go to the income statement. That's the revaluation model, whether it's an intangible with a finite useful life or an indefinite useful life. Periodically, you would adjust the intangible to its fair value, and the gains and losses would go to the income statement. That is the revaluation model. So just remember, under IFRS, you make a choice with intangibles, either the cost model, which is very similar to U.S. GAAP, or the revaluation model. Let's do a couple of questions. Number 10. Number 10 says, under IFRS, an entity that acquires an intangible asset may use the revaluation model for a subsequent measurement only. You can only use the revaluation model only if what? Answer B, there's an active market. Has to be an active market for that intangible. Number 11. Number 11, an entity purchases a trademark. Following costs are connected with the purchase of the trademark according to IFRS, and applying IFRS and assuming that the trademark meets all of the initial asset recognition criteria, at what amount would you capitalize the trademark? Well, remember, in this regard, in terms of what you capitalize for an intangible, U.S. GAAP and IFRS are really the same. We're going to pick up the purchase price. That one-time purchase price of $100,000. Under U.S. GAAP and IFRS, you would pick that up. The VAT taxes, the value-added taxes, pick that up. The purchase price, the cost of acquisition. So you're going to pick up that 105. The training sales personnel to use the trademark, that's expensed. Research, expensed. Legal fees to register, pick that up. That's capitalized, that $10,500. Salaries of administrative personnel would be expensed. So what you capitalize for the trademark under IFRS and US GAAP would be 100 plus 5 plus 10.5. Answer B. In that regard, US GAAP and IFRS are identical in terms of what you capitalize for a copyright, a patent, a trademark, whatever it might be. Let's talk about investments for a minute. Now, first of all, you know, under US GAAP, there are three categories of investments. First, there's held-to-maturity securities. Under US GAAP, held-to-maturity securities are accounted for under amortized cost. Then there are trading securities. Trading securities are accounted for at fair value. Right? With trading securities, under US GAAP, we write them up to fair value, down to fair value, and the unrealized holding gains and losses go to the income statement. They're included in earnings. Then there are available-for-sale securities. Available-for-sale securities are accounted for at fair value. Periodically, at year end, we would adjust the available-for-sale securities to their fair value, but the gain or loss would not go to the income statement. It would go directly to stockholders' equity as an item of OCI, an item of other comprehensive income. That's US GAAP. Now, under IFRS, for held-to-maturity securities, you have a choice. Under IFRS, you can either, for held-to-maturity securities, use amortized cost, just like US GAAP. You can either use amortized cost or fair value. It's what they call fair value through profit and loss, FVTPL, fair value through profit and loss. In other words, that means adjust the held-to-maturity to fair value, gains and losses go to the income statement. They go through profit and loss. Just remember, it's called FVTPL, fair value through profit and loss. So, one more time, under IFRS, for held-to-maturity securities, you make a choice. You can either account for held-to-maturity securities under amortized cost, just like US GAAP, or FVTPL, fair value through profit and loss. For trading securities, it's identical to US GAAP. Both US GAAP and IFRS account for trading securities using what? FVTPL, fair value through profit and loss. Trading securities are adjusted to fair value. Gains and losses go to the income statement under US GAAP and IFRS. And then finally, available-for-sale securities. Under IFRS, you make an election. You can either use the US GAAP approach, where available-for-sale securities are adjusted to fair value. Gains and losses go to OCI, just like US GAAP, or you can make a choice under IFRS to account for available-for-sale securities using FVTPL, fair value through profit and loss. Let me say that again. For available-for-sale securities, you make an election under IFRS. You can either use the US GAAP approach, meaning available-for-sale securities would be adjusted to fair value, gains and losses go to OCI. Or you can elect under IFRS to account for available-for-sale securities using FVTPL, fair value to profit and loss. Just like trading, just like held-to-maturity, if you elect to use it for held-to-maturity, you would adjust available-for-sale securities to their fair value. Gains and losses would go to the income statement. Now what I want to get into is one of the most important areas in terms of IFRS and how it's different from US GAAP. And what I'm talking about is the area of fixed assets. There are some significant differences in IFRS regarding how to account for fixed assets compared with US GAAP. First of all, under IFRS, there are three categories of fixed assets. First category, property, plant, and equipment. It's a category we're very familiar with. Property, plant, and equipment, it's the same as US GAAP in terms of what would be included under that heading. But IFRS has a couple of other classifications of fixed assets, which U.S. GAAP does not have. IFRS has investment property. Investment property is property held to earn rental income or capital appreciation or both. Again, under IFRS, there's another category of fixed assets called investment property. Investment property is property held to earn rental income or capital appreciation or both. And then under IFRS, there's also biological assets. Plants, animals. Under IFRS, biological assets are disclosed separately. This is assuming they have future economic benefits. I mean, we are assuming these are plants or animals that have future economic benefits. But in IFRS, biological assets are separately disclosed. It's a separate category of fixed assets. All right, now, how do we account for fixed assets under IFRS? Well, let's start with biological assets. With biological assets, under IFRS, you make an election. You can either elect to use the cost model. Now, the cost model means that the biological assets would be on the balance sheet at their original cost minus any accumulated depreciation, minus any impairment loss. I'll say it again. If you elect to use the cost model for biological assets, those biological assets will be on the balance sheet at their original cost minus accumulated depreciation, minus any impairment loss. What if it recovers? What if there's been an impairment loss and it recovers in value? It would be recorded. Generally, IFRS would record a recovery in market, except for what? Goodwill, right? Except for goodwill, just like U.S. GAAP would not record it. There they agree. But generally, IFRS records a recovery in value. All right, so for biological assets, if a company elects to use the cost model, those assets will be on the balance sheet at their original cost minus accumulated depreciation, minus any impairment loss. And again, if it does recover, it would be recorded. Or, for biological assets, you can elect to use the fair value model. Now, to use the fair value model, again, there has to be a ready market for these biological assets. And under the fair value model, periodically you would adjust the biological assets to their fair value. Gains and losses would go to the income statement. In other words, it's FVTPL. You can elect for biological assets to use FVTPL, fair value through profit and loss. Periodically adjust the biological assets to their fair value. Gains and losses go to the income statement. And listen, no depreciation is taken. No depreciation is taken in the fair value model. Let's talk about investment property. For investment property, you make an election. You could elect for investment property to use the cost model. And if you elect to use the cost model, the investment property will be on the balance sheet, at its original cost, minus accumulated depreciation, minus impairment loss. That's the cost model. So if a company elects to use the cost model under IFRS for investment property, that investment property will be on the balance sheet at its original cost, minus accumulated depreciation, minus any impairment loss. What if it recovers? Recoveries are recorded under IFRS, except for goodwill. You wouldn't record a recovery in market of goodwill. Now, also for investment property, you can elect to use the fair value model, just like biological assets. For investment property, you can elect to use the fair value model, and now you're getting used to it. It's really FVTPL, fair value through profit and loss, where periodically you would adjust the investment property to its fair value, gains and losses go to the income statement, and no depreciation is taken. FVTPL. So you can elect to use the fair value model. Now let's talk about property, plant, and equipment. Now for property, plant, and equipment, you have to decide for each class of property, plant, and equipment. In other words, for each class, whether it's land, that's a class, equipment, furniture and fixtures, ships. For every class of property, plant, and equipment, you make an election. For each class, the entire class, you make an election. You can either use the cost model or the revaluation model. Again, for every class of property, plant, and equipment, whether it's land, that's a separate class. Furniture and fixtures, it's a separate class. Equipment, separate class. For each class, you make an election. You can either use the cost model or the revaluation model. Now, the cost model would mean that that asset would be on the balance sheet at its original cost minus any accumulated depreciation minus any impairment loss. And if it recovers, it would be recorded. That's the cost model, again and again, right? So for property, plant, and equipment, for each class, you decide if you want to use the cost model, that asset will be on the balance sheet at its original cost minus accumulated depreciation minus any impairment loss. And if it recovers, it would be recorded. Or you can elect, for property, plant, and equipment, each class, you can use the revaluation model. Now, under the revaluation model, periodically, you would adjust the asset to its fair value. So now the asset would be on the balance sheet at its fair value minus subsequent depreciation. In other words, now depreciation would be taken based on that new value. In the revaluation model, periodically, you would, and there's no guidance how often you would revalue. It just has to be with sufficient regularity. But it doesn't have to be every year. There's really no guidance on how often you have to revalue. But it has to be of sufficient regularity. But periodically, you would adjust the asset to its fair value, subtract subsequent depreciation, and any impairment loss. And if it recovers, it would be recorded. Now, one thing I want to mention, that when you apply the revaluation model to property, plant, and equipment, and let's say I've decided to use the revaluation model for equipment, that whole class, okay? So a company's elected to use the revaluation model for a whole class of property, plant, and equipment called, equipment. That means periodically we're going to adjust it to fair value. Let's say the fair value's gone up for the equipment. That means I would debit equipment, I'd write it up to fair value, and I credit, listen, revaluation surplus. It's very important that you understand this entry. If you're going to use the revaluation model on a class of assets like equipment, periodically I adjust it to fair value. Let's say fair value's gone up. I would debit equipment, and I would credit what is called revaluation surplus. And that revaluation surplus, that goes to OCI. That's an element of other comprehensive income down in stockholders' equity. And then what happens when I dispose of the asset, that gain that I put in revaluation surplus would be transferred to retained earnings. So let me go over that one more time. If I elect to use the revaluation model for a whole class of property, plant, and equipment, like equipment, and at year end, I'm revaluing, the equipment's gone up in value, I would debit equipment, write it up to fair value, and I credit an account called revaluation surplus. You might see that account name in the exam. And that revaluation surplus goes directly to stockholders' equity as an item of OCI. And then, in the future, when I dispose of the asset, that revaluation surplus gets transferred to retained earnings, ultimately. Try some questions on this. Please do 12 to 19, and then come back. Welcome back. Let's look at these questions together. In number 12, they ask, under IFRS, which of the following is not a class of long-lived assets? Well, you know that biological assets, investment property, C and D, are long-lived assets. Financial assets can be long-lived. Intangible assets can be long-lived. Equity investments are long-term investments. And by the way, when you talk about equity investments, I meant to mention that IFRS and US GAAP are really the same with equity investments. If a company has significant influence over another company, they can either use the equity method or FVTPL, fair value through profit and loss. That's true under US GAAP and IFRS, either the equity method or fair value through profit and loss. But anyway, equity investments, long-lived. But it's got to be inventory is always a current asset. Number 13, which of the following is not a true statement? Not a true statement regarding the accounting and reporting requirements related to property, plant, and equipment under both IFRS and US GAAP. A says both IFRS and US GAAP require a provision for asset retirement costs to be recorded when there's a legal obligation. No, that's a true statement. They both require that if there's a legal obligation to do so. B says Changes in depreciation method, residual value, salvage value, useful life, are treated as a change in accounting estimate requiring prospective treatment under U.S. GAAP, retrospective application under IFRS. That's false. That's not true. Under both U.S. GAAP and IFRS, a change in salvage value, residual value, estimated life, change in depreciation method, these are changes in estimate, prospective approach under U.S. GAAP and IFRS. So answer B is false and not true. 14, under IFRS, which of the following is not an acceptable method of accounting for inventory? Well, LIFO is not acceptable under IFRS. Gross profit method's okay, the retail method's okay, weighted average is okay, but LIFO is not accepted in IFRS. Number 15 is about Murray Company. And it says Murray Company maintains its accounting records under IFRS. During the year, Murray sold a machine that had been accounted for using the revaluation model. So they're selling off a machine that's been accounted for under that revaluation model. The sales price, $150,000. The machine's book value on the date of sale, $80,000. And notice down in stockholders' equity, OCI, there's that revaluation surplus of $9,000. Remember we talked about that. That if you elect to use the revaluation model for property, plant, and equipment, when you revalue property, plant, or equipment to its fair value, if it's gone up in value, you debit the asset and credit revaluation surplus. And that revaluation surplus is down in stockholders' equity. It's part of OCI. Which of the following is correct regarding the sale? Well, how do we handle the sale? Well, when you now sell off the asset, first thing you do is debit that revaluation surplus, $9,000, and credit retained earnings, $9,000. I mentioned that earlier, that revaluation surplus gets transferred to retained earnings when you dispose of the asset. So on the date of sale, they would debit revaluation surplus, $9,000. Credit retained earnings, $9,000, and then handle the sale as you always would. Debit cash, $150,000, credit the asset for its carrying value, $80,000, and credit gain on sale, $70,000. You make those two entries. First, debit revaluation surplus, credit retained earnings, and then just handle the sale in the normal way. Debit cash, $150,000, credit the asset for its carrying value, $80,000, and then you credit gain on sale, $70,000. So with those entries in mind, the answer is C. The gain of $70,000 would go to profit and loss, and the $9,000 revaluation surplus does get transferred to retained earnings. Number 16, on January 1, Pax Company acquired for $18,000 a new piece of equipment with an estimated useful life of 10 years. The equipment requires the addition of a custom-made component costing $3,000. It has to be replaced every 4 years. Pax uses straight line. Under IFRS, what was the depreciation expense for the year ended December 31? Well, it's a good question for us to do because here's another little picky difference in IFRS. Under IFRS, if different components of a fixed asset have different periods of benefit, under IFRS, if different components of a fixed asset have different periods of benefits, under IFRS you are required to depreciate them separately. So under IFRS, what we would do is take the $18,000 equipment over its useful life, straight line, divide by 10 straight line years, that would be $1,800 of depreciation every year. But we'd separately depreciate the component that has a different period of benefit. We would take the $3,000 component, the component has to be replaced every 4 years. Divide by 4 straight line years, we would take $750 depreciation on the component. So the depreciation for the year would be $1,800 plus $750, answer D, $2,550. You see why? Because under IFRS, different components of a fixed asset that have different periods of benefit are required to be depreciated separately. So I took that $3,000 component with only a useful life of 4 years. I divide by 4 straight line years. I take $750 depreciation on the component, $1,800 of depreciation on the machine, Total depreciation is 1,800 plus 750, 2,550. Now, under GAAP, you can actually go either way. GAAP would let you depreciate the components separately, or under GAAP, you could instead just take the 21,000 over 10 years and pick answer C. Again, GAAP you can go either way. GAAP, you could depreciate the components separately, or you could just take the 21,000 over 10 straight line years and go for answer C. GAAP would allow C or D, but under IFRS, it has to be D, because you are required to depreciate different components with different periods of benefit separately. Number 17. Under IFRS, which of the following is false concerning the accounting for long-lived assets? A says property, plant, and equipment are accounted for under either the cost model or the revaluation model. Well, that's a true statement. We want to know which one is false. B, reversal of impairment losses is recorded with a gain going to the income statement. That's a true statement under IFRS. D, the revaluation surplus account is transferred to retained earnings when PP&E is sold. That's true. We're looking for the false statement, and C is false. C says, under the revaluation model, property, plant, and equipment is adjusted to fair value with any gain or loss going to the income statement. No, it's adjusted to fair value. The gain or loss goes to OCI, that revaluation surplus account. So we were looking for the false statement, and C is false. 18. An entity elects to use the revaluation model under IFRS. Which of the following items correctly reflects how assets would be adjusted and where the gain or loss would be reported? Well, asset basis, under the revaluation model, the asset basis is adjusted to fair value. And the gain or loss eventually ends up in retained earnings. Answer B, remember, it initially goes to revaluation surplus in OCI, but when you dispose of the asset, we transfer the amount in revaluation surplus. That amount in OCI goes to retained earnings. So eventually, it does go to retained earnings. 19. Under IFRS, when an entity chooses the revaluation model as an accounting policy for measuring property, plant, and equipment, which of the following is correct? How about A? When an asset is revalued, the entire class of property, plant, and equipment to which the asset belongs must be revalued. That is a true statement. Remember, when you choose the revaluation model, it's applied to an entire class, equipment or land, an entire class. That's a true statement. If you had our class on leases, you know that a lessee has a capital lease if any one of four criteria are met. And the memory tool that I gave you in our class on leases was 2 BOP 7590. That helps you remember the criteria. Remember TO if there's a transfer of ownership. BOP if there's a bargain purchase option. 75 if the term of the lease is equal to or greater than 75% of the remaining life of the asset. Or 90 if the present value of the lease payments are equal to or greater than 90% of the fair value of the asset. That's the criteria. Any one of those four criteria are met. If during the lease there's a transfer of ownership, if during the lease there's a bargain purchase option, the lessee has the option to purchase the asset at a bargain price, or if the term of the lease is equal to or greater than 75% of the remaining life of the asset, or if the present value of the lease payments are equal to or greater than 90% of the fair value of the asset. Any one of those criteria met, in U.S. GAAP, the lessee has a capital lease. Well, under IFRS, it's a little different. And as we said at the beginning of this class, perhaps the most significant difference between IFRS and U.S. GAAP is that U.S. GAAP, it is argued, is a rules-based approach. U.S. GAAP lays down bright line rules, 2 BOP 7590 that you have to follow, where IFRS is more of a principles-based approach. IFRS generally lays down principles regarding reporting and measurement and allows more judgment in applying the general principles. And it's really illustrated with leases, because here's the criteria under IFRS. Under IFRS, the lessee has a capital lease. And by the way, under IFRS, a capital lease is called a finance lease. You should be aware of that. Under IFRS, they call a capital lease a finance lease. And under IFRS, the lessee has a finance lease if it meets any of this criteria, any of it. First, if there's a transfer of ownership. If during a lease, the ownership of the asset transfers from the lessee from the lessor to the lessee. You always look for that. Hey, is there a transfer of ownership? During a lease, if the ownership of the asset transfers from the lessor to the lessee, if there's a transfer of ownership, it's a finance lease. Or if there's a bargain purchase option, during a lease, the lessee has the option to purchase the asset at a bargain price. Is there a BOP? Is there a bargain purchase option? It's a finance lease. Or if the term of the lease is a major part of the economic life of the asset. Notice, not equal to or greater than 75%. No, if the term of the lease is a major part of the economic life of the asset. In other words, under IFRS, arguably 65% is enough, because you have to use judgment. It's not a bright line rule. But if the term of the lease is a major part of the economic life of the asset, it's a finance lease. Or if the present value of the lease payments are equal to substantially all of the fair value of the asset. Notice, not equal to or greater than 90%. No, you have to use more judgment here, because if the present value of the lease payments are equal to substantially all of the fair value of the asset. In other words, arguably, 85%, 82%, it's enough. You got to use judgment. Or if the asset is of a specialized nature, if the asset is of a specialized nature and only the lessee can use the asset without substantial modification, it's a finance lease. Again, if the asset is of such a specialized nature that only the lessee can use the asset without substantial modification, it's a finance lease. Or if the lessee were to cancel the lease, the lessor's losses would be borne by the lessee. It's a finance lease. Again, if the lessee were to cancel the lease and the lessor's losses would be borne by the lessee, it's a finance lease. Or if any gains or losses on the asset accrue to the lessee, if any gains or losses on the asset accrue to the lessee, it's a finance lease. And one more. If the lessee has the option to continue the lease at a lower than market value rent, it's a finance lease. See, there's a lot more judgment involved. Again, that last one, if the lessee has an option to continue the lease at a lower than market value rent, it's a finance lease. So what you're seeing in all that criteria, even though it's a lot more extensive, is that IFRS allows more judgment. It's not so much bright line rules. It's more of a principles-based approach. Now, in the area of pensions, here again, if you had our class on pensions, you may remember that there are 6 elements that make up the pension expense in U.S. GAAP if a company has a defined benefit pension plan. If a company has a defined benefit pension plan, there are 6 elements that make up the pension expense for the year. And the memory tool that I gave you in that class was SIRPAT, S-I-R-P-A-T. The S, service cost, always a plus. I, interest on PBO, interest on projected benefit obligation, always a plus. R, return on plan assets, that's a minus. That lowers the expense, it's good for the company. P is prior service cost amortization, it's a plus. A is actuarial gain or loss. If it's an actuarial gain, it's a minus, it's good for the company, lowers the expense. Actuarial loss is bad for the company, increases the expense. And then T, transition asset, transition obligation. Transition asset's good for the company, lowers the expense, it's a minus. Transition obligation is a plus, it increases the expense. So that's the memory tool that I gave you in our class on pensions. Well, under IFRS, it's very similar. Under IFRS, the memory tool for the 6 elements that make up the pension expense in a defined benefit plan would be SIRPAS, surpass. The S is the same, service cost, always a plus. I, interest on PBO, always a plus. R, return on plan assets, always a minus. If it's a return, if it's an actual return, it's a minus. P, prior service cost amortization, a plus. Actuarial gain or loss, gain is good for you, it's a minus. Loss is bad for you, it's a plus. So the only difference, it's all the same. SIRPA is all the same as US GAAP. The difference in IFRS, the last element is not transition asset or obligation. The last element is settlement or curtailment. Settlement or curtailment, this is some agreed upon settlement. It could be with a union, it could be with your employees, it could be a legal judgment, it could be a result of arbitration, but some agreed upon reduction of benefits. And it would be a minus, right? It would be a minus because it's good for the company, lowers the expense. So that's the difference in IFRS, that instead of SURPAT for the 6 elements, it's SURPASS. That last element now becomes settlement and curtailment. Some agreed upon settlement, some agreed upon reduction of benefits, and that's good for the company, so it's a minus unless it was a reversal of a settlement and curtailment. If it was a reversal of a settlement and a curtailment, it would be a plus. But I just don't think that the exam is likely to get into that. Another little picky difference with pensions. Now, you have to think back to the class we had on pensions. That actuarial gain or loss. Remember, if a company, let's say, had a $40,000 actuarial loss for the year, they don't just put, under US GAAP, you don't just put $40,000 in as the 5th element. Remember, there's a little calculation you go through. You look at 2 numbers. First, you look at the market-related value plan assets. I'm just going to make up some numbers. Let's say the market-related value plan assets is 100,000. Then you look at PBO. Let's say projected benefit obligation is 80,000. Those are the 2 numbers you have to look at. You look at the market-related value plan assets. Let's say it's 100,000, and you look at PBO. Projected benefit obligation is 80,000. Take the larger of the 2. Whatever number is larger, that's the number you use. So because the market-related value plan assets is larger, I'll use the 100,000, multiply by 10%. Why 10%? It's just a threshold in the opinion. You're supposed to multiply it by 10%. That comes out to 10,000. Notice the actuarial loss that I made up, 40,000, is greater than that 10,000 by 30,000. Under US GAAP, you take the difference. Again, the actuarial loss is 40,000. 10% of the market-related value plan assets is 10,000. So there's a $30,000 difference. Because the actuarial loss is $30,000 higher than that threshold, you would take that 30,000 and divide by the average remaining service period for the employees. Let's say that's 10 years. Let's say the average remaining service period for the employees is 10 years. You divide by 10, and you would put $3,000 as your 5th element. And it would be a plus because it's a loss. It's bad for the company. So it would be 3,000. The difference in IFRS doesn't go through all that. IFRS would just put the whole 40,000 in as the 5th element. I know you like IFRS better, but that's what IFRS would do. IFRS would just take the whole 40,000 actuarial loss as the 5th element. In the area of bonds, bonds are basically accounted for in IFRS just as they are in US GAAP, but there is a little difference you should be aware of, and it has to do with convertible bonds. Let's go to a problem. I'd like you to go to problems 20 and 21. Let's look at it together. It says on December 31, Charles Corporation issued $1 million of convertible bonds at 106. On the same day, Charles issued bonds without any conversion feature for 98. Now, question 20 says, under US GAAP, what amount would Charles record as discount or premium on the issuance of the bonds? Well, here's the entry in US GAAP. In US GAAP, Charles goes out and sells $1 million worth of bonds at 106. And Charles would debit cash $1,060,000. Charles is going to debit cash $1,060,000. Charles would credit bonds payable for the face amount of the debt, $1 million, and credit premium on bonds, $60,000. Answer B. Answer B. In other words, notice, even though this is a compound instrument, convertible bonds are a compound instrument. It has elements of debt and elements of equity. Under US GAAP, when you issue convertible bonds, you don't try to separate out the value of the conversion feature. You don't try to separate the debt component from the equity component. Under U.S. GAAP, you basically just treat it as an issuance of debt. So you would debit cash for $1,060,000, credit bonds payable for the face amount of the debt, $1 million, and credit premium on bonds, $60,000. That's why the answer is B. Now, number 21 says, under IFRS, what would Charles record as discount or premium on the issuance of the bonds? Well, under IFRS, all compound instruments must be divided up into their debt and equity components. See, that's the difference. This is a compound instrument. It has elements of debt and elements of equity. And under IFRS, all compound instruments must be divided up into their debt and equity components. So here's the entry in IFRS. Charles goes out and sells $1 million worth of bonds at 106. So they would debit cash $1,060,000. Credit bonds payable for the face amount of the debt, $1 million. But now you'd look at it this way. You'd say, well, if on the same day Charles issued bonds without any conversion feature for 98, that difference between 98 and 106, that 8% difference, must be the value of the conversion feature, the equity component. That gives you an objective basis to value the conversion feature, the equity component, the difference between bonds without a conversion feature, 98, and bonds with a conversion feature, 106. That 8% difference is a reasonable way to value the conversion feature. So we're going to take that 8% difference times $1 million and credit additional paid-in capital, $80,000. Notice I took that 8% difference times $1 million and credit additional paid-in capital, $80,000. And now the entry doesn't balance. I need a $20,000 debit to balance the entry out. That's a discount on the bonds. The bonds actually sold for a discount. When you back out what really came in for the equity component of the instrument, the bonds really sold for a discount of $20,000, and the answer is A. Just remember, under IFRS, all compound instruments must be divided up into their debt and equity components. Let's talk about deferred taxes. Now, I'm sure you're aware that under U.S. GAAP, we account for temporary differences using the liability method. Well, that's true in IFRS as well. Under IFRS, we account for temporary differences under the liability method, but there is a little difference here in the liability method. Let's go to problems 22 and 23. Go to 22 and 23. It says, at December 31, Barron, Inc. is reporting the following deferred tax assets and liabilities. They have a current deferred income tax asset with France, $25,000. A non-current deferred income tax liability of $100,000 with France. A current deferred income tax liability of $35,000 to Germany, and a non-current deferred income tax asset of $60,000 to Japan. Number 1 says, under U.S. GAAP, how would these assets and liabilities be reported on the December 31 balance sheet? Well, see if this rings a bell. Remember, under U.S. GAAP, we are required to report on the balance sheet for deferred tax assets and deferred tax liabilities the net current amount and the net non-current amount. That's U.S. GAAP. Under U.S. GAAP, on a balance sheet, the way we report deferred tax assets, deferred tax liabilities, is to report net current amount, net non-current amount. So in U.S. GAAP, notice I have two current items. I have a current deferred tax asset of $25,000 to France, a current deferred tax liability to Germany of $35,000. I would net the two. They're both current. Since they're both current, I would net them, and I'd record a net current deferred tax asset of $10,000. Look at answer B. Do you see why I'm going to have a current deferred tax asset, a net current deferred tax asset of $10,000? Excuse me, a net current deferred tax liability of $10,000, because I net the current amounts. I have a current deferred tax asset of $25,000 to France, a current deferred tax liability of $35,000 to Germany. I net them. It's a net current deferred tax liability of $10,000. Now, how about the non-current? I have a non-current deferred tax liability with France of $100,000, a non-current deferred tax asset with Japan of 60. They're both non-current. I net them, and again, the answer is B. I end up with a net non-current liability of $40,000 because that's made up of the non-current deferred tax liability to France and the non-current deferred tax asset to Japan. I can net them. They're both non-current, so I end up with a net non-current liability of $40,000. That's U.S. GAAP. On a balance sheet for deferred tax asset and deferred tax liabilities, we are required to report net current amount, net non-current amount. Now, number 23 says, under IFRS, how would these assets and liabilities be reported? Well, I already know it's answer D. Why? Because under IFRS, all deferred tax assets and liabilities are non-current. I'll say it again. Under IFRS, all deferred tax assets and deferred tax liabilities are non-current. There's no current deferred tax assets and liabilities in IFRS. Under IFRS, all deferred tax assets and liabilities are non-current. Now, if you look at answer D, I already know it's D because it's 0 under current, which is, that tells me it has to be D. But can I net the non-current items? You can net the non-current items. In other words, if you have a non-current deferred tax asset and a non-current deferred tax liability, you can net them only if they're to the same taxing authority. Again, if you have a non-current deferred tax asset and a non-current deferred tax liability, you can net them only if they're with the same taxing authority. So if you look at this, for France, that current deferred tax asset of $25,000 now would be non-current. For France, I have a non-current deferred tax asset of $25,000. Again, that would now be non-current. I have a non-current deferred tax liability of $100,000 to France. Since they're both to France, they're both to the same taxing authority, I could net them and show a net non-current liability of $75,000. Then I also have the liability to Germany, that's non-current now, and a non-current deferred tax asset with Japan, $60,000. So just to point out that all deferred tax assets and liabilities are non-current in IFRS, and if you have a non-current deferred tax asset and a non-current deferred tax liability, you can net them in IFRS only if they're with the same taxing authority. If you look at question number 24, 24 says under IFRS, which of the following statements is true? Look at A. Deferred tax assets and deferred tax liabilities are calculated under the liability method. That is a true statement. You know, both U.S. GAAP and IFRS does use the liability method. Look at B. B says deferred tax assets and liabilities must be separated into current and non-current. No, that's false. There's no current deferred tax assets and liabilities in IFRS. C says a deferred tax asset from France can be netted against a deferred tax liability from Germany. Not the same taxing authority. That's not true. And then D says future tax rates cannot be used if they're only substantially enacted. No, they can be. Under IFRS, as long as the tax rate is substantially enacted. You know, all over but the shouting. All over but the final signature. You can use the future tax rate. The last topic we're going to get into in terms of the differences between U.S. GAAP and IFRS is consolidations. And you'll be happy to know that both U.S. GAAP and IFRS uses the acquisition method to prepare consolidated financial statements. So there's no difference there. Both U.S. GAAP and IFRS, they both use the acquisition method in preparing consolidated financial statements. But there is one little picky difference, and I think the only way to understand it is to go to a problem. So I'd like you to go to 25 and 26. It says, on December 31 of the current year, Pastor Corporation purchased 80% of the outstanding shares of SNAC for $1.1 million. On the purchase date, the book value of the sub's net assets equal to $1 million, the fair value equal to $1.2 million. This business combination, like all business combinations under U.S. GAAP or IFRS, is accounted for under the acquisition method. Now, number 1 says, under U.S. GAAP, what would be reported as goodwill and what would be reported as the non-controlling interest? Well, it's a good little review for us. I hope you remember how to do this. How do I figure out the goodwill? Well, I basically set up a formula. I say, well, if the parent bought 80% of the stock for 1,000,001, I set up my equation. I know that 80% of X, 80% of all the substock, X, must be worth 1,000,001. Then whatever I do to one side of an equation, I do to the other. So I divide both sides by 80%. And if you divide 1,000,001 by 80%, it comes out to 1,375,000. That tells me X, 100% of the substock, must be worth 1,375,000. So that's the point. If someone had purchased 100% of the sub shares, they would have had to pay 1,375,000 for net assets worth 1,002,000. I look at the fair value of the sub's net assets on the day of purchase, not the book value. So if someone had purchased 100% of the sub stock, they would have had to pay 1,375,000 for net assets with a fair value of 1,002,000. So total goodwill in this acquisition comes out to 175,000. Look at answer C. There's the goodwill. Remember, one of the objectives of the acquisition method is to record the goodwill at its full fair value. Now, another objective of the acquisition method is to record the non-controlling interests at its full fair value. And now we can figure that out too. Because now we know that if someone had purchased 100% of the sub stock, they would have had to pay 1,375,000. What percent of those shares do the non-controlling interest shareholders own? 20%. Parent owns 80%. The non-controlling interest shareholders own 20%. A 20% interest in 1,375,000 is worth 275,000. Again, it's answer C. So under the acquisition method, the way it's applied in U.S. GAAP, goodwill would be 175,000. The non-controlling interests would be 275,000. Because that's the objective of the acquisition method, to record the goodwill at its full fair value and record the non-controlling interests at its full fair value. Now, number 26 says, under IFRS, what would be reported as goodwill and non-controlling interests in the consolidated balance sheet at year end? Well, the answer is D. There is a difference here. Notice under IFRS, you can use the same approach we use in U.S. GAAP. We can record goodwill at its full fair value, which is, as we now know, is 175. We can record the non-controlling interests at its full fair value, which we now know is 275. That's perfectly acceptable under IFRS. Or under IFRS, you can elect to record just the parent share of goodwill. That would be 80% of 175 or 140,000. Again, under IFRS, you can elect to record only the parent share of goodwill. That would be 80% of 175,000. Notice you're not going to record goodwill at its full fair value. You can make an election to just record the parent share of goodwill, which would be 80% of 175,000 or 140,000. And you can elect, and you have to be consistent, if you elect to do that, you would also elect to record the non-controlling interest for just its share of identifiable assets. In other words, non-controlling interest will not get any share of goodwill, because when you record just the parent share of goodwill, now you're going to record non-controlling interest just for its share of identifiable assets. Now, the fair value of the sub's net assets is that 1,002,000, right? The fair value of the sub's identifiable assets, 1,002,000. Non-controlling interest shareholders own 20% of those net assets, or 240,000. You see why it's answer D. In other words, in that approach, non-controlling interest isn't getting any share of goodwill. You're only recording the parent share of goodwill and only recording non-controlling interest for its share of identifiable net assets. So that's one very picky difference between how the acquisition method is applied in IFRS as opposed to how it's applied in U.S. GAAP. Because in U.S. GAAP, we always record, in the acquisition method, we always record the goodwill at its full fair value, and we always record the non-controlling interests at its full fair value. When we're talking about SEC reporting, we're really discussing the Securities Acts. The Securities Acts of 1933 and 1934. Let's talk about the Securities Act of 1933. The Securities Act of 1933 relates to IPOs, initial public offering of securities, IPOs. And the purpose of the act is to provide investors with full disclosure relating to any initial public offering of securities. That's the purpose of the act, to provide investors with full disclosure relating to any IPO. any initial public offering of securities. And of course, the purpose of the act is to prevent fraud and misrepresentation related to an IPO. And if you fail to comply with the act, which I wouldn't recommend, if you fail to comply with the Securities Act of 1933, there are civil penalties, fines, and criminal penalties. You go to jail. You just can't do this. All right, so how do you comply with the act? Because if you don't comply with the act, you're subject to civil penalties and also potential criminal penalties. The way you comply with the act is that before any IPO, before an initial public offering of securities, the corporation must file a registration statement with the SEC. You cannot offer securities to the public before you file the registration statement. It's that simple. That's how you comply with the act. You have to file a registration statement with the SEC before any IPO. And you cannot offer securities for sale to anybody until you file the registration statement. And you can't sell securities until the effective date, which is always 20 days after the filing. You can't sell securities until the effective date, which is always 20 days after the filing. Also, you are required, when you have an IPO, you're required to provide a prospectus to all potential investors. That's required as well. Now, some securities are exempt from the Securities Act of 1933. Commercial paper, securities only sold within one state, intra-state securities are exempt. So there are some securities that are exempt. But usually if there's an IPO, before there's an IPO, you have to file a registration statement with the SEC. That's to comply with the Securities Act of 1933. Now, the Securities Act of 1934 applies to subsequent trading of securities. In other words, the purpose of the act is to federally regulate all securities that are traded over the counter in interstate commerce. That's the purpose of the act, to federally regulate all securities that are traded over the counter in interstate commerce. Any security that's traded in any national stock exchange is regulated by the SEC through the Securities Act of 1934. Even if a security is exempt under the 33 Act, it still is regulated by the Securities Act of 1934. Now, some securities are exempt from the Securities Act of 1934. Some securities are exempt, obligations of the U.S. government, treasury bonds, municipal bonds. There are some securities that are exempt, but almost all securities traded over the counter in any national stock exchange are regulated by the SEC. And if you fail to comply with the act, there are severe civil penalties. So how do you comply with the act? Well, the way you comply with the act is by following reporting requirements. All right, but first of all, who has to meet these reporting requirements? Well, the reporting requirements apply to companies that sell securities to the public after an IPO. And as I may have mentioned, even if you somehow were exempt under the 33 Act, you're still governed by the 34 Act, because you have to comply with the Securities Act of 1934. You have to comply with reporting requirements if you're a company that's now selling securities after an IPO. You also have to comply with the Act. You have to meet the reporting requirements if your stock trades in any national stock exchange. And then finally, even if your stock does not trade over the counter, if you're a corporation with assets greater than 10 million and 500 or more shareholders, even if the stock does not trade over the counter, but if you're a corporation with assets greater than 10 million, 500 or more shareholders, you also have to meet these reporting requirements. All right, so what are the reporting requirements? Well, first of all, you have to file the 10K. The 10K is the annual report. It's a comprehensive overview of a company's business and financial conditions. That's the 10K. And the 10K is due within 90 days from the close of the fiscal year. You know, the exam loves due dates. The 10K, the annual report, is due within 90 days from the close of the fiscal year. Now, the 10K includes financial statements audited by a CPA. It's expensive because the 10K includes audited financial statements by a CPA. It includes a management discussion and analysis, a risk factor section, and also any potential legal proceedings. Then there's the 10Q. The 10Q is the quarterly report filed with the SEC. This is due within 45 days from the close of a quarter. 45 days from the close of a quarter. Now, the 10Q includes quarterly statements reviewed by a CPA. Not audited, but reviewed by a CPA. It's less detailed than the 10K, but it does have to be reviewed by a CPA. Now, there are 3 10Qs filed every year, and then the 4th 10Q is included in the annual report, the 10K. Then there's the 8K. The 8K is for extraordinary transactions. If you change auditors, again, the 8K, Form 8K, extraordinary transactions. So if you replace your auditor, you replace the CEO, you replace the director, mergers, acquisitions, you know, material events. And the 8K is due within 4 days from the actual event. And then finally, you should be aware of what Regulation SX is. Regulation SX regulates the form and the content of all financial statements filed with the SEC. That's Regulation SX. It regulates the form and the content of all financial statements filed with the SEC. So when you go in the exam, just make sure you know what the 10K is, when it's due, the 10Q, when it's due, the 8K, when it's due, and Regulation SX. Please do questions 27 to 32, and then come back. Welcome back. Let's look at these questions together. Number 27 says the law that requires issuers of securities making public offerings for sale to register with the SEC. What law requires a registration statement? Answer A, the Securities Act of 1933. Number 28, which of the following is the principal accounting regulation of the SEC? Regulation SX. Remember, that regulates the form and the content of all financial statements filed with the SEC. 29, which of the following is a true statement relating to the responsibility for full, fair disclosure in an SEC registration statement? A says it is the SEC's responsibility to ensure full and fair disclosure. No, it's not. No, it's not. That's not their responsibility. It is the company that's going to issue the securities. That's their responsibility. B, if important information is omitted from a registration statement, the SEC will not request an amendment. Oh, no, they will. C, once a registration statement has become effective and securities have been sold, the SEC has no recourse if the registration statement turns out to have omissions. No, they file a stop order, and that's why it's answer D. But they certainly have things they can do. D says if a registration statement does not adequately disclose all material facts, the SEC may issue a stop order. And that'll be that. Number 30. A company is an accelerated filer that is required to file a 10K with the SEC. What is the maximum number of days? Well, a non-accelerated filer is a corporation that has less than $75 million of securities in active trading. You know, what they call public float. That would be a non-accelerated filer. Again, has securities actively trading less than 75 million, what they call public float, actively trading less than 75 million. That's a non-accelerated filer, and they have to file the 10K within 90 days from the close of the year. An accelerated filer is a filer that has a public float, securities actively being traded of at least 75 million, but less than 700 million. That's an accelerated filer. It's a corporation that has, actively trading securities, public float of at least 75 million, but less than 700 million. And they have to file within 75 days from the close of the year. So the answer is B. It's an accelerated filer. And then you have a large accelerated filer. That's with securities trading more than 700 million, a public float of more than 700 million, and they have to file their 10K within 60 days from the close of the year. But this is an accelerated filer, 75 days. Answer B. 31, the SEC required form used to report extraordinary transactions, major events, that's the 8K. Answer B. 32, who must generally register with the SEC under the 33 Act? How about A, securities sold in the United States unless they're exempt from registration? That's pretty much it. All securities sold in the USS, all securities sold in the United States unless they're exempt from the registration requirement. That concludes our discussion of the SEC reporting requirements and also the differences between US GAAP and IFRS. And from all of us at Bisk CPA Review, we want to wish you the best of luck on the CPA exam. Do a great job.